ended almost 1% or so higher as far as the week is concerned. Now, what happened in Asia is also quite similar. Hang Seng was up almost 1.5%. The Kospi too closed the week with good gains of around 3%, but it was the Nifty that actually underperformed most of the global as well as the Asian indices. Nifty closed with a loss of almost 0.8%. Now, the market fell for the sixth straight week. This is the longest losing streak that we've seen since 2020. And, the cumulative loss that Nifty has posted over the last 6 weeks is almost 5%. The broader markets too continued to underperform. As far as sectoral indices are concerned, the fall was largely led by Nifty Pharma as well as Nifty Realty. Both of these indices were some of the top losers last week, and PSU banks on the flip side were the top sectoral gainers. Now, as far as today is concerned, and in fact this week is concerned, there are a couple of economic cues that we need to watch out for. August 12th, we'll be keeping an eye out on India's CPI as well as US CPI data. August 14th, India's WPI and US PPI will also be something that we'll be watching out for, and this is a truncated week because August 15th will be closed for trading on account of Independence Day. Lots of earnings lined up today. Astral, BML, Krishna Diagnostics, Som Distilleries, Tilak Nagar Industries, Titagarh Rail Systems. As far as today's earnings reaction are concerned, we'll be watching out for Tata Motors, Siemens, Voltas and Manappuram Finance. These counters will be reacting to their numbers. Keep in mind, Bluestone Jewelry will also be opening. The IPO will be opening for subscription. That is another thing that we'll be watching out for. The Gift Nifty will also come up for you on the screen. It was indicating a flat start for today's trading session now with a slight negative bias.
Okay, Mamakshi, thank you so much for that. So, slight bit of a negative bias over there for the Gift Nifty. But let's move on to Gaurav, who's waiting by to tell us which are the important stocks that we should be keeping on our radar this morning. Good morning, Gaurav.
Well, good morning. When we look at the weekend, it was not a pleasant weekend when we talk about earnings, because let's talk about Voltas first. Revenue declined almost by 20%, while profit declined almost by 58% on a year-on-year basis. So a weak set of number here. Other than that, Siemens also came up with weak set of numbers. EBITDA margin that came in at around just 12% versus estimates of 12.3%. And when we look at profit, that also declined almost by 3% on a year-on-year basis. Tata Motors, mixed set of number is what we saw. Revenue declined almost by 3%, while EBITDA margins declined to around 9.3% versus what it was at 14% just a year ago in the same quarter. Manappuram Finance also came up with weak set of numbers. Net profit that declined almost by 76%. In fact, numbers were expected to be weak, but operationally this was a weak quarter for Manappuram because net interest income that declined almost by 14% on a year-on-year basis. Power Mech on the other hand, actually, there we saw good set of numbers. Revenue increased almost by 28%, while profit increased almost by 30% on a year-on-year basis. Other than earnings, there are few candidates who will be on our radar. First is ICICI Bank, because now bank has raised its average minimum balance for savings account in metro and urban areas to 50,000 versus what it was at 10,000 rupees. Shilpa Medicare, now this company is also going to be on our radar today, and this is because CDSCO, which is one of the Indian drug regulator, has given approval for NOR-UDCA drug. Now, this drug is used for fatty liver disease, and this company is actually the first of its kind to launch this drug. Other than that, OMCs are going to be in focus because government has approved 30,000 crores of compensation for LPG under recoveries. Jefferies estimate that this can actually give upside of around 29 to 42% on EBITDA. And lastly, let's also focus on Home First because there's going to be a block deal today, and indicative price is going to be somewhere in the range of 1,143 to 1,202 rupees per share.
Okay, Gaurav, thank you so much for that. Important stocks to keep on our radar this morning. Finally, we have Mangalam, who's here to tell us what are the important cues that we should be watching out for in the world of FNO. Good morning, Mangalam.
Good morning. So 6 consecutive weeks of a downtick for the frontline index. So there's no two ways that, there has been a fair amount of bearishness from the FIIs in the FNO space itself. The question is for what time period and for how long? So it was a near 1% decline that we saw on Friday. In fact, the Nifty ended close to the day's low, and that day's low was much lower than what we thought in the first part of trade, and pretty close to what we saw on August 7th as the day's low as well. So between 24,350 to 24,300 is where the market has been making these lows. On the cash market, though, we saw purchase from both DIIs and FIIs to the tune of almost 10,000 crores put together. But the answer to that is because, Bharti Airtel, there was a large trade that day. So as a result of which, there was that big institutional buying. No, support coming in from the FIs in index futures. They sold another 1,800 crores, added 10,000 short contracts. And in doing so, their net contracts are now at just 8.3% long and nearly 1.8 lakh contracts on the short side. So that scheme of FII holdings comes up for you on the screen. On the other hand, it's the clients, the retail HNIs of the country who are on the long side, 70% long exposure, plus 1.24 lakh in terms of long contracts. But the put-call ratio on Friday after that decline has gone back to near oversold levels of 0.66. So we'll have to watch out for whether there is a bounce in the frontline index or not. 24,500 is the call, which is extremely active, as is the 24,600 call, telling you that there is strong supply at higher levels, closer to 25,600 to 25,650. And at the lower level, though, the next leg of support we're looking at is 24,200, because that's where a lot of the put writers are at 24,300. On the way up, we have to look at the 100-day moving average. On the way down, were we to break this 24,200 zone, we will have to look at the 200-day moving average as the last leg of support. In terms of stocks, Kalyan Jewellers saw a lot of short positions being added on Friday. And RBL Bank, we had alluded to the possibility of that bank entering F&O ban. That's exactly what's taking place.
Okay, Mangalam, thank you so much for that. But let's move on. And now the cabinet has cleared 30,000 crore rupees as cash compensation to oil marketing companies for LPG under recoveries. The payment will be made in 12 tranches until FY27. The government has also reduced the number of subsidies LPG cylinders under the PM Ujjwal Yojana. We have Sapna Das, who is here to give us those details and what was the decision, what came in from the cabinet.
Well, the important part is that the rupees 30,000 crore worth of LPG compensation that goes to the OMCs, that is going to be paid in tranches. The government has indicated very clearly it's going to be in 12 tranches. So probably 6 tranches in this year and 6 tranches in next year, which means that 15,000 crores is going to be paid this year, and the residual 15,000 crores in FY27. Now, for those 15,000 crores to actually flow out immediately, and this is something that we had indicated earlier in the day, that the amount is going to go in tranches, the compensation is going to be paid in tranches. So having said that, most likely the approvals will be taken to withdraw the sums from the contingency fund. And once the supplementary demands for grants comes up in the winter session of Parliament, the Parliament approval is going to be taken for that 15,000 crore worth of withdrawal for the current year. And for next year, the amount probably is going to reflect in the FY27 budget estimates itself, so it will be clear right from the beginning. That's one aspect. The second also, a very important update in terms of the PM Ujjwala Yojana. As per the cabinet decision, the number of subsidized cylinders under the scheme have now been reduced from 12 to 9. There is a 300 rupees subsidy per cylinder under the Ujjwala scheme. The number of cylinders have been reduced because we have been given to understand this is basically to plug duplication or leakages or to prevent frauds. People have been trying to game the system. So this is basically to protect it from that end. The amount of subsidy remains unchanged, but the number of cylinders will come down.
Okay, Sapna, thank you so much for giving us those important updates there. But on that note, we're going to slip into a very short break. When we come back, we'll get you all the global market action on the other side. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now getting you the latest on India-US trade tensions. The Parliament Committee on the Foreign Affairs is set to meet today to discuss the negotiations and tariffs. What are the details? What are we watching out for today? We have Pariksha joining with us this morning. Good morning.
Well, yes, India has begun an outreach not just with the US, but with its domestic audience as well. And the reason why the Parliamentary Committee on Foreign Affairs meeting today is important is because this will give our parliamentarians a sense of what's happening in the India-US trade negotiations. So you have top officials like Foreign Secretary Vikram Misri, Sunil Bartwal, the Commerce Secretary, who will be appearing before the Parliamentary Committee to give a briefing on the India-US trade negotiations and the tariff impact on India. So this will be critical in building a narrative and opinion among our parliamentarians in New Delhi. Secondly, India has also initiated an outreach with top Republican politicians. For example, India's ambassador to US, Vinay Quatra, spoke to Senator Lindsey Graham last week, and this was about increasing US-India energy trade and India's energy security. Graham, if we remember, is the Republican politician who had said that the most consequential thing that India could do to improve ties with the US is to help President Trump end the bloodbath in Ukraine. He had also previously said that countries like India and China who buy oil from Russia should get a 100% tariff because they're funding the Ukraine war. So let's see how things pan out on that front. But overall, sources tell us that when it comes to India-US energy trade, over the last few days, India has been conveying to the US its perspective on energy security and how India is increasing energy purchases from the US, and this is being conveyed to multiple people in the US administration. India has conveyed that India's crude oil purchases from the US have increased by over 70% in 2025 and will increase further. Just one more point that is very important to watch out for is the Trump-Putin meeting in Alaska on the 15th of August. India has welcomed the meeting, and they've said this meeting holds the promise of ending the ongoing conflict in Ukraine and opening the prospects of peace.
Okay, important updates coming in there. Even till 15th of August, we'll wait out for that meeting of US President Donald Trump with Putin as well. But what happened in the US markets on Friday is that they ended the week with a solid gain led by the tech sector, and that is why we saw that the Nasdaq closed at a record high, rising nearly 1% in Friday's trading session. While what we saw for S&P 500 and Dow Jones, also we saw a significant gain to close higher. Both of them managed to close with gains of more than 0.5%. But let's talk about some more updates coming in from the US. We have, after the Federal Reserve Chairman, that is Adriana Kugler, stepped down from her role, US President Donald Trump selects one of his trusted guides, that is Stephen Miran, as a temporary replacement. Now, former Federal Reserve Governor Randall Kroszner also believes that the Fed will cut rates by the fall, and regardless of the governor, whoever is there, listening to what is he had to say.
Chris Waller has made it clear that he sees very little impact of the tariffs and would be obviously dissented at the last meeting, so he's ready to start to cut. I do think that the Fed, regardless of whether Kugler had continued to be there or Myron's going to be there, would start cutting this fall, because I think they see a weakening labor market, and so far at least the impacts of the tariffs have been quite muted. So I think we are going to see lower short-term rates. Certainly by the end of the year.
Okay, on that note, we're going to slip into a very short break. We'll get you the cues in the world of commodities after the break. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now we have Manisha Gupta who's joining in with us to tell us what to watch out for in the world of commodities. Good morning, Manisha. What are we watching out for this morning?
Morning, Vinny. Thank you for that. Well, I'll start with the crude oil prices where we've seen 4 to 5% of a decline in the previous week. And the crude oil prices in Asia also have continued to decline today. We are trading at a 2-month lows right now. All eyes on the U.S. and Russia presidents, which are slated to meet in Alaska on 15th of August, with an expectation that while U.S. is pushing for a ceasefire, Russia is going to be demanding territorial concessions. And then, of course, there are threat over secondary sanctions on Russia energy trade partners as well. So not just Russia, but many of these trading partners, including India, are looking out for this meeting. If you look at the natural gas prices, well, we've seen a decline onto that one as well. It's down by nearly 5% in the previous week, has started this week on a lower note as well. So while energy continues to be on the weaker side, it is the gold prices which also are looking at consolidation right now. There is ease in geopolitical concerns. The gold markets also are looking at the U.S. and Russia meeting. Silver, in the meanwhile, did gain 3% in the previous week, holding above $38 an ounce at this point in time. Markets also are awaiting clarification from U.S. on tariff policy on gold bars. Remember, there was a lot of confusion in the previous week, which is expected to be cleared in this week right now. Having said that, there's just so much data coming in this week. You have the U.S. inflation numbers, U.S. Fed Reserve Jackson Hole Symposium, and then the markets also are looking at the August 12th deadline for the U.S.-China tariff truce. So promises to be a very volatile week, this one.
Okay, a volatile week maybe is what we are bracing ourselves for. Thank you so much for that, Manisha. Keep an eye out on those commodities over there. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming to you live from the CNBC TV18 Motilal Oswal studios. Monday morning, lots to talk about. Hopefully better things as compared to what we've had over the last few weeks now. I'm Prashant, with me my colleagues Surabhi and Nigel. Guys, good morning.
Hi guys, morning. Hope you all had a good weekend. Hope our viewers had a good restful weekend as well. What's been really amazing over the weekend is the number of memes on politics that are out on social media. Those AI generated videos on who's meeting whom, who's going where, who's dining with whom. Very entertaining, but also very important to track, actually, even from a market perspective.
Well, that's right. It was Raksha Bandhan over the weekend as well, and that as well got a share of memes, right, with regard to the political angle as well. But our markets have been a little bit under the weather. Things have been looking a little bit gloomy. Let's hope that this week is better than the last 6.
Absolutely. By the way, you said talking about those memes, right? AI generated. Did you guys see that? There was this meme about, there were bunnies jumping on a trampoline. Did you guys see that?
No,
it went absolutely viral.
Yeah.
For about a week it went viral, and it looked like, some hidden cam had recorded it at night. This was in the night in the US, I think. And a week later, people realized that it was AI generated. I think this is one of those things which tells you where we are headed.
Yeah.
It took a week. And then, somebody came out and said, well, this is AI generated. So I think, the lines between reality and what is, of course, generated content out there.
Prashant, you almost had me out there because, just this morning, I was jumping on the trampoline for around 2-3 minutes, and then I was like, did Prashant know that it was the bunny?
I got a cam right there. But anyway, you should check it out if you've not. YouTube, check it out. Anyway, let's just take it from the top, right? In terms of what you need to know as we begin a new session. And I think, and I may be completely sort of off the mark here, but maybe this is a better week. This is a better week starting maybe tomorrow, day after. It's a holiday shortened week. Friday is a market holiday because it's the 15th of August, Independence Day. And why do I say that perhaps, leading up to that Friday, which is a holiday here in India, things perhaps get a little better. The US President Donald Trump will meet with Russian President Putin on Friday in Alaska. And this is with regards to both trying to negotiate an end to war in Ukraine. Remember, Ukrainian President Zelensky has already warned that Ukraine will not cede any territory to Russia. So he's saying, well, any agreement which is signed without us there, without Ukraine there, is moot. It won't matter. But the stakes are really high. You've got leaders of both countries meeting in Alaska. It's like a peace summit. And both sides, especially President Trump, would like to walk away from that summit with something concrete in his hands, right? An agreement of some sort. And I think that is the reason why this becomes the single most important talking point, news point for the market as we look ahead. And that is the reason why I'm saying, and this sort of connects to the positioning in the market, which is extremely short. And I think some 1.8, 1.9 lakh contracts short, 35,000 crores worth index shorts in the system. So, ahead of a big summit like this, I think you will have some nervousness. Just look at what's happening with gold prices this morning. They're down about 1.5%, oil, etc. So I think you will have some nervousness. Shorts will be nervous going into that Friday. What if, there is a resolution and end to the war, which is struck. It's been going on for 3 years now. And of course, I don't need to explain, but if that war goes away, Russian sanctions go away, and of course, that 25% ad hoc tariff on India, also perhaps we start to see some relief. So India has, by the way, welcomed the summit between United States and Russia. And India will hope that a peace deal means India will also see tariffs and other sorts of relief. So in a way, it's what it is, but our situation here with those 25% additional tariffs which were imposed because we buy Russian oil, military hardware, etc., is tied to what US does with Russia in that sense. And that's the reason why this is important in that sense. Okay, just a couple of other things. So US-China trade standstill, that also expires on the 12th of August. There are some headlines which say that that could be extended for another 90 days. We'll see. US equities rallied on Friday. Nasdaq, by the way, was up 1%, set a new all-time high. And the narrative in the US seems to be very simple, that AI, productivity and profitability are more important than tariffs. And this has been true for some time. And of course, I mean, the other narrative is that there will be weakness because of these tariffs in the second half, but there will be Fed rate cuts, which will take care of that. So this is the two kind of, main threads, a US market narrative, which is underpinning the entire thing there. Last week, just look at the sort of price action, right? Nasdaq 4% higher. You have the MSCI Asia Pacific Index, which was up 2 points. So, by the way, US did well. Asia did very well. India was down 0.8%. And that's extremely stark out there. Since last October, by the way, MSCI India has underperformed the MSCI World, and this is in dollar terms, by 20%. That's a massive underperformance that we've seen. And, there is, of course, I started with the summit in Alaska, but I think, tariffs are 50%, FIs have sold over $10 billion, $12 billion, YTD. And, of course, I mean, you start to wonder, are we near peak fear levels? By the way, only 2% of MSCI India total revenues come from good exports to US. It's not unknown data. This is very well known. But the thing is, I mean, it's what comes first, right? I mean, if this gets resolved on Friday with a peace deal between Russia and Ukraine, negotiated by US, you don't have to wait for 20 days. Otherwise, I mean, there is this 20-day negotiation window when this additional 25% tariff takes effect. So, sentiment, of course, overhang will persist unless something happens before on Friday. I'll just leave you with the levels. Nifty support 24,243, and then, on the downside, 23,800 and 23,900. These are the two kind of levels which you should watch from here. For the Nifty Bank, support stands at in the range of between 54, it's a gap area, 54,442 to 54,054. So this is the gap area where the Bank Nifty should find some support. But I mean, the way I would think about it is that over the next couple of days, because the positioning is so massive on the short side, you start to see some covering into that Friday event. And Friday you can't trade because the markets are shut. So whatever comes out of it, you'll only be able to react to on Monday. GIFT Nifty will give you a quick sense of how we're likely to start, and we'll pick it up from there. It's absolutely flat in terms of the implied open. Surabhi.
Absolutely. Prashant, maybe some people like you and me always keep some track of global politics, but usually it's not, center stage or center court for the market. But the last, I think, 4 weeks has changed all of that, including, the statements that Mr. Munir made last night in the US on that visit. It's the second visit that he's made in the last 3-4 months since Operation Sindoor happened. And it was in full public display, the verbiage, the commentary on the nuclear threat, that if we are under attack, then we'll take half the world down with our arsenal, so on and so forth. So lots of rhetoric also coming in. Anyway, we'll see how this resolves. For today, we've got a mixed picture across Asian markets. Some of the markets like Japan are shut. It's all about the US-China trade negotiations. And in all probability, we had some overtures even last week from the US side that this 90-day pause window will probably be extended for China. So let's see how that goes. By the way, FT put out a very interesting story that's telling you how US companies have been finally allowed to send their chips and sell them in China again. It's coming on the back of what seems to be a 15% revenue share arrangement with the US government. So all the revenue out of selling those chips in China, 15% goes to the US government. That's how NVIDIA and AMD apparently have been allowed those sales. Anyway, now we talk about us within the Asian context, because we've had our own charted course, and it's been a course on the way down. The market is at a 3-month low, near 3-month low, the lowest levels that we saw since the 12th of May. And today we are on the 11th of August. So, 3-month lows for all practical purposes. Friday was disappointing because we had a sell day despite positive institutional flows. Look at the institutional flows on Friday. You had about 2,000 crores of buying coming in from the FIIs. Domestic institutions were buyers of cash equities worth over 7,700 crores. So it's telling you that the capitulation that happened over the last couple of days, specifically Friday, that's where HNI, some of the larger retail participants, they are now beginning to get a little worried, and they have contributed to the selling. Speaking of retail, today the MF data is going to be in focus. The monthly numbers will come in. And if you remember, Nilesh Shah of Kotak Mutual Fund told us on this very show last week that expect record equity flows for the month of July. But we have to wait and watch to see if retail is indeed keeping the faith beyond just the SIP numbers as well. Okay, now what next in terms of watching the India-US headlines? We have headlines coming in from the Commerce Minister over the weekend, Mr. Piyush Goyal. And he's again reiterating, obviously, the same stance that the Prime Minister took by saying that we will protect our farmers. He's saying that India will not kneel in front of anyone. And on that comment about India being a dead economy, which the US President made, he's saying we contribute 16% to global growth and we'll have our own trade negotiations with different trading partners beyond the US as well. So again, the stance of the Indian side seems to be that we're not going to back down. Just placing that on the table. Now let's come to some very interesting corporate developments as well, starting with ICICI Bank. What has ICICI Bank done? They're going up the premium curve, so to speak, because they've increased the minimum account balance requirements across the board. For urban accounts now, it's instead of 10,000, it's 50,000. For semi-urban, it's 25,000 versus 5,000, and even for rural accounts, the threshold has been increased from 5,000 to 10,000. So we'll see. Largely from a market perspective, this will be taken as positive because you deal with wealthier clients, so to speak, and basically it gets you a better bang for your buck. We'll see how the market reacts to it. Talking about the OMCs, watch for that because finally, as we've been reporting all along, this LPG compensation package has come through. It's a large package, 30,000 crores, maybe not covering the whole losses, but some amount has come through. Coforge fell very sharply on Friday, and the worry was what's happening to Saber's guidance, which is one of their key clients. Now, Coforge hasn't disclosed anything. They're saying there's nothing material to disclose right now. Nothing is impacting our finances. Let's see if the market gets convinced or not. It's an important stock, so watch for this. And finally, tracking weekend earnings. There are, I'm afraid, not too many positive headlines to report. The tail-enders are a little disappointing. Siemens margins are a miss. Tata Motors, there's weakness across the board on JLR or their other numbers as well. And Voltas, like PG Electroplast, is another completely washout quarter. By the way, we'll speak to PG's management as well. But short point, earnings not exciting, but there's lots of other news to look forward to this Monday. Nigel.
Well, the Nifty is on a 6-week losing streak. The bulls have their back against the wall, but I expect them to come in there and fight to save the 200 DMA. I think we'll see a better fight coming in from the bulls. And maybe, in fact, after the kind of sell-off that we've seen, maybe this week is a better one. And, if you look at the data points as well on the domestic front, power consumption, aviation data, movement of cement and steel, the FASTag numbers as well, just for the past 7 to 10 days, they are showing some kind of signs of improvement in terms of the domestic economy. Let's hope that sustains because that's the crucial data point that Trump's tariff tantrums will gradually settle down. So that's going to be important. What about the FIs? No prices progressing. They went ahead. They added short positions on index futures. They added shorts even on stock futures. So they continue with their shorting ways. And last week, at the start of the week, we were talking about them being net short with close to around 1.5 lakh contracts on the short side. Guess what? This week, we are starting the week with their net short contracts at around 1.83 lakh contracts. It's moving to that extreme level that we have seen in the past. And in percentage terms as well, the long positioning is only at around 8%, while you have the shorts at around 92%. So the short point is this market is heavily net short. When you have such a net short market and you have a big weekend coming up, big event lined up during the week, maybe the shorts will get a little bit nervous because they've seen a lot of follow through on the downside. But now, in case things go right, then in fact they could get stumped out. And there are 3 big cues that I look at. One is the FI net short positions. Well, in percentage terms, the highest we have seen since March 2023. The PCR has come down to that level. Normally at around 0.65, 0.6 is when you see that bounce that comes about because call writing has got too easy. So we're at that. And the relative strength index has come down to around 35. At around 30, that's when we get into the oversold zone. So put all these 3 factors together, you're expecting a bit of a bounce, and that could be due in the next couple of trading sessions itself after the kind of pullback that we have seen. The options data comes up for you, 24,500 call, 24,300 put, both of them seeing aggression. And just take a look at that. The 24,500 call writers, they're getting very comfortable. 85 lakh shares getting added out there. The premium is what they're eating into. Which brings us to the levels. Now, it's very, very important that the Nifty defends that 200 DMA. So that's the deeper support. You do on this level, the options data suggesting near-term support of around 24,200. So this zone is extremely important. Well, if the markets can get up, you'll want to get past the 24,500 odd mark because that's where the 100 DMA comes in at. So you'll want to get past that. But crucial that we defend this mark. The Nifty Bank, well, that's not broken all the technical levels, because at least as of now, it's still holding on to the 100 EMA. That's only 200 points away from current levels, but you don't want this to get broken decisively. So that's going to be important. And in terms of stocks that I'm looking at, well, I'm looking at Home First Finance because Nimesh should be joining in. There's a large trade that it's expected. Last 1 month, the stock, in fact, is down close to around 13% approximately. And, this is a clean-out trade, so we'll keep an eye out on that one as well. But various cues indicating that we're in an oversold zone. Maybe this week is better for the bulls.
Well, I think it should be, right? I mean, been a while since we've had a better week as compared to global markets. Nigel, thanks for that. We have Vikas Parishad, Portfolio Manager, Asian Equities at M&G Investments. Vikas, good to have you with us here this morning. Good morning. Just a quick word on the summit in Alaska on Friday. You think... there will be, of course, a lot of this. The summit is a summit, and there'll be the photo op and the all of that. But behind the scenes, I mean, I'm assuming both sides would try and figure out a solution for their leaders to sign upon, right? So you think we will see something concrete? Looks like it. I mean, if you're making a big show of it, a big effort, going all the way there, what should markets expect, Vikas?
Good morning, Prashant. I think something concrete should happen. India presumably will be part of these conversations. There's an impact to oil, there's an impact to various sectors that we're exposed to in India, but broadly, of course, as well. It's interesting that President Zelensky from Ukraine will not be there. It's for President Trump and President Putin. So we'll see, but all eyes on that, but all eyes on negotiations between the US and China as well, the US and India, of course. In early May, when the markets had rebounded and India was the first major market in the world to erase its post-Liberation Day losses, if somebody had told me that we'd be talking about tariffs that are higher on India than on China, that would not have been my base case. So a lot of surprises, but we remain very constructive on India. It's easier to be constructive on more constructive on Indian equities at these levels than back in May or even in September, but we were fully deployed in September at the end of last year. We were fully deployed in April and May. The constituency or the constituents of the portfolio have changed a little bit, but we remain very constructive on India for the long term.
That's good to know, Vikas. Hi, morning. Great to have you on the show. These days, it's probably, you can still try predicting markets, but predicting global politics, well, that's become another thing these days, right? Ever since Mr. Trump took office. Now, on that, just to conclude that point on whether this weighs on India, do you think the fact that there seems to be a rupture in the relationship and then, even diplomatically, militarily, trade, would that at all become a bit of a niggling issue for foreign investors looking at this market? Because it's not like we have 20% earnings to make up for any other gray areas. My short point is, will India's relationship with the US in the short term weigh on investors' mind?
So I think clearly the answer is yes. FIIs, it seems like for the past few months, have been looking for reasons to sell, whether it's India, Pakistan, or the Liberation Day tariffs, when there's uncertainty around that. Our view is the opposite, that this uncertainty, this volatility is creating a lot of long-term opportunities. Yes, we don't have the 15 to 20% top-line growth in aggregate, but it's still pretty healthy. What we've seen in the most recent earnings season, not done yet, there's still some companies to report, is that active management matters. There's a lot of dispersion within sectors. If you look at IT services or staples or healthcare or the automotive sector, a lot of dispersion, a lot of differential between the leaders and the laggards. So active management matters. Having a long-term view matters. But in the short term, clearly FIIs are voting with their capital and they're electing to put their money elsewhere.
Hi, Vikas. Good to see you. When the last time we chatted, we were talking about how India was the first market to bounce back. And now all of a sudden, we're getting the harder end of the stick from President Trump. But our markets have reacted a fair bit. I think in the past, there were a couple of sectors that you were quite positive in the Indian markets. NBFCs, defense. You had lightened some positions, though, out there. Currently, which is your top sector here in the Indian markets that you're looking at?
Our portfolio is diverse. If you look at our top 10 holdings, you'll see 10 different sectors represented. If there are some common themes, there are beneficiaries of manufacturing, direct manufacturing, not the EMS sector, where we have very little positioning. It's healthcare services, not so much pharma, diagnostics, hospitals, higher-end property, auto ancillaries, the derivatives of the automotive sector, two-wheelers in particular. There's defense as well. We had lightened up in defense a few weeks back because it had priced in quite a bit post-Operation Sindoor. but we've added some of that exposure back as these names have been selling off because the long-term story still remains intact. I would, just on this tariff situation, I would recommend viewers go back and watch the conversation with Mr. Tharoor from earlier this morning. He brought up a lot of good points. In the long term, India and the US need each other. I think both sides would agree or disagree on who needs the other more. But these are clearly going to be long-term partners.
Absolutely.
For political reasons, yeah.
Yeah. Since you mentioned Mr. Tharoor, just reminded me today, I think the Commerce Minister is also going to be briefing the Parliamentary Standing Committee on External Affairs, and Mr. Tharoor is leading that committee. So I think we'll have some more idea about where things stand. But thank you very much, Vikas, for your perspective this morning. Very, very helpful. Thanks for joining in. Well, with that, let's quickly tell you what else we've lined up for you. It's a packed next 2 hours coming up. Lots of interactions today at 9 a.m. We'll have Rohan Mandora of Aquarius Securities to talk about trends in the banking sector. What have we picked up from the first quarter numbers? At 9:20, Mihir Vohra joins in. He's our market master of the day. Then we get into a conversation with the management of Bluestone Jewelry and Lifestyle. They're coming out with their 1,500 crore rupee public issue. So they tell us more about their business. A little later at 9:50 a.m., we have Shweta Arya, Managing Director of Cummins India, to talk about the quarter gone by and, of course, the outlook ahead. Towards the end of the show in our special segment, Indianomics, Lata today discusses the impact of a key Supreme Court decision on the power sector with Alok Kumar of All India Discoms Association, Pradeep Kumar Pujari of the former Power Secretary of India, and Nikhil Nigania of Bernstein.
Time to slip in a short break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. We're looking at IOC, HPCL, BPCL, Lemon Tree Hotels and DOMS. All of them will be reacting to positive news flow on the flip side. We're split down the middle. Tata Motors, Siemens, Voltas, Manappuram and Home First Finance will be reacting to negative news flow. Get into that break, come back. We'll get into further detail on all of these names.
Welcome back. Let's quickly glance across Asia. Pictures are quite mixed across the markets over there. You can see not too much of a great directional cue coming in. Let's get the implied open up on the screen. Will there be any hope for the bulls, any respite from the non-stop selling that we've seen? Well, quiet. Let's see if we can build, start 15 points lower and then build on it going forward. There are lots of very interesting stocks in focus today on earnings and other news flows. So let's straight away get to our top 10 list. We've got Sonal kicking off the proceedings with OMCs, who finally have some relief on the LPG under recovery. Sonal, morning.
Oh yes, there's been a long wait for that, and finally the government has announced that there's a 30,000 crore compensation that they will be providing OMCs, and this is for FY26 and FY25 as well. This is of course lower than 41,300 crore for under recoveries that oil marketing companies have won till date. Also, it is not known whether this is the only tranche they'll be getting or they will be getting more than what they have received right now, but it will be done monthly over 12 tranches for these companies. Jefferies says that it is a big positive that has come by. They estimate an upside of 29 to 42% for their EBITDA for FY26, that is, and around 38 to 70% for FY26 PAT. Of course, this is assuming that all of this amount would come in FY26 itself for these companies. ICICI Securities says that it will be a material boost for their fortunes, and it will help offset all the margin worries for FY26 as well. So this is about oil marketing companies overall. Additionally, the government has announced that subsidized LPG cylinders under PM Ujjwala scheme will be cut from 12 to 9. So basically the 300 rupee subsidy that households were getting, that will be done only for 9 versus 12 cylinders earlier.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Reema. She's here to tell us about Tata Motors numbers that looked a little bit soft. Hey, Reema, morning.
Well, slightly soft on expected lines. There was a tariff impact. So revenues declined 3%. EBITDA was down 35%, with EBITDA margin coming in at 9.3%. So in single digits now, and profits are lower by 35%. But analysts are saying that broadly numbers are in line if you exclude the tariff impact, which was estimated at 3.8% of the Q1 sales. Now, in terms of commentary, the management says that JLR demand is healthy in the US, stable in UK, but weak in China and EU. The tariff impact they've calculated is 500 to 600 million pounds this fiscal year and 300 to 400 million pounds after that. The outlook, but despite a weak Q1, the company still maintained the EBIT margin guidance for JLR, which is between 5 to 7%. Now, the stock is down 14% since the start of the year. Valuations, according to analysts, are largely undemanding. And from here on, Sudarshan was saying, it's, this Q1 is muted on expected lines, but going forward, the festive seasons is going to drive, the sales is going to drive sentiment for Tata Motors. Back to you.
All right, Reema, thank you very much for that. So keep an eye out on this one. Siemens is the next one we want to focus on. Vamakshi is here with details. Vamakshi, morning.
Well, good morning, Prashant. When you look at Siemens, the revenue grew by almost 16%. The execution was better this time around, and the revenue has come in higher than what the street was anticipating. However, the operational performance was rather weak. Take a look at the other expenses. They surged by almost 40% on a year-on-year basis. This in turn led to the EBITDA margin contracting by around 90 basis points, and it came in almost 31 basis points lower as compared to the street's own expectations, and the net profit declined by almost 3% on a year-on-year basis, and that is because the other income also declined by 21%. So operationally, a weak set coming in from Siemens. Now, as far as segment-wise contribution is concerned, the growth largely this time around was led by mobility, which grew by almost 34%, and smart infra, which saw almost 21% growth. The digital industries this time around saw a degrowth of almost 5%, and low voltage motors were up almost 1%. So not great growth coming in for digital industries as well as low voltage motors. Now, as far as segment-wise margins are concerned, the sharpest drop in the margins was seen in the low voltage motors, which declined by almost 1,150 basis points. Good expansion coming in from mobility as well as digital industries. The ordering activity, though, this time around was up almost 13% on a year-on-year basis. This is higher than what most analysts were expecting. So, operationally, a weak set coming in for Siemens, going with the red for this counter.
Okay. All right. So, Siemens, not that great in Q1. Thanks for that, Vamakshi. Let's talk about Voltas, another AC company, another disappointing performance. Vinny, tell us more.
Absolutely, a very weak set of numbers that's come in from Voltas in Q1 FY26. Revenues are down by 20% and it's miss on all the fronts, whether revenue, PAT, EBITDA margins, everything was a miss coming in for the company. And obviously, this was led by the weak performance that came in the unitary cooling products. That's the AC segment of the company. Now, the UCP segment, that's the unitary cooling products, like I mentioned, is down 25%. Shorter than expected summer, early rains is something that led to the sharp fall and sharp decline in the RAC sales. Now, other than that, margins for the segment also were down by 500 basis points and came in at around 3.6%. Negative operating leverage is also a factor that came into play over here. EMP segment, that was also seeing a bit of a weakness. Muted performance, down 3% on a year-on-year basis. And the management is quite cautious about their approach going forward as well. Voltas Beko, on the other side, for the company, was the only one which managed to see growth this time. So that will be interesting to watch out for. Overall, a weak set of numbers from the company.
Okay, all right. Thanks a lot for that, Vinny. Well, let's hop across to Gaurav, who's here to tell us about Manappuram Finance. Gaurav, longer-term story, the street is optimistic, but the past quarter, soft quarter, right?
Well, yes, when we look at first quarter specifically, it was operationally weak and a longer term story still remains intact. But when we look at the numbers, now net interest income declined almost by 10%, which was actually 9% lower than the street's expectation. And as a result, net interest margins that declined almost by 80 basis points on a sequential basis. Coming to the operating profit, the same trend follows. It declined almost by 32% on a year-on-year basis. When we look at the provisions and the credit cost specifically, it was something which was positive because that declined to around 5.1%. It was fairly in line with what the street was expecting. But as a result of weak operational updates, we saw profit declining almost by 76% on a year-on-year basis. When it comes to AUM, there also we saw a degrowth of around 1% on a year-on-year basis, and this was specifically pushed by gold, and that was something which was a supporting factor for AUM. In fact, company is also saying that going ahead, they will be taking gold portfolio to around 75% of the portfolio, which is currently at around 65%. What they're again saying is that when we look at asset quality, vehicle finance is something which was a pain point in this quarter, and at the same time, going ahead, what they're saying is that they are also expecting some kind of moderation in the margins in terms of gold books. So that is also something which is concerning to the street, because these net interest margins will not see much of an upside going ahead. What is positive is that the deal with Bain Capital, now the company has said that that remains intact. The progress is as planned, and they are awaiting RBI's approval. They are expecting it by next month. So that is something which is positive from the commentary. But all in all, weak set of numbers in terms of operations from the company in this quarter.
All right, Gaurav, thanks very much for that. Let's talk about the next one. Lemon Tree in focus. Mangalam is here. Mangalam, morning.
Good morning. So the first quarter was fairly disrupted by, one, it being seasonally weak, and secondly, we had the Operation Sindoor and a lot of travel plans as well, which were disrupted. But despite that, Lemon Tree did well in the first quarter. In fact, further on their revenue and EBITDA expansion, they had lower finance costs and higher other income as well. That gave a big boost to the net profit. So 18% revenue growth is what the company reported, 22% EBITDA growth, which implies a margin improvement of almost 150 basis points, 160 basis points to be precise. And the net profit, that jumped 139% from 20 crore to 48 crore. That was aided by lower finance costs because the company's debt reduced by 10% and their cost of debt reduced by another 10 percentage points as well. Total rooms for the company this time around were higher by 5%. Occupancy on all of that increased by about 600 basis points. And we had the average room rate increasing by 10 percentage points as well. So all these factors aided to a good performance. But apart from all of this, the company is looking at the next leg of leadership as well. Patanjali Govind Keswani, who was currently the MD CEO of the company, has now moved to become the executive chairman. And they've hired Neelendra Singh from Shoppers Stop. He's been there for about 26 years to take over as MD from October 1. So that's a strategic leadership shift that we will watch out for Lemon Tree.
Okay, all right, got it. So Lemon Tree on the radar as well. Thanks for that, Mangalam. Let's go back to Vinny. She's looking at some numbers for DOMS. Vinny, how are they?
So DOMS numbers, at least on the top line front, a very strong growth that has continued for the company, 26% growth. Even last quarter, they managed to see this growth. So they are sustaining that 26% plus growth for the company. Now, where the impact came in this time was in terms of the margins. They have seen a contraction of around 200 basis points, and this was due to the change in the mix. Segment-wise, they managed to see growth coming in across the segments. Margins, that's where the concern came in. Now, overall, the company is highlighted, that they are keeping the target revenue growth of around 18 to 20% for FY26. FY26. So on the back of this, we're seeing ICICI Securities, they've maintained the ad rating, but the concern comes in on the target price because they've reduced the target price a slight bit to 2,550 from 2,675 rupees. So maybe we'll see the stock open up in the green and then maybe could end the day a bit muted in the trading session.
Okay, all right. Thanks a lot for that, Vinny. Well, let's hop across to Nimesh. He's here to tell us about Home First Finance, where there's going to be a clean-out trade. Nimesh, tell us more.
Yes, Nigel, there is a clean-out trade. It's a large block in Home First Finance in morning trade. Bob is looking to sell its entire 10.3% stake via block deal. The size, the indicative size is close to 1250 crores, and the price band suggests a 0 to 5% discount. I understand there is a strong demand from some long-only funds, but the execution could be key. If not in block window, the stock may open in the red to start with, and then to see how the demand pans up. But a large clean-out trade in Home First in the morning trade.
Okay. All right. So we'll watch out for Home First as well, Nimesh. Thanks for putting that on the radar. Let's quickly recap a list of stocks to watch. The ones that have positive news flow this morning are IOC, HPCL, BPCL, Lemon Tree Hotels and DOMS Industries. Those that have negative news flow would be Tata Motors, Siemens, Voltas, Manappuram Finance and Home First Finance. Okay, so that's a list of stocks. Let's also do a roundup of the commodity market action. We have Manisha joining in with the latest. Manisha, good morning and happy Monday. What's on the radar?
Well, it's going to be a very, very eventful and loaded week, this one. So I'll start with the crude oil prices, where we are trading at a 2-month lows right now. Prices did decline 4 to 5% in the previous week. All eyes on the US and Russia presidents, which are meeting in Alaska on 15th of August. So while the US is going to be pushing for a ceasefire, Russia is demanding territorial concessions. And then there is also a threat over secondary sanctions on Russia energy trade partners. So a lot in focus here. For the metal as a sector, well, we've seen more than, it's more like a consolidation at this point in time, with markets awaiting further development. When it comes to data, you have plenty of that coming in this week as well. You have the U.S. inflation data, and then the U.S. Fed Reserve Jackson Hole Symposium. That's between 21st to 23rd August. Much of the cues would come in from that. And then you also have the 12th August deadline for the U.S.-China tariff truce. So that is what really seems to be leading many of these metal markets. Gold prices have gone in for some profit taking, but the metals seem to be doing well. So silver gained 3% on the previous week. We've also seen some consolidation come back for copper. Aluminum gained up by 2% in the previous week as well. So metals seem to be doing quite well.
All right, Manisha, thank you very much for that. So that's commodities in focus and copper in play as well. We'll take a quick commercial break here. We're going to come back in just a bit from now. And we'll talk about individual stocks. We'll have Prakash Diwan help us do that. A lot more coming up here over the next 30 minutes or so.
Welcome back. Hope you're having a good morning. Well, let's welcome Prakash Diwan, market expert who joins us on the show. Hi, Prakash. Good morning. Good to see you win. Prakash, let's talk about Tata Motors. You know, the numbers were disappointing, but the stock has underperformed. Do you think if it opens up a little bit weak, it's actually providing an entry opportunity, or would you stay away?
Good morning, Nigel. So there's no doubt there is softness on the stock. You know, I think it's the first big casualty of the tariff impact, given the fact that US is a significant contributor to the JLR portfolio. But what's interesting is that the company is still kind of sounding confident of being able to maintain margins in a healthy band, which kind of justify the present price band that you've seen. It's already about 14-15% off since the start of the year, which means a lot of the other things have impacted the stock in terms of triggers. But more importantly than the numbers, I think it's what's going to weigh heavily is this acquisition from the Italian major that auto major that they spoke about. That's something which over the next 18 months is going to be critical for them to be able to juggle their balance sheet, to be able to grow in spite of all these weights that they carry. And one interesting thing that they mentioned about the CFO was that there's no impact on production because of the China rare earth metals kind of supply issues. So that's quite different than what we've been hearing otherwise, which means that they have bigger things to worry about, not so much on the supply side. It's more on the demand side, pricing side. So it's a little bit of a confused spot that the stock is in. I don't think buying it at this stage is going to be very rewarding unless there's a positive triggers that change the trajectory in a bit more decisive way. So I would give it some time, some sort of consolidation before things happen.
Okay, Tata Motors. So let's see how the market will react. Stocks anyway been down so much over the last 1 year. Now let's talk about ICICI Bank. So if you're a customer, then the minimum balance requirements, they've been boosted up across the board. And for urban and I think even semi-urban areas, the requirement is minimum balance of 50,000 rupees. Gaurav is here with more details. Gaurav, just run us through all the thresholds and any commentary around it, if at all.
Well, yes. For ICICI Bank customers now, this is actually, it could be taken in a negative way because, at least specifically for the new customers, because the minimum average monthly balance has been raised to around 50,000 rupees to metro and urban areas, which was earlier at 10,000 rupees. In semi-urban area, it has been increased to 25,000 versus what it was at 5,000. And for rural areas, this limit has been increased to 10,000 versus what it was at 5,000. Now, it clearly seems that ICICI is maybe moving to the customers who are well off and more elite. But at the same time, let's also not forget that this is only for the customers who are opening the account from 1st of August, and for existing account holders, it is not, the changes have not been made yet. Now, from what we can see is that from the regulatory point of view, let's understand how it is going to impact. RBI has not prescribed any kind of cap on the minimum balance for savings account, but at the same time, they also believe that the bank charges should be reasonable and commensurate for the cost of rendering the services. So definitely we'll watch out on how, if at all, a regulator is going to play any role in this kind of information and any kind of changes in the minimum account balance. At the same time, we will also be watching out on other banks. So when we look at some private sector banks like HDFC, ICICI, IndusInd Bank, they are actually currently holding this minimum threshold of around 10,000 now, depending on the conditions. While PSUs, they do not have any kind of such conditions for the minimum accounts balance. So we will be watching out on private sector banks if they are going to follow the same trend. Secondly, when we look at ICICI Bank specifically, or in fact across the industry, we are seeing the CASA ratio is falling. In fact, for ICICI Bank, for first quarter, CASA ratio was at around 41.2% and the deposit growth was at around 12.8%. So it will be interesting to see how the CASA ratio is going to pan out and how the deposit growth is going to pan out specifically now that they have made some changes. But as of now, we can see some kind of sentimental negative impact on ICICI Bank today.
Just one thing, Gaurav, the salary accounts are exempt, right?
Yeah, as of now, there are no updates specifically on salary accounts, but these changes are specifically for the savings account as of now, as per what they have published in the...
No, so do we know if salary accounts are exempt or no? We don't know.
It is not,
They've not specified.
Clear. Yeah.
Okay.
Yeah.
Okay. Because I would have thought that if salary accounts are exempt, I mean, that's 75% of the, I think about 75% of the deposit base. Yeah. So then, I mean, the logic is that is anyway exempt. The rest is, people using all service, from a bank's perspective, using all services, etc. of the bank.
Yeah.
I mean, using it to move money in, money out, etc. So it doesn't make that much of a, so you want to charge something. I'm assuming that is the, but we'll have to clarify this. That's a very important
in terms of the, I think the press release and the updates that came in over the weekend at least, I don't think there was a specific, call out or mention to...
I think I would imagine that
logically it should
logically
be, right?
it'll be exempt.
I mean,
because
logically, you'll have newcomers who are joining at $20,000-30,000, and then it won't be possible. I have my first.
I mean, I read it for first time. I thought, well, I think I don't know why I thought, but I think it's just logical that it should be exempt. We'll clarify with the bank.
Yeah, absolutely.
And I'll just mention this, that my first job was, I had an ICICI Bank account, and it was exempt from for salary onwards 20 years ago. So.
Because if that is the case, then I don't think that is it is kind of well thought out.
In urban centers, especially 50,000 as the minimum account requirement or minimum balance requirement in urban areas, and that could come into conflict with entry-level salaries and those accounts that the bank has. We'll see how this plays out. But all things put together, we should pull up that last chart that Gaurav brought in, because that's what the sort of point of debate is going to be. That's deposit growth. Let's call out the CASA, which has been falling. Prakash, now come in on this. One way of looking at it is that you're getting rid of the smaller ticket size accounts and, the operational effort of, keeping them functional. You're going up the premium curve. But then CASA, we don't know the salary piece right now, but do you think that CASA could be under some pressure for ICICI Bank, and therefore will this be negative or positive because of maybe some margin improvement?
No, so I think the bank's doing the right thing in terms of moving up the premiumization chain. And remember, this is for incrementally new accounts opened. It's not for the existing accounts as yet. Most of the banks have done that. When Axis took over the Citibank portfolio, they continued with some relationship value on an aggregate basis of a minimum monthly balance of 10 lakhs, for Citi Gold customers. So, if you don't do that, you end up being in a situation where you can't pass on some of the services to clients. And it's a fee-based income that most of these banks would probably start relying on. It's an era where credit deposit ratios are not so favorable. You don't have credit growth as yet. So it's a good step. They'll of course, they have the flexibility and freedom to calibrate, recalibrate if required at some point in time. And just to add to that, salary accounts usually are out of the ambit of what these saving balances contain because they are special. But the moment you move out of a particular organization and the salary account converts into a regular saving account, then of course these norms would apply. So I think it's going to be good for the bank if you really ask me. It might seem like they're letting go of savings account deposits, but that's not so much the case. The reliance is more on fixed deposits, term deposits, and that would probably continue to offer them the time liability mismatches not being there. So all in all, I think it's going to be positive, not so negative. Even if the market reacts, it'll probably be a little bit of a sentiment reaction.
You took me back a long time, Prakash. I recall when I was employed and then, took a bit of a break, and then it was a struggle to maintain that AQB, average quarterly balance, which at that point of time was 10,000 rupees. It took me back a long, long time. Prakash, stay with us. For the time being, we slip into a short break. Prakash will be joined by our technical experts. Mitesh and Sudarshan are waiting by.
Welcome back. I think you got 11 minutes to go for the pre-open session. The GIFT Nifty implied open is just about 5-6 odd point lower start. Sudarshan and Mitesh are with us with what they'd want you to do as far as trades are concerned. Gentlemen, good morning. Great to have both of you here. Mitesh, what's your sense? How's the structure looking? Friday, of course, the market sold off. Where are supports at, and what are the trades to take?
Morning, Prashant. So the structure is definitely weak. The only, positive side is that with 6 weeks of continuous decline, we are slightly oversold. But on the upside, if the Nifty in the coming few days fails to capture 24,750, 800 decisively, then I think we'll head much lower. One, so that's the level to watch on the upside in case we get a rebound. And on the downside, while there are some supports over here, there's a gap around this 24,350, 200 level. But the weekly charts have started turning negative, which means that we could be looking at levels below 24,000, possibly to about 23,850 as well. So the way to approach the index is, if you get a bounce back, try and get into short side of the market around 24,700, 750 zones. Otherwise, if if you have been long, we'll clearly advise against trading much on the long side. On the index, we have maintained, that trading the index with bear spreads could be a good idea, and I'll continue with that strategy. Just that you'll have to now shift at lower strikes.
Okay, all right. But Mitesh, structures punctured, yes, but you're not ruling out a near-term bounce?
Nigel, yes, because the idea is that will know in the live market, but with 6 weeks of fall on the hourly and the 2-hourly charts, the indicators are showing very, very extreme oversold readings. So a day or two of pullback can happen. The PCR also improved for a day in between, but I think still is close to the lower side of the range. So my idea is that yes, there can be a pullback because of the fact that 6 weeks of continuous decline means that there will be short covering at some level.
Got it.
And there is an event, right? There's an event as well, which I think on Friday, where we are shut. So will we see some of this covering in that sense? Before that, shots perhaps at the margin will be nervous. We'll see. Sudarshan, good morning. How are you thinking about markets from here?
Good morning. Well, it's a little depressing because 24,500 was a strong support. And I had explained once earlier that what happens if the support breaks? Then there's nothing to hold the market. Markets can stop anywhere. The support is only a number. But the next visible support comes much lower at 22,500. I don't even want to talk about it. But the point is that this market doesn't have any strong reason, technical reason to stop falling. It'll only be news. So in such an environment, I do not think we should go long. We should be looking at a small tepid rally towards 24,500, 24,550, whatever in that zone to build short positions again. It's news against us, seasonally weak months are ahead of us, and a market that is primarily a little overvalued. So this is a deadly cocktail. Look for lower levels.
Okay, all right. Let's get then to stock picks. Sudarshan, what's on your radar?
Well, the first is HDFC Bank. And HDFC Bank is likely to significantly outperform ICICI from now on. So I would suggest buying HDFC Bank with a wide stop at 1900. That's a positional trade, a swing trade. It's not intraday because intraday markets will do anything. Then I have Titan. Titan is a buy above 33.90 with a stop under 33.90. Dalmia Bharat is a buying opportunity with a stop under 2200. And the only intraday short, my last and fourth stock, is GMR Airports, where an intraday short can be considered with a stop above 91.
Okay, all right, got it. What about Mitesh? What is in your radar?
Nigel, I have more of sell calls, so I would want to, advocate a sell on DLF on a mild pullback, say around 750, 754 zones. That's a good range to take short positions. Keep a stop about 766.5 and look for a 725 kind of a target. A couple of stocks which I would want to short if the lower levels are taken out. So HDFC AMC is at support levels of 55, 30, 25. So if it breaks that 55, 20, 55, 15, if it starts sitting there, take a short with a stop at 55.61. Look for a target of 54.40. Similarly, Indian Hotels, if it starts trading below 730, take a short with a tight stop at 741. Look for targets in the range of 710 to about 705. And one buy call, that's MFSL. Keep a stop below 1530. Look for targets in the range of 1600.
By the way, that large trade on Home First Finance, that's got taken out. It's happened in the block window itself. And if you look at the last 1 month chart of Home First Finance, the stock actually has underperformed. It's down close to around 13%. And with this large trade taking place in pre-open, in the block window, that means, some of the shorts will be in trouble today. So we'll have to see how the stock reacts. It's down 12.5%. There was that sniff that could be a potential large trade. And now that's out of the way. So we'll have to keep an eye out on that particular counter. This was a bit of an overhang. Well, we'll take a short break. Come back. We'll get you pre-open rates. We'll also get Rohan Madora of Equirus Securities who will be joining in. Stay with us.
Welcome back. 16 minutes to go before the day's action kicks off. And of course, just about a minute till we start getting some indication from the pre-open session. Let's ask Prakash what he would advise shareholders of PG Electroplast. Prakash, amongst all the other drama, this was the highlight. This became the headline by Friday afternoon, right? This big cut in the guidance and the way the stock collapsed 22%. Now, whatever is the management's explanation so far, and I think they did the investor call as well, about this just being a seasonality issue, too much inventory. Does it cut ice with you? And also tell us additionally if there's any other question you have, because we'll be speaking to them shortly, so we'll take up your question as well.
So this is a bit of a tricky one given the timing. A couple of things that the market probably is putting a bit of weightage into on the negative side is they raised money when they were kind of just about a while back when they were aware of what's happening, or this could have been anticipated, if not in its intensity, at least in terms of direction. And they, of course, have liquidated some holding, which a lot of promoters keep doing, of course, for other reasons. But where this takes the company going ahead from an organic business growth perspective, what's the application of all the funds raised, that's going to be a critical thing. End of the day, it becomes a capital allocation question. And if that is judicious enough, we know the business has been good. The management has delivered in the past. There's no doubt in terms of their ability to execute and all. But is the seasonality far deeper? The damage from the seasonality is far deeper than anticipated. How long does it? If it's a one-off and there's some assurance that you can kind of get when you speak to them, would mean that the stock does get some sort of a support. But the market always loves an excuse to book profits on some of these things which are valued richly and which haven't disappointed in the past. So anything that happens for the first time does get much more weightage, and that's what's happened. So I would believe it'll probably consolidate at lower levels, and then once the commentary starts turning favorable, things could be very different.
Okay, well, let's see if they can offer any further explanations that will help assuage some of these concerns. Thanks for that, Prakash. Have a great day, and we'll connect again soon.
Thank you.
But for the timing, it's back to banking. SBI came out with a very steady set of numbers for the first quarter. Numbers were more or less in line with street estimates. Profits rose, net interest income remained flat on a year-on-year basis. Our colleague Ritu Singh caught up with the SBI chairman, Mr. C.S. Sethi, to discuss the quarter gone by and, of course, the outlook ahead in a fast-changing rate environment as well. Listen in to that conversation.
We are still sticking to 12% credit growth.
So which is not much of an upside from 11.6%, the rate that we're seeing currently.
Yeah, but we want to be, a little more balanced in that. In fact, I did say last time that if things improve, we may even reach 13%.
Okay.
But if you see this 11.6% growth rate, what we achieved is better than what industry has done.
Of course, that's 9.5% kind of rates. On the deposit as well, your guidance was about 10%. Is that something you maintain?
Yes.
And you believe the deposit repricing is done, so therefore margins which have shrunk in the quarter, what sort of headroom do you see, for further improvement, especially if RBI, maybe brings down rates further sometime in the future?
So the margin improvement is coming mainly the repricing of fixed deposit, which is likely to happen. In our books, normally it takes about 8 to 12 months for the 80% of the fixed deposit to get repriced. So that advantage anyway will come in. Number two is that the margin improvement on account of CRR cut. We almost will have 52,000 crores CRR.
Starting September.
Starting September. That means, earlier also I mentioned that the NIM trajectory of U-shape will still we are holding on to it.
Yeah.
It's a combination of the cost of deposits coming down and the repricing of retail loans becoming stable. At least till December, we don't see any further rate cuts. Which means that the retail personal loans, retail home loans will remain at the rate what it is today.
But it's a U-shaped recovery. It's not a, it's
no, it will be a U-shaped because there's a lag in terms of deposit.
So you'll be able to get back to or defend rather 3%.
So our exit NIM probably would be above 3.
A quick word on the asset quality as well. So typically we understand the first quarter does see a spike, but it's a biggish jump for you, from 4,200 odd crores to almost now you have 7,900 crores. Briefly for our viewers, where did the stress come from? And other pockets of stress that lenders have been highlighting, whether that is MSME, MFI, is there something you'd like to point out as well?
No, first of all, I think the comparison should never be with Q4.
Yeah.
You should compare with the Q1 of the previous year.
Which is more or less flat. There's little bit of a spike.
200-300 crores and in a book of 42 lakh crores is not a matter of concern. And also in the Q1 generally is the gross slippages. Right? As we go forward, it become net slippages. For instance, from the 30th June till today, almost 14 to 1,500 crores have been pulled back. In the slippages. So there's no great concern in terms of the asset quality. We have not seen any of the segments doing, in our book at least, that any stresses.
Okay, so improving margins, no asset quality stress, biggest bank, really helping, I think, take away some of the concerns that we've seen in some segments, and actually in Tier 2 banking more than Tier 1. Let's discuss this and more with Rohan Mandora, banking analyst. Rohan, I definitely want to talk about SBI and the whole Q1 banking performance. But even before we get that, can we just address that very newsy development from ICICI Bank before we talk earnings, of them increasing this minimum, account balance threshold? Do you see this as a positive overall or a negative?
Yeah, hi, good morning. Thanks for having me on the show. With respect to this news, I think it's slightly negative from a medium to long term perspective. Clearly, most banks have been focusing on a higher MAV customers as part of their strategy, but explicitly shunning the smaller MAV customers may not be a right thing to do. See, if you look at certain customer segments which are young in college, the first account that they open goes on to become a primary account over the next 5-10 years. And if you are missing out on those opportunities at this stage of time, it can have a medium-term implications on the CASA strategy of a bank. So that's where I think, from a focus perspective, this thing could still have been continued by tweaking the KRAs at a branch level, which most banks have been doing. And ICICI also had been following a strategy wherein whatever channel checks we did last year, we got to know that if a customer of say 10, 20,000 average minimum balance was willing to exit the relationship, ICICI Bank was not making efforts to retain them. So if those things were happening even earlier, maybe specifically calling it out that we don't want to focus on a smaller segment customers and as a strategy don't want to onboard them may not be a right thing to do is what we believe.
With salary accounts not part of this, Rohan, you think, I mean, if they would have looked at the data, right, in terms of where they're making money, where they're actually, what is the unprofitable segment in that sense, and what you said, right, you start working, open an account, and then sort of that becomes a primary account. I mean, those are salary accounts. What you're describing in that sense, right, Rohan?
Yes. So, see, from salary mandates, the minimum balance remains as 0. But see, in India, there's a good number of self-employed people also who have a decent balances in their bank accounts. And that is a segment that does not get covered under the salary account relationships. So that way, I think there's a good opportunity. College students, when they open their first account, the balances would be low. But typically, when they join a workforce, if they are, say, having an HDFC or an IDFC first account, and if the employer gives them an option to continue with that, then they'll most likely continue with that account going ahead also. And earlier, it used to be a mandate that every time you change a job, you open a new account. But now, in the last few years, we have seen that when people are changing jobs, typically a large employer has relationship with more than one bank on the salary relationships. So those kind of accrual that happens, or the account opening that happens, even at salary opening level, that thing can change. So that's where I think from a medium to long-term perspective, it can have an implications. On an immediate basis, obviously, there will be no implications for ICICI Bank.
Yeah, absolutely. Actually, I completely take that point. And to second Nigel's point as well, I remember that, many of us, first account, ended up being with ICICI or any account. When you're young and you're opening an account with a bank, the tendency to close is not there unless you're being penalized at some point. Many times those relationships then go on to become, far more durable, bigger relationships as well with any bank. But yeah, let's say that's ICICI's approach to it. Okay, so medium term, slightly negative, near term, not much of a reaction. Got that point, Rohan. Now let's come to earnings. Let's start with actually SBI itself. Numbers look really good. You just heard the commentary from Mr. Sethi. He's promising better margins by the end of the year. Unlike so many other lenders, so reassuring, right? No asset quality stress in SBI. What's your call on the stock? Or what's your general takeaway and your sense on larger banks, if not this stock per se?
So see, I think 1Q was a quarter wherein we have seen NIM compression. For 2Q, for most of the PSU banks, we would expect that NIM compression would be lower because the repo impact has been highest in 1Q for most PSU banks. For the private sector packs, we would see that second quarter will see a higher impact of repo transmission because most of them were either on a month-end, quarter-end, or a rolling 3-month basis kind of a transmission, unlike PSUs which are on T+1. So 2Q would be slightly more challenging on NIMs for private sector banks. And as MD Sir said, for SBI, second half would see improvement in NIMs. So that's how we would also expect that 2Q should be more, but one would see more pressure on NIMs on the second quarter, and second half onwards the recovery would come in. The few softer aspects that came across in this results were clearly on the asset quality side, which largely were focused on the smaller ticket secured segment also like CV as well as small ticket LAP. This becomes a monitorable. It would be good to understand incrementally from the management that is this an impact from the the impact from, say, the MFIN 2.0 guidelines, wherein certain smaller ticket customers were not able to avail loans to be able to refinance their ongoing requirements. So that could be one implication that may be leading to this kind of thing. And plus, overall, the commodity is over-leveraging and overall economy remains weak. So some implications of that could also be there.
Okay, all right. Thanks very much, Rohan. Good conversation. Short one, but helpful and crisp. Thanks for joining in. Let's quickly look at the market and then get some final trading ideas before we move very, very quiet. 8 points. That's all the Nifty is giving you in the pre-open. The Sensex is up 27 points and the Midcap Index is absolutely flat as well. So going back to our technical experts, Sudarshan, what's the 9-10 call?
That would be GMR Airport, intraday short in GMR Airport with a stop above 91.
Okay, got it. And Mitesh, what about you?
I will choose the sell on Indian Hotels if it breaks 730, take a stop at 741, look for a 710 to about 705 kind of a target range.
Okay. By the way, just want to point out, Mitesh, in case you have very quickly 30 seconds, levels on Voltas. Voltas could be starting substantially lower, 7-8% lower, and then we'll see if there are buyers that come in. But just levels to watch.
See, actually, last time the Voltas stock had gone into correction, we saw, 2 or 3 times it bottomed out around 1190, 1200 zone. So I think that's the first level to watch out for. In case we start breaking below that, then don't be surprised if we even head towards 1050.
Okay, all right. Talking about Voltas, let's hop across to Vinny. She's here to tell us about the stock that in pre-opens down more than 7%. Vinny?
Hi, so yes, we're expecting a red coming in for Voltas. So given that the weak set of numbers was reported by the company, a quick take on what the brokerages are saying. Jefferies, they're maintaining their buy target price of 1,670 rupees per share. But they're saying that obviously those weaker volumes is something that impacted the earnings. And they did highlight one point, that market share on a month-on-month basis in April, May and June, that had seen an increase on a month-on-month basis. Now, what Jefferies is expecting, that festive season, early festive season, plus possibility of a second summer in the month of September, October is what we're watching out for. And the new BEE ratings are something that could maybe lead to some bit of a recovery for the RAC segment. Though as of now, Voltas is trading, below its 5-year historical average. Nomura, maintaining a neutral rating, target price of 1,317 rupees per share. They're saying there is a risk to the margins is given that the rising competition is coming in. Demand recovery, they said, is already factored in for the stock as well. Now, they are lowering the FY26 RAC industry growth to just 5% from previously 10%. So that's a sharp decrease in the RAC segment overall. And they're maintaining their FY27 target at around 20% in terms of the tailwinds that could come in for the segment. For the UCP segment, the revenue growth they're expecting is at 6% from previous 13% is what they were expecting in FY26. Voltas on CLSA on Voltas also is maintaining the hold rating. They've cut the target price to 1,170 rupees per share, given that the weak set of numbers that came in from the company and higher inventories is still a concern that they're watching out for.
All right. Actually, Vinny, thanks very much for that. The management of PG Electroplast joins us at 9:30 this morning. And that's the first and exclusive interview to talk about the revised guidance and, of course, the trends in the AC industry. So that's Vikas Gupta, PG Electroplast. Stock was down 20% on Friday. We'll talk about another segment, right? OMCs, oil marketing companies, where that sort of one-off payment, which has been long awaited by the market, seems to be coming through. How's the market going to take it? Sonal is here with the news and the impact. Sonal, morning.
Good morning. Well, yes, it's after a long time that this positive news has come by for oil marketing companies. The street was waiting for this 30,000 crore rupees in terms of LPG under recovery compensation, which will be paid over tranches. Although, remember, 41,300 crore rupees has been the total under recovery so far for all the 3 oil marketing companies. It is unclear whether it's a one-time grant now or the government will go ahead and give them the rest that is pending as well. But nevertheless, it is a positive news. Jefferies says that they estimate an upside of 29 to 42% on EBITDA for all the 3 companies and 38 to 70% in terms of profitability as well for FY26. Now, do remember, this is under the assumption that all of it is paid in FY26 itself. ICICI Security says that LPG compensation is a material boost for these companies, takes away all the margin worries that these companies had for FY26. Morgan Stanley says they prefer HPCL and BPCL. Subsidy could boost FY25 earnings by 75%. It could delever their balance sheets by 12% and support a consistent consistent 14 to 15% ROCE, that is return on capital employed as well. There is limited downside risk if fuel prices are cut further by 1 to 2 rupees. UBS says that the payment currently is 74% of FY25 dues and 62% of the dues which are accumulated till now, that is 41,300 crore rupees. It is equivalent to the book value between 8 to 16% for all the three names, and the market capitalization for that, it is a percentage of around 6 to 9% for all the three companies in that order. So yes, a positive news that has come by, but again, it's not the full amount that they've received. It's 30,000 crore rupees this time.
All right, Sonal, thanks very much for that. I think we got a slightly positive start and slipped into the red. So nothing on the indices. 24,360 on the Nifty. The Nifty Bank is at about 54,950, absolutely flat here. The mid-cap index is down about 0.25%, 150 points. And I think you've got the small-cap index, which will come up, which is also starting lower. That's about 40 points down, 0.25%, 17,385. But absolutely kind of sort of holding on to very, very flat levels as we begin this particular session. Almost evenly balanced, right in the middle. The number of stocks which are higher and lower on the Nifty. So you've got 25, right? I mean, ICICI on one end and Grasim on the other end. So let's get down to individual names, mid and small caps, etc. as well, because the index is not doing very much. It's kind of blinking red and green. Surabhi.
You know what? Before I talk about index stocks, Prashant, I want to pull up PG Electroplast once again. 22% on Friday, another 10% this morning. Let's pull up the stock. Okay, it opened up almost 9-10% down, now 6-7% lower. And I was just checking the shareholding pattern, how it stood after the promoter sold stake in May. So from a level of 49.4%, which is where they were at the end of the March quarter, June quarter shareholding, it's come down to 43.7%. The share sale happened in May at a time when the business was obviously going through difficulties. And I think it's more a question of just trust and credibility. And let's see, the management has been speaking on investor calls. We'll talk to them as well. And let's see what explanation they have. Business weakness is one thing, but disclosure obviously very, very important for the market. Anyway, coming back to the Nifty names now. On the Nifty, some green, Grasim, SBI itself, good commentary from SBI, 1% higher over there. There's some buying on Trent this morning. Adani Enterprises, NTPC. Some of the metals are doing pretty okay. Hindalco, Tata Steel, JSW Steel. Some hope building up, of course, around this US and China trade conversation that's going to happen today. Tata Motors is actually reacting positively. I mean, maybe you can argue a lot of the negative is in the price. Stock's been slammed over the last 1 year anyway. So is recovery in sight. Let's see, 1% higher on that note. On the flip side, ICICI Bank, the market is not too enthused. And I think the market probably is seeing merit in the argument that the analyst from Aquarius was just making, that in the near term, are you sort of, or in the medium term at least, are you going to be weakening your CASA franchise? That's the concern. 1% lower on ICICI Bank. Other weak names include Asian Paints, HUL, slight weakness there. Reliance is kind of dragging its feet, sluggish this morning, 0.5% cut. But net, it's even, Stephen, for the Nifty. Absolutely neutral, 9 points up.
The stock of the last 1 week has to be NSDL. It's 1,400 rupees now, 1,350 odd. I think let's pull up NSDL. That's the big mover from the listing price. It just moved one way. The float could be rather limited. Last few trading sessions, it's been moving very, very well. NSDL is listed on the BSE. That should come up for you on the screen. For those that got it in the IPO, well, they're very, very happy. And those that bought in the pre-IPO as well, now they would be breaking even. They'll be making some money because now the price is at around 1,400 rupees. So there'll be restrictions on selling these stocks because it'll be locked in. What else is doing well? Yatra, massive move out there. That stock is up close to 10%. So big up move is what we're seeing on Yatra. A couple of other good earnings reactions that we are seeing. It's actually up now 12%. Genus Power, that stock is up close to 3%. Massive volumes is what we're seeing on that particular counter. And keep in mind the run rate that they're going at, they could probably, outbeat what they've set out for this year itself. So that's why the street likes it. Volumes high, up close to around 2%. HPL Engineering, that's the other stock that's up. Uniparts, that's another one that's coming on the list in terms of big gainers. And I think you have Jyoti Structures as well, that's up close to around 5%. These are all big volume movers in this morning's trading session. So we should get some of them up for you on the screen. On the flip side, PG Electroplast, now it's down close to 10%. Best Agro, got hit last week. It's got hit even more this week. That, in fact, is down close to around 6%, I think, the last time I checked. And Concord Biotech, that as well, is getting a drubbing this morning. That's down close to around 5% or thereabouts. So big movers in the broader market.
Absolutely. On the AC stocks, I just want to mention that Voltas also has had a complete washout quarter. Every number is a miss. So that stock anyway is down 6.5%. And this whole nervousness around the space has drawn down Blue Star. Blue Star numbers are already out. Everything's done, discussed. But again, just the sentiment negative is rubbing off on Blue Star as well, which is down about 2.5%. Prashant.
Absolutely. And, we got, 30 points higher on the Nifty now, 24,400 on the index at this stage. And I think you've got the Nifty Bank, which is also starting with about a 90-odd point higher start. That's about 0.17%. So this is a much better kind of sort of screen as compared to what the GIFT Nifty or the pre-open, etc., were indicating. Just a few other names here, right? I mean, of course, PG and Voltas. Amber is the other one, right? Amber is, again, big in ACs. 4% lower on Amber, so 7,045 on Amber. You got Siemens, which is down 3%. Vamakshi was talking about this earlier. Sagility is another one, 3%. Numbers were very, very strong for Sagility for the quarter, but stock's been at that 45, 44 rupee levels for a while. It's not corrected, though, in this market fall. Biocon is down about 3%. Wockhardt is coming off with about a 2.5% knock this morning. Concord Bio is down 6%, 1,500 rupees on Concord Biotech. Havells, I think we mentioned Havells is down 2%. Again, that same sort of, AC story there playing out. Deepak Fertilizer is down 2%. And then I can go down the list, but volumes start to thin out very, very quickly at this stage. HBL, engine is the largest volume-led gainer coming through this morning. It's up 10% on the back of solid numbers. Look at that, 2.5 million shares. Number one across the board on the NSE with regards to volume and price action. Sarda Energy is up about 6% as well. Again, it's got, for this point in the day, it's got large volumes. So 567 on Sarda. I think Nigel already mentioned Yatra.
Yeah.
There is Afcons, which is up about 3%. Yatharth is up about 2.5%, 3% as well. So that's the sort of picture as things stand right now. 45 points on the Nifty, 24,400 is where we are at. Mihir Vora is now with us, Chief Investment Officer at Trust Mutual Fund. Mihir, good morning. Great to have you with us on the program. Thanks very much for your time. I just want to, I know you don't want to talk about individual names, and I won't ask you to comment, but I want to ask you sort of comment on you to comment on a situation. PG Electroplast, Shaw, and of course, I mean, consequently, I mean, the PG as a episode. What would you kind of sort of make as a veteran investor? How would you read it? There is the angle of the fundraise, and we, by the way, speaking with the management in about 10 minutes' time. So that one, and second, of course, implications for the AC space, Mayor, if you want to weigh in. Stocks are weaker.
Sure, Prashant. See, the point is that there have been indications of an overall urban consumption slowdown. And you on your channel also have been highlighting, the white goods space, especially AC, fridge, etc., have not been doing well. So there were lead indications that this space is not doing well, and obviously companies which cater to this segment would be impacted. We are also there are some reports of some issues about the Chinese stopping or at least delaying permissions for engineers to come in and set up the compressor units, etc. So overall, the news flow has not been that positive, and I don't think it's too much of a surprise that this segment and suppliers in this segment have shown signs of margin pressures and slowdown.
But on this issue, I mean, outside of the business point, Mihir, hi, morning. Surbhi here. My bigger question is, and I invite everybody to go and check out Hormoz's article on this on our website, CNBC TV18.com. He's written how mutual funds, because obviously the business was so good, the commentary was good, how mutual funds and retail investors have loaded up on PG Electroplast in the last many, many quarters at a time when the promoters have sold, and the promoters clearly haven't, disclosed this timely enough, perhaps, this whole business environment. So, Mihir, will this cast a shadow? Or do you think the market will move on and PG will go back to its winning ways? Because it's good business, then running into slightly tough weather, versus the fact that perhaps there was not adequate and timely disclosure. Your thoughts on how the market perceives such events, not only in PG, but in general?
Yes. So overall, I think the
the manufacturing space, especially the durables and electronics manufacturing space, including mobile phones, etc., it is a sector which has high potential, high growth potential, but which also needs a lot of capital investment. So you have seen a lot of companies in this space come up with fundraisers because they have large plans. Some of them have plans in adjacencies. Some of them have actually gone into semiconductors and the PCB manufacturing space also. So this is a very exciting sector from the growth potential point of view, but it is a sector which requires capital. So, issuances and QIPs and capital raise is not a surprise, because when the going is good, when the markets are in a bullish phase, investors are looking at growth stories, and this space does offer long-term growth potential. So I'm not too surprised about the fundraise part. As far as disclosures, etc. are concerned, probably the timing can be better in some of these cases.
All right. Hi, Mir. Good morning. Good to see you in. But how are you feeling about the markets on the whole, Mir? This Trump tariff tantrum, that's something that's definitely weighing on sentiment. But I think the bigger cue is what's going on the domestic front. And the first quarter was actually very, very weak. If you look at power demand, if you look at, aviation, traffic over there, if you look at movement of steel and cement via rail as well. Now, all these indicators actually, at least in the last 7 to 10 days, they're showing some signs of life. If I look at the FASTag data, in value terms, the growth is good. There'll be an element of price increases. If I look at the power demand, that actually has perked up a little bit. Steel and cement, the movement via rail, that as well has done quite well. Are you seeing signs that things are going to be recovering? Because I'll tell you what, the next 45 days are going to be very, very crucial from a market perspective. We'll have pre-Diwali buying as well. Do you think you're seeing signs of a recovery domestically?
I think right now it's more of a hope case, in the sense that by default, we do consider this period as a slow period. So slowness in some of the segments that you mentioned is not a surprise in this particular time of the year. But always the hope is that once the monsoons are past us and the harvest comes through, domestic consumption and demand will come through. That's always the case that we work with. And given the fact that monsoons have been good, liquidity has been provided by the government and the RBI, there is a reason to believe that the natural cyclical recovery in consumption should happen in the busy season, in the festive season, so to say. So I don't think that's an irrational assumption to make. We are also going with that assumption. Having said that, the bigger elephant in the room is how the trade talks are going to pan out, because India is clearly at a disadvantage as far as the tariffs are concerned versus a lot of its potential labor-intensive manufacturing competitors like Vietnam, Cambodia, Thailand, and China, of course. So this 50% tariff is definitely not sustainable, and we hope that before the deadline of August is concerned, we should be able to come through some sort of an agreement, because clearly 50% is not tenable. It would destroy a lot of exports to the US. So, and that, of course, can lead to job losses, and that can impact consumption more than the cyclical recovery.
All right, Amir, thanks very much for that. Good getting those details from you. Really appreciate your time here on CNBC TV18. I think we can go across to the management of PG Electroplast now. The stock is down about 10% once again after falling over 20% on Friday. Shocking guidance cut coming in from the management. We have Vikas Gupta, Managing Director at PG Electroplast, who's with us. Vikas, good morning. Great to have you with us here on the program. Thank you for joining us. You've got, I'm sure, lots of questions around what has happened, what has transpired. Let's just start with what happened, Vikas, because the guidance cut from you came as a large shock to the market, as you can well imagine, because even at the end of the last quarter, not this quarter, the previous quarter, there was enough and plenty indication that the AC season is going to be weak. We heard it from OEMs that we speak with. We heard it from others as well, that generally things are looking a little weakish. The season is not going to be all that great. But we've heard it from you after the quarter has ended. So let's just start there. What happened?
So, good morning, Prashant. It's always a pleasure to be on your show. So basically, I'll try to first answer the question on the quarter one head on. That is a more important thing, that how it played out. So, everybody was expecting that the overall AC sales will rebound in months of June and July. In fact, we were operating at more than full capacity in months of April and May. And so it was looking very, very, very like the momentum was going in our favor. But actually, as the channel inventory built up, and there was no rebound in the sales for the air conditioners, the secondary sales of the air conditioners in the months of July and August, as we are seeing now. So we had to revise our guidance accordingly.
But
So
Mr.
we felt
Gupta, sir, if you allow me to ask you this, and you've been in the business for so long, right? And you'd know this, and I know it's more, you're in B2B sales, but in general, the peak months where the best offtake for ACs happens is actually much earlier. I mean, February, March, that's where people start buying to build up for the summer months. In fact, if anything, June and July usually, I mean, it's not the peak season, isn't that so? So how is it that you didn't see this building? Because from fan makers to cooler makers to AC makers, Blue Star, Crompton, everybody was telling us that it's a weak summer and expect a sluggish Q1. So how did you not see it?
So, Surbi, let me clarify on that. If you look at the peak months for the production for a company like ours, start in fact in month of November, December. So we start ramping our productions in month of November, December, and the sales and the brands also start picking up the inventory from our factories. And they also, the channel partners also start picking up the inventory, and that's the primary sales which start happening in months of January, February, March. So there is a lot of anticipation in the channel, in the industry, that the sales will be good. So that's why everybody built up the inventory for that. So as we progressed in the month of May also, we were hoping that the market will improve, the demand will improve. We were having the order book, we were having the forecast from our brands, our customers, that was quite robust, and we were building on it, and we were believing that numbers, and we were going ahead with those production numbers. So it was only later in the July, in the month of June, that we saw that the secondary sales are not picking up, and the channel inventory is becoming huge. And that's when the demand from the brands fell off the cliff for us. And we realized that we are sitting on a huge inventory for us.
Got it, got it. So I'll tell you what, I think what has compounded the problem, I'm sure there was some, misreading of the situation. Very clearly that's happened. But what's compounded the problem from a stock market and your investor perspective is that all of this has happened when you as promoters have sold stake in the market. And that has a business hit is one thing, and business hits always happen. I mean, it's a cyclical business. So just explain this to us, and I'm repeating for the benefit of viewers. March 25, promoter shareholding 49.37% as on the Bombay Stock Exchange. End of June quarter, promoter shareholding 43.72%. So when people tie this together, they're saying, what is this? Why won't we give in an advance warning? So many companies do business updates. You could have given an advance early indication. Could you not have done that? Was that a miss?
So, Survi, like the optics and the timing looks like that, and it is unfortunate that it is looking like that. Please understand, as I told you earlier, the May month also we were operating at more than our capacity. The sales were looking good, and the block deal that the promoters have done does not change our outlook on the business. The long-term outlook on the business remains intact. And we have done the QIP also. We have raised 1,500 crores from the investors, from the marquee set of investors in December 2024. So we are already working on those capex guidelines that we have given earlier. We are building on our new product diversification. We are working the new launch of product platforms. We are building up new capacities. So the long-term story of the business remains intact. It cannot be impacted by the one single week summer.
All right. Hi, Mr. Gupta. Good morning. Thanks a lot for joining in. Mr. Gupta, you have created big wealth for investors over the last 5 years. The problem is what has just happened. So let's get a couple of those questions out of the way. You have guided for a net profit of around 310 crores for this fiscal. Is there a downside risk to that number?
So, Nigel, as of now, we do not see any downside risk to that number. So definitely the margins are getting impacted. We know that. But as of now, we do not see any downward risk to that.
Because even after this correction, you're still at 15,000 crores of market cap, which doesn't make the stock very cheap. So that's why investors will be fretting if in case that 310 crores of net profit guidance will be missed. You're saying no as of now, right?
So, Nigel, if you've seen the history of the company, we have been always trying to outperform the guidance.
Correct.
So, we
Correct,
will
sir.
try to do that.
The problem, sir, is you're best remembered for your last performance, and the last performance has been a little bit jittery, so hopefully you find your form yet again. So that question out of the way. Next, your promoter holding from around 65% because of dilution, the QIP, because of the block deal, it's come down to 43%. Now, I'll tell you what, analysts will say this and that, buy and sell side will say this and that, but the promoter is the best analyst on a stock. And if he's going to back up the stock, then it's going to be important. Since this sort of an untoward event has happened, would you consider coming in there, buying 1.5%, giving some confidence to the shareholders? Because currently, all those marquee names, they are fretting a little bit. They're saying Mr. Gupta was promising us big growth, and that's not really taken place. Would that be an option?
So, Nigel, as per the block deal, I think terms, we are not allowed to do any trade for a period of 6 months. So, given an opportunity, we will definitely like to participate in that.
Exactly. So that's my next point then. 6 months down the line from that May 26th, when you sold that block, will the promoter entity, try to come in there, increase their stake? Because as of now, there's no visibility. Q1 has been an absolute howler. You've gone ahead and cut your guidance. Next 2 months will be plagued by discounts and heavy inventory in the system. So probably, the intent could be post this cooling off period, Mr. Gupta and family could come in there and increase stake?
So, Nigel, we will definitely participate if the time and the rules permit. We will like to look at that opportunity also. But
where would you want your stake to be, sir? Sir, it's just a question of confidence. Like Nigel said, your stake has come down from the 60s to now 43, 44%. When this window is, whenever the window opens, where do you want your stake to be in your company? How much equity do you want to own, sir?
So, Surabhi, I don't feel that we are sitting at a small stake in the company as a promoter family. If you look at our peer group, so we are sitting very decently at the kind of stake that we have in our company. And as I told you, that we are fully committed to this business.
Right, Vikas, got that. Yeah. So it's not, no, absolutely. It's the incremental change which was the promoters sold. That was the point. When you met investors in May for this for the promoter stake sale, you're saying there was no indication at all of the fact that this is, and all this happened in the month of June. That's what you're saying.
So I told you, Prashant, what happened. We were already running full steam in month of April and May and June as well.
Okay.
So we were hoping that the recovery of the demand will happen. It didn't happen that way.
Okay. Now, Vikas, how by this inventory that you're sitting in, by when will this return to normalized inventory?
So for us, the normalized level of inventory is almost a 1 month production. So we feel that by the month of October or November, we should be normalizing the inventory levels to a level of 1 month production. So we already have some kind of indication from the customers for the coming season, and we are working with them to see how to recover the situation.
October, November is when inventory gets back to the standard normal 1 month sort of inventory, right? Inventory level.
Yes.
So 2 quarters. I mean, you've got to basically bear for 2 quarters in that sense. That's the way to look at it from here. Now, could you give us a sense of margins as well? 125 to 150 basis point cut in margin guidance. What levers do you have? Where do you see margins basically from here on? And what levers can you use to restore margins to F525 levels? Vikas.
So please understand, currently the margins have been impacted. There are broadly 3 factors that have impacted the margins. First is the finance cost. With the kind of inventory that was there in the system, the whole working capital was tied up, and that we had to use a lot of discounting and factoring to manage our cash flow. Secondly, please understand the AC season is a highly seasonal. The profitability is highly seasonal. We usually make our money in the peak months. Then we have to manage our fixed costs during the lean months. But in the current year, as the summer season shortened and the sales fell off, so the number of lean months have gone up. So we have to manage our cost on that, and that has an impact on the margins.
Sure.
So that is where the operating leverage actually turns against us in this case. So we are trying to see how to recover from that situation. Thirdly, the input costs have also gone up. The dollar exchange rate and the copper tubing, everything had a impact on the margins as well.
Sure. So I just want to go back to that point. I think that'll be very, very reassuring for your investors to know. You said that you're committed to the business. I ask that question again, sir. What is the level of equity shareholding that the promoter family wants to maintain, even when the regulatory window opens up again? You're right now at just under 44%.
So, Surbhi, if you look at the when we did our QIP of 1,500 crores, our shareholding went below 50%. So, in our case, in our family, there was a lot of discussion on that, whether we should lower our stake in the company below 50% or not. But we have to see what is the good for the company and how we can grow our company. Even if that required for us to dilute our stake below 50%, we went ahead and did that. And we felt that was a better thing to do for the company in the long run. So the equity holding of the promoters is, I think, 43% or 45% or 47% does not make any difference. It is that the commitment of the promoter family towards the business is more important.
No, absolutely, sir. I mean, your point is well taken. There are completely professional companies with very low promoter holding, and the IT sector is an example of that. But investors do take that as some indicator of what's coming. If the promoter is lowering the holding, who are the bigger institutional investors? Therefore, I ask that question. Will you maintain it at least 44%? Could it go down? Would you want to go up towards the 50 mark? What is the intent of the promoter family right now?
So, Surbhi, the intent of the promoter family is clearly to look at how to grow the business. We will be engaging with our long-term investors. We will be meeting them in coming days and try to reassure them how the business is going to play out in coming months and coming years. That is more important. 1 week summer cannot define the destiny of the company.
All right. Mr. Gupta, so growth is what you're focusing on. And since you told us, that we could look at some of the peer companies as well. Amber is one peer that has 40% of promoter holding. But the last quarter, their growth was phenomenal, in terms of year-on-year growth. But it appears the industry itself went through a bit of a weak phase. That said, what about the compressor? That facility is what we have been looking forward to. That deadline has got pushed actually numerous times. And we have chatted in better times as well on this channel itself. Tell us, what is the date? Which quarter onwards do you expect things to start moving ahead?
So, Nigel, for the compressor thing, we do acknowledge that it has been delayed, and it has been delayed quite a lot. But from our side, we have done our bit. We have constructed the building. We are ready with that. We have already evaluated all the RFQs for the equipment or the plant and machinery that we need to buy. We are just waiting for certain approvals. Our Chinese partner is waiting for certain approvals at their end. As soon as they come, we will be placing the orders for the equipment and everything. Definitely, the timelines have been pushed now again. So we are hoping to have certain kind of clarity from our partner in month of October.
Okay. So FY27 is the safer timeline, Vikas?
So FY27 definitely looks better.
Yeah, okay. For this compressor JV to kickstart in that sense. I just had 2 more questions. Are there, other AC-related stocks are also coming off sharply? I think you were mentioning that what you've seen in this summer in terms of AC sales is the worst since 2008, Vikas?
Yes, Prashant, yes.
Yeah, 2008 was the GFC. I mean, of course, there were other factors then at play as well. Has something really, is there any reason for demand to crater like this, as you see it?
So, please understand, Prashant, like if you look at the last year, when the demand went through the roof, so nobody could anticipate that time also, like how the market is going to behave, how market actually behaved. And there was the talk in the market that there was a shortage of the inventory in the channel, and there was a lost opportunity of more than 1 million or 2 million ACs which could have been sold because of the shortage of the inventory. So it is very difficult to anticipate, but please understand, there is a lot of impulsive buying of air conditioners still in India. And as there is a longer dry spells, the people tend to go and buy ACs. That is something that needs to maybe change over a period of time. But if you look at the long-term story, I say again, the long-term story for this business looks very robust. We should not we should not try to define this business on the basis of single summer. So,
right.
So we have to look at that way.
All right, Mr. Gupta, very quickly before we let you go, will you consider buyback? I'm not sure about the regulations, but you can't buy from the open market. Since the stock has crashed in this manner, you have lowered your capex as well. Is the buyback something that you all could think about?
So no, so we will be like the current capex is already going ahead. So there is not a scope of buyback that we are looking at. We are going ahead, building our capabilities.
Okay.
We are not stopping here.
Yes, got it, Mr. Gupta. We appreciate you joining in, fielding all those questions. As you're saying, the longer term, you'll have your focus on the industry is going through a bit of a weak phase, but you're coaxing your investors to keep the faith. We'll hold you to these numbers, and we look forward to chatting up with you, sir. But for the past quarter, it's been very, very disappointing for your investor community. And as we speak, the stock is down close to 15%.
Okay, so that is PG Electroplast. Market still has more questions. Let's see. The management has given lots of answers. We'll see how this plays out earlier. But from all the secondary market action, let's talk about the primary market because there's a new issue out there. Bluestone Jewelry's IPO is opening up. It's an issue which is a little over 1,500 crores, 1,541 crore rupee IPO to be precise. It opens out for subscriptions today. The price band has been set at 492 to 517 rupees per share. The company has raised just under 700 crore rupees from anchor investors. So let's talk about the business and the prospects with Gaurav Singh Kushwaha, Chairman and Managing Director, and CEO Rumit Dugar, Chief Financial Officer at Bluestone Jewelry and Lifestyle. Gentlemen, thank you so much for joining in and good to have you with us. I can say, I've been a customer already. But, so I have two straight questions. One on the losses, because while the company has been growing very, very well, you've exhibited 50% growth. It's, fashion jewelry, jewelry for the modern woman, etc. That's been the positioning. Losses have continued. That's one part. The other question that I had was actually on what happens to the IPO, because there's been some chatter and some conversation that apparently there is a case that's been filed in the Securities and Appellate Tribunal, making some allegations on disclosures, etc., things like that. Where does that stand? I mean, and could it impact the IPO? I don't know what's happening at SAT. So if you could just clarify.
Sure, let me take that. So on the SAT case, there was an appeal that was filed by one of the litigants. That appeal, there has been multiple hearings that have happened. The appeal has not even been admitted yet. And we've got all the requisite approvals. So absolutely there is no impact on the IPO.
And on the losses part?
Yeah, sure. So on the losses, look, I think the business has seen tremendous amount of growth. We've been investing quite aggressively in the business to build scale. As you can see, we have almost 275 stores. And we are at a point in time, if you look at our EBITDA margins are already close to 7%. And a lot of the capital investment has gone in the last 2 to 3 years. And thus, we are coming to a market at a time where a lot of the investments have gone. The growth is still very high. And thus, there is tremendous amount of operating leverage that is flowing in the business.
Morning, we're calling it KYC, Know Your Company. So Ruby knows the brand. For those who don't know the brand, Gaurav, if I can request you to just tell us a little bit about the business itself.
Sure. So we started as an online-only jewelry brand, and for 7 to 8 years, we were largely online only. I think at that time, we realized a very peculiar user behavior where people are finding it very comfortable being able to browse so many pieces of jewelry sitting at home. But I think given the nature of the category, given the price point, given gold, diamond, etc., there was a push from customers that, okay, we also want to see it in person, physically before completing the purchase. So while online was doing its job of pulling in people in droves, and see, online in a way is a much better, it's much better at letting people browse jewelry, because that is something you cannot do in offline stores. And so essentially that worked very, very well for us. And the ask from users was to allow them to also see it physically before they could buy it. So we started opening stores and we are very young to it. So FY19 was when we opened our first store. We opened 5 stores in that year, then 11 and so on. So and we saw tremendous success, and that's why we started increasing the store presence exponentially. And that also links back to some of those questions about losses, because those early stores are extremely profitable. But what happens is, because it's only been 5 to 6 years since we started opening the stores, the ramp is like this. And most of the stores are sitting in a very, very young cohort. But they're all showing very strong SSSGs. So if you look at same-store sales growth at a blended level also, that's 30% plus, which is kind of unheard of.
How many stores do you have now?
275.
Across, in terms of...
Across 117 cities, across all geographies. In fact, another beautiful thing is in this category where most of the players are very zonal, very regional, we are among the two who are naturally national.
In terms of the split of products that you sell, how does that, gold and...
So almost 67% of our sale comes from studded jewelry, which is gold with diamond or gemstones. And 30 to 35% is from plain gold jewelry. And we also, as a consequence, we also have industry-leading margins. So our gross margins are to the tune of 37, 38%, which are, again, so our growth and margins both are unheard of in the industry. And I think those losses are a result of some of the front-loading of investments that we've done.
All right. Hi, gentlemen. Good to have you all in the studio. Looking forward to interacting with you all, on a quarterly basis, at least with regard to your results. And maybe since you'll be given that push, visit one of your stores as well. That said, when do you all turn profitable?
So, that'll be a forward-looking statement, obviously. So we are constrained by that. But what we can tell you is the business momentum, as Gaurav mentioned, is pretty strong. We've grown at about 50% CAGR for the last 3 years.
Okay.
A lot of the capital employed in the business has gone in. If you look at some of our older cohorts, they generate about 24% store-level EBITDA, which is something that's part of the disclosures. And there is no reason for us to believe, given the kind of growth momentum we are seeing, that there should be any difference in the younger cohorts.
All right. So you'll have cut out the path towards profitability is what you're telling us. And once you list, then I'll push you a little bit more on that point. Got that out of the way. But if you could help us out with, your margins as well. If I look at ad spends as a percentage of the sales mix, it's relatively higher in comparison to the industry peers as well. Where does this number settle at?
So, look, in terms of A&P leverage is pretty high, and it's a function of what is the size of the revenue base. So, if you look at some of the larger brick and mortar peers, the revenue bases are much higher. Thus, as a percentage of A&P, it keeps coming down. So, there is reasonable amount of operating leverage that is sitting on the corporate costs and A&P. We've seen those levels come down from about 12% 2 to 3 years ago to almost 9% last year. So we're seeing that continued trend of scale driving a lower A&P.
I just want to check on this number. Our colleague was telling us that as of now, if we talk about total revenue, then online is giving about 15% of your total revenue as of now. Would that be right?
No, so, okay, the way we see our business is we don't see online and offline channels separately. So all our journeys, all our users start their journey online. Some of them are comfortable placing the order online also. But for most of those people, they actually are more comfortable once they have shortlisted online to walk into a store and then convert. And just to put it in context, this is like pretty much buying a car. You can do all your research online while buying a car, but you won't click a buy now button.
No, absolutely. That's philosophically, how you've seen the business.
In terms of invoicing.
But I'll tell you, sorry, go on.
In terms of invoicing, that number is lower than 15%.
Yeah, it's about 6 to 7%.
6 to 7% is actual purchase happening only online without the store walking.
That is invoicing online. What also happens, Surbhi, is that if, let's say, because we are an omni-channel player, if you place an order online and that product is sitting at a store which is 2 kilometers away, it'll get delivered from a store.
So the reason
it'll reflect in store revenue.
The reason I'm asking you is very, very simple. If it was, if the bulk of it was happening purely online and there's no need for physical stores, obviously it's great for profitability and margins, right? That's not the case. I was a customer who came in who was a walk-in customer, didn't even bother checking online. So as your store count keeps increasing, and you'll do a blend of mix and match of both styles, what's an aspirational, and I'm not even asking FY26 or 27, I know you can't talk about that, but give us a directional aspiration. Where should EBITDA margins settle at once stores have matured, once the model has matured, say 3 years down the line?
So I think the best way to kind of look at it is how my older cohorts are performing. My older cohorts, which are at a 10 crore revenue productivity at a store level, deliver a store level EBITDA margin of 24%.
Okay.
Right? So that, and that happens at a 10 crore productivity, right? So unlike big box, we don't need a 40, 50, 60 crore store productivity to deliver a 23, 24% store level EBITDA. We do it at a much, much lower revenue threshold. And the reason for that is our gross margins are close to 38%. So directionally, that's the performance.
20% plus could be an achievable target a couple of years down the line, not immediately. Okay. Can't say much. I
can't say much.
I just have to ask the lab-grown diamond question. Is there a threat? Because that's the
We
new...
don't see that playing out in the smaller diamond categories where we are our majority plays. So essentially, diamond category also, there are two type of customers. One is solitaire customer, other is people who buy designs that also happen to have diamonds. And those diamonds are very, very small diamonds. So typically what's happening is the lab-grown impact is being seen in the solitaire space, be it US, be it India and so on. And I think Titan also in their multiple commentaries has revealed almost the same thing. In case of smaller diamonds, there's hardly any cost advantage of lab grown, and hence there's hardly any momentum in that particular space.
So you're not looking to go big on
And solitaire is only 2 to 3% of Indian market, right? India is not a solitaire heavy market like many of the Western societies. India is more like design market. We have jhumkis, chandbalis, plenty and plenty more of.
So you're not looking to really push on the lab.
We are not.
All right, gentlemen, we'll leave it there for now. Thank you very much, and hope to speak with you on the day of listing. And of course, we'll have many more conversations after that. Good luck.
Thanks, Prashant.
Thank you.
Thanks.
Okay, I think we've got the market, which is, I mean, actually it's not moved, right? I mean, it's right there, 35 points, the Nifty 24,400. And although the overall market breadth with about 45 minutes of trade behind us is a little negative, 1,500 stocks are lower, and you've got about 1,050 stocks which are higher. We'll take a break, more coming up on the other side.
Welcome back. Let's keep it with the corporate conversations then. Cummins India reported a good set of numbers for the first quarter. There was a beat across the board and the stock was, of course, surging higher in Friday's trading action. Revenue growth was driven by healthy domestic and export sales. Our colleague Vamakshi caught up with the company's MD, Shweta Arya, to discuss the quarter gone by and the prospects for growth going ahead. Take a look.
The growth is very broad-based across different segments in the domestic market, across different markets from an export perspective. So very broad-based. So likely going forward, we should see this kind of demand coming in and our ability to execute better on that demand.
Just wanted to check in on your exports then. You mentioned they have not been, you've been cautiously optimistic on them as you've been highlighting. This time around the exports were up almost 34%. So did you see any sort of pre-buying maybe that probably came in from the parent before, the tariffs came into force? Was that, number one, the reason behind the exports going up? And number two is, on one side, we do have some positives like the FTA with UK. On the other hand, we have 50% tariffs from the US. So how are you assessing the global situation right now? And, how are you navigating these sort of challenges?
It is definitely challenging times for us, as is for everyone else who has exports around the world. The good thing is that our exports are diversified to different countries. So as you rightly said, on one hand, there is tariffs from the US. On the other hand, there is FTA as well coming in. So our teams are evaluating how best to position ourselves. But the diversification of our market does give us a natural balancing factor. We are trying to see how best we can take advantage of the places which are in our favor to increase our presence in at least those markets and balance our exports thereby.
All right. Let's also discuss how the pricing environment has been for you, right? So versus where you were in probably, the beginning of the energy transition norms to now, have you largely been able to hold on to the pricing? Is that correct?
We have been largely able to hold on. In different segments and different nodes, there have been movements in the whole year. Broadly, we have been able to hold on to pricing, although I will say that there are huge competitive pressures in the market. So we keep monitoring that situation. At the end of the day, we want to be very competitive in the market and provide the right value to our customer base.
Sure. So given the kind of competition that is now creeping in, across the nodes, would you perhaps look at revising your pricing in order to maintain your market share? Is that something that you might consider in case, the competition does go ahead and offers more competitively priced products, given that India, is a very price-sensitive market?
What we try to do is, one, we continuously try to optimize our own cost base so that we get that leverage if we have to change our pricing in the market. And we also monitor the market to be competitive, as well as we work with our customers to help them understand what value we bring to the table when we sell the products to them. So it's a mix of all those three. It's not always that you have to only react to pricing. We have all these levers with us, which we can work with. And the product has been very well accepted by the customers in the market.
All right, and let's also talk about your margins, because at 21.45%, they're the highest we've seen since Q4 of FY24. So if you can just help us understand what is driving this improvement, and can you help us understand if you would be able to sustain at these margin levels, and are there any other levers that could perhaps play out that could probably push them even higher from here?
So from a margin perspective, if we look at this quarter, there's always a product mix that plays in different quarters. In this particular quarter, there is favorable product mix that has played out. And also because we had the volumes in this quarter, so there's some leverage benefit on our costs that we got. Going forward, if the volumes increase or stay closer to where we are, then we continue to get the leverage benefit. The levers in our hand are internal cost optimization, which across the board, we work on that, direct material cost or our own other expenses. We work on those. Those are the levers. And for sure, catering to the demand in the market and executing as well as we can so that we get that volume benefit and the leverage that we have been enjoying in this last quarter.
Sure. And, you've mentioned about volume. So I believe last time around you had said that, volumes would probably cross the CBCP2, products in the next 1 or 2 quarters. So has that happened right now?
The volumes are actually back to the pre-CPCB4 plus era at this point in time. They haven't crossed. They are the market volumes. The market volumes are back to pre-CPCB4 plus numbers now.
And for you, is it better?
It's a different kind of a mix now, because there are different segments which are at play now versus the earlier time. So it won't be right to compare just the volumes of now versus pre-CPCB4 plus.
All right. And, you've also opened up a new opportunity for you with the BESS. So if you can just help us, quantify what is the kind of total addressable market cap that you're looking at over here, because I'm sure you must have thought about the opportunity and thereby launched this product. And other than that, what could its contribution be to your overall revenue pie, not in the short term, but at least in the longer, the medium or the long term perhaps?
So we have launched the battery energy storage system, considering where the market could move. And also it is in line with our Destination Zero strategy, where we want to contribute towards products which can bring us towards utilizing different kinds of energy sources better. So this product is in line with that strategy. We are right now working with customers in India to see how they accept this product. There is a lot of value that we can provide to our customers. Largely, our customer base in the power generation segment would like to diversify the energy sources that they use. And battery energy storage system is that possibility that we can provide them. So from that perspective, we have launched the product. Yet to be seen what kind of market can we garner through this product launch.
So you're still assessing how customers are reacting to your products. But I mean, if you can just give us a ballpark of the kind of investments that you could perhaps make in this particular segment.
So as of now, we have launched a range of battery energy storage systems across kilowatt hours. We will see how the product gets accepted in the market and then decide how do we want to invest in terms of promoting this product more. So for the time being, we are testing the market with the product and seeing the acceptance.
How would this product fit in with your overall blended margin? So therefore, would it be better than the margins that generally, I'm not asking about your company specific margins, but in general, when it comes to the margins for BESS, are they better as compared to the power gen?
I would say that the power gen margins would be better because this is a new product. These are experimental days. And in the initial period of time when we seed these units, we will not, either the industry or us, the margin profile will not be same as power gen. Power gen would be higher.
All right. Well, that's the management of Cummins in conversation with my colleague, Vamakshi. Mitesh is with us with what he'd want you to do. We got a bit of a lift today to 24,400 plus. Mitesh, welcome back again. What would you do?
Yeah. We got a bounce back. The opening was slightly subdued and then we got a mild bounce back, I think, aided by the bank Nifty, and that's where the action is. Indian Bank is something which I would recommend on the buying side. It's breaking out of a supply pivot of around 655, 657. So keep a stop below that. 654 is what I recommend. Look for a target of around 690 on the upside. I think SBI is leading the chart, but Indian Bank is the one which is outperforming. And the other stock is Muthoot, which I would turn slightly negative upon. So sell the stop at about 2,605. Look for targets of around 2,500.
Okay. All right. So individual trades there. Mitesh, thanks very much for that. We'll take a break. Manisha on the other side, commodities in focus.
Welcome back. Equity markets are having a quiet morning. Let's find out what's the latest in the world of commodities. We have Manisha with us in the studios now. Manisha, what's captivating your imagination this Monday?
Well, the energy markets really, because that is where we've seen a lot of movement come in the previous week with a very, sharp decline that we've seen across energy board, whether it has been crude prices, natural gas, heating oil, almost everything. So for the crude oil prices, we've seen 5% of a decline in the previous week, and we've opened Asia 0.5% on a weaker note. That tells you that you're trading at a 2-month lows for the WTI and the Brent prices also. All eyes on the US and Russia presidents meeting in Alaska on 15th of August. As of now, the US is pushing for a ceasefire. It has been doing that for some time. While on the other side, Russia is demanding territorial concessions. Russia has been hit with 18 packages of sanctions from European Union and various sanctions from other countries, including US as well. So that's exactly what they're asking for. Well, at this point in time, there also is threat about secondary sanctions on buyers on crude oil. For example, India, China and Turkey. That is the reason these countries and most of the global markets really will be watching out for this event and the statements coming in from there as well. There also are concerns that the US tariff could slow down crude oil demand going forward. That seems to be weighing onto the markets as well. OPEC and Plus, while they have continued to increase production and until the month of September, but the latest numbers show that the OPEC and allies are pumping less than the newly increased output. On paper, it's 2.5 million barrels per day. But when you look at the last couple of months, the kind of increase that they should be doing is not happening. That perhaps could be supportive for the prices. The markets also have seen some support in sense of the China crude oil stocks. For the second quarter, we've seen 82 million barrels of an increase therein. So China clearly seems to be collecting inventory there. And then the Europe oil stocks are down 9% of the 5-year average. You also are looking at US stocks down 5-year of the average as per the seasonal markets there. So these are a couple of factors that actually could be giving some support to the markets. But at this point in time, as I said, all eyes on geopolitics and tariffs, and some easing of stress could be coming in from that. I also want to take you through on what natural gas prices seem to be doing. A big move coming in here. We've seen nearly 5% of a decline previous week. It's trading 3% down in the Asian markets right now. The production growth is much higher at around 6 billion cubic feet per day, while the demand growth at 3.3. The street also is looking at the kind of inventories that European markets are holding, and that is weighing on. Bank of America, interestingly, has cut natural gas price expectation to below $3 per MMBTU for the fourth quarter as well. And the last plate should show you on what we've done in sense of prices for crude and natural gas as well. So in the last month, we've seen crude decline by 5%, but natural gas was down 15%. And in this year until now, we are negative in the double digit for both of these commodities. But this is going to be a very interesting week. You have so much events, so much data and so much statements anticipated as well. To begin with, you have the US inflation numbers coming in, CPI and PPI, both of these in this week. 12th August is deadline for US and China tariff truce. Whether we get an extension on that is something that the street will watch out for. And then US and Russia presidents meeting in Alaska on 15th of August is going to be a very important event. And moving forward, it is going to be about the US Fed Reserve Jackson Hole Symposium. That's from 21st to 23 August. A lot of statements anticipated out of this as well. So promises to be a very interesting week ahead.
Okay, and if there is a peace deal on Friday, I think oil prices fall a little bit if it happens. Manisha, thank you very much for that. It's a special segment, Indianomics. Lata in conversation on the impact of the key Supreme Court decision on the power sector with former power secretaries Alok Kumar, Pradeep Kumar Pujari and Nikhil Nagani of Bernstein also weighing in as far as individual companies and stocks go. Coming up in just a bit.
Welcome to Indianomics. Today we put the spotlight on a very important Supreme Court order to the state electricity regulatory commissions to raise tariffs and allow discoms to run on commercial lines. Were it not for the tariff issue, this order would have grabbed the headlines in all newspapers. The Delhi power distribution companies have actually taken the DERC, that is the Delhi Electricity Regulator, to the Supreme Court, asking for the recovery of their past dues amounting to 27,200 crore rupees. These past dues in jargon are called regulatory assets. The Supreme Court, in response last week, gave a broad order to all the state electricity regulators as follows. First, it said that the tariff decided by the SERCs shall reflect the actual cost of power. Second, the accumulated dues or the regulatory assets should ideally not exceed 3% of the annual revenue requirement of the discoms. Third, these regulatory assets or past dues must be liquidated in 3 years, either by raising tariffs or getting the state governments to pay. The current backlog of past dues have to be paid back in 4 years. That's the telling point of the order. It has more. Joining us now are two former power secretaries, Mr. Alok Kumar and Mr. Pradeep Kumar Pujari. Mr. Pujari has also been the Central Electricity Regulator Commission's chairman. I'm also joined by Nikhil Nigania, the director and senior analyst at Bernstein. Gentlemen, thank you very much indeed for your time. Mr. Pradeep Kumar, if I may start with you, sir, since you have, worn both hats as power secretary and as chairman of the CERC, do you think this moves the needle a bit? There have been several national tariff policies which have told the SERCs to do exactly this, liquidate the past dues in 3 years, 7 years, whatever. Nothing has moved them. Will the Supreme Court order move the needle, at least for Delhi?
Thank you. What Supreme Court has said is already there in the various statutes. The 3% limit, liquidation of the regulatory assets, and when regulatory assets are to be created, they are supposed to be created in under exceptional circumstances. Now, the issue is that not only the statute, but also the various, I'll not call it direction, but various letters that has been issued from the ministry also had asked the regulator to take necessary steps. Unfortunately, when the regulatory assets are created at the same time, the regulator should have included a roadmap within the time frame during which these regulatory assets are supposed to be liquidated. So unfortunately, this has not happened. So I'm really happy about this direction that came from the Supreme Court. And I'm sure that the various regulators, state regulators who are having or have to take necessary action will now take action to liquidate these regulatory assets within the time that has been stipulated by the regulator. The rule and the policy says that the old regulatory or the legacy regulatory assets are supposed to be liquidated within 7 years. However, the Supreme Court has now put a new timeline of 4 years. So they need to be regulated. I'm sure that all the regulators will comply with this direction.
Oh, you feel so? Let me get first thoughts from Mr. Alok Kumar. Sir, it is a large number. I mean, DERC itself has to pay 27,000 crores in terms of legacy assets. Their annual amount is much smaller. It's like 20,000 crores or thereabouts. How are they going to clear this backlog? And it is to all SERCs. So if you go to a state like Tamil Nadu, which is, a huge offender, their accumulated losses or accumulated dues, sorry, are 89,000 crores. And in any given year, their annual revenue amount is only 91,000 crores. I mean, this doesn't look even feasible. What's your sense?
Thank you for having me on this show. I will add what Mr. Pujari has said. The Supreme Court has very clearly said it's a regulatory failure. And the regulators are prepared to work under dictation. So that is the sorry state of affairs. But there are some say, silver lining. If you see the new scheme, the Government of India has floated the RDSS. One of the pre-qualification which participants have to meet every year is the no new regulatory asset has been created and past has been liquidated. If you read the order carefully, they accept Madhya Pradesh, Rajasthan, and Tamil Nadu. This is not a very widespread problem in the country. There's some states where the regulatory failure has been very prominent.
Yeah.
But I'm happy to see, if you leave the case of Delhi for a moment, the 4 states which have given their affidavit, they said that we have not created any significant regulatory assets post 2020. So that means this carrot and stick approach by government of India is working, number one. Number two, DRC also wrote a letter to the government of Delhi saying that they should take it up, that private sector discoms should be able to participate in government of India schemes. What happens? This has been my view.
Yeah.
Normally, the government of India has been excluding the private sector discoms from schemes like RDSS and even other. That is not done because the consumers in those companies, they face tariff hike because grant is not given. So there is also a administrative view which needs to be changed, that under the regulatory oversight, the private discoms should also be made fully eligible for participating in Government of India schemes. Third, I'll say there has been a lot of debate why Ministry Power has come and made rules. Now, I'm very happy that most of the rules which were made when I was in the ministry, now Supreme Court has welcomed. He says, endorsed them. They said there is nothing can be more clearer than tariff policy.
Yes.
So now the issue is that we need the stick from APTEL and Supreme Court, and we need the carrot from Government of India to see that these things doesn't happen. Past dues are huge, and I personally feel like Tamil Nadu has been giving a lot of support to the discoms from their budget. I think part of it has to come from budget. All of it can't be passed to tariff, and some parts should come from the tariff rise. Most important is going forward, the DRC has to give up this approach of giving only 8% of DRS for recovery of capital as well as interest, whereas carrying cost is also more than 8%.
Yes.
So if DRC should correct at least the future stance,
so what is this DRS?
Past can be addressed.
What is DRS?
DRS is called the deficit recovery surcharge, which DRC has been allowing at 8%. It's a laughable. Carrying cost is more than 8%, and you expect to recover everything 8%. That's all I have to say.
Fair point, sir. So let's get a market angle from this. Nikhil, as both the former power secretaries are saying, when the word comes from the Supreme Court, it has a much larger, force of law than a national tariff policy. Policy is a guidance. A Supreme Court judgment is law. So do you think we are going to see, more money flow through? If not all the 2.3 trillion rupees of past dues, will something flow through to the power sector?
Yeah, so absolutely. I think, as Mr. Alok Kumar said, it's a carrot and the stick approach, the stick being the Supreme Court and the APTEL, and the carrot being schemes like RDSS by the central government. So definitely a big positive step in the right direction for the broader power sector. In terms of flowing through, if it does, it doesn't impact the P&L of these distribution companies. It impacts the cash flow, which itself is a big benefit. The most immediate beneficiaries would be power distribution companies in Delhi, assuming that's where the case was regarding. And the 3 there are, one is Tata Power, Delhi Distribution. The other 2 are owned by Reliance Infrastructure. We don't cover these names, but they are the ones who stand to gain the most. And beyond that, if we expand it to other parts of the country, then CSC is another one, which has regulatory assets, although not all of it might be approved. And so those are the large ones I would say are immediate beneficiaries.
Yeah, I agree. Adani Energy also is there in some states. But generally, the discoms are likely to get more power, more money if the law is implemented. I'm going to take a bit of a liberty with all of you. I'm not going to restrict it only to the Supreme Court's order. Since I have 3 very knowledgeable people on power, I will meander into other questions as well. But Mr. Pujari, just to finish this argument for the moment, do you think it will be more tariffs, or will state governments have to cough up? Like Mr. Alok Kumar said, Tamil Nadu has been coughing up, and they have to, because their losses are really huge, or their dues are really huge. But do you think the state governments will be forced to take this order seriously, or they are, likely to be in contempt of the court?
Yeah, one thing is very clear that the Supreme Court has rightly recognized that it has to be done in a partnership. Both the state and the regulator have to work out a solution. And as you understand, the structure of the is such that the regulator is supposed to determine the cost reflective tariff. Now, how much of that is to be passed on to the consumer? The state government can always intervene. And if they intervene, the scheme is very clear, saying that the gap, you cover it on the subsidy. So now, suppose the legacy regulatory assets are to be clear, and depending on how much it impacts the consumers, the state government, the specific state government, looking at the local context and the local the consumer mix, what is the position of the discounts, whether there is an affordability issue. Considering that, the state government has to take a view how much it will allow, or how much should go to the consumers, and how much the state government will cover it through subsidy. So I don't think it is a general rule that a particular sort of approach will be followed. My understanding is that every state government with a state-specific approach they will take, looking at 2 or 3 major things: the financial health of the discoms, the consumer mix, what is the present tariff of the C&I sector vis-a-vis the domestic sectors, and how much, what is the financial position of the state government. So considering that, I think the each state government will take a view on that. That's my take. There will be no sort of one should fit all sort of approach. And this is very clearly, Supreme Court has said that both the state government and the regulator have to work it out.
Yeah.
So this is how the probably approach will be.
I'll come to this point in just a minute. Let me, before I take my first break, give our stock market viewers some big gift from the people who are here. Mr. Alok Kumar, very quickly, I mean, I saw your excellent piece in the Mint about how the grid capacity has fallen short because of the waivers given to renewable energy guys. If you can very briefly tell our viewers which part of the power ecosystem today looks most profitable. I mean, where is the demand-supply gap? Is it for transformer makers? Is it for electricity construction companies? Is it, for discoms, for power generators, renewables? Which is the best sector now?
I'll say best sector is transmission, because it's a most essential component, natural monopoly, and their dues are mostly paid. You can't live without transmission. So go and invest in transmission first.
Okay. All right. Actually, I have to take a break. But all of you Bazaar viewers, just watch. There is a wealth of information coming on power sector from 3 of the best minds in this space. We're going to a break, chart busters for you. But you can catch the full conversation after market hours.
Volta's first quarter numbers miss estimates on all fronts as room AC demand remains weak, the stock lower by 5%.
PG Electroplast continues to fall, down another 15% today after the management significantly cut its guidance last week. The management, speaking to CNBC TV18, attributed the revision in guidance to the lack of recovery in AC sales in July as well as in August.
Siemens opens with cuts but recovers from lows, nearly 5% recovery from lows as the company's profits and EBITDA margins miss in the quarter. The company's revenue, however, grew higher than expected, and that has the stock recovered.
Grasim's higher as well following its first quarter numbers. Brokerages Jefferies, Motilal Oswal and Nuvama, they have raised their target price on the stock following the numbers.
And if you look at some of the other results as well, strong earnings coming in from the likes of Cummins Industries, Jubilant Consumer, the erstwhile Jubilant Chemicals, and all of them have reported a good performance.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. The Nifty is trading in the green. The Nifty Bank has well has seen a bit of a recovery. The Midcap index has moved into the green. So all the frontline indices, they're now trading with gains. Remember, we are bouncing off extremely oversold levels. You know, we have to see whether or not we can build in from here. But good to see after a while, all the frontline indices well in the green. Hey, Mangala.
Hi, Nigel. We start a good week, a week on the front foot after 6 weeks of losses. The question whether it sustains or not, and the answer to that would be in how the India VIX performs. Even as the frontline indices are all in the green, the Nifty is actually at the high point of trade. We have the India VIX, which has spiked about 4% first thing in the morning itself. It's closer to 12.5. Remember, when the markets were falling, it was between 10 and 11.5, almost 12. So with the market moving, seeing a bit of a bounce, VIX is moving as well. Bulls would have liked to see that cooling down. So let's see where that goes on as well. But there's the last week of earnings, a lot of them listed on the bourses to report their numbers. Let's get in earnings conversations itself. JK Tyre reported a weak quarter with profits falling nearly 22% as the margins contracted due to raw material costs. We are joined by Anshuman Singhania, who's the managing director of the company. Thanks a lot, Anshuman, for joining in. If I look at your revenues, your first quarter revenues grew by about 6%, but there was a big decline in Mexico, near mid-teen sort of decline, even as India grew high single digits. On both the Indian business and the Mexican business, if you could give us a sense on what kind of revenue growth are you factoring in this year, given all the uncertainty that there is on tariffs, etc. If you could give us, start from the top line and then we go all along the other parts of your income statement.
Yeah, hi. Thanks for having me on your show. Well, the top line growth this year, we are looking at high initial double-digit growth. And we are looking at the markets to be very bullish. The domestic market is performing well. In fact, in the domestic market, we've had a robust 11% growth in both in our OEM and replacement market, which is an aftermarket, on year-on-year basis. And we continue to see that sentiments are good. And we see the growth drivers and our continuous strengthening in the market presence is going to continue. Even for the export market, though it was a challenging quarter with lots of uncertainties, having said that, even the passenger vehicle witnessed good growth for a quarter-on-quarter basis and year-on-year basis. Well, you talked about the tariff. A tariff for America right now, as we know, it is 50%, but we are still sort of reading in between the lines and getting some clarifications. From our top line, US is only about 3%, and we are very well poised to divert that sale to other non-American countries, and where we have a good footprint, namely EU, UK, Middle East, Latin America, and Brazil.
All right. Hi, Anshuman. Good to see you, Ben. So you're targeting double-digit revenue growth, right, for FY26? Got it. And that'll be in early teens.
Yes.
Got it. All right. And, if you could help us out with the Mexico business, that's clearly been under some pressure, right? There was a degrowth in the first quarter, and it delivered an EBIT loss. When does this business get back into the green terrain? Point number one. And what kind of a growth are you factoring in here?
Well, last 2 quarters, because of the uncertainty of the tariff, there was a lot of uncertainty So JK Tornel was a lot under pressure. However, the worst is behind us. In fact, in Q1, JK Tornel recorded a revenue growth of 12%, and on currency constant basis, which is the pesos, it recorded a revenue growth of 7%. And as we go along around the quarter, we are very optimistic about the growth of Tornel for this year because we serve the US market, and the US currently the tariff is 0 right now. They have given a pause period of 90 days, and we are largely serving the Mexico market and Brazil and Latin America, which is looking to be good in Mexico.
So Mexico
optimistic.
Mexico will become profitable again?
Yes, it will become profitable again.
In the second quarter itself?
Yes.
All right, so that should be good news. What about your overall margins? Because, we've seen a lot of your peers report numbers as well. They said that first quarter, second quarter, there might be some compression in margins because of the high cost inventory that they've been sitting on. But going from here on, they could see some sort of improvement as we move along. So for the entire year, what kind of margins are you targeting? And by when does recovery start?
Well, the margin for us in the Q1, we had an expansion of almost, in the absolute numbers, we had a 10% increase in the margins. And we see that the margins improvements are going to be coming in as we go along quarter on quarter this year. Raw material prices are down from the previous quarter, and we see a stability in raw material prices. Lot of our attribute towards improving our operational efficiency, plus a lot of our premiumization thrust on product mix is definitely going to be helping the margin expansion, and notwithstanding the government's push in the infrastructure projects. So H2 is going to be very exciting with the repo rate also coming down and the monsoon being good. So it argues well going forward.
All right, and raw material costs have trended lower. Operating leverage will pick up. So that means that margins from around this 10.5% handle should move back towards, say, that 12.5%, 13%. Is that something that you would like to achieve for the year on the whole?
Yeah, that has been our general guidance. So it should be in that range.
12.5% to 13%. Got it. If you could tell us, what about your capacity addition plans? Currently, what utilization levels are you functioning at? And do you have plans to add capacity?
Yeah, sure. So we are currently right now at a 89% capacity utilization. Our radials have been at a 90+% utilization. And we have our capacity plan, which is already going on, which is a layout of 1,400 crores in passenger car radial, truck bus radial, and all steel radial tires. So that is well within our plan, and that is progressing well.
Right. And, if you could give us a sense on how your revenue mix changes from here on itself. You did say that OEMs and replacement markets did well in the domestic business this time around. Passenger vehicles also saw a bit of a pickup, but nearly half of your revenue does come in from commercial vehicles, where the outlook is slightly muted. So if you could give us a sense on that. And secondly, premium tires as a proportion of sales, how much is that, and how much is that likely to be over, say, 2 to 3 years? Because you're pushing for premium tires to go to OEMs.
Yeah, sure. So we have a sharp increase in our premiumization. And when we talk about across the board in all the categories, in the passenger car, we were about 20% about 2 years back, 15-inch and above. And now we are treading towards 26 plus in our mix. And going forward, as our capacities are coming in, we will be definitely targeting a very high digit number going from here. Our acceptance in products of premium tires has really caught on, not only with the OEMs, but we have good traction with the dealers and our channel partners. To name a few, our Levitas ultra high performance tires have been really performing well, and it has really caught the fancies of the luxury car market. Coming to truck tires, our XF series, which is a value-add product, which has been well accepted in the OEMs and also getting a lot of traction in the aftermarket. So going forward, we're going to be introducing many more products like that, and we are very confident that with our innovative technology, which is the heart of it, will definitely deliver better.
Running out of time, Anshuman, quickly, if you could give us your current market share and where do you intend that to go by the end of this year?
We don't give market share, but I could say that today we are the number one in the commercial vehicle segment. We are definitely installing a lot of capacities for our passenger car. So we are strong there, market share in there.
Take that point. Thank you so much. Good luck for the remainder of this year. More importantly, we'll watch out for a turnaround in your Mexico business and at the same time margin improvement from here, even as you guide for double-digit growth for the entire year. With that, we'll take a short break, come back, focus on the markets and a lot of stock-specific action. Stay with us.
Welcome back. Well, let's focus on the technicals of the market. We have Shivangi Sarda who joins in. Hi, Shivangi. Good morning. Good to see you in. Belated happy birthday. Hope you had a good one over the weekend. That said, the markets are having a good one this morning. What's your view on the Nifty? Where are we headed? Point number one. Point number two, fill us in with a couple of stocks. Please go ahead.
Morning, Nigel and Mangalam. Thank you for having me, and thank you so much for the birthday wishes as well. Well, looking at the markets, there has been good support-based buying, and we've seen that it has become sticky at the lower levels. The Nifty put-call ratio has sunk, but the India VIX has also risen. So somewhat pressure at the higher zones is intact. But then again, bulls are stepping in at the lower levels to save it up from further downside from the last 3 trading sessions. So we're looking at a capped upside move, but sort of a range-bound move where bulls are coming in to save, but bears are firmly having a control majorly. So levels per se, we're looking at 24,150 as an important support level for the upside zone of 24,650 zone. So quite a range-bound move that we're expecting in Nifty with volatile swings in between. Talking about Bank Nifty, this one has been, showing strength from the PSU space specifically, but heavyweights are not contributing to this index. However, it did, take a good support near 55,000 levels, and there was buying seen, which made it rebound and hold above these levels. So till the time it holds above 55,000 levels, we could aim for an up move towards 55,750 levels. While 55,000 stands as an important support level here for this one. Now, talking about the stock-specific action, of course, talking about the banking space, first up is from the PSU banking space, which is Indian Bank. This one has resiliently held and shown strength from the last 5 to 6 trading sessions. Even we've seen good volumes adding up here on the weekly basis as well. It's broken out from its consolidative band of the last 8 trading weeks. And on the monthly basis as well, we've seen that the stock has continuously performed and it has been holding at the higher zones from the last 6 to 7 months. So definitely on radar and strength adding up here for the next targets towards 690 levels with a support of 650 zones. And the second one on my radar is Fortis Healthcare. We've seen a lot of action in the healthcare space today. And this one has actually shown strength from the last week. We've seen volumes adding up here with a good amount of unwinding, and good momentum to continue here. Of course, this has been an outperformer for the last 4 years, and even on the immediate basis, we're seeing momentum adding up. So this one is looking quite lucrative for the next target of 945 levels with a support of 890 zones.
Take that point, Shivangi. Thank you so much for your calls on the market as well as the mid-cap stocks along with the Nifty Bank. Wish you once again a very happy birthday. Meanwhile, just watch out for a couple of these defense names which are spiking right now. Mazagon Dock had a weak session on Friday but has now bounced back. And look at Solar Industries. That's the other one which has moved higher. Manappuram Finance too. Gaurav told us the results were slightly shy of street expectations, but that one too has recovered from the lows, currently at the high point of trade. Take a short break, come back, get you more of the markets and a lot of stock-specific action. Stay with us.
Welcome back. Well, the markets have hit a century right now. It's been a long time coming, but it seems the bulls finally, they have found the form. And in fact, now they're seeing the ball big, hitting a good 100 runs as we speak. The Nifty Bank up 270 points, so things are good. Mangalam, and we will take some credit that we have been the good luck charms. The last 30 minutes, in fact, has been quite good, Mangalam. Number of stocks advancing, way more than the number of stocks declining. But now the pressure is on team trading hour.
It is on team trading hour also because while, the first runs were easy to get, now we have the 100-day moving average coming in on the Nifty closer to that 24,500 mark. So first start belongs to the bulls. Let's see where the next part goes. The good part, however, is that from the time we started the show to now, we've seen a mild smidge of a downtick on the India VIX as well. So if things are looking better and continue to look better, who knows, we can see a bigger move in the latter half of trade. With that, we wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Reema Tendulkar and Hormis Fatakia. Good morning guys. It's a Monday morning but a truncated week. And you know, I was hearing Nigel and Manglam, they took credit for the surge that we're seeing in the Nifty today and they put it on us. They're like, the Trading Hour team has the pressure to see whether it continues or not. Jokes aside, of course, last week was 6 consecutive weeks of losses for the Nifty. Today, we are seeing some rebound, of course. It touched that 100-point uptick mark as well. Right now, up around 93 points. Banks are doing really well, lending support to what we are seeing in the markets currently. Earnings coming in thick and fast, so a lot of reactions to that as well, which we are talking about in greater detail. So if we talk about the major indices right now, Nifty at the day's high for sure. We have mid-caps which are gaining 0.6% there, and that is an outperformer as we speak. Banks are lending support. All the sectoral indices, they are in the green right now. Nifty PSU Banking Index, that's lending support, and that explains the move that we are seeing on Bank Nifty as well. But again, we are towards the fag end of the earnings season. So a lot to talk about.
Indeed. Let's just take stock of the big movers at 11 o'clock right now on the, at least in the Nifty large cap screen. It's Tata Motors right on top. Profits were down 35%, but largely the impact was an account of tariffs. And excluding that, analysts say numbers were in line, plus the stock is corrected 14% from the start of the year. And now all eyes will be on the festivities to see if we can take it forward. SBI continues with its gains. Some of the pharma names, Sun Pharma, Cipla, Dr. Reddy's, these are higher by 1.5%. Trend is a big mover, 2.5% up on Trend this month. It's seen a gain of close to about 9% thereabout. But Hormis has now moved over to the big wall and he's going to put the spotlight on some more stocks. Hormis.
Some obvious cases and some that have sprung a surprise among the movers and the first couple of hours of the trading session. Can't not talk about PG, Electroplast, and barring the last 2 days, the stock is now down for the 4th straight session and it has almost shed 40% in those 4 sessions. And just as the management was speaking to us earlier in the day, there was a block deal worth over 500 crores that took place in the stock. And as a result of this block deal, we have already seen 3 crore shares of the stock already being traded compared to a 20-day average of just over 6.5 lakh shares. The stock down 16% as we speak. The other positive surprise has come in from Yatra Online and it's a result reaction, a 20% upper circuit on the stock. It is the best single day gain since the stock has listed and 60 lakh shares have already been traded on the stock compared to its 20-day average of just 1.5 lakh. But despite this move today, the stock remains below its IPO price, which is of 142 rupees a share. HBL Engineering is the other one among the top gainers on the small cap index today. It's the biggest single day gain it has seen since March of this year. We've already had 1.5 crore shares that have traded in today's session compared to a 20-day average of just over 2.5 lakhs. So a very sharp volume mover on the upside. And as a result of this move, the stock has turned positive on a year-to-date basis, continuing with its trend of delivering positive annual returns every single year since the start of 2020. And a negative mover today has been HDB Financial, and after a ho-hum to steady listing, the stock is back to its IPO price of 740 rupees a share. Just last week, the stock even slipped below that, making a low of 732, and multiple analysts initiated coverage on the stock today, but none of them see any significant upside on the stock. So while NSDL continues to scale newer heights, HDB Financial, another major IPO of the year, is back at its issue price.
Okay, all right. Thank you so much, Hormas, for joining us. So with that list, as always, that's one set of stocks which are in focus and they're buzzing either on the upside or on the downside. The other pocket that I'm watching out for is the oil marketing companies. They open with a spike but are off from the highs of the day as well. There is an important news that has come by, and that's the LPG compensation that the government has announced to be given to oil marketing companies, 30,000 crore rupees in terms of LPG dues. This is, of course, lower than the 41,300 crore rupees, which is pending till date. Nevertheless, it is a positive for these stocks. However, it is unclear whether this is a one-time grant for the remaining losses or they will be compensated as well. So that remains to be seen. For now, Jeffrey says that they estimate an upside of 29 to 42% on EBITDA for FY26 and 38 to 70% for profits. And this is assuming that the compensation is fully paid by in FY26 itself. ICICI Securities says that LPG compensation is a material boost to fortunes. It helps offset margin worries in FY26 FY26 itself. Morgan Stanley says they prefer HPCL and BPCL. It could boost FY25 earnings by 75%. Their deleveraging could happen by 12% and consistent return on capital employed between 14 to 15%. But there is a downside risk if fuel prices are cut. That is something which would mean under recoveries in the other part of their business as well. UBS says that payment is equal to 74% of their FY25 dues, 62% of dues till date. That is 41,300 crore rupees. It's around 8 to 16% of the book value, June 2025 book value, and equivalent to 6 to 9% of current market capitalization of all these companies. So a definite positive, but the stocks have come off sharply from the highs of the day. So to understand that, let's get in Nilesh Ghuge, who is the institutional analyst at HDFC Securities. Nilesh, good morning. Thank you so much for joining in. First up, what do you make of the compensation that has come by? Do you think the companies will see a major change with just this, or they need more in terms of compensation?
Yeah, hi, good morning. So, as you mentioned that already they lost about 41,300 crore in FY25, and this 30,000 crore is not sufficient to compensate for the last year's under recoveries. Still this year also, till date, the company are making losses on LPG per cylinder in the range of about 165 to 170 rupees per cylinder on their subsidized cylinders. So these are not adequate, but still I will say it's a slightly positive because at least they are getting something to compensate, some compensation out of their 41,300 crore loss last year. So that's the positive part out of this.
Nilesh, as you said that, it's good, but it's not adequate. So do you think this is going to be a one-time grant, or will we see continuing support from the government? What happens to the balance 11,000 crore of under recoveries which is still pending?
Yeah, there is no clarity as we speak, but in my opinion, government will compensate in due course of time. But it will not, if you look at the current compensation, it is not adequate. So in due course of time, they will compensate oil marketing companies, not through direct subsidies, but maybe through another way to compensate, to earn some marketing margin or something like that.
You know, Nilesh, there has also been a cut to the number of LPG cylinders under the Ujjwala Yojana. Does that do anything to offset any potential further loss that could have happened from the under recoveries, or even that is not a very meaningful step to offset any further loss that could have come across for these companies either?
Yeah, this will definitely help. On top of that, if you look at the step that Ministry of Petroleum has taken in April, on 8th of April, they already raised prices of cylinder by 50 rupees. At the same time, the benchmark Saudi prices, the LPG prices, have already corrected from the peak of about $630 in December, January to now around $430. So already they have corrected. So these 2-3 things will definitely help oil marketing companies to cut under recovery in FY26.
Nilesh, what are the current marketing margins for these companies that we are seeing right now? Do you think there is a possibility there could be a fuel price cut?
I do not see in immediate effect any cut in the marketing margin. They will continue to earn decent marketing margin. Government may allow them to earn marketing margin.
If you can quantify, what are the current marketing margins on both petrol and diesel, and the average as well currently?
Yeah, our back of envelope calculation indicates that it's in the range of 8 to 10 rupees on petrol and diesel, in that range.
And what would your top picks be in this space? What is something that we are watching out for? Because we are looking at refining capacities globally. We are seeing a lot more supply that has come by. Singapore GRMs did see an improvement, but that's not something we saw in HPCL's numbers as well this time around. For IOCL and BPCL, the numbers are yet to come. What is one important thing that investors should be watching out for in FY26 when it comes to OMCs?
Yeah, we do not see a significant jump in refining margin. But oil marketing companies will continue to gain on the marketing front. That is a positive for oil marketing companies. Yeah, you are right. They already increased the capacity, particularly the HPCL expanded their capacity, and that will boost their EBITDA and PAT in going ahead. But in the space, oil and marketing, in the oil and gas sector, we are positive on CGD compared to oil marketing companies.
And in CGD, you like both IGL, MGL, or you have a preferred pick?
Yeah, I prefer MGL over IGL. Yeah.
Thank you. Thank you very much, Nilesh, for joining in. Get into a break. On the other side, we'll put the focus on crypto market. Manisha will join in on the other side.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. It's Crypto Corner time, and Manisha is here to tell us what is happening in the world of the digital currency. Today, she's telling us how to invest and what to do with your investments in crypto. Manisha.
Oh, well, absolutely. In Crypto Corner, we're talking about how to invest to begin with. And with these investments as well, you can earn passive income. So it doesn't just stop at buying and holding, but also earning on that. So let me remind you that India is one of the leading crypto markets with many centralized exchanges. All you have to do is open an account there and you could start trading. Also, let me tell you that owning and trading and holding cryptos in India is legal with profit taxable under law here. Also, just to take you through the kind of taxes that we have at this point in time, it's a 30% tax on profits on whatever you earn, 1% is a TDS, and there is an additional 4% cess for health and education as well. So heavily taxed, but it is allowed to be traded in Indian markets there. Just to give you an example, losses here cannot be offset in sense of profits in crypto. So if you have made a profit in case of your crypto tradings, 34% of that goes to the government. But if you made a loss, then 100% of that loss is to be borne by the investor itself. Well, all crypto exchanges in India have a KYC verification. So you have to, once you open an account, there would be a KYC verification, and then you can start buying crypto with as low as 100 rupees as well. There are a lot of people who are now doing SIPs, buying disciplined as well, and absolutely buying in those blue chip cryptos there. Well, as of now, crypto is not recognized as a legal tender in India, and it lies outside of the traditional banking system. Interestingly, you can actually earn on your crypto holdings as well. One of that is yielding. Lenders can earn yields that often exceed traditional saving rates, as the history has shown us. Also, borrowers get access to capital for a leverage trading here. You also are looking at centralized services after fixed rates and institutional security. Apart from yielding, it also has to do with staking. People tend to earn with staking as well. This is a practice of locking your digital tokens to a blockchain network. Well, with this, what you can really do is that the investors earn awards, which is usually a percentage of tokens that you would be staking. The on-proof blockchain is something that leads it to security, and staking earns the right to participate in proof-of-stake blockchains as well.
Okay, all right. Thank you so much for all those details, Manisha. With that, we'll do one thing. We'll slip into a break. When we come back, we'll get you more on the markets and stock-specific action.
CNBC TV18 presents Crypto Corner, powered by CoinDCX. से पढ़ें।
Welcome back. The mid-cap index is holding up pretty well, up about 0.5%. EPAC Durables has slipped nearly about 3%. Remember, there was a large block deal which took place last week. Augusta Investments, which was a significant public shareholder in EPAC Durables with a more than 10% stake, has not exited, but sold close to about 5%. So that's a stock which is under pressure and slipping a tad bit. And Sri Lotus Developers, one of the recent listings from last week, very strong listing, and that stock has retreated a bit. Nagaraj Shetty from HDFC Securities is now joining in for a quick technical check on the markets. Nagaraj, good start to this truncated short week. Do you think we can build on the momentum at this level? Is there a trade? And then your stock calls.
Hi, good afternoon, Rima. Market has been in a downtrend, no doubt, on the daily chart. Market has been drifting down by forming a lower tops and bottoms. There's just a pullback rally of a downtrend. I'm not expecting any bigger upside from here onwards. At higher levels, 24,500, 600 is going to be a strong resistance. I wouldn't be surprised if Nifty come down again towards the recent low of around 24,300 in the near term. But important support is placed around 200-day EMA, somewhere around 24,200 levels. So from the stock side, I have a mixed strategy. One is from long end, one is from short. PSU banking has been in a consolidation phase, and recently it has outperformed the benchmark. And the Indian Bank, what we can observe on the chartically is making an attempt of upside breakout of the larger consolidation band somewhere around 650, 660 levels. The overall chart pattern is looking positive. Currently trading around 660. One can look to buy at this point of time. And the upside target would be around 700. And one can place a stop loss at 640. And second one is from a short side. IT has been laggard recently. We have seen consistent decline in IT over the last few weeks. And the Coforge is the one is continuously downtrend. In a downtrend, low tops and bottoms is on the chart. Recently, it has broken below the crucial support of 200-day EMA, currently trading around there. Currently trading around 1609 levels. One can look to sell at this point of time, and one can place a downside target of around 1535 levels. One can place a stop loss at 1650.
What about PG Electroplast? Nagaraj, you've come down from 700 plus to sub 500 now. Does this 500 level prove to be a bit of a floor, or do you see more downside now on these distorted charts?
Yeah, I'm expecting more downside. The way it has reacted down after moving into a larger consolidation looks like a strong downside breakout. And though placed at the support level, still there is no indication of any reversal pattern forming at the lows. There is no indication of any buying emerging from the lower levels. I think 450 is going to be the next support for the stocks in the near term.
Okay, all right. Thank you so much, Nagaraj, for joining. And that's about PG Electroplast. The stock is down 15% on that guidance cut. In fact, we have a lot of stocks which are on our radar. AC stocks are under pressure, of course. Ria is joining us with some details, the valuation picture, and a sectoral outlook as well. Ria.
Well, yes, today a lot of these AC and cooler stocks are facing a lot of pressure. These include PG Electroplast, Voltas, Amber and Bluestone. In fact, PG Electroplast is down as much as 15% after ending at a lower circuit of 20% on Friday. So let's see what's hurting all of these stocks. First, we've seen weak earnings coming in from Voltas in this quarter. PG Electroplast also reported a very weak set of numbers, and they've cut their guidance in a very major way for FY26. And we also have high inventory concerns weighing on the entire sector. So for Voltas, the Q1 FY26 numbers were below estimates across the board. The revenue was down around 20%. Even the EBITDA and net profit have seen a fall of around 58% each on a year-on-year basis. And the EBITDA margins have halved to just about 4.5% versus 8.6% in Q1 of FY25. Now, a lot of brokerages have come out with notes on Voltas. Nomura has maintained a neutral rating on the stock. They've said they've lowered their FY26 RAC industry growth estimates to 5% versus their earlier estimates of 10%, and they've also cut their FY26 and 27 UCP revenue growth estimates to 6% and 24% versus their earlier estimates of 13% and 21%. Jefferies, on the other hand, on Voltas has maintained a buy call. They've said that from here on, for the early festive season, the possibility of a second summer and the new BEE rating and tactical cost control could help RAC recovery going ahead. Moving to PG Electroplast, they've cut their FY26 guidance. The revised revenue growth guidance is now at 17 to 19% versus the earlier estimates of around 30%. And the net profit guidance has also been lowered to just about 3 to 7% versus the earlier estimates of over 39%. So a very major cut on the net profit estimates as well. But going forward, the company has said that, first of all, they've said that the revision of guidance was due to the lack of rebound in AC sales in July and August. But going forward, they are expecting a normalized inventory level of inventory in October and November, and that one season doesn't affect their overall business trajectory for the year. Now, just coming to the valuation picture quickly, for PG, Electroplast and Voltas, they are trading below their 3-year averages at the moment, and Blue Star and Amber are trading below their 3-year averages.
Thank you very much for that. Earlier today, we also spoke to PG Electroplast, and that continues to remain under pressure. We spoke to Vikas Gupta, Managing Director, and we kept trying to ask him to understand that why the company couldn't give an indication that things are slowing down. Because this cut in guidance came as an absolute shocker, especially the extent of the guidance cut, especially when all signs were there, signals were there of a slowdown in AC sales. Listen in to what he had to say and what the outlook is going ahead.
As the channel inventory built up and there was no rebound in the sales for the air conditioners, the secondary sales of the air conditioners in the months of July and August, as we are seeing now. So we had to revise our guidance accordingly. In the month of May also, we were hoping that the market will improve, the demand will improve. We were having the order book, we were having the forecast from our brands, our customers, that was quite robust, and we were building on it, and we were believing that numbers, and we were going ahead with those production numbers. So it was only later in the in the month of June that we saw that the secondary sales are not picking up and the channel inventory is becoming huge. And that's when the demand from the brands fell off the cliff for us. And we realized that we are sitting on a huge inventory for us. We are already working on those capex guidelines that we have given earlier. We are building on our new product diversification. We are working the new launch of product platforms. We are building up new capacities. So the long-term story of the business remains intact. It cannot be impacted by the one single week summer. As of now, we do not see any downside risk to that number. So definitely the margins are getting impacted. We know that. But as of now, we do not see any downward risk to that. Level of inventory is almost a 1-month production. So we feel that by the month of October or November, we should be normalizing the inventory levels to a level of 1-month production. So we already have some kind of indication from the customers for the coming season, and we are working with them to see how to recover the situation. The equity holding of the promoters is, I think, 43% or 45% or 47% does not make any difference. It is that the commitment of the promoter family towards the business is more important.
All right, that's an important commentary coming in from PG Electroplast. With that, we'll slip into a break. Up next, we'll discuss the market fundamentals with Sunny Agrawal from SBI Securities.
Welcome back. Still some bit of resistance at that 24,500 mark for the index, but still holding on to some bit of gains. Just before we go to Mangalam for his F&O setup, they're still holding on to the day's high. But pull up NSDL, that has seen a bit of a cool off now from the highs after a move from 800 to 1400 plus. NSDL is now moved into the red, and it's a very, very sharp sell-off that the stock has seen from the highs of around 1420 now to around 1280 levels. A 1.5% lower is NSDL. So almost 10% off the highs of the day has NSDL moved, a very sharp move from the highs of the day. Over to Mangalam now to tell us what the F&O data is indicating as the index moves closer to that 24,500 mark. Mangalam.
Well, the market has pulled back, 6 consecutive weeks of losses on the frontline index, and now it looks like maybe from oversold levels, there has been a bit of a bounce back that we've seen. Almost 100 points for the Nifty Bank doing better as well, and the Midcap index. And if you look at the tug of war that is taking place in the Midcap end of things, the advanced decline. Now the green line is marginally above the red line after a bit of a smidge and pull and push in the earlier part of today's trading session, but it's only again marginal. So seems like maybe the first couple of hours did belong to the bounce back. The question is whether it sustains or not. Going from here on the way up would be tough because of a couple of factors. One, even as the markets moved higher, what's also moved higher is the India VIX. Usually for the market to sustain higher, you would like to see the India VIX come off a little bit. And secondly, the Nifty, today's high has been very close to the 100-day moving average of 24,494. So if only we cross beyond that is something that we will watch out for. And can we sustain and cross beyond that? The answer to that question lies on the Nifty Bank. So what's a resistance for the Nifty is actually a support for the Nifty Bank, which is the 100-day moving average, closer to that 55,000 mark. And just as we speak, the IT stocks are picking pace. So if they continue to do higher, you will have 2 engines of the Nifty taking it higher as well. But amidst all of this, we've seen a lot of shorting activity take place in a couple of stocks, Amber and Blue Star. So all of these consumer discretionary names after a weak summer are seeing some shorting activity, and one stock that is most likely to go into F&O ban today is PG Electroplast. We've been talking about how the stock had underperformed ever since it trimmed its guidance and came out with poor numbers, and the management joined us on this channel today as well. Stock's down another 15%, taking this monthly losses to almost 40%, and with the kind of open interest surge that we've seen at 105% of market-wide position limits this early in the day, the stock's most likely to go into F&O ban, so I'll watch out for that.
All right, so that's the F&O setup. Thank you so much, Mangalam, for joining in with that. Let's go across to Sunny Agrawal from SBI Securities now to discuss the market fundamentals. Sunny, thank you so much for joining in. What is the market factoring in? Is it the tariff situation? Because we still have till 26th of August to get the next round of negotiations as well. Is it earnings? Because it's the 6th consecutive week of losses that we saw on the Nifty, but today we are seeing some green. What, according to you, will be the next big trigger for the markets?
Yeah, good morning and thanks for having me on the show. I think, definitely, trade, a tariff negotiation is something which is a big overhang on the market, and that is leading to weaker sentiment as far as the last trade is concerned. But I think going forward, ultimately, markets are driven by the earning growth, and even the earning growth this quarter has been kind of a mixed bag. Even within a sector, we are seeing a few companies reporting a better earning compared to their peers. So I think September quarter onwards, we believe that the earning for Nifty 50 and broader universe should scale back to a double digit. If you remember, last September quarter was the first quarter year over year where we have seen a kind of slowdown in pace of earning growth due to the lower government capex. And on the low base, we are expecting that September quarter onwards, the earnings should rebound to double digit, and that should at least help the market to sustain at the current valuation, which is close to 20 times to 1 year forward price to earning multiple. Having said that, we believe that at current juncture, the action is stock specific. The companies which are delivering a decent set of numbers with an healthy growth visibility over the period of next 4 to 8 quarters, their street is rewarding those companies. So I think going forward, anyway, market is likely to be a stock specific.
Sunny, hi. Morning, Rima here. Talk to us about Tata Motors. Numbers were okay. Their EBITDA was down 35%. The company said that the tariff impact will be 500 to 600 million pounds in FY25 itself. But the stock is up 2.5%. What is it that the street is excited about, post the numbers or from the commentary or looking ahead?
Yeah, so coming to Tata Motors, I think most of the negatives were already in the price. So we have already seen that stock has corrected from highs of close to 1100 to now trading close to 700, 600 price band. And I think anyway, Tata Motors has cautioned the street on the weaker growth expectation for the fiscal year 26. And on the top of that, because of the global uncertainty, we have already seen a weaker set of numbers reported by Tata Motors. So I think on valuation front, we feel that most of the negatives are priced in, and hence we have not seen an adverse reaction in today's trade. Once we get more clarity on a growth trajectory as far as the both the domestic portfolio on passenger vehicle as well as on international front JLR portfolio, at that point of time, street will start rewarding Tata Motors shareholder. At a current juncture, we believe that M&M is relatively well placed, and hence that stock is also trading close to 52-week high. Both the businesses firing simultaneously. One is passenger vehicle and other is farm equipment segment. So we have got a buy call on M&M with a fair value of 3,600.
Sunny, what about the recent listings, the two major ones that have listed in the last 2 months? HDB Financial is one of them. It was a somber listing, and since then the stock has only flattered to deceive. It's only now back to its IPO price. Whereas on the flip side, NSDL has moved from 800 to 1400 plus and has now seen a very, very sharp correction over the last few minutes. Would you advise booking profits here in NSDL, considering the move that it has seen? And also if you have a view on HDB Financial.
Yeah, so coming to NSDL, yeah, definitely at the time of listing, the valuations were relatively cheaper as compared to its peer CDSL. And now post recent run up, now I think the valuation catch-up game is over. Sorry. And going forward, in case NSDL is able to catch up on a retail side in terms of market share gain on account opening front, we believe that NSDL can sustain a relatively expensive valuation compared to CDSL. So we need to track the data. Yes, obviously, if somebody has got an allotment during an IPO, we have seen a very decent up move. And if somebody was looking for a short to medium term gain, one they can look to book the profit. But if somebody is a long term investor, I think any dip over the period of next 5 to 10 days can be a good opportunity to add to the portfolio. Coming to HDB Financial Services, again, as we have seen that certain pockets are witnessing an asset quality issue, whether it is MFI or unsecured book, and that is something which is weighing on all the NBFCs company. And we have recently seen some NBFCs reducing their growth guidance, and that can have an rub-off effect on other financial services or NBFCs firms like HDB Financial Services. I think, again, long term, we believe the growth opportunity for this entire NBFC industry is very well, and going forward, maybe 12 to 13% kind of advances growth, it should not be an issue for large players like HDB Financial Services. I think any correction is a good opportunity to accumulate in the portfolio.
Okay, so that's about some of the new listings. Sunny, what about these oil marketing companies? This particular announcement of compensation of 30,000 crore rupees, it is positive, of course, but the stocks have come off from the highs of the day. What take do you have on the entire space?
Yeah, so coming to oil marketing companies, yes, definitely, I think this news flow was positive, but I believe that the ongoing trade negotiation wherein there can be an reduction in sourcing of a discounted crude from Russia, that can have some negative sentimental impact as far as oil marketing companies are concerned. We believe that on valuation front, anyway, oil marketing companies are trading at a very reasonable valuation. So downside is limited, risk reward continue to remain favorable. I think again here our top pick will continue to remain HPCL. So once this trade deal overhang is through us, then we may see again a bounce back in all the oil marketing companies. But if I have to pick one stock, HPCL is the one stock wherein we believe the fair value is close to 480 rupees.
Okay, HPCL, so about a 20% upside from current levels, 480, the preferred pick. Thank you very much, Sunny, for joining in. Get into a break. On the other side, we'll put the spotlight on buzzing stocks like Yatra Online and Siemens.
Welcome back. You're still tuned into Trading Hour. Well, before we get stock specific, let's quickly take a look at the Nifty. It's down sharply from the highs of the day, up just 47 points as we speak. When we started the show, the Nifty was up around 100 odd points. In this hour itself, we've seen some fall from the highs coming in for the likes of ONGC, there's Hindalco, Eternal, names like IndusInd Bank. That stock should also come up for you on the screen. So IndusInd Bank has come off from the highs of the day. We do have the likes of Hero MotoCorp, Tata Motors. Some of these big names are seeing some fall from the highs as well. Tata Steel is one of them, which is at the day's low as we speak. So is Bajaj Auto. So some of these auto names are leading to the fall that we're seeing from the highs for Nifty currently. We'll keep tracking those moves for you, but let's get stock specific now. Siemens is the stock on our radar. Vamakshi is joining us to tell us why the stock is on our radar today.
Well, Sonal, the stock is in focus on the back of its Q3 September year ended 25 numbers. Siemens follows a September year end, so which is why it's Q3 for them. Keep in mind that the revenue growth here came in at almost 16% on a year-on-year basis. This is 4% higher than what we were expecting, and therefore it's driven by largely better execution. But on the flip side, when you look at the operational performance, the other expenses grew by almost 40%. The project bought outs and other direct costs were up almost 22%. Resultantly, the EBITDA margin came under pressure, down almost 90 basis points, and in fact slightly lower than what the street was anticipating it as well. So therefore it's a miss as far as the EBITDA margin is concerned. EBITDA came in 7% higher, but the net profit declined by 3% on a year-on-year basis, and that is because the other income declined by almost 21% on a year-on-year basis, and therefore it missed the street expectations. Let's also look at how specific segments performed this time around. Good growth came in from mobility, which was up almost 34%. The smart infra business also, which is a major contributor to Siemens revenue, saw an uptick of almost 21%. But what did not do too well is the digital industries, which was down almost 5%, and low voltage motors also saw subdued growth of around 1%. Now let's look at how each of these segments contributed to the margins as well. The sharpest fall came in low voltage motors, down almost 1,150 basis points. The margins for smart infra also were under a tad bit of pressure. But on the flip side, mobility and digital industries reported an improvement in their margins as well. Ordering activity came in at 5,680 crores. This is the order inflow. This is up almost 13% on a year-on-year basis and has come in higher than what some of the brokerages were anticipating. So bodes well for the company. The order book too seeing an uptick of 8%. Nuvama has a hold rating target price of 3,170 rupees per share. Overall, operationally, it's a weak set of numbers, but the ordering activity was good, and probably that could be the reason why the stock has seen a good recovery.
Indeed, Vamakshi, thank you for that. 2.5% higher on Siemens, a very sharp recovery from the lows of the day, almost 150 plus rupee pop from those levels. On the other side, Yatra.com online is the other one, a 20% upper circuit on the stock after its results. Mangalam is here to break down those numbers. Mangalam.
Well, good performance coming in from Yatra.com. In fact, if you look at the large part of their business, which comes in from corporate travel, that's actually done well for them. And additionally, if you look at the reported numbers as well, if you compare it to what the company reported same time last year, even as the gross bookings have grown just 9%, the company's own revenue recognition has led to a big jump. 100 crores has turned into 209 crores, and that's flowed down all the way to the bottom line. So EBITDA has actually risen from just 4.5 crores all the way up to 23 crores, telling you that there has been a sharp margin expansion from 4.5% all the way up to 11%. And that's not all. We've had the net profit as well surge all the way up from 4 crore to 15.9 crore. Remember, gross bookings are up 9%. So what explains this big improvement in performance? Their take rates have improved. At the same time, their revenue from corporates have improved. And their hotels and packages business, along with contribution coming in from the meetings, events, and all the other sectors, has seen a big surge. They've also closed 34 new corporate accounts during the quarter, and gross debt for them has come down from 54 crores to 2.9 crores quarter on quarter. So that's aided their finance costs too. If you look at the gross margins, air business as well has seen a big surge in gross margins from 3.1% to 4.6%. And remember, while on an absolute level, these look small, 3 to 4 or 4.5, or for hotels business, 7.5 to 9%. But the kind of volumes that these online travel aggregators work on, even a percentage basis points improvement in margins actually has a bigger impact on their overall numbers. And that's something that we're witnessing on a low base. Strong performance, and the stock up 20%.
Thank you very much for that. Get into a break. On the other side, we'll talk about ICICI Bank. It's raised the average minimum balance to 50,000. Welcome back. Now, ICICI has decided to increase the minimum balance to 50,000. Now, the question is, what are the implications of this? What happens to people with the lower income who do not have sufficient balance to keep their account going? Why has the company done that? Is there a regulatory angle to it? Ritu joins in with her understanding. Ritu.
Well, Reema, starting the 1st of August, and this is already in effect, ICICI Bank has significantly increased the minimum monthly average balance that is required for new savings accounts. So, for instance, just to quickly recall the charges for customers in metro and urban areas, the new minimum monthly average balance is 50,000 rupees, which is 5 times the earlier amount of 10,000 rupees. In semi-urban branches, it rises to from 5,000 to 25,000, while for rural branches, it is doubled to 10,000 rupees. Now, this is the highest minimum balance savings account customers have to keep across any bank in India at the moment. Now, if the required minimum balance is not maintained, ICICI Bank is going to charge a penalty of 6% on the shortfall or 500 rupees, whichever is lower. But keep in mind, these changes apply only to the new savings accounts that are opened on or after the 1st of August. So existing accounts will continue under the current minimum balance rules. There are also some accounts which are exempt from this hike altogether, and that includes all salary accounts, pension accounts, the basic savings bank deposit accounts under RBI guidelines, the PM Jan Dhan Yojana accounts. They all remain zero balance accounts. Now, the big question that everybody seems to be asking, why did ICICI Bank do this? Now, while the bank has not officially given any statement yet, the move is being seen as a clear strategic shift away from masses to target the more affluent customer segment. Now, for the bank, this makes sense because this will bring various benefits, more stable deposits, improvement in CASA, higher balances that will come in at lower savings rate compared to, the higher FD rates the bank would have to pay, so lower cost of funds, improvement in margins, more premium cross-selling opportunities, strengthen the liquidity position, and the potential, of course, to reduce the dormant low-value accounts, to name a few. But to put this in perspective, other private banks like HDFC, Axis, Kotak, Yes Bank, they usually require about 10,000 in urban areas, which is much lower than ICICI Bank's new level. Now, in contrast, of course, there are public sector banks like SBI, Canara, Punjab National Bank, to name a few, that have no minimum balance requirement at all. So for customers, there is a wide variety of options that remain open, but for new ICICI Bank customers, 50,000 rupees minimum balance is something they will have to maintain. It'll be interesting to see if other private banks also follow the move and how the regulator reacts. Now, to be clear, ICICI Bank is not breaking any rule because RBI merely says that bank charges should be reasonable and they should be commensurate with the cost of rendering the service. But there is no prescribed cap on the minimum balance that banks can have for savings accounts.
Okay, thank you so much, Ritu, for joining us and explaining that to us. This is something which is very important from consumer interest point as well. So thank you for making sense of that news. With that, we'll take your leave on this edition of Trading Hour with the news that Nifty has come off sharply from the highs of the day. It's up 50 points, a 50-point downtick from the highs, though still in the green. That's the case across the major indices. From Reema, Hormuz and myself, thank you so much for joining in. Stay tuned. Halftime report comes up next.
Stocks perk up on hope of some forward movement on resolving tariff issues, even as calls for domestic reforms rise. Realty, industrials and power are key gainers, while domestic consumer durables and FMCG drag.
In a significant relief for oil marketers, the government has agreed to allocate 30,000 crores payable over FY26 and FY27 to partly compensate them for their over 40,000 crores in under recoveries. The stocks perk up on the news.
Tata Motors takes a hit on the US tariffs and expects an impact of 500 to 600 million euro in FY26, but an easing to a 300 to 400 million thereafter, even as it holds on to its FY26 guidance for JLR. An undemanding valuation supports the stock.
PG Electroplast tells CNBC TV18 they were operating at over 100% capacity till early June with strong orders on hand before demand fell off a cliff, catching them off guard. And while inventory remains a big issue for now, the company argues the future trajectory won't be altered by one bad season.
ICICI Bank tilts its focus towards high-income, high-net-worth customers by upping the minimum account balance in saving accounts for all new customers from August 1. Experts express concerns over the medium-term impact, even as several savers plan the move.
Hello and welcome to Halftime Report, live from the CNBC TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session where we're just about consolidating with a positive bias at this point in time. So we've started in the green. Let's see whether we manage to end that way, considering that it's been 6 weeks of weekly losses that we've seen for the market. So maybe this week will be lucky. And remember, it is also a holiday shortened week. So maybe some luck in the next 4 days. But nonetheless, for the markets, it seems to be a lot about specific stocks in today's trading session. May it be Tata Motors, may it be ICICI Bank or PG Electroplast, it is about specific stocks. And when you're talking about earnings today, a lot of focus in terms of the broader market numbers, because that seems to be where the crux of the numbers would be from. So the likes of Tilaknagar Industries to Ipca Laboratories and a couple of others such as even Krishna Diagnostics and BML. So that'll really take focus or center stage probably in the second half of the trading session. Hi, Mangalam.
Hi, Ekta. A lot of individual stocks on our radar. Maybe the early bird gets the worm for the market. And let's see whether the going continues to be as smooth. The early signs so far, the first half of trade, we've seen some decline from the highs. So for the Nifty, it's important to go ahead and cross that 24,500 mark. We've seen a big spike in India VIX as well, so we'll watch out for that. And there is that tug of war which has taken place in the advanced decline ratio. For a large part of today's trading session, we had, the green line above the red line. And now, just the last 15 minutes or so, the red line has claimed its superiority over that one back. But then again, who's to say? It's right in the middle, split right down the middle for 1,400 stocks in the green, red for about 1,300 stocks in the green. Among the stocks which are in the green right now, Adani Group, causes a notable mention. It's up 4.5% for Adani. And if you look at Adani Ports as well, that's doing well. Remember, these stocks were fairly well sold on Friday's trading session. So now seeing a bit of a pickup once again. And if you pull up something like an Adani Total Gas as well, that's seeing some purchase. The stock has moved to the higher end of today's trading range. But it's the oil marketing companies which are doing a lot better in today's trading session as compared to the other parts of the markets. This as the government has agreed to allocate 30,000 crore rupees as payable over over this financial year and the next financial year to partly compensate them for their over 40,000 crore rupee under recoveries. Stocks mildly higher, though off morning highs. Sonal joins in on the news. Sonal.
Well, thank you for that. It is a big news that has come by, and the street was waiting for this for a long time. That is the 30,000 crore rupee compensation that these companies have received in form of LPG subsidies. Now, do remember they have under recoveries to the tune of 41,300 crore rupees till June 2025. So only a part of it is what they have received. What we don't know whether this is a one-time compensation or whether there will be more tranches of this compensation that will be given to these companies as well. Nevertheless, brokerages, they are quite positive on this one. Jefferies says they estimate an upside of 29 to 42% on EBITDA for FY26. In terms of profits, it will be around 38 to 70%. But this is only when they get the entire compensation in FY26. They will be paid in tranches. We don't know whether all these tranches will take place in FY26 itself. ICICI Securities says that LPG compensation is a material boost to their earnings. It takes away the margin worries for FY26 as well. Morgan Stanley, they prefer HPCL and BPCL. They say subsidy could boost FY25 earnings by 75%. Deleverage their balance sheets by 12% and support a consistent return on capital employed to the tune of 14 to 15%. There could be a downside if fuel prices are cut by 1 to 2 rupees per litre on the marketing side, but that's a limited downside that they talk about. UBS says that the payment that they are receiving right now is equal to 75% of FY25 dues and 62% of the dues which are accumulated till June 2025. So that's around 62%. It is equivalent to 8 to 16% of their book values for all these three stocks for FY25 and is equivalent to 6 to 9% of current market capitalization as well. So yes, it's a relief, but a lot depends on what's happening with crude sourcing as well. Maybe that's the reason the stock are not reacting as positively as it was expected. But nevertheless, it is a positive news that has come by for the entire sector.
Okay, all right. Thanks very much for that, Sonal. Well, yes, definitely positive news coming in there for the OMCs or the oil marketing companies. But let's talk about Grasim now, which is in focus as the company reports an improved performance in the quarter gone by. Nigel is here with the earnings fine print. Nigel, over to you.
Well, that's right. Grasim has reported an improved performance in the first quarter itself. And if you look at the absolute number on a year-on-year basis, there's an improvement out there. And the margins, for the standalone business as well have improved on a sequential basis. Quarter 4 FY25 seems to have been a bit of a bottom year. And from there, we are seeing some improvement in margins from around 2.5%. It's holding at around 4.7%. And what drove this improvement? Well, the chemicals business. That clearly has seen a big improvement. So the chemicals business, EBITDA, has now clocked more than 400 crores. That compares with around 300 crores on a year-on-year basis as well as on a sequential basis. While the fibers business as well has done some kind of improvement, particularly on a sequential basis. So chemicals business improving, that's what's led the way. Besides that, the newer businesses, paints as well as B2B, that are clocking more than 1,000 crores a piece now on a quarterly run rate. The losses out there have come down. So from around 350 crores of EBITDA losses, that's down to around 300 crores. And both these two are scaling up rather well. Brokerages, well, they're quite enthused with regard to these numbers. Jefferies, they retain their buy rating. They've gone ahead. They've increased the target price to around 3,500 rupees. They say that scaling up of the new business, that's the key trigger with regard to the valuation re-rating. Motilal Oswal, they as well have gone ahead. They've increased their target price to around, the 3,500 or thereabouts. They have raised their EBITDA estimates as well because the first quarter's numbers were quite good. So that's why they've tinkered with that. They point out that the holding company discount is at around 41% and the average of the last 3 years is close to around 37%. So that holding company discount as well a little bit higher. Nuvama, they retain their hold rating, but they've increased the target price to 2,971. They increased their FY26 EBITDA estimates by around 20% because of the beat that we have seen in the first quarter. The reasons are they feel that Grasim is a value buy. The global VSF cycle, well, that's near the bottom, which, they are pointing out. And also they say there's potential long-term value, particularly in the paint segment. So the standalone numbers look quite good, particularly with regard to the chemicals business. The losses in the newer businesses, that's B2B as well as paints coming down. Brokerages upping the estimates for this year. And that's why the stock holding higher in today's session.
All right, Nigel, thanks a lot for that. That's about Grasim. With that, let's talk about Tata Motors. That's the one which is buzzing in trade as well. The company's first quarter performance meets estimates while management holds on to its FY26 guidance for Jaguar Land Rover. Undemanding valuations also support the stock. Rima joins in with a fine print.
Thank you. Let's first go through the numbers. Now, Q1 consolidated revenue was down 3%. EBITDA was down 35% with margins coming in at 9.3%. And that led to a drop of 35% in the profitability. But large part of the impact of the weakness in Q1 was linked to the tariffs. If you strip that out, analysts say numbers were largely in line. The management commentary on JLR then. Healthy demand in the US, stable in UK, but EU and China is still subdued. They also quantified the tariff impact, 500 to 600 million pounds this year, and thereafter that, 300 to 400 million pounds. What the analysts point out is that despite a weak Q1, the company still holds on to its JLR EBIT margin guidance for FY26 at 5 to 7%. So that is reason number one, for the up move today. Secondly, as you pointed out, the stock has already corrected. It's down 12.5% year to date. From its 52-week high, the stock has fallen 43%. So perhaps a lot of the bad news could be in the price. And thirdly, valuations. Now, Nomura says valuations are currently at 4.6 times forward multiple in terms of EV to EBITDA, which they say is undemanding but fairly, fair considering all the risks. And lastly, the street is looking ahead to what the festive season holds and whether we are going to see an improvement in the domestic sales. Back to you.
Okay, all right, Reema, thanks very much for that. So that's Tata Motors, that stock up around 2.5% at this point. And for the markets as well, just about holding with a gain of around 0.2% or 0.3% currently for the Nifty. And the advanced decline ratio is absolutely even keel. We have around 2,000 stocks advancing for around 2,000 stocks declining. So just split down the middle when it comes to the advances and declines in the broader markets. We'll take a short break on that note, but on the other side, we'll connect with the management of Poly Medicure to discuss the quarter gone by. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC TV18 this Monday afternoon. Well, let's talk about one specific company now. Poly Medicure, which is basically a medical device manufacturer, reported what was a tepid Q1 performance with muted revenue growth of around 5% and margins coming under pressure. The company has reduced their international business growth guidance to 5 to 10% versus 12 to 15% and are expecting higher R&D costs but are bullish on the domestic business. Himanshu Bed, the MD of Poly Medicure, now joins in to discuss more. Mr. Bed, thank you very much for taking the time out. Well, let's talk about the international business to start with. You've reduced your guidance there. You're expecting around 5 to 10%. Europe was weak this time. Just tell us what took place in Europe, because we understand your infusion therapy segment was impacted the most.
See, I think our core business has been infusion therapy in Europe. And I think due to, certain overstocking by European suppliers, and I think inventory reduction was also one of the core reasons. Because of this tariff issue globally, I think most of our customers were working on reduced inventory. But I think what I've also mentioned in our call earlier, that, now the market is bouncing back. The customers are now, placing more orders. So I think things are going to normalize, but we have lost one quarter, and probably that is going to impact us.
Which is what, what we wanted to understand in terms of your overall projections for this year. Because I remember, Mr. Bed, when you joined us earlier, you had said this year's overall revenue would be upwards of 20%, led by domestic, which is 25 to 30%, and exports, which is 15 to 18%. So on the back of this lost first quarter, would you revise your guidance for this year?
See, for domestic business, our guidance still remains around 30%. So I think, and that's 1/3 of the revenue. So almost 10% growth comes from there. And I think export business, that's 2/3 of the business. So our guidance is between 5 to 10%. I think we should hit the upper deck. I think things are now changing rapidly now in Europe for us. So a lot of new approvals have come in. Actually, we got a lot of our products MDR certified only in June this year. So I think that was also kind of a laggard. So that is also changing a bit now. So I think we should hit the upper deck at 10%, I think.
All right. I just wanted more details with regards to the US business, because that's, a small percentage in terms of sales. In fact, you can quantify it for us. Yeah. And what is your reading in terms of, this 50% tariff and how it could impact a company such as yours, which is doing business with the US? And in fact, I think you have 2 CDMO contracts come up, which are also focused on the US. So how does this play out?
See, I think, we were okay with the 25% tariff because we were very competitive as compared to our neighboring countries like Vietnam, China, or maybe Malaysia. But I think 50% keeps us a little bit away from the US market because of the cost reasons. We don't know what is going to happen, but I think, for certain products, we are still going to move forward because we haven't seen anything from our customers so far, because it's a pretty fresh thing right now. But it is going to impact if it's going to stay around 50% level. So that is the worry right now, within the company. But as US business is still very low, it's close to around 2.5% of the total business, even this year. So we're not overall worried with the US tariffs. But I think next year and year forward, I think we have a lot coming from the US. So I think that will be a little worrisome.
All right. So, that is something that we will definitely monitor. Currently, just 2.5%. Next year, a lot more comes in from the US. We'll talk about next year in just a bit. Yeah. But just to speak about FY26 once again, you said exports should grow between 5 to 10%, the upper deck of that. Yeah. So that's about 10%. That's two-thirds of your business. Yeah. Domestic grows at 30%, which is 1/3 of your business. Yeah. So if I do a weighted average, this year you grow at 10% on your top line. That's nearly half of what we thought in at the start of this year.
The weighted average will be Mangla will be close to around 16%.
Got it. So that's 16%, and that grows around 4 or 5 percentage points lower than what you had earlier accounted for.
That's correct. That's correct. Absolutely.
And margins between 25 to 27%, that guidance stays?
We should be, because in fact, you see, Q1, the gross margins have improved by 150 pips. So I think on the margin side, we are very comfortable. I think we should be close to 26.7%. I think we are pretty much okay with that number right now.
Okay.
So we are comfortable there.
Okay, your guidance on margins is 26 to 27%, though you're hiking your R&D costs to focus on newer segments, I understand.
Yeah, that's correct.
Okay. Your renal business is doing very well. Are we now talking about the exports reducing significantly when it comes to high-end medical devices in India, and companies such as yours are now being substituted by the larger companies, the Siemens of the world, etc.?
So I'll tell you, in certain categories now, Indian companies are starting doing well. Let's say orthopedic implants is one of the categories where India is now using 50% locally made, let's say knees or hip implants. In cardiology, even stents, if you see, around 70% is now locally made products being used in the country. So in many categories, we are achieving a higher local content, local consumption compared to foreign made devices. So that's a very welcome sign. And I think even after COVID, if you see, almost 2,500 new factories have come up for medical devices, or new licenses have been granted for medical devices across medical device parks and across different parts of the country. So I think the industry seems to be quite positive and promising. And I think government has done a lot actually in last 4 or 5 years. So I think we continue to get that support. I think we'll get the self-reliance very soon on medtech industry. I think
So
we're 5 to 7 years away.
What are you guiding for? I have an additional question actually on that before I get to your guidance.
Yeah.
What do you think that Indian companies could become net exporters when it comes to high-end medical devices?
Yes, and I think if you see large companies like GE, Siemens, and Philips, and many others have started manufacturing in the country. And a lot of high-end equipment we were importing earlier is now getting manufactured in the country. So currently the ratio is still a little skewed. It is 8 billion of imports and 4 billion of exports. But if you add local manufacturing, we are at par. So 4 billion local manufactured, locally consumed. So industry size around 16 billion. So I think in next 3, 4, 5 years, I think maybe 5 years, we'll be exporting more than importing in the country.
Wow. That's music to our ears, definitely, for the medical device community. But Mr. Bed, before we let you go, then can give us a concentrated guidance in terms of the renal business. How many dialysis machines do you think that you can probably install in FY26 and maybe extrapolate it for FY27 as well? And tell us about the cardiology and the critical care business as well. What is the growth estimate for both those segments? Let's start with the renal business.
So for renal, I think this year we have guided for 600 to 700 machines. In the first 4 months, we already installed 130 odd machines. And, as we see the year, we should hit that 500 to 600 number easily. Next year, our target is to install close to 700 to 800 machines. Indian market is probably around 5,000 machines per year. And that's the run rate today. So overall, 50,000 machines are installed in the country, which has an average life of 10 years. And so that's where we are guiding today. So we should have around 12 to 15% market share by end of next year, at least for the machine business. And on the consumable side, we should already do over 15% by end of next year. That's the plan. On the cardiology side, we have just launched the product this year. So we will be implanting around close to 20,000 stents this year, and a lot of other consumables which we already started manufacturing, and most of them are import substitute products. And so next year, number could go up to around 50,000 plus stents. And Indian market for stents is close to around 15 lakh stents today.
And what does this mean in terms of revenue? 500 to 600 dialysis machines this year and 20,000 stents this year. And for the next year, 700 to 800 machines and, 50,000 plus stents?
So for dialysis business, we have guided for a revenue of around 50% increase from last year, 150 crores to around 50% increase in FY26. And FY27 also, I think we should be close to around 40-45%. That's the number we have in our mind. And for cardiology business, it's just a start. So, numbers are very small right now, but this year itself, we will do close to 25 crores. Going forward, next year could be 100% growth to around 50 plus crores.
And critical care?
Critical care has also started, only early last year, we started critical care. And critical care is more focused toward oncology side, again, import-driven business. So again, in that area, we should do close to 25-30 crores this year, and next year around close to 50 crores.
All right, take that point. Thanks a lot, Himanshu, as always, for joining in and giving us your views on the growth in the devices market for the country and for yourself itself. Because of the lost first quarter, you've seen a decline in your overall guidance for this year. You believe growth can come back in the remaining 3 quarters rather. With that, we'll step into a short break. And as we do that, let's get you some good news. All you viewers, CNBC TV18, which is India's business news leader, is now just a click away via the all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the app from either the Apple Store or the Google Play Store, or just scan that QR code, which is up for you on the screen. Welcome back. Even as the markets continue to hold on to those gains that we saw from the morning, even as we're off the day's high, a lot of the broader market stocks are buzzing around. The market's making another attempt at the higher end of today's trading range so far. So let's go across to Vivek, who has the list of all those stocks which are moving and shaking. Vivek.
Well, thank you so much for that. Well, a brief hint of recovery as far as the broader end of the markets are concerned, and that is what we are witnessing. Quite a few buzzers in the session today. First on the list, as far as the broader end of the markets are concerned, has to be DOM's sequential recovery seen year on year. Still a muted set, but despite that, markets like this particular set of numbers are high by 11% on good volumes today. The other stock is HPL Engineering, earlier known as HPL Power Systems. Very good set of numbers. That's the top NSE 500 gainer. Very strong growth seen as far as the EBITDA margins are concerned. Street clearly likes this particular set of numbers. Home First Finance, we had intimated to you last evening that there could be a large block that could happen in today's trading session. We understand from our sources that Warburg is the likely seller in the session, and the overhang now is done away with. Back of that, there's been a big recovery in the stock from the intraday lows. And keep an eye out on data patterns as well. Now, even though the company actually delivered a muted set of numbers, across all parameters, guidance has been retained, and that has led quite a bit of a recovery as far as the stock is concerned in the trading session today. But on the other hand, quite a few stocks that are seeing selling pressure. The first on the list has to be the one that made the news all through the second half of Friday, and that is PG Electroplast. You saw almost 25% downtake today, again 17%, and not too much recovery from the intraday lows. Along with that, Voltas, remember, delivered its results over the weekend. Again, muted set of numbers. Similar space, consumer durables continue to be quite weak, and on the back of that, almost 6% low as far as Voltas is concerned. Along with that, key worry being the market share loss that the company has seen. Container Corporation, now this particular stock, very weak set of results. Q1 is something that the company did see, significant amount of pressure as far as volumes are concerned. While the management has retained the guidance, there has been significant selling pressure post Q1, another down day as far as Concor is concerned. And Equita Small Finance Bank, NII, PPOP, all of them falling along with that asset quality pressures. That stock in the broad end of the market is down over 6% today.
Okay, all right, Vivek. Thanks very much for that. Well, ICICI Bank is the big stock in focus. It's raised the minimum account balance in savings account for all new customers from the 1st of August. RBI Governor Sanjay Malhotra says it is up to the banks to decide on the minimum balance and it is not under any regulatory domain. Listen in.
ये जो मिनिमम बैलेंस की जो बात है, जो मिनिमम बैलेंस का जो आप बात कर रहे हो, वो उसके अंदर में रिजर्व बैंक ने सभी बैंकों के ऊपर में छोड़ा है कि वो किस प्रकार का मिनिमम बैलेंस वो रखना चाहते हैं। तो अब किसी बैंक ने 10,000 रखा है, किसी ने 2,000, कईयों ने माफ भी किया हुआ है, लेकिन ये रेगुलेटरी डोमेन में नहीं है।
All right, that's what the RBI governor has said, that they have given a freedom to the banks to go ahead and decide those limits. So it's not part of the regulatory framework. So we'll watch out for how this moves from here on. But as of now, the stock under pressure at a time when the Nifty bank is up 159 points. We have ICICI Bank, which is actually at the low point of today's trading session. Sudeep Shah of SBI Securities joins in with some trading strategies after this short break.
Welcome back. Well, stable for the markets. We have the Bank Nifty, which is up around 0.3%. Just watch out for State Bank of India because it is reacting positively post the commentary from the management numbers on Friday. So that stock is up around 2%. And year to date, it's now given returns of around 3.2%. But Mangalam standing by at the wall with an F&O update for this Monday. Mangalam, over to you.
Well, the market's pulled back. It has been falling for the last 6 weeks. So it was only imperative that the Nifty actually goes higher in the morning. The question is, where does it go from here on? Because on the one hand, while the market's moved higher, secondly, it's also seen some bit of supply at higher levels and advanced decline. They are jostling for space between, the red and green lines. Currently, the red one slightly above the green one, even as we have, an almost equal number of stocks which are advancing. And the second part is typically when the market moves higher, bulls would like the India VIX go lower. That speaks about, a put selling. But this time around, maybe that's not the case. The India VIX is higher, so that tells you we're probably not out of the woods, even if we have seen a bit of a relief rally. The technical analysts would say that, the Nifty has to, for instance, sustain above these levels, cross the 100-day moving average at 24,494. And for that to happen, the Nifty Bank has to stay above the 100-day moving average. So what is the resistance for the Nifty Bank is actually, for the Nifty is actually a support for the Nifty Bank. All of this means one thing. The next leg of recovery rests on the IT index. The intraday chart of the IT index comes up for you. For most part of today's trading session, it was in the red. Thereafter, it moved higher and currently at the high point of trade. So if that continues to do well, maybe we see a further up move on the frontline index itself. The earlier oversold levels are now taken out. The Nifty put-call ratio is at 0.8, telling you that there has been some put writing at lower levels at 24,400 and 24,350. Which means that maybe Fridays and the previous trading sessions lows of around 24,350 thereabouts will continue to hold on, but it has to cross the higher levels, which hasn't been witnessed right now. In fact, the 24,500 call writers are still equally active and they're holding on to their short positions, in fact, adding more to that. So the 24,500 call comes up for you. 1.5 crore shares in open interest out there, 43 lakh of which have been added just today. A premium of 100 rupees telling you upwards of 24,600 will continue to see supply for the markets. A lot of individual stocks on our radar. Consumer discretionary stands out on the way down. Amber and Blue Star have both seen a lot of selling in index futures, so a lot of fresh shorts built out there. And I'm watching out for PG Electroplast. The stock is down nearly 40% this month. Will most definitely enter F&O ban today with the kind of open interest surge that we've seen on the stock. It's actually crossed way past the 95% mark of market-wide position limits, after which a stock enters F&O ban.
Okay, all right, Mangalam. Well, that's on the F&O space. Sudeep Shah now joins in to discuss the technicals of the market. Sudeep, hi, welcome to the show. Well, we are, trading in positive terrain, but do you think that's enough? What's your call on the stocks and as well as the Nifty?
Good afternoon, Ekta. Ekta, yes, after 6 continuous weeks of downtrend, we've seen some kind of a better Monday morning. But what I feel is that even if you look at stocks, you're not seeing that bigger recovery. So for me, it is important that when I'm seeing at the charts of Nifty, 24,530, 24,550 now needs to be taken out on a closing basis. So until and unless that does not happen, there are always chances that you see bouts of selling pressure from higher levels, and once again a retest of 24,350, 24,370 could be possible. This from an intraday perspective. Overall, from a positional perspective, 24,200, 24,180 zone where the 200-day exponential moving average is there seems to be a very strong support, a potent support here. So I feel 24,200 needs to be that line of defense that bulls have to watch out for. On the upside, 24,530 needs to cross and indices need to sustain above that.
All right, Sudeep, and individual stocks, how would you look at trading them?
See, there are a couple of stocks from the mid-cap space now. The first one is Affle India. Here we have seen some kind of a decent breakout post some consolidation, and the prior trend over the last several months have been quite positive. So we feel that this could be bought with a stop loss at 1940 on the downside and a target of 2100 on the upside. And the second stock is Policy Bazaar. Here also we post some consolidation. There is a breakout that is visible. The stock has taken support at its 200-day moving average, which is closer to 1750. Over the last 2 to 3 weeks, the stock has been taking support at that zone. And today we have seen a breakout, a short-term breakout. And overall, we feel that the stock could do 1930, 1950 on the upside. And this can be bought with a stop loss at 1775 on the downside.
Okay, all right. We're going to leave it on that note, Sudeep. Thanks very much for joining in and taking us through all the technical calls. We'll take a short break now, but up next, Manisha Gupta will join in. She has with her an agri expert, Rajesh Paharia. Stay tuned.
Welcome back. Joining us on the show now is agri expert Rajesh Paharia. Mr. Paharia, thank you so much for joining in. I want to focus on rice with you because when you look at the international markets, we've seen the prices continue to decline. We're looking at a very strong crop, not just in India, but in Vietnam and Thailand as well. And if you look at the rice futures on the screen, it's trading at an 8-year lows right now. I will come to the US tariff concerns later on. But with the way the international rice prices continue to decline, would you say it's becoming a problem now for the rice exporters?
Good afternoon, Manisha ji. It is going to be a problematic as the supply and demand has been a great mismatch at the moment because of the overproduction in our Asian countries. The places like Thailand and Vietnam has been swapping their positions of being the largest exporter. Number 2 has become number 3 and number 3 has become number 2. So there has been an interchange, and parallelly, India also is going to give an additional 5 million ton of paddy production, which will be again a chaotic situation. The demand from the West African market is not rising, and that is going to be a catch again. In case if the demand is not being stable, what we are going to do with this rice for at least 1.5 years, it will be a very, very problematic. Manisha ji.
Mr. Paharia, what we have seen within, for rice, within Indian markets, of course, has been PDS for one, and then, of course, broken rice going in for ethanol the other. But even with these deployments, we still are sitting on a very huge surplus, would you say?
See, overall, what the buffer norms, which has been redefined by the Food Corporation of India very recently, even though we are almost 216% higher than what the buffer norms are. So even if the PDS is being offloaded, it will not be consumed as what the availability of the other premium varieties are available in the domestic market. Our food habit has also developed in India. The people who were consuming the FCI quality of rice, now they have shifted to a better grade like Basmati, Dubar, Tibar, and even the semi-premium Basmatis like Sona Masuri and Samba and others. So I don't feel that there will be an additional demand coming in, despite if the prices has been reduced by FCI. A lot of offtake methods has been taken up by FCI, wherein they have been allocating to ethanol at 22.50. I'm surprised in last 2 tenders, there has been a nil participation by the ethanol takers, even at 22.50, 100% broken. Apart from that, only a part of the cargo was sold in Delhi and in Assam through the tendering process, because still they feel the prices which has been offered are very high.
Really. Mr. Paharia, also, what's your sense for the Indian prices now? Because, yes, there's a lot of disparity when you look at the rice within the Indian markets also. With the global futures now trading at an 8-year lows, what is your sense on where the rice prices could be headed for India?
When we all go with the sentiments, like in case if it is a bearish moment at the moment, everyone in the African market who were talking about 385, they've started talking about 360. Now they have been asking at 340 levels, because we have to compete with Thailand, Vietnam, Myanmar. So in case if the prices are correcting, I'm 100% confident India has to match up with that. And then accordingly, the cargo will be coming and it will be being sold. We have a high estimates of making the target of exports, which our Honorable Minister Piyush Goyal ji has said that 22 million has to be 25 million ton this year. So we need the support of the government to subsidize, to increase some subsidies for the exporters. Then only we'll be able to achieve that number.
Mr. Paharia, while the target is 22 and 25 million tons, what's your sense? What have we done till time this year?
So far, so good. If the things get supported in the similar fashion, we have almost completed around 4 million ton. So the next season is on. So the pace will be taking up accordingly. But parallelly, we have threat and competitors like Pakistan, Vietnam, and Thailand, who are also going to offer the similar quantities. So in case if they come into the picture and the government of India supports, definitely 22 million ton, which will be easily achieved.
Mr. Paharia, what's your also sense with the US tariffs, with 25% in place, 50% from 27th of August perhaps? What kind of deals or what kind of negotiations really are happening with the US counterparts?
Manisha ji, last time also when we have spoken on this subject, as I told you, that around 650,000 ton is being exported to US market, combining both Basmati and semi-premium Basmati, non-Basmati rice. So even if whatever the 50% tariff has been there, it is an essential commodity. Like they have, US has been kind enough to give the grant to gold imports. So definitely our ministers and the entire diplomatic battery is working on that rice or the food commodities should be exempted at least. So certainly we have to just wait and watch. because this 25 plus 25%, we become out of the market at the moment.
All right, Manisha.
Okay, all right, Manisha. Thanks very much for that and taking us through that conversation. Well, we need to take a break with a small reminder for our viewers that unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBCTV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. The Nifty is now moving higher, 115 points higher on the frontline index, even as the Nifty Bank is just about 250 points higher. So we're closer to the higher end of today's trading range. And a large part of that could be attributed, as we spoke about earlier, to the Nifty IT, which had moved to the high point of trade. And that continues to do well. The other big, contributor to the Nifty on the way up right now is L&T. So pull up the intraday chart of L&T and you would see that stock too has, spiked and is contributing to the Nifty. Just watch out for Yatra, because the company reported its numbers over the weekend, in fact, Friday last late evening, and it's a very stellar set of numbers. On a low base, we've seen a near doubling of the company's revenue, and as a result of which, the EBITDA of the company has moved almost 400%. So from 4.5 crores, it's jumped all the way up to 23 crores. So that's the nature of these businesses. A small change in the amount that they charge per ticket or the realization per ticket and hotel packages, etc. on that volume brings a big amount of change in their overall performance. The net profit too, on a low base as a result of this, has seen a big surge of nearly 300% from 4 crore all the way up to 16 crore. If you look at the internals, gross bookings were up just 9%, which was understandable given the travel sector this time around in the first quarter faced a fair amount of disruptions. For the company, the hotel packages business, as well as the meetings, events, and investor conferences, etc., did well for them. Add to all of that, they added more corporates as well, nearly 34 new corporates that they added this quarter, and this company has been the go-to travel partner for a lot of corporates, so that does well for their overall realizations. And if you look at their gross margins too, that saw an improvement across all their segments, the air travel segment as well as the hotel segment year on year. Doing well for Yatra.com or Yatra Online, and doing well for the markets. With that, we'll wrap up on this edition of Halftime Report. You stay tuned to CNBC TV18 as Business Lunch comes up next.
Markets are at the highs of the day as stocks perk up on hopes of some forward movement in resolving tariff issues, even as calls for domestic reforms rise. Realty, industrials and power are the key gainers, while consumer durables and FMCG are the big drags.
In significant relief for oil marketers, the government has agreed to allocate 30,000 crore rupees payable over FY26 and 27 to partly compensate them for their over 40,000 crore rupees in under-recoveries. The stocks perk up on the news.
Tata Motors takes a hit on US tariffs and expects an impact of around 500 to 600 million pounds in FY26, but an easing to 300 to 400 million pounds thereafter, even as it holds on to its FY26 guidance for JLR. Undemanding valuations support the stock.
PG Electroplast tells CNBC TV18 they were operating at over 100% capacity till early June with strong orders on hand before demand fell off a cliff, catching them off guard. And while inventory remains a big issue for now, the company argues the future trajectory won't be altered by one bad season.
ICICI Bank tilts its focus towards high-income, high-net-worth consumers by upping the minimum account balance in savings accounts for all new customers from the 1st of August. Experts express concerns over the medium-term impact, even as the RBI governor rules out any regulatory action. Very, very sharp move over the last few minutes on the index. You're watching Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormas Patakia. With me, as always, is Vamakshi Dhoria. Vamakshi, good morning. We are good afternoon, actually. It's turning out to be a good one, actually, for the bulls. Well, 24,500. We are at that 100-day moving average of 24,494. So there and thereabouts. We'd be hoping, the bulls would definitely be hoping that these gains sustain.
Well, absolutely, Hormas. Nothing to complain given the kind of last few weeks that we've had. Very bad weeks. It's the longest losing streak that we've seen since 2020. So some green on the screen will be rewarded for sure. And the bulls will be hoping that this could likely be maintained this time around. The Nifty is hovering close to the 24,500 mark. Supporting it on the way up is the Nifty PSU Bank index. It's up almost 1.8%. Nifty Realty too is another sectoral index that is adding to the moves. Take a look at Prestige Estate. That stock is up almost 2%. Brigade as well. And of course, we have a whole host of earnings reactions play as well. Yatra Online locked in 20% upper circuit. Apart from that, Hero Pipe Industries as well, up almost 13%. And DE Development just reported its numbers just a short while ago. That stock too is seeing an uptick of almost 11%, Hormas.
Indeed. Can't not also talk about PG Electroplast. Still another 15% lower. We spoke to the management earlier in the day. There was a block deal also that took place in the stock. No respite whatsoever on that stock. 15% lower still is PG Electroplast. And with that move, the stock has now turned almost halved on a year-to-date basis. Is down over 50%. And in line with PG Electroplast, most of the other AC manufacturers are also sulking. Take a look at Amber Enterprises. Amber Enterprises is down 7% in today's session. And along with that is also Voltas, which is also trading with losses of over 6%. Now, the big news of Friday and the impact of that today is the cabinet having cleared that 30,000 crore rupee package for LPG under recoveries for these oil marketing companies, and not a significant reaction seen in all of them. But Sonal is joining in with more details on this and what brokerages are making of this. Sonal.
Well, thank you for that. It is a big news that has come by, and the street was waiting for this for a long time. That is the 30,000 crore rupee compensation that these companies have received in form of LPG subsidies. Now, do remember they have under recoveries to the tune of 41,300 crore rupees till June 2025. So only a part of it is what they have received. What we don't know whether this is a one-time compensation or whether there will be more tranches of this compensation that will be given to these companies as well. Nevertheless, brokerages, they are quite positive on this one. Jefferies says they estimate an upside of 29 to 42% on EBITDA for FY26. In terms of profits, it will be around 38 to 70%. But this is only when they get the entire compensation in FY26. They will be paid in tranches. We don't know whether all these tranches will take place in FY26 itself. ICICI Securities says that LPG compensation is a material boost to their earnings. It takes away the margin worries for FY26 as well. Morgan Stanley, they prefer HPCL and BPCL. They say subsidy could boost FY25 earnings by 75%. deleverage their balance sheets by 12% and support a consistent return on capital employed to the tune of 14 to 15%. There could be a downside if fuel prices are cut by 1 to 2 rupees per litre on the marketing side, but that's a limited downside that they talk about. UBS says that the payment that they are receiving right now is equal to 75% of FY25 dues and 62% of the dues which are accumulated till June 2025. So that's around 62%. It is equivalent to 8 to 16% of their book values for all these three stocks for FY25 and is equivalent to 6 to 9% of current market capitalization as well. So yes, it's a relief, but a lot depends on what's happening with crude sourcing as well. Maybe that's the reason the stock are not reacting as positively as it was expected, but nevertheless, it is a positive news that has come by for the entire sector.
Well, thank you so much for that, Sonal. But moving on, AC stocks, as Hormaz was highlighting earlier, are under pressure today. Stocks such as Voltas, PG Electroplast, Amber Enterprises are reeling under pressure. Earlier, in fact, we spoke today to Vikas Gupta, who's the managing director of PG Electroplast, on their guidance revision and more. Let's listen in.
As the channel inventory built up, and there was no rebound in the sales for the air conditioners, the secondary sales of the air conditioners in the months of July and August, as we are seeing now. So we had to revise our guidance accordingly. In the month of May also, we were hoping that the market will improve, the demand will improve. We were having the order book, we were having the forecast from our brands, our customers, that was quite robust, and we were building on it, and we were believing that numbers, and we were going ahead with those production numbers. So it was only later in the in the month of June that we saw that the secondary sales are not picking up, and the channel inventory is becoming huge, and that's when the demand from the brands fell off the cliff for us, and we realized that we are sitting on a huge inventory for us. The equity holding of the promoters is, I think, 43% or 45% or 47% does not make any difference. It is that the commitment of the promoter family towards the business is more important.
The management there of PG Electroplast, the stock looking to recover from the lows, but every recovery is being sold into as of now. But ICICI Bank was the other newsmaker over the weekend, as it has raised the minimum balance for its savings account to around 50,000 rupees from 10,000 rupees earlier. Ritu is here to tell us more on this. Ritu.
Starting the 1st of August, ICICI Bank has significantly increased the minimum monthly average balance that is required for new savings accounts. Now, for customers in metro and urban areas, the new minimum balance that they must maintain is 50,000 rupees, which is 5 times the earlier amount of 10,000 rupees. In semi-urban branches, it rises from 5,000 rupees to 25,000 rupees, while rural branches see the minimum balance doubled to 10,000 rupees. Now, this is by far the highest minimum balance saving account customers have to keep in any bank in India. Now, if the required minimum balance is not maintained, the bank is going to charge a penalty of 6% on the shortfall or 500 rupees, whichever is lower. But importantly, keep in mind, the change applies only to new savings accounts that are opened on or after the 1st of August. The existing accounts are going to continue under the current minimum balance rules, so there's no changes there. Some accounts are also exempt from this hike. For instance, all salary accounts, pension accounts, basic savings bank deposit accounts under RBI guidelines, and of course, PM Jan Dhan Yojana accounts maintain zero balance accounts. But the big question everyone seems to be asking, why the steep increase? Now, the bank has not given officially any statement yet, but the move is seen as a clear strategic shift away from masses to target the relatively more affluent customer segment. And for the bank, this brings various benefits. For instance, more stable deposits, improvement in CASA, high balances at lower savings rates or lower cost of funds, more premium cross-selling opportunities, and of course, the potential to reduce the dormant low-value accounts, to name a few. But to put this in perspective as to how this compares, other private banks like HDFC, Axis, Kotak, Yes Bank, they usually require a minimum balance of 10,000 rupees for urban areas. That is much lower than the 50,000 that ICICI Bank is now asking. Now, in contrast, public sector banks like SBI, Canara, Punjab National Bank and others have zero minimum balance requirements. So it is going to be interesting to see if other private banks follow the move and how the regulator reacts. Now, but to be clear, ICICI Bank has not really broken any rule. RBI merely says bank charges should be reasonable and they should be commensurate with the cost of rendering the services, but there's no RBI prescribed cap when it comes to the minimum balance that banks can ask for savings accounts.
Well, thanks so much for that update on that development, Ritu. But moving on, RBI Governor Sanjay Malhotra says it is up to the banks to decide on the minimum balance and it is not under any regulatory domain. Let's listen into that.
ये जो मिनिमम बैलेंस की जो बात है, जो मिनिमम बैलेंस का जो आप बात कर रहे हो, वो उसके अंदर में रिजर्व बैंक ने सभी बैंकों के ऊपर में छोड़ा है कि वो किस प्रकार का मिनिमम बैलेंस वो रखना चाहते हैं। तो अब किसी बैंक ने 10,000 रखा है, किसी ने 2,000, कईयों ने माफ भी किया हुआ है, लेकिन ये रेगुलेटरी डोमेन में नहीं है।
The RBI governor there on that major developments at ICICI Bank. Take a short break. More news and updates on the other side. Stay tuned.
Welcome back. You're watching Business Lunch on CNBC TV18. Well, on to updates from the national capital then. Opposition leaders took to the street over alleged irregularities in the Bihar voter list revision as well as the alleged voter theft during the 2024 Lok Sabha elections. Opposition MPs gathered outside the parliament to march towards the Election Commission's office. Delhi police has heightened security measures on the route. Leader of the opposition Rahul Gandhi was detained during the protest, while Samajwadi Party Supremo Akhilesh Yadav sat in protest after alleging that the police stopped him from moving further. Meanwhile, here is what the leader of opposition had to say.
एक्चुअली बात नहीं कर सकते, रियलिटी ये है, क्योंकि सच्चाई देश के सामने है और ये जो लड़ाई है ये राजनीतिक नहीं है, ये कॉन्स्टिट्यूशन की लड़ाई है, कॉन्स्टिट्यूशन को बचाने की लड़ाई है, वन मैन वन वोट की लड़ाई है। इसीलिए हमें साफ प्योर वोटर लिस्ट चाहिए।
Getting in the latest now on the India-US trade tensions, the Parliament Committee on Foreign Affairs is set to meet today to discuss and negotiate on the tariffs issue. Parikshit is joining in with more details on this. Parikshit, tell us more.
Well, the Parliamentary Committee on Foreign Affairs is headed by Congress MP Shashi Tharoor, who has been leading the government's charge politically, and he's been visiting the United States and other nations to speak about Operation Sindoor. The Parliamentary Committee has members across party lines from the BJP and the opposition. The idea would be to understand the status of the India-US trade negotiations, the current tensions, and the tariff situation and the impact. So you will have top officials, including Commerce Secretary Sunil Bartwal, the Foreign Secretary Vikram Misri, who will be appearing before the panel to help them understand where we are with the trade negotiations, what are the problems, and what will be the impact of a 25% tariff and a 25 plus 25 additional penalty that has been imposed by Donald Trump. Having said that, all eyes are now on the outreach that India is doing. The Indian ambassador to US, Vinay Quatra, has spoken to Lindsey Graham, who is a top Republican senator, someone who had said that countries like China and India should be slapped with a 100% tariff because they are purchasers of Russian oil and gas. He has also said recently that the biggest favor that India could do to US-India relations is to help President Trump in bringing the Russia-Ukraine war to an end. So this meeting becomes very critical, and we're told that our ambassador conveyed India's stand on energy, US-India energy trade as well. While immediate details were not available on the meeting, sources tell us that India has now conveyed at multiple levels to officials in the US that India-US energy trade is going up. It is already up 70% year on year in a Jan to June period, especially for crude. LNG purchases have also doubled, and these energy purchases will only increase in the months to come, and India-US energy ties have a very robust future. We cannot cut off our ties from Russia, but clearly our oil companies will be making more purchases, more long-term contracts with US companies. All eyes now on the 15th August meeting between President Putin and President Trump to see if there can be any breakthrough in the Alaska meeting and whether it will have any ripple effect on India-US relations as well.
Well, thanks so much for that, Parikshit. That will be an important meeting that we all will be tracking very closely. But do stay on with us, because electric vehicle maker Tesla has opened its second showroom in the country today in Delhi. Parikshit, tell us more.
Well, yes, Tesla has finally driven into Delhi. This is their second showroom in India. Where I'm standing, it's the World Mark III Mall in AeroCity, which is right next to the international airport. So what you have on display behind me is the Tesla Model Y standard version and the long-range version. The starting price, the base price, is about 59 lakhs. This is minus road tax. There are superchargers which have also been installed in the World Mark Mall, and these are superchargers which can charge your car to up to 267 kilometers in about 15 minutes. So you've got 4 superchargers which will be installed by Tesla in Delhi, 3 destination chargers. As far as the booking pipeline goes, that's the big question on everyone's mind. But sources tell us that Tesla's own projections are being met in India. When we spoke to officials about the booking pipeline, they did not comment on that, but they said that the booking pipeline is good and as per our projections. So hopefully that is an encouraging sign. Are they going to open more showrooms? Well, yes, they did announce that their next showroom, service center, warehouse would be coming up in Gurgaon Horizon Park. So that's the next showroom we can expect in the next few months. They will also be launching a charging center in Bengaluru. That would be coming up in the next few months as well. Is there a plan to get new Tesla cars? No such plan for the moment. They will be doing an assessment based on the sales that are on. Whether there will be more showrooms in the country, definitely yes. But currently the company, we are told, is doing a heat mapping of the kind of bookings they're receiving from across cities, the kind of response there is. And depending on the sales volume and where they get the maximum volumes from, they will open up more showrooms in the country. But for the moment, they have announced mobile service, a Tesla collision center, and a diagnostic center, remote diagnostic center in India as well.
Well, new cars or not, Parikshit definitely has plans to take a test drive, so we'll leave you for that. Thank you for those updates. Parikshit, take a short break. We'll be right back on the other side. Stay tuned.
पड़े।
Welcome back. Now, the Supreme Court has issued an order to round up and impound all stray dogs in Delhi. Ashmit is here to tell us more. Ashmit, what are you picking up from this order from the Supreme Court?
Well, a highly emotive issue, this, as far as stray dogs and the spread of rabies is concerned. This was a case where the Supreme Court had taken suo motu cognizance. Now, what's important is that there are sweeping directions that the Supreme Court has issued. The Supreme Court is essentially saying that the time for compromise is over. There is no space. There is no reason at this stage to hear animal rights activists at this stage, and going on to say that the need of the hour, according to the Supreme Court, is to round up all the stray dogs and to move them outside the city, to move them to dog shelters. That's the direction that the Supreme Court has given. The Supreme Court is very clear that the rights of animals cannot weigh against those who are affected by rabies. Rabies does not have a cure. All of these arguments weighing on the minds of the Supreme Court. And at this point, the Supreme Court making it clear, in fact, at one point also making a reference to an old Hollywood movie, The Good, the Bad and the Ugly, saying that when it's time to shoot, don't talk. And with those words, the Supreme Court has directed for rounding up of all the stray dogs, saying that we want Delhi to be free of stray dogs. We don't want any stray dogs affecting people, affecting students, children, people going for walks. And on that count, asking for these dogs to be rounded up. As to where will these dogs be taken? Well, the second direction that the Supreme Court has given is that there need to be dog shelters, dog pounds that need to be set up by the Delhi government, by the MCD, by the NDMC, and these dogs need to be put there. However, importantly, no safeguards have been issued by the Supreme Court as to what conditions the dog will be kept in. One important message, however, that the Supreme Court is keen to send out is that as far as these dogs that are rounded up, they cannot be released once again back on the roads. That's a clear message. And in fact, the Supreme Court also disallowed for a plea that was asking for adoption of these stray dogs, and then going on to say that it's time to act now. There is no room for sentiment, and that this is an issue which is pressing, which is on the minds of the court, and with that asking for all stray dogs to be wound up from the streets of Delhi.
Sure. Thank you so much for that, Ashmit. But with that, it's a wrap on this edition of Business Lunch. We're leaving you with a green-looking screen. Don't go anywhere. Midcap Radar takes all of the action forward.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. A Monday morning, the week has started on a positive note. It's a truncated week as well. So a lot of action which is expected. Also, we are towards the fag end of the earnings season now, Vivek.
That's the only positive news as far as this particular week is concerned, along with the fact that it's a truncated week. We've come off 6 straight weeks of decline as far as the Nifty is concerned. So the street would have anticipated and hoped for a green start to the week, and that's what we are getting. Sharp recovery from the intraday lows. But we have a lot lined up on the show today, an important corporate conversation as well. So let's start off with the top headlines. Market near day's high as stocks spoke up on hopes of some forward movement in resolving tariff issues, even as calls for domestic reforms rise. PSU Bank and Realty are key gainers, while consumer durables drag. Midcaps gain.
PG Electroplast tells CNBC TV18 they were operating at over 100% capacity till early June with strong orders on hand before demand fell off a cliff, catching them off guard. And while inventory remains a big issue for now, the company argues the future trajectory won't be altered by one bad season.
Sun TV in focus after all legal notices issued by family members to promoter of the company have been irrevocably withdrawn. The company gains nearly 5%.
DEE development gains after reporting its Q1 numbers. Revenue surges 21%, while EBITDA has risen 45% versus last year.
Equitas Small Finance Bank under pressure after a muted Q1. Net interest income, pre-provisioning operating profit all fall, and also asset quality deteriorates.
All right, these are the top headlines that we are tracking for you, but this is our segment Midcap Movers. We have Hormuz who's taking us through the midcaps that are moving around in trade today. Hormuz.
Well, after 6 weeks of losses, you were expecting a bounce. Started off the week on a positive note. We hope that it sustains, at least the bulls would. Look at the midcap movers here today. Hero Pipes is up 15%. And there are a lot of movers that are seeing double-digit gains today within the broader market space. GE Power is up 13, Uniparts is up 12. Transformers and rectifiers had a very choppy last week, but it has started off this week on a positive note at the highest point of the day, 8% higher on that stock. Now, the positive earnings reactions, Yatra Online is in a 20% upper circuit as it has been almost for a better part of the day. Look at HBL Engineering, look at Domes, look at DE Development Engineers, came out with numbers just recently, and all of them seeing gains of anywhere between 10 to 14%. On the flip side though, does not look good for stocks like Entero Healthcare Solutions. That's at the lows of the day, 7% lower there. PTC Industries is an earnings reaction, as is Voltas. But of course, Voltas is bearing the brunt of the industry-related sentiments as well. And the newsmakers of the day, of course, can't not talk about PG Electroplast, seeing some bit of a recovery from the lows of the day, but still down around 14%. Amber, Home First, of course, after the block deal, and Akzo Nobel. Part of it is also trading ex-dividend for 160 rupees of a special dividend that was announced. And lastly, stocks that are moving on the volumes front. And those names include the likes of Afcon, Sun TV, and TVS Supply Chain, some of the movers in the broader markets. Back to you guys for the Amphi data.
Okay, all right. Thank you so much, Hormuz, for joining us with all those details. By the way, the net equity flow is at a multi-month high. I would say it's an all-time high as well. 42,672 crore rupees in terms of equity inflows, which compares with 23,567 crore rupees. You know, in this fiscal itself, so far, we haven't seen this number. I have data from June itself. June last year was 40,573 crore rupees. Then we had December at 41,136 crore rupees. Apart from that, it has been ranging between 24 to 30,000 crore rupees. So this 42,000 crore number is a big surge that we have seen, multi-month high that has come in for the equity inflows as well. So big surge there on a month-on-month basis, of course. In terms of large cap funds, let's quickly take a look at what the inflows there have been. It is coming at 2,125 crore rupees. It compares with 1,694 crore rupees. So even that number is quite impressive if we look at that number, because around the 2,000 mark, that's the number we saw in March and April. So this also explains this is not led largely by large caps. It will be led by mid caps or small caps. That number should also come up for you on the screen in just a bit. But for now, large cap fund inflows at 2,125 crore rupees. Of course, it's an increase, but it is lower than the numbers that we saw in Jan, Feb, in March. Of course, at that point in time, we saw a different number as well. So here you go. Small cap fund inflows have come in higher at 84 crore rupees. And I think even this is a number which is higher. We have not seen the 6,000 number in a long time. Yes, that's right. The equity inflows this time around led by small caps and mid caps as well. Both of these segments have done really well. Even that 5,000 crore mark for mid caps we haven't seen in a long time. So higher mid-cap flows, higher small-cap flows. We'll have to see how hybrids are doing as well, because when markets started declining, we saw that major shift coming in to hybrids, people making a choice which has all the forms of investment asset classes. So far, looks like a decent improvement that we have seen. Liquid fund has seen as an inflow as well. That's also happened because we saw savings bank rate go down. So liquid funds are where people were parking their regular money for higher returns.
And this is despite in all the weeks of July, you've actually seen the markets go lower.
Yes, of course.
So when you take that particular data into account, clearly indicating that the kind of selling that we've seen, especially from the FI, especially post a muted Q1, if you could call it in terms of an earnings season, you've seen inflows across all of the asset classes, across all of the equity mutual funds actually go ahead and significantly rise on what was a quite strong base of the month of June. So equity funds, 42,672 crore is the number that we are seeing. The net equity inflow, like you just mentioned, has almost doubled on a year-on-year basis. ELSS, fund outflow marginal, but the important point is when you're looking at the mid-cap and the small-cap flows, that's gone up quite significantly. And resultantly, despite a muted market performance or equity market performance, what's actually transpired is that the total AUM of the equity market has actually gone up on a year-on-year basis. Again, something that is quite positive.
It is something that tends to happen, right? Whenever we do see flows increasing, and SIP number has been at record highs every month. Last month, it was around the 27,269 crore mark. Let's see which way things go this time around. But as you pointed out, 6 weeks of continuous losses in the markets, but we've still seen inflows coming into large caps, mid caps and small caps as well. We'll just look at the numbers in greater detail and get you more analysis. But for now, it's an improvement for sure. Let's get in Akhil Chaturvedi of Motilal Oswal Financial Services joining in now. Akhil, good afternoon. Thank you so much for joining in. What do you make of the numbers? Despite the decline, we have seen improvement across the board when it comes to different segments. Can you give us your sense of what led to this improvement? Which are some of the categories which continue to do well?
Yeah, so I've just got hold of the numbers. I think the numbers are looking, pretty exciting now. From the previous month, we did about 32,000 crores, so it's 10,000 crores more in equity in terms of net sales. So clearly, I think what we sense is that investors are trying to benefit from the volatility in the market and trying to, invest as the markets are giving opportunity. And that's the sense we broadly get. But the numbers are very, very exciting, honestly. And it's a very positive change that if markets get volatile or if markets correct, then investors actually take a positive view and try to benefit rather than what used to happen earlier on where redemptions used to go up. So pretty positive numbers.
Akhil, this time around, we did see, in the last month, we did see that inflow falling in the sectoral funds, in the thematic funds, and lower NFOs as well. But this time around, we have seen an improvement. New fund offer inflows have been around at 30,000 crore rupees, sectoral funds at 9,000 crore rupees. Is this just the start of a new wave of inflows into sectoral and NFOs?
I'm not sure. It's early days. Honestly, I have to see the breakup of the numbers category-wise.
Right.
But I think we need to wait and watch maybe some themes, such as manufacturing or defense. I think these are some of the or digital, some of the categories where investors have taken interest. But I've yet to see the breakup, honestly, to make any comment right now.
Absolutely, Akhil, we'll wait by and we'll get more comments from you a little later once the intricate details are out. And we'll also wait and watch for the monthly SIP number, whether that has sustained similar to last month's level or whether there could have been a slight bump up over there as well. But we'll now slip into a short break. The management of D Development Engineers joins us next to discuss the Q1 and FY26 outlook. Welcome back to Midcap Radar. Well, one stock from the broader end of the market and one company that delivered very strong Q1 numbers just a couple of hours ago was D Development Engineers. Now, this particular stock, post the results that came in at around 11:30, the stock has surged almost 15%. We are now joined by the management, Krishan Lalit Bansal, the chairman at D Development Engineers, to explain the numbers to us and the way forward. Thank you so much, Mr. Bansal, for joining us. First up, quickly, if you could tell us, what exactly worked for you in the quarter gone by, what led to the sharp increase as far as EBITDA margins is concerned, and a few hygiene numbers. What was the order inflow, and what does the current order book stand at?
Yeah, thank you so much. Thank you so much. So let me begin with this thing that we really had put up a good show in quarter one. Major reason for that is that we had a very solid order book in hand, and the things which had been anticipated, they are moving exactly as per that. The new facility is almost ready. We are likely to announce the major expansion of that also very shortly. And of course, the new facility which is already operating, and it has started giving us dividends, which has helped us to improve the numbers. And at present also, the order book in hand is more than 1,230 crores approximately, I'm saying. So we are quite secured for the full year, and whatever projections we have given earlier, we are absolutely on track as on date to maintain that.
Okay, so Mr. Bansal, two-part question here. Can you reiterate what the growth plan or target for FY26 is in terms of top-line growth and margins as well? And second, when you say the new facility has started contributing, and that is something that you saw in this quarter, what was the total contribution from the new facility? How much do you think it will contribute by FY26? And has it come at full capacity utilization? If not at full capacity utilization, what kind of contribution will it make?
The anticipation was that we should be doing almost around 200 crores from this facility in this fiscal, and we are I will say that almost on track to maintain that with almost I will say 50 to 60% capacity installed, and when the full capacity is installed, we are targeting around more than 300 crores of revenue from this particular facility alone, and this is what it is.
So it will be in this year itself, you will do 300 crores?
This year we shall be doing more than 200 crores out of this facility, because this is not fully commissioned as yet, and we are operating, we have been able to commission the capacity of almost around 60% of the total capacity, which is likely to be there.
Okay, Mr. Krishan, first up, just a quick clarification. The new facility that you're talking about is the Anjar facility, right? And did it come on stream in January? You said last time there was a bit of delays due to the early months.
No, that January is, for our new unit, which is for seamless pipe plant, which we are putting it over there. But
okay.
Fabrication unit, which we are constructing from last 2 years, and we commissioned the first phase, I think about 9 months back already. So I'm talking of that. But that also is on track that within January, we shall be able to commission that seamless pipe plant also fully operative.
Okay, so one more question. You said that currently you're sitting on an order book of close to 1,200 crore. So with that order book, what is the kind of visibility that you have? Does it extend beyond FY26? And when it comes to new order inflow, Q1, what was it? FY26, where do you expect, or what kind of ordering are you expecting to book?
So we were able to book almost around 320 crores worth of orders in Q1, and also build almost the same amount. So, practically, we had set a target that we shall be keeping our order book above 1,000 crore at any given time, and we are well on track for that. And out of this 1,300 crores also, we shall be carrying forward at least 400 crores worth of orders from that itself. Plus, with many orders are in the pipeline, and the projections which earlier given are absolutely on track. Again, I'm saying time and again, but we do not see any reason that the order inflow should hamper or it should slow down. The things are moving exactly the way we had planned, and with all the things, other things in place, we are quite well placed to have a very robust year-ending results also.
You know, the last time that we had spoken to you, you had indicated that gross margins were under pressure because of the order mix that you had. But this time around, there's an improvement in gross margins to 67.6%. Your margins have improved to 16% versus 13.4%. What is the order breakup currently? The new orders that you're getting, are these high margin orders? Will you be able to do the Q1 margins of 16% in FY26 overall?
Yeah, you know, that's the target. Our target is even more than that. What we have projected is...
Can you quantify that for us?
No, you know, we have been saying that we should be hovering around anything between 18 to 20% of EBITDA margin. We have been telling this right from the day one, and we are still maintaining that. And, you know, our Q1 is always on a very, very leaner side. And, you know, we start picking up after Q1. So our Q2 is likely to be much stronger than Q3, than Q4. Last time we were down in Q3, but that was an exceptional thing. This is not going to happen this year under any circumstances.
Okay.
So that's the case.
Okay. A couple of questions, Mr. Bansal. First up, EBITDA margins. Earlier you had mentioned that you're targeting the 20% range, 16% currently. End of FY26. Where do you expect that? And secondly, post IPO, one of the reasons you had done the IPO was to reduce debt. So where does the current debt stand at, and what are the debt reduction plans, especially the kind of capex that you have lined up?
You know, the debt levels have not increased. We have not gone in for any new debt per se. So exact numbers, I'm sorry, I don't have right now. But what I can say broadly is that, the numbers have not increased. Debt has not increased. The utilization of already sanctioned debt might have increased, but at the same time, there has been repayments also. So I don't think there would be any increase.
Mr. Bansal, what is the absolute debt currently?
Pardon?
What is the absolute debt number currently?
It should be around 300 or 400 crores. Again, I'm saying I might be wrong in this, so I really will not be able to.
So, do you have any plans to reduce debt this year itself? What's the plan with cash flows?
The cash flow, there is a substantial increase going to happen in the cash flow, but since we are still in the expansion phase, we are still going to invest in the pipe plant also. Otherwise, all other major capex is over. So the overall, the capex at the end of the year will be slightly more than the previous year. This is what I can tell you.
Okay, Mr. Bansal, thank you so much. The street clearly likes the kind of results that you've shown in Q1 and the commentary that you're giving for the rest of FY26. We'll expect more numbers from you when you join us next time around. Thank you once again for joining us. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. We're looking good for the markets. 150 points higher on the Nifty currently. Even the mid-caps are outperforming. 0.6% higher for the mid-caps as well. So it's closer to the day's high as well. It did see a dip around 11:30 a.m. But since then, it's been a one-way move on the markets. A couple of stocks that you should keep on your radar. SP Apparels. There's a sudden spike on this one. It's up around 13.5% suddenly. Remember, all these textile stocks have been in focus since the news of those tariffs coming in from the US. The other one is Paytm, or 197 Communications. That stock is up 3.5% as we speak. That stock also is at the day's high. The mutual fund data flashing for you at the bottom of your screen. But for now, we'll take your leave on this edition of Midcap Radar. Our special show, Finding Alpha, is up next.
What's brewing in India's alcohol market? What's worth sipping and what should you steer clear of? Hello and welcome to a fresh edition of Finding Alpha. I'm Nigel D'Souza, and joining me today on the show is Karan Turani, Executive Vice President of Elara Capital. Well, Karan, thanks a lot for joining in. And just to all our viewers, well, Karan is all set to uncock some answers, pour out the facts as we address queries on alcohol, media, as well as on retail. Karan, welcome to the show. Well, I'm sure you've had your fill over the weekend, But let's focus on a couple of stocks. Let's focus on the sector on the whole. So let's start off with a very basic query then. What's the size of India's alcohol market as of now? And where do you see this number headed?
Hi, Nigel. It's a pleasure to be here on this show. If you look at the alcohol market in India, it's about $47 to $48 billion. It's growing at about 8 to 10%. The overall volume numbers is about 1,000 million cases. Okay. 450 million is the spirits market, which is whiskey, brandy, rum put together. 420 is the beer market, and the balance is country liquor. So the market is growing very well at about 8 to 10%. 6-7% is volume-led growth, and the balance is value-led growth.
So from around 3 trillion rupees approximately, you're saying that in the next few years it heads to around 5 trillion, right? My query to you is, a lot of the youth of today, they are very health conscious. That's at least the buzz that we hear. And maybe when we were growing up, it was a little bit different. But have you taken into account this risk factor in that estimate of around 3.5 trillion rupees to around 5 trillion rupees?
So what's happened, Nigel, in a market like India is that more than 40% of the population is Gen Z. Now, Gen Z are basically the ones who actually don't want to drink quantity, they want to drink quality.
Okay.
Right? So we have seen a rapid movement in terms of premiumization trends, wherein the luxury segment, the higher end segment is growing at a faster pace. A lower end segment continues to struggle here. So I think there is a bit of a pressure in terms of volumes.
Okay.
However, the negative impact of this lower volumes will be more than offset by positive impact of the realization per case, because the consumer is moving towards the high end of the segment, the luxury upper prestige segment which is there. So I think net, the industry should grow at about 8 to 10%. And as I said, volume is going to be negative for the lower end of the band, but the upper end of the band will take care of this negative impact.
Okay, India wants to consume more premium alcohol.
Absolutely.
Let's focus on the per capita, because that gives you a fair indication, right? Yes. India was lagging, till a few years ago, but gradually India's per capita consumption, if I compare it with the globe, that's, I think, catching up a little bit. So could you fill us in with those numbers?
So the per capita consumption has increased over the last 3 to 5 years, specifically in the post-COVID era. What's happened is that we're looking at about 3.5 liters in terms of per capita consumption. Now, if you break up that number, we are a very high ratio or a high split here towards spirits and whiskey. As far as beer is concerned, we are less than 10% in terms of volume share. If you look at other markets on a comparative basis, markets like US, China, European nations put together, their share towards the beer market is, in terms of volume or in terms of consumption, is as high as 40%, 50%, even 70% in certain states. But in our country, the beer share is less than 10%. That's where we are. So we are a spirits and a brown spirits, white spirits market in a large manner.
Yeah, and that gap with the global per capita, which used to be around 3 liters, that's come down to around 2 liters, and now it's hovering in that vicinity of around 1.5 liter. And, going ahead, that's likely to narrow. But since you briefly spoke about, the split of the India market and what Indians are consuming, give us a few more details. What is it category-wise? Whiskey, brandy, beer, if you could break that down for us. And in IMFL, if you could further break it down for us, what is it?
So if you look at the market, as I said, at the one end, you've got the beer, which is about 400 million cases. At the other end, you've got spirits. Now, spirits is like a large market. It's got multiple segments within that. Around 65 to 70% of your volumes is brown spirits, which is largely whiskey. The second largest segment is your brandy segment. Yes. Third is the rum, which is around 10-12%. And the balance is basically wine, vodka, everything put together. So I think this is how the spirits market is. Now, if you look at the realization per case within these categories, it's a huge gap. If you look at the likes of vodka, the realization per case would be in the range of 3 to 3,500 rupees. If you look at wine, it's around 4 to 4,500 rupees realization per case. Whiskey is like a wide range, between 500 to even 10,000 rupees realization per case. If you look at the likes of brandy and rum, they are more in the lower end. There's not much of premiumization happening in these two segments specifically. So realization per case is low in the range of 15 to 2,000 rupees in these two segments which are there. But as we speak, going ahead, India is largely a spirits market, and within spirits, India is a very large market in terms of brown spirits, which is whiskey.
Whiskey, all right. And I think that chart should come up for you as well. But, Karan, if I heard that number correctly, in terms of volumes, beers and whiskey is more or less at par in number of cases, but the realization differs. Is that correct?
Yes, absolutely. So if you look at the market, as I said, 450 million cases is what the whiskey market or the spirits market is. Then you've got the beer market is 400 million cases. The reason why the spirits market is fairly larger as compared to beer is because realization per case. You do get a beer at maximum in terms of pricing in the range of 800,000 rupees per bottle, right? But in the case of whiskey, you can get a whiskey for even 1,000 rupees to even 1 lakh rupees or 50,000 rupees. So because of the big gap in realization per case, in terms of value, the spirits market is far bigger as compared to the beer market.
And since the largest segment, as you said, is whiskey, let's break that down for us. Premium whiskey, that's something that's been selling more. So explain that to us, prestige and above, and what was normally, below that level. And if you could tell us how luxury as well has moved as a segment.
So whiskey typically is like a very large market in terms of multiple categories. So because the market is so large in terms of volume and in terms of value, you've got multiple categories, multiple brands here. To break it down, out of the 400 million cases, one can say that 270 million cases is brown spirits, which is whiskey, and the balance is other white spirits put together. Okay. Now, within the whiskey segment, which is like a key focus area for any company, there's a ratio. So the ratio is basically 100, 110. Then it moves to 60, then it moves to around about 20, and then moves to 10. Now, this I'm talking basically in the line of low prestige, mid prestige, upper prestige, and luxury segment. So as you keep moving upwards in terms of curve, okay, the pricing is higher, realization per case is higher, the margins are better, right? The growth rates are better in every segment. So, for example, in the case of low prestige segment, the growth rates are now about 2 to 3%. In the case of luxury segment, growth rate is 25-30% in terms of volumes.
Right.
Also, very important point to note, India as a premiumization market, if you see, our volume share in luxury segment was only about 3 to 4%, about 4-5 years back. Today, it's about 8 to 10%. So that's the rapid adoption of luxury that we're seeing today. This is also thanks to single malt culture that is picking up. We have seen a lot of new single malts coming in the market, like Rampur, Indri, Paul John introducing some single malts and so on and so forth. So this is actually driving the premiumization luxury culture in a market like India as far as whiskey is concerned.
Okay, let's focus on whiskey then. In the last few years, who's gained market share, who's lost market share? If you can briefly tell us about that, and then we'll get to the big deal that was announced where, you have a brandy player that now wants to sip on some whiskey. So fill us in with first the whiskey market, who's gained, who's lost?
So as I said, whiskey market is largely fragmented. Every company has got at least 4 to 5 brands of whiskey in multiple segments, right? So if you look at the winners here, I think the winners clearly are, some brands of Radico, which have gained the luxury segment. You've got the likes of Blender's Pride, which has also gained market share. Something like a McDowell's No. 1, which is a market leader in the low prestige segment, they've kind of maintained market share at those levels, which is like a commendable task in itself because that segment is seeing a decline.
Yeah.
Iconic White is also doing well, which is a new brand launched by ABD. They've gained significant headroom and market share over the last 3 to 4 years. If you look at the losers here, I think 8 PM has lost market share in the whiskey segment. If you look at Officer's Choice, they've lost market share in the whiskey segment. So these are some brands which have been winners and losers.
And from the top list that's up for our viewers on the screen, just to clear it out, McDowell's is United Spirits. The next two brands, which is Royal Stag as well as Imperial Blue, they come in from Pernod. And Imperial Blue now will move to Tilak Nagar. And Officer's Choice, that's the one that belongs to Allied Blender. So just, those are the brands, you'll be familiar with that. But in terms of stocks, just thought I'll put out that relation. Since we're talking about that big deal that took place, nearly $500 million USD of a deal was done between Tilak Nagar. They have picked up Imperial Blue. Could you tell us, how does this change things? This brandy player going to have a stiffer peg, how do you see it? First for Tilak Nagar, how do you see it panning out?
So I think this deal is a very big positive for Tilak Nagar. Tilak Nagar, as you know, has been a South-based player. More than 90% of revenues coming from South. More than 90% revenues coming from brandy segment. They've tried a lot to innovate and move to whiskey segment, but somewhere they haven't got that kind of scale, what they've got in brandy. Now, what this does to Tilak Nagar is 2-3 things. One, it will give them a pan-India access because, Imperial Blue is a large brand, about 25 million cases all over India. So you can get a good distribution cloud and a pan-India distribution mechanism, which is very important for the alcohol business in a market like India, which is, different state subject, different tax issues which are there. The second thing is basically they can also cross-sell, upsell. So many of the new markets which will open up because of this, so they can cross-sell, upsell their existing brands, existing brandy brands.
That is brandy.
Yes. Third very big move is the entry in the whiskey segment. So as I told you, in terms of value, volume, whiskey is a very large market. So it gives them the much needed access to entry into the whiskey segment. And within that, I think now it's about the execution, right? In terms of how they innovate, how they launch new brands, is going to be a key monitorable. But the deal is extremely good from Tilak Nagar's perspective because they can actually become a sizable pan-India player, something similar to what a Radico was about 7 to 8 years back.
All right. So, that'll be interesting to see because some believe that maybe they're looking to have a too stiff a peg, but we'll have to see how that goes. Since you're saying sizable player, you want to put a number to it? As of last count, they were doing some 250 crores of EBITDA. Given that now they're going to get Imperial Blue, say in the next 2 years, what is the rough EBITDA number you should work with, say for Tilak Nagar Industries?
So for Tilaknagar, if you look at standalone business, I think they were doing EBITDA of 250 crores, which has grown a CAGR of 30% odd over the last 2-3 years with very good margin improvement. I think going ahead, one should expect margin improvement, not in a big manner, but maybe around 8-10% of EBITDA CAGR is what they can do going ahead for the brandy business. So let's assume this EBITDA probably goes to 300-320 crores over the next 2 years. Then you have the Imperial Blue, which is the business that they've got. That, as per our assessment, is making EBITDA in the range of 300-350 crores. That potentially will grow in the range of 7-8%, not more than that, because the segment is struggling for volume growth.
Right.
So let's assume that EBITDA moves to 400 odd crores. So if you do the math, 1 + 1 of both these EBITDAs, you will get about 750 crores of EBITDA in the next 2 years. Now, the thing is that from here on, there are enough synergies that they can draw. They can draw innovation, they can draw luxury, high realization per case, which can lead to better EBITDA on an absolute basis going ahead. If that becomes the case, yes, there is a potential for Tilaknagar to reach 800 crores of EBITDA in the next 2 years, depending on how they execute on the new brands and depending how they turn around the Imperial Blue portfolio, because that's one portfolio which has lost market share in the last 2 years.
Indeed. Yeah, that's the important point. Imperial Blue has actually lost market share. Now, could this be an issue, though, for United Spirits? I ask you this because, see, Pernod, now they'll sell out Imperial Blue. So they'll focus more on Royal Stag, which has been actually gaining market share. And Tilaknagar, they have taken over this brand that actually has been degrowing. So additional focus on Imperial Blue. Could it be a risk to the market leader, which, as you said earlier, was McDowell's, which comes out from United Spirits? So is it a risk for them?
So I think this is a risk for the entire ecosystem. One new player actually becoming bigger in the system here, one new local player rather. So if you look at the market, you had 2 large MNC giants, which is Diageo and Pernod operating, and then you had the likes of Radico, ABD, which are operating in a local environment manner. Now, this is one more entry, one more new player which is going to come in. So there will be competition because they will again innovate. They will innovate across segments, not only in the low prestige segment. They will also try to move in the luxury segment as well. So I think this is a risk for the entire industry as a whole, wherein the MNC companies are anyway struggling to gain market share because they are focusing on the luxury segment, which is a very small part of the overall pie.
Yes.
Whereas in the case of local companies, yes, Radico and UNSP, Radico and ABD rather, will see a bit of a pinch basis this.
Indeed, but Radico is one stock that actually you have been quite positive on. And that graph actually should come back on for our viewers. It could pose a bit of a challenge to them as well. But I think they have been focusing on premiumization. So how do you see this pan out? New player coming into the whiskey market, Pernod as well getting aggressive. What's the take on Radico? Does it have enough triggers to even do well from here?
So Radico does have triggers to do well from here. There are 2-3 reasons for that. I think Radico net, you have to see the P&A volumes have been extremely strong. They're growing at about 15-20% P&A volumes consistently in the last 3 to 5 years, and that traction continues. They are a market leader in vodka segment. Okay, so vodka segment, they've got more than 60% market share. They are the 5th largest vodka in terms of selling, in terms of Magic Moments as a brand. So that's their moat. Third mode for them is basically the expansion into single malt. They are expanding aggressively over there, launching single malts. Luxury offtake is very high, and that's leading to the entire premiumization play for them. So I think these are things which are playing in favor of Radico. Plus, Radico is a company which is like a portfolio-led company.
Yeah.
They don't have exposure only in one single category like a whiskey or a gin or a vodka. They are broad-based across categories, right? Okay. So even if one category doesn't do well, they always have the option to go to the other category and do launches over there and piggyback over there.
So just to revise what you're saying, Tilaknagar, it has potential. We'll have to see execution. United Spirits, it could be under pressure because of a new player coming in there. Yes. Radico, you believe it has enough of diversification, enough of focus on premiumization.
And luxury, yes.
And luxury, which can continue to do well. What about Allied Blenders? What's the view out there?
So I think Allied Blenders is done well in the Iconic White, the new brand which they have launched. But Allied Blender is not able to innovate in the luxury segment or do well in the luxury segment the way Radico has done with their brands. So ABD needs to focus in terms of premiumization luxury segment in a very big manner if they were to scale up their market share and go to premiumization.
Okay, so that's going to be the focus for Allied. What about the UK FTA? That's supposed to be a benefit, right? Who benefits and by how much? If you could give us a few numbers.
So UK FTA, that way in terms of overall impact, you could see Scotch prices coming off by anywhere in the range of 15-20% over the next 1 year. Whenever
so that would help volumes.
That would help volumes. But that would help volumes in a very small manner because if we look at the Scotch market as such, it's only about 8 to 10 million cases, right? And so in UNSP as well does not do more than Scotch volumes of more than 4 to 5 million cases. So it's a very small positive impact, so to say. And it's not a big positive for UNSP rather because, the margins are capped in this Scotch business. So in terms of overall EBITDA, they may not see a big delta, but volumes will obviously go up for United Spirits. The bigger delta from the UK FTA will be the bulk Scotch prices. So for any whiskey company, around 8 to 10% of their COGS is coming from bulk scotch, whose prices will come up by 40%.
Yeah.
So this is an EBITDA margin positive impact for all the companies which are procuring bulk scotch, and that's going to drive margins anywhere in the range of 100 to 150 crores of a positive impact after UKFT.
All right, so UKFT will be positive for United Spirits, but you're saying in the entire scheme of things, it may not be that big a delta, at least as of
because of the margins being capped and because the volumes being smaller.
All right, let's turn our attention then to beers. You know, there has been focus on premiumization there as well. But gross margins haven't really improved because, you know, the cost of goods actually has moved up. The input costs have moved up. Now that's cooling off. So what's your view on United Breweries? First, tell us the size of the market, how is it headed, and view on United Breweries.
So beer as a market is very similar to spirits. You know, you could see volume growth of 6 to 7%, which is slightly higher as compared to spirits, which is 4 to 5%.
Yeah.
And value-led growth of around 9 to 10%, which is similar to the whiskey market, which is there. In terms of beer, you know, what has happened, the margins have actually come off significantly for United Breweries because of 2-3 major reasons. One is they are focusing on premiumization of beer. So they are trying to actually launch new products in the premium beer segment, which requires new bottles. Now, because of this, the glass prices have seen a significant increase for them.
Yeah.
And glass, as we all know, is 40% of COGS for any beer company. So that's one reason which is there. Second is reusability of bottles has also come down. There's been some issues in terms of supply chain, all those things which are there, which is also impacting the glass, again, the elevated glass prices which are there. Third, I think they're investing very aggressively in terms of operating efficiencies, manufacturing excellence, all those things to drive actually, you know, better efficiency from medium to long-term perspective.
Yeah.
A fourth reason has been the barley prices. Now, the barley prices post the Russia-Ukraine war has seen major elevation in around 2022, but that's not seen a cool-off to the pre-Ukraine, Russia-Ukraine war levels. So I think that's also impacted margins to a certain extent. So putting all these things put together, I think margins have, that's why, come off by 600 bips in the last 3 to 4 years.
Yeah.
But nonetheless, you know, we do see glass prices cooling off, primarily because now the premium beer glass prices will slightly come off.
Yes.
And secondly, the reusability of glass will also increase. So putting both these things into perspective, we do see margin improvement of 200 bips over the next 2 years for a UBL.
But yet you'll have a sell rating on that.
We have a reduced rating on UBL with a target price of 2,000.
All right. And on UBL, the premium segment, you know, the graphic plate was showing us that actually that has gone up, you know, that's growing at a faster clip. How much is premium as a percentage to their total mix?
So if you look at UBL, their premium beer is about 10 to 12% contribution in terms of volume.
Yeah.
But the growth rates are significantly higher. So
Okay.
since Heineken took over the company, the entire focus was on premiumization play. If you look at their market share in premium beer, it was, you know, sub 10%. It's now come to about 15 to 18%. Because they are consistently growing about 25-30% in terms of premium beer volumes.
Got it.
And that's primarily because of the Kingfisher Ultra, Ultra Max, Heineken push they're doing right now.
All right. Karan, we have some more questions for you. Maybe squeeze in a couple of them on alcohol. We'll also talk retail as well as media. We'll take a short break. Up next, we'll answer all the queries that you've sent us. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. And as promised, we're going to be taking some queries. So let's take the first one that comes on our list. We have Rupesh Patel, who has written to us from Mumbai. He holds shares of Zomato. He wants to know what's the outlook. Karan, what would your advice be? Eternal. That's the stock that he has. But your view on that one and, between Eternal as well as Swiggy.
So I think Eternal is a good stock to hold. Obviously, from a near-term standpoint, there is not much of upside. We have a target price of 340 on the stock.
Yeah.
But from medium to long-term perspective, I think the compounding story is pretty much intact as far as Eternal is concerned.
Okay.
Quick commerce market is a large market. It's about 7 to 8% of the entire e-commerce market. It's a very small number. It can scale up. It can penetrate further. Second thing is that if you look at the quick commerce market as such, the worst seems to be over in terms of price wars and in terms of the competitive intensity. So Eternal has maintained market share. Blinkit rather is a market leader in quick commerce even right now. So if you want good compounding stories with low risk and high reward from medium term perspective, I think Eternal is one stock you can hold. As far as Eternal versus Swiggy is concerned, we have an accumulate rating on Swiggy. The reason for that is one should play Eternal and Swiggy in the weighted of 70-30 because Swiggy has been very volatile in terms of execution. So whether you call it the losses coming off, whether you call it the growth rate, whether you call it market share numbers, they've kind of been very inconsistent in terms of their performance and execution has not been top notch. But nonetheless, if the market is kind of seeing a positive momentum in terms of the quick commerce industry, seeing a re-rating of valuation multiples put together, Swiggy will also be a beneficiary of that. And in that angle, one should hold Swiggy as well because of lower valuations.
All right. In between the two?
Prefer Zomato over Swiggy, yes.
Okay, all right. Let's get to our next query then. We have Meera Srinivas, who has written to us from Chennai. She holds stock in PVR Inox. Wants to know what's the outlook. Well, that's been a surprise move, right? In the last few months, out of nowhere, you got a few hits that's coming, and it appears the pipeline as well is looking pretty okay. Your view on PVR, it's already had a bit of a run. From here on, does it have more in store?
So from PVR perspective, I think the structural risk remains here. I think if you look at the number of Hindi films put together which are being released are down by 30-40% versus pre-COVID. If you look at the OTT consumption that continues to be on the rise, there is still fragmentation, still a lot of content that the consumers are watching online. Again, the dependence on large budget films is increasing. Small, medium budget content, people are not going to cinemas in large numbers. And having one hit like a Sayara within 3-4 months doesn't hold good for the cinemas because they need consistent occupancy to pick up. Nonetheless, I think next 6 months it could be a good tactical bet because Hollywood Writers Association strike is now coming off. Hollywood pipeline remains to be extremely strong. Even in terms of regional Hindi pipeline, the movies are there for the next 6 months to drive occupancy levels. But structural risks are also there in terms of discounting or ticket prices, F&B, lower profitability, which are there. So I think one should play this stock on a tactical standpoint. You could see 10 to 15% upside in the near term. But from medium term perspective, you'll always find sellers on the rise for this.
All right, structural risk persists, but maybe the near term pipeline is looking good. Personally, I've gone and seen quite a few movies in the last 4 months or so, but let's see how that goes. Let's get to our next query. We have Gurbinder Singh Bedi, who writes to us from New Delhi. He says that he owns Trent shares. He's a long-term investor. What to do, Karan? The stock ran up so swiftly, then it pulled back, but now it seems to be finding its feet. And he's mentioned that he's a long-term investor. So what would your advice be?
So Trent, again, from a near-term perspective, we don't see too much of an upside, but the worst seems to be over in terms of growth. Growth rates for a Trent have converged from 35% to 20%. So the worst seems to be over. I think what is working against them rather is the lower LFL growth. I think expansion plans have been largely on track. They're adding stores about 150, 180 stores in terms of Zudio and overall portfolio level. What's working against them is also the West Side portfolio, which growth rate is now more than 8-10% over there. Margins obviously have done well, but margins are not a way to kind of drive re-rating for these stocks because these are high P stocks. Investors expect very high growth from these stocks. So from near-term perspective, not much to draw here, but once we see LFL improving, once we see adoption of fast fashion non-metro markets, because that's where the new stores are opening right now in a large manner, you will see Trent also moving up gradually.
So you expect Trent to do well in the longer term?
Yes.
Well, Karan, it's been a pleasure having you on the show. Thanks a lot for joining in, giving us your insight into the Alco-Bev industry, some picks with regard to the retail space, as well as, from retail as well as media. Thanks a lot for joining in, Karan. Well, we'll wrap up on this edition of Finding Alpha with news that, in fact, India's alco beverage market is growing. It's expected to grow. Higher focus on premiumization. It's going to be very interesting in the whiskey space with the new player coming in there. And Karan is quite optimistic on stocks like Eternal, Swiggy, PVR as a tactical play, and Trent as well. We'll wrap up on this edition of Finding Alpha. We'll join you back in the next couple of weeks with another theme.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
When you're looking at Hang Seng and Taiwan Index, that's very muted, right? Not much of an upside or a downside.
Nifty support 24,243 and then, on the downside, 23,800 and 23,900.
There's no great concern in terms of the asset quality.
That market share on a month-on-month basis in April, May and June, that had seen us increase.
It's 24,360 on the Nifty.
Already working on those capex guidelines that we have given earlier. We are building on our new product diversification.
Got all the requisite approvals, so absolutely there is no impact on the IPO.
Last week was 6 consecutive weeks of losses for the Nifty. Today we are seeing some rebound, of course.
किसी बैंक ने 10,000 रखा है, किसी ने 2,000, कईयों ने माफ भी किया हुआ है, लेकिन ये रेगुलेटरी डोमेन में नहीं है.
Monday morning, the week has started on a positive note.
Well, I think that last line, Monday morning, started on a positive note, very much so. 200 points, and looks like we are set. At least the beginning of the week indicated that maybe this is going to be a much better week. It's all relative, of course, compared to the last few that we've had. This was essentially the broad thinking here in the morning as well, leading up to, of course, that big event on Friday. This is Closing Bell. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. Surbi and Reema are with me, and Nigel should be with us in a bit from now. Guys, hi, good afternoon.
Hi. After 6 weeks of losses, at least we've started off the week and we built on the momentum. Like in the morning, we were up about 100 points. Now we're up 200 points.
Yeah, no, this is looking like such a good-looking screen. And I was just thinking, several things are coming to an end, right? The earnings season is coming to an end. So whatever casualties or disappointments you had to look at, you've dealt with it. That tariff is already 50%. So technically it should only...
it's not 50%.
Not yet.
It's
26.
Oh, okay, fine. Yeah. So even if assuming 50%...
That is the whole thing. That's why Friday is important. If Friday if there's peace...
Yeah. Then maybe it's 25%.
The question is, can we draw a straight line from there to our situation here?
Yeah.
So, I mean, that solves this.
So basically, I mean, it seems that the direction of travel in terms of news flow, at least, maybe hopefully should be positive in some days. And the inflow data, look at the domestic resilience, the money in the market. So incremental news flow, hopefully gets positive from here on.
Absolutely. I mean, that domestic inflow number, which will be, we'll discuss this in greater detail, but I think it's at an all-time high. Equity flows and just incredible. Let's just a quick look at where we are at. So 24,570. I mean, the broad thinking, of course, was that, huge amount of shorts, right? Especially index short position. I mean, we ended last Friday and came in this morning before markets opened with about 1.8 contracts short. That's about 34,000 crores in value. Just index futures, as far as FIRs are concerned. And we don't know, actually, if anything will happen on Friday. I spoke on CNBC Prime about an hour and a half back with two seasoned diplomats when I asked them to put odds to a peace deal on Friday, well, they both kind of said, well, they're not hopeful. It's gone too far and a bunch of reasons. But if you are short and short in any meaningful size, it doesn't matter what happens. You want to sort of cut some of those short positions, and I suspect that is essentially what will happen through today to the end of the week. Also, especially, by the way, because Friday is a market holiday here in India. So all of those factors coming together in a bit of a way. The low, by the way, was around 12 o'clock, just before 12 o'clock today, as you can see. And then the market's basically seen a big move up from those levels. 24,600, nearly coming back on the Nifty. Reema.
Well, 24,350 was that intraday low around 12 o'clock. So from that point, we've managed to recover close to about 200 points. It's been a one-way sloping up kind of a trading session in the second half. 1 hour to go. The big sectors which are gaining today, one is defense and the other one is PSU Bank. So PSU banks are up close to about 2% with State Bank of India, PNB, UCO Bank, Union Bank all higher in trade. And the other sector with strength is the defense. We'll talk about stocks, but first let's tell our viewers what we have for you on our show. Mutual fund equity inflows hit record levels in July. SIP collections also at record levels as investors stay the course despite volatile markets. AC makers in focus as demand falls. Actually, it's fallen off a cliff, sparking similar moves in other AC and AC component makers. Voltas's first quarter numbers also add to the pain. We'll get you excerpts from our conversation with the management of PG Electroplast, which continues to fall after that steep cut in guidance. A spate of clean-out trades hit Dalal Street over the past few months, with sales totaling over $2 billion since April. And HBL Engineering is a big volume gainer, surging 13% as the street shares a good set of Q1 numbers.
Okay, so plenty of stock action to track, and we also have Nigel joining in. Nigel, we were just discussing the green looks good on the screen after a long time, and a trending update at that. I mean, at least it's not been too jittery here and there, but it's a nice looking screen.
Well, that's right. Nice looking screen, and the indicators were there, right? And, you had the PCR that moved to around 0.65. You had the RSI that had moved to around 35. And the FI is aggressively net short. So this evening's reading of the data is going to be very, very interesting. I'm going to look forward to the Bhav copy later today and see what the flows of the FIs are in the cash market. Could they potentially turn buyers? Let's see. But I'm sure there will be some shorts that would have to scramble for cover because that had reached extreme levels. Mitesh Thakkar joins us on the show. Mitesh, we were talking about this bounce. Finally, it's come about. The structure could still be rather weakish, but good to see a solid recovery. And as we speak, in fact, we're at the high point of the day. Tell us your reading.
So, there was always this chance of a recovery given that we have had a big decline. We were at a gap support level and we are quite oversold if you look at the hourly, 2 hourly, 3 hourly charts. So I think that started playing out. Now, the first question which comes to your mind is, what are the levels which this recovery could take us to? There's a minor pivot at 24,630, but I think overall I was talking about 24,750, 780 as the zone. So I think we might head towards that, which means that we still have another 200 points to look at. And on the stock side also, I have some long ideas as trading recommendations. Buy with a stop below 18, Policy Bazaar is a buy. Keep a stop below 1825. Look for targets of around 1900 to begin with, and then maybe we can look at even higher levels eventually. And the second stock which I like, that's a buy as well. SBI Life, buy with a stop below 1830 for targets of around 1900.
Okay, all right, got that point. Thanks very much for that, Mitesh. We'll keep that in mind. Now let's just take a look at what has been a blockbuster July for mutual fund investors, for inflows. And this is the time where all the tariff uncertainty was playing out and we had all kinds of negative headlines coming through between geopolitics and what's happened. Investors have just simply kept the faith. And you can, of course, also credit the industry for it because a record number of NFOs, new fund offerings, 30 NFOs coming in and mopping up over 30,000 crore rupees. That is what has led, let's get the data up if we can, that has led to what is a record surge of flows. Look at that number, 42,672. So the July inflow has surpassed even the inflows that we had last Diwali. That was the previous record, October of 24, which was around 41,000 crores. So it's incredible and squarely led by the NFO party. Like I said, and it's multiple NFOs that have come together. So big AMCs like ICICI Mutual Fund and HDFC, they've of course had their offerings, but a bunch of others actually have contributed to this inflow number, 30,412 crores, 416 crores to be precise. Let's flip this over, get the NFO cards if we can. Okay, before we get to NFOs and since we're flashing large cap, let me talk about this. Large cap funds have drawn in about 2,100 crores, but it's the mid caps and small caps. That's where the interest is so high. In fact, small cap funds have drawn in over 6,000 crores. Mid cap almost 5,200, small cap 6,000. So the preference for SMIDs is very much there. Now let's see if we can get you the NFO graph, because that's what's really important. 30,000 crores flowing in via new fund offerings. Over 9,000 crores have come in sectoral and thematic funds. And this is the number that I'm talking about, 30,416. Incredible. All-time highs coming in via a whole spate of NFOs, a good number of funds coming in this quarter. The other great number to look at is the SIP number. Once again, records in SIPs as well, because the total SIP contribution is 28,464. That's also a record. That bar actually should be inched up even a little slightly higher. Last time it was 27,000 crores. Now it's 28,400 odd crores. So that's as far as SIPs are concerned. And just some other trends. It's telling you that the multi-asset category is, gaining a lot of popularity. Perhaps people are seeing the surge in gold and silver prices, and these funds invest in gold and silver and other commodities as well, and in equity and in debt. So That's an all-time high for the multi-asset category as well. Over 6,000 crores have flown in. So records galore, looking very strong. That's been the equity inflow picture. In fact, let me start right there. Dipan, it's quite heartening. And this is the participation that's coming in. Even though so many blocks, so many IPOs, they're sucking in the liquidity. So you see this as a sign of confidence, will this patience of investors be rewarded, and by when?
Good afternoon, Surti, and thank you for having me on your show. Yeah, I hope it gets rewarded because, the way the earnings season has gone, there are far more disappointments. And overall, I think the news flow on the fundamental side certainly is building. But yet, I think Indian investors are reposing faith into Indian equities to mutual funds. But it's going to be very, very selective. And I'm not sure all the funds and fund managers will be able to deliver. So I do hope that, majority of the investors get good returns. But look, I think the clouds of uncertainty, especially after the Trump tariffs, has certainly increased. And this earnings season definitely has been a bit of a disappointment. So let's hope for a better festive season. Perhaps only that can lift the earnings and then lift the index from these levels.
Let's just get to some of the big earnings gainers. So one of them is Yatra, where the revenues have doubled. The other one is D Development. HBL Engineering, which Vamakshi will talk in detail. After 3 quarters of revenue losses this time, the top line has grown well. And even DOMS, where the revenue growth stands at close to about 18%. So these are some of the stocks reacting to positive earnings. And on the way down, it's Entero Health. And the other one is Voltas, where the company continues to lose market share. So Dipan, first on the mid-cap earnings gainers list, Yatra, D Development, HBL, DOMS, anything that you like?
Yatra, and we've been tracking it for some time now. And clearly, I think they have improved the efficiency within the business by focusing on corporate travel and focusing on their margins. They've been able to get fantastic gains as far as the profitability is concerned. And look, when you're looking at the entire travel tourism space, which is still quite a strong investment theme, there's certainly one business which can scale up very well and have huge benefits from operating leverage. And there's a fair bit of consolidation within these, travel agent type of portal type of businesses, and entry barriers are pretty high. So very positive on Yatra Online. And also another company which is disappointed us is RateGain Technologies, but it is still on our watch list. And we are quite hopeful that despite very tepid numbers for this quarter, this company can come out with good long-term growth rates because of purely on account of its business model.
No, absolutely. Just as an aside, a data point, right, to Surabhi's numbers that she put out about the strong SIP, the 47,000, the
42,000, over 42,000 crores, 42,600 odd.
So, Surabhi, started in 2023. Every year, if you look at private equity and venture capital funds, 2023 was the first time they sold more than 1 lakh crore of their total stake in listed entities. 23, 1 lakh crore, 24, over 1 lakh crore, 25, I think we are well on track for over 1 lakh crores. Same thing with private promoters. 2023, 1 lakh crore, 24, it's actually more than 1 lakh crore, 1.2, 1.3, etc. 2025 again is going to be. So and the only constituent, which is where shareholding is continuing to inch higher and higher.
Retail.
It is retail. It is, and through domestic mutual funds. That number was about 14%. 2023, it's about 17%.
Yeah.
So it's actually a big transfer. Actually, if you look at and the other constituent is FIIs. Actually, locals own more than FIIs now in terms of just the value of
their numbers have gradually dwindled.
Come off quite a bit. So it's just.
And this is despite people not getting returns. In the last 1 year, we're flat for the Nifty. The mid-caps are down. So you often say that money chases returns, but the returns were great.
I don't know how to read this, right? But a lot of the NFOs, I don't know how to read if it's SIPs is one thing, right? You don't, and that's the idea. Go up, down, periods of underperformance, you keep going. Yeah. So you get higher prices, lower prices, it evens out over a long period. But if it's a new fund offering, and then there's a fair bit of aggressive distribution, there's the other marketing push behind it, you collect a lot of money. So, that's the only sort of caveat here.
So if you strip out the 30,000 crores that's come in via NFOs, and a lot of AMCs have launched different funds, and everybody's in it. ICICI, HDFC, AMC, Bajaj Finance, Axis has done an NFO. Almost Franklin has done an NFO. And all of them have garnered decent amount of money, between 1,000 crores to 2,500 crores. I was, talking to some internal people on the data. These are not public figures, but you get a sense. So everybody's nicely, chipped in. But if you strip out the NFO number, and then you look at SIPs are doing very well, no doubt about that. But clearly there are some redemptions also, if you look at net of NFO data. But anyway, we look at everything cumulative.
We're talking about new retail investors being at all-time highs. I think in the next 1 year, we will see lots of new AMCs also. Already you've got 3, 4 which have sort of come through in the last 6 months. I think there are more in the pipeline. So it's just, it's sticky money. Once, especially the SIP flow is very, very sticky. It takes a lot for that to shake out. So as a business, AMCs, I think, are a pretty good business as well. Let's talk about the other pack of stocks, right? To focus on ACs, AC stocks. PG Electroplast, of course, was that company which cut the guidance. But it's, I think, showing up as ripples across other stocks as well. Ria's got details here. Ria, take it away.
Well, yes, today all of these AC makers have been under extreme selling pressure. Of course, PG Electroplast taking the biggest hit. So let's take a look at what has hurt these stocks. The first key reason is that Voltas reported a very weak set of numbers. Even PG Electroplast reported a weak set of numbers, and they've also cut their FY26 guidance substantially. And there are also high inventory concerns across the sector. First, looking at Voltas, the Q1 numbers were below estimates across the board. Revenue saw a decline of around 20% on a year-on-year basis. Even EBITDA and net profit fell by over 58% each, and EBITDA margins nearly halved to 4.5% versus just about 8.6% in Q1 of last year. Now, on the back of this, Nomura has a neutral rating on the stock. They have lowered their FY26 RAC industry growth estimates to 5% versus their earlier estimates of 10%, and they've also cut their FY26 and 27 UCP revenue growth estimates to 6% and 24% versus their earlier estimates of 13% and 21%. Even CLSA has a hold call on the stock. They have highlighted that the high inventory is likely to keep utilizations low, and it's also going to weigh on margins going ahead. However, Jefferies has a buy rating on the stock. They've said that from here on, the early festive season, possibility of a second summer, the new BEE rating, and the tactical cost control could also help RAC recovery going ahead. Moving to PG Electroplast, they've cut their FY26 guidance quite substantially. The revised revenue growth guidance is now at 17 to 19% versus about 30% that was guided earlier. Even the net profit, they've cut the growth guidance to 3 to 7% versus the earlier guidance of over 39%. So big cut coming in on this front as well. And they've highlighted that the lack of rebound in AC sales in July and August led to this revision in guidance. But they've also said that they are expecting a normalized level of inventory in October and November, and that one season doesn't alter their business trajectory for the entire year. Apart from this, just quickly taking a look at the valuations for all four of these companies. At the moment, PG Electro and Voltas are trading below their 3-year average PEs, and Bluestone and Amber Enterprises are currently trading above their respective 3-year average PEs.
Okay, all right. Thanks a lot for that, Ria. In fact, earlier today, we spoke to Mr. Vikas Gupta, the Managing Director of PG Electroplast. Let's listen into excerpts from that conversation.
As a channel inventory built up, and there was no rebound in the sales for the air conditioners, the secondary sales of the air conditioners in the months of July and August, as we are seeing now. So we had to revise our guidance accordingly. In the month of May also, we were hoping that the market will improve, the demand will improve. We were having the order book, we were having the forecast from our brands, our customers, that was quite robust, and we were building on it, and we were believing that numbers, and we were going ahead with those production numbers. So it was only later in the July, in the month of June, that we saw that the secondary sales are not picking up, and the channel inventory is becoming huge. And that's when the demand from the brands fell off the cliff for us, and we realized that we are sitting on a huge inventory for us. We are already working on those capex guidelines that we have given earlier. We are building on our new product diversification. We are working the new launch of product platforms. We are building up new capacities. So the long-term story of the business remains intact. It cannot be impacted by the one single week summer. As of now, we do not see any downside risk to that number. So definitely the margins are getting impacted. We know that. But as of now, we do not see any downward risk to that.
All right, Dipan, what's your take? Mr. Gupta saying that, the longer term story is intact. In the near term, there's going to be some pain. But I also asked him whether he can do 310 crores of PAT that he's promised. He says, as of now, that is on. Even if they achieve that, the stock is trading at nearly 50 times. What's your view on the company? You know, it's been a company that's delivered in the past. The problem is this time around, they raised a QIP, then the promoter sold in the open market, and then this disappointment comes in that. So the sequence of events is a little bit disappointing. What's your take?
I think that's a good observation. The optics certainly don't look good in PG Electroplast. But look, in the consumption space, air conditioning is like a real nice long-term investment theme. Eventually, you will get decent growth rates. I think one bad summer is not going to change the long-term prospects of the industry. And sooner or later, we will have a very hot summer, which may certainly improve the sales over there. And gradually, I think it's becoming more non-seasonal in nature as the years and quarters go by. So very positive on the air conditioning industry. And of course, I think Amber Industries, according to us, did pretty well compared to its peer group. And within the branded air conditioning space, I think Blue Star certainly needs to be watched. If Blue Star and Voltas correct a little bit more like that, I think they're down 30% or thereabout from their top, but once they're down 40-50% or so, that may make a good entry point with a 2-3 year type of a view. Because end of the day, this country requires much more air conditioning than it has at present. Air conditioners are no longer a luxury, they're a necessity. So demand will revive eventually. It's just a matter of being patient in these stocks.
Okay. All right. Deepan, I had a couple of more questions out of time. Next time, thank you very much for joining us, Deepan. Great speaking with you as always here on CNBC TV18. What we'll do is we'll take a break. Aditya Sood from InCred Asset Management joins us on the other side with more coming up. Stay tuned.
Welcome back. It's a 200-point gain on the Nifty. Apollo Hospitals is rising ahead of numbers tomorrow. Tomorrow, 3 Nifty companies report: ONGC, Hindalco and Apollo Hospitals. And Apollo Hospitals is clocking in some smart gains. Reliance Industries too is seeing a bit of an uptick. But now let's shift focus to an exclusive. We understand from sources that the GIC, the General Insurance Corporation of India, has asked the general insurers to revise premiums to viable levels. Yash joins in with what he's picking up from his sources.
Well, this move from GICRE could be a very important move in terms of, fixing the loopholes, fixing the areas where GICRE's book is bleeding today in terms of excess losses. What we've been given to understand from our sources is that GICRE, in its communication to various general insurance companies, has asked them to revise the premiums upwards and bring them to viable levels. Now, a simple explanation of this in terms of how it helps GICRE is essentially if the general insurance companies sort of raise their premiums to a viable level, then in terms of the losses arising out of claims where reinsurance is taken from GICRE does not impact GICRE's book out of proportion if they are not viable. What we've been given to understand further is that GICRE has told insurance companies that it will provide reinsurance capacity only if it feels and where it feels that the pricing by the insurance company has been done to viable levels. Along with it, we are also given to understand the segments where GIC has asked insurance companies to revise premiums upwards. This could be motor, health, as well as commercial lines. In terms of motor, GICRE has asked insurers to increase or revise premiums upwards by about 10 to 12%. That's required for it to provide enough reinsurance capacity. Health insurance, it has asked insurance companies to reduce costs by about 10 to 12%. And finally, commercial lines, that's where it sees the highest amount of increase, which is required of about 30 to 35%. These include aviation, fire, marine, hull, all those commercial line segments. 30 to 35% premium revision has been sought. Also separately, GICRE is likely to make a case to the government to continue with an obligatory premium of 4% for FY27. That is the next financial year as well. Do remember, GICRE collects about 1,500 crore in terms of premium when it comes to the obligatory reinsurance premium.
All right, Yash, thank you very much for that. Basically, reinsurer telling insurance companies, up your premiums. I guess bad for consumers, but that's what they're asking insurers to do. Well, Aditya Sood is with us, fund manager, InCred Asset Management. Aditya, good to have you with us here. Thanks very much for joining us. So we are now sort of coming to a close with the earnings season, Aditya. Across your portfolio companies, what has done very well, what has done poorly, sort of left you wanting for more? Just give us a sense.
Sure. So I think so broadly the sense is that, last 12 months we have been in a very, very tepid return environment. And whatever you did in the portfolio, it is not leading to any meaningful returns for investors. But this is the nature of the market. And I do believe that we are at a very, very interesting juncture because on one hand, you have seen, the risk-free rate practically collapsing in India. The risk premium within emerging markets that India has also collapsed. This is a perfect recipe for multiple expansion going forward. The first port of call was that, obviously money moved out of the US. It went to cheaper markets, particularly Europe. I think so it is only a matter of time wherein we see earnings recovering. There have been 7 consecutive quarters wherein small and mid-cap earnings have disappointed. And this is the first quarter wherein we are witnessing in certain areas wherein earnings have started to improve meaningfully. The only thing is that, people were not very focused on this kind of stock picking because the market was focused on either growth at reasonable price or reasonable certainty in terms of earnings. So, what we have seen, Yatra being an example, it is a holding for us. Sangvi Movers is another company which reported, excellent sort of earnings. I think so. If you are very, very focused on a value as a strategy, although I must confess that, the pockets of value are not, I mean to say it would be very difficult to find, 200 stocks. But for a PMS, for people like us, whether we can identify enough value in terms of, value unlocking going forward in terms of catalyst. We own this wonderful company known as Chola Holding. I've been holding that company for the last 5 years. There is a promoter settlement which is going to happen at some point in time. Religare obviously is another case in point, wherein I don't see any sort of, hitch now. They will appoint a new CEO. The capitalization has already happened. 3-year returns are zero. So I think so there is enough and more to focus on in this sort of environment. Even if we get, next 3 to 6 months of very, very tepid growth in troubled investing industries, for example, today seafood seems to be a very, very troubled, sort of a pocket. Avanti Feeds, somebody like that, or garments, for example. I'm sure you will have, at some point in time, these pockets will have value of opportunity coming through.
Just to confirm, Yatra, Sangvi Movers, Chola Investment, Religare, these are a part of your portfolio.
Yeah. All these.
And you're looking for opportunities in the sectors like textiles and shrimps. Do you own any stocks?
No, we don't, but we are watching it very, very carefully because, if you are a value investor and if you have seen these companies, tanking by 50, 60%, and obviously there is enough and more confusion on the tariff side and on the trade side as well. I think so these could be really very good opportunities because Avanti Feeds, the stock price has not gone anywhere for the last 7 years, essentially, right? So the real question to ask yourself is that, at some point in time, whether these companies will present opportunities. So we like this construct of, 3, 5, 7 years of zero return, but obviously then we should be convinced that something is changing. For example, in the case of Yatra, we were very, very simplistically, we figured out that the market capitalization when we bought it was 1,400 odd crores. And when we bought the stock went down, basically, we were in a position to figure out that this is a company which can do 100 crore sort of a PAT in FY 27-28. And it was the cheapest internet stock to buy. Even today, the market capitalization is only 1,800 crores. Right. So it is a very, very, once I look at, Make My Trip, which is obviously listed on NASDAQ, and I do a compare and contrast. And Yatra business, the kind of pivot that they have made, they are trying to, I think so 15-20 crores of saving will come from the structure that they have on the NASDAQ. So that plus the capital allocation getting better, would lead to, sizable returns over a period of time.
Yatra locked in 20% circuit. What a move today, really. Incredible. Aditya, hi. Good to have you on the show this afternoon. Anything interesting on your radar that you found worthwhile in the primary markets? So many issues, right? So many. We just spoke to one today, Bluestone today. I mean, they're in the right space. Discretionary spends, jewelry. It's done really well for a lot of the other jewelry retailers. Kalyan, even this quarter, 30% growth. But the stock sold off, that's a different point. But you tell us, anything interesting in IPOs?
See, we are not an IPO house. Our framework has been that, character of management doesn't get tested. It only gets tested in adversity. So in a bull market, if IPO is happening, it is very difficult to judge a character of management. Our view also is that, you have had these. For example, Bluestone, they have an institutional investor, which is a fairly large sovereign wealth fund, who has already invested. So one of the things that we do at InCred is that, we also have a private equity fund. We have a, credit fund. So we try to leverage that strength in terms of looking at companies very early. But most of these companies, our simple guess is that, they are overpriced. What is your probability of making money in the last leg? And even if the portfolio is, even if the stock is chased by most, you won't get allocation, right? So our view is that, it is better to stay on the sideline. In fact, what we do like is that, there are many IPOs which happen. So they become, out of sight, out of mind. I can give you a name, for example, Brainbees, right? Which is First Cry, right? If you look at the stock price chart, it is halved, and it has all happened in the last 6 months, right? So
you find that interesting?
Yeah, we find that interesting simply because, if I have to just value the domestic business today, right, and not value the overseas business wherein they are losing money and the 800 crore that they fund that they run like, Info Edge basically in the business. I can pretty much justify the option value, and it is like 3 times GMV, right? So 3 times GMV, which was like 6 times GMV going into IPO. I believe that it is a neglected stock today. So we are doing some work. We don't own it, but I can give you enough and more examples wherein, this always happens, post IPOs. Yatra is an example. For example, Yatra got IPO'd and then, immediately there were no takers in the name.
Yeah, looking for value in the forgotten spaces. That's the mantra. Got it. Good conversation. Thank you so much for joining in. Appreciate your views on the show. So that's a call coming in from Incred, but it's that time of the show where Hormaz joins in. And as always, his board is buzzing with a lot of interesting names. Hormaz, take it away.
The underlying theme of today's list predominantly is underperforming names with outsized returns today. We put the spotlight on some of those. And we start off with a stock called Uniparts India. This is the biggest single-day gain that the stock has seen since listing. But that's not the important point here. In the last 25 sessions before today, the stock had gained only once. And that was only a 0.5% gain sometime last week. And ever since, the stock has been on a losing streak. Now, it goes without saying that despite this move, the stock remains well below its IPO price of around about 573 odd. But today, they've had 10 lakh shares traded compared to a 20-day average of just around 32,000 shares. And that was the mention that 577 was the IPO price for Uniparts. The other big mover today is Hero Pipes. And that's also, of course, an earnings reaction. It's also the biggest single-day gain that the stock has had since listing. Here we have had 40 lakh shares that have been traded compared to a 20-day average of just around about 3 lakh shares. And courtesy of this move today, the stock has turned positive for 2025. Of course, can't not talk about PG Electroplast. This is a 4th straight day of losses. And despite the last 2 days of outsized down moves, we've had 37% of declines in the last 4 sessions. Just as the management was speaking to you guys this morning, we had a block deal too worth over 500 crore rupees today. It'll be interesting to see who are the buyers here in this list. And 5 crore shares have already been traded today compared to a 20-day average of 20 lakh shares. And courtesy of this move, the stock has already more than halved on a year-to-date basis. Another underperformer with outsized returns today is Idea Forge, and that has snapped a 3-day losing streak today, almost 7% higher on the stock. We have had 6 lakh shares traded compared to a 20-day average of around about 2.5 lakh. But the post-listing high of this stock is around 1,344, which was exact 100% from its IPO price of 672. And from those post-listing highs, the stock is still down 67%. And last one on this list is Universal Cables today. Snapped a 3-day losing streak in today's session and around about a 6% move as well. 4 lakh shares have traded in today's session compared to a 20-day average of just 23,000. And despite this move, its stock is still down YTD, and we have had strong gains of almost 50 to 70% over the last 3 years each. And despite that, the stock is down on a year-to-date basis. So some underperformers doing well today, most of them being earnings reactions.
Okay, all right, Hormaz, thanks a lot for that. Well, let's get to our favorite segment then. D-Street Chatter. Nimesh joins us to help us out with what he's picking up. Nimesh, what are you picking up this time around? Looks like the shorts will be running for cover. What about the flows?
Well, looks like, Nigel, and again, a good recovery intraday, but, we've said this so many times in the past, right? PCR around 0.65 or below that, and you see a sharp recovery, and that's happened in today's market as well. The PCR actually has moved intraday back from 0.6 to almost at 1. So I need to see how much it can further go up from here. But from a flow perspective, again, a mixed day. It's on the sell side for the last many days. But there is a small MOC, is what I understand, on the buy side at leading FIDS. But that's not going to move the needle much. It's very small, is what I understand from a flow perspective. I guess, the bigger pain seems to be in the broader markets now. You're seeing a consistent underperformance in that space. And it looks like now it's lost the momentum. When I talk to a lot of HNI desk and all, there is very much reluctance from larger HNIs or for that matter retail investors to participate in this market because it's been such a dull market for the last many weeks now, and people are not making money. So there is a bit of nervousness for sure from larger investors, so to speak, especially the retail and HNI category in the last many days. So that clearly plays out in the broader market. I guess the big accident of the day is PG Electroplast. Yeah. And we've seen this in the last 4 weeks. That's also impacting the sentiment. In the last 4 weeks, every week we have had at least one big accident wherein individual stocks have collapsed 30, 40, 50% as well in a single week. So that's also, impacting the sentiment to some extent. But broadly, I guess today it's more of a technical pullback from an extreme low level, but flow seems to be quite mixed as well from larger FI.
All right, Nimesh, what about individual stocks? What are you tracking?
Well, there are a lot of stocks which are in the broader markets which are buzzing in trade today. So again, it's quite mixed is what I would say. That not much in terms of institutional activity, but more from a retail activity point of view. So the first stock on my list is, there is one stock which comes to my mind. Maybe it's not the first stock on my list, but Maruti Electronics is something I'll first talk about because that's been a big mover today, up 20% and locked at 20% upper circuit and on large volumes. There is a board meeting scheduled today not today, but this week. And I understand some market investors are likely to invest via preferential issue. So that's the first stock. And I mean, that was not the first stock, but I thought I'll start with this because it's been big mover. In fact, in the last week itself, it's moved from 17 to almost 24 and locked at upper circuit. So that's something to track. And again, as I said, the volumes are quite high in Maruti Electronics today. So that it looks like there's a lot of interest in that name. So that's the first stock. The second stock, the one more stock which is in my list is Nibe. It's part of that, it's part of the defense basket. While the defense stocks have seen a bit of recovery today, Nibe is actually down and down 4%. But again, in Nibe, the feedback is that maybe you're going to see a fund infusion from the promoters very soon. So that's a trigger as far as Nibe is concerned. So that's another stock to watch out for. The third name, again, something which I track very closely, previous specialty. While the stock has been buzzing in trade today, I understand there could be a large block deal in preview very soon. Looks like one of the ex-promoter entity could be seller in that block. So watch out for that in the days to come. And the last one is Indus Tower. A small uptick in today's market, but for Indus Tower, the big thing to watch would be the capital allocation because ever since the company has deferred the dividend payout, the stock has actually underperformed. But there could be some corporate development is what I understand. And that's the reason some bit of flows have picked up at HNIs in Indus Tower.
Nimesh, for our younger audiences who may be watching, Merck Electronics, right? This is the company which makes the Onida brand of TVs. For many of us, I guess the first color television, right? And I think now they make washing machines and I think other consumer durables, etc. So have done that for a while. So board meeting sometime this week with some investors coming in.
I think it's day after. The board meeting is scheduled for day after, and it mentions that they're likely to raise funds via preferential stroke QIP or whatever. But my sense is it's going to be a pref issue. Some large market investors could participate. So a good fundraising and some big names coming in. Maybe that's the reason why the stock is excited in the last couple of days.
Market cap is 700 crores. So, so we'll see what happens. But remember the tagline?
Legendary, the devil, the Onida devil.
Yeah. Neighbors envy, owner's pride.
Owner's pride.
Yeah. The man with the devil. The horns, right? I mean,
gentlemen, you realize we've all kind of suitably given away our age by, sharing with audiences what we know about that ad. It was a, all-time classic, long time ago. Anyway, on that note, we'll quickly take a break, come back on the other side, and we'll get you all the trades you can look at in the last few minutes of today's action.
से
Welcome back. It's been a good day of trade, 200 points on the board. Let's hop across to Nigel. He's on the F&O desk.
Yeah.
Get us the latest derivative cues. Nigel?
Well, after a while, actually, in the early morning trade, you saw the India VIX that popped up close to around 4 to 5%. The fear was that it's going to be running away. But just take a look at it. From the top, it's cooled off a little bit. The last time I checked, it was only around 1% or thereabouts. And the India VIX, even if it jumps up, it's at extremely depressed levels, the lowest we have seen in multiple months. The other cue that we look at is the PCR. At the start of today, I had made this point that around 0.66 odd, we normally do get a bit of a bounce on the Nifty because it means that put writing becomes, call writing has become extremely easy and the put writers actually are a little bit jittery. But just take a look at the way things have panned out today. From around 0.65 odd, the PCR has moved to around 1. Why is that? Because put writing has come back into play. And the put writers, they are writing these strikes and eating into the premium. In fact, if you just pull up a few strikes, 24,400 put, 24,500 put, 24,450 put. On all these three premiums that come up for you on the screen, there's massive open interest built up and the premium has come down by half. That's telling you the bulls believe they're back in the game. They want to defend the lower levels and that's why put writing has come into play. But the call writers that were getting very, very confident, which caused the PCR to move down to around 0.65, they are scampering for cover. Just take a look at the 24,500 call. Massive open interest decline out there because the premium from around 80 rupees has shot up to around 150 rupees. So those call writers, now they're packing their bags, they're getting jittery. Does this market have enough momentum to push it higher? Then those call writers will be trapped. The Nifty, important to note that in terms of technical levels, it's at least conquered the 100 DMA in today's trading session. Talking about the 100 DMA, well, let's get to the important levels. The downside, 24,050 needs to get conquered, needs to be held out actually from a bullish perspective. Why is that? Because in fact, that's where the 200 DMA comes in. And that's where the line in the sand is. Very, very important mark we're looking at. Resistance, however, in terms of a broader band, is at around the 24,750, 24,850. That's where the 20 DMA comes in. So those are the important levels. And in terms of individual stocks that you're looking at, the trader favorites, Trend, BSE, both of them saw a sharp pullback. Today, both those two stocks are higher and open interest is lower, telling you that the shorts are scampering for cover out there. On Amber, we are seeing fresh shorts get built into the system. The stock is down, open interest has swelled up. And one stock that's possibly going into the F&O ban, going by the data because of the massive surge in open interest, is PG Electroplast. By the end of today, I think by once the the evening file comes out, this is one of those stocks that could probably move into the F&O ban. So keep an eye out on that. So it's a good trading session, but we'll need to see some follow through from here. Back to you.
Thank you very much for that. Big crack indeed on PG Electroplast. Two more stocks moving. One of them is JM Financial reacting to the numbers. Net profit stands at 454 crore versus 171 crore year on year. The stock has gained in trade. And the other one, which is spiking as we speak, is Kalyan Jewellers. On Friday, we kept wondering why the stock is under pressure despite a seemingly good set of numbers. But today, Kalyan Jewellers is rebounding and those moves are happening just as we speak. Mitesh is now back with us for a few BTST calls. Mitesh?
The SBI, I think, looks very good as a BTST position. Keep a stop below levels of 818, 817 and 835 could be a target. And the other one is Ultratech Cement, which I would recommend BTST with a stop just below 12,320 and a target of 12,500 or thereabouts and below.
Okay, thank you very much for that. Get into a break. We'll come back with more on the markets. Last 10 minutes to go.
Welcome back. Well, the screen is looking good actually, and the Nifty has managed to hold on to this 200-point gain, and more importantly, we have crossed the 100 DMA, so that's good news. The Nifty Bank as well defends that mark. Craftsman's Auto, just take a look at that stock. Suddenly, a big spike is what we're seeing, headed back towards the 52-week high. So good move is what we're seeing on that name. Anand Tandon joins us on the show. Anand, the EMS space, everyone is going gung-ho about, giving it very premium multiples. Now you have a player in there, PG Electroplast, that has generated a lot of wealth. That's cautioning the market and cut their guidance big time. Because of that, the entire sector is under pressure. What's your view on this theme? Would you be looking to add into this correction, or do you think it got way too expensive?
Well, it has been expensive for a while, but so far it's a sector that has also delivered in terms of growth. I have always been concerned with the kind of margin it makes, especially the mobile manufacturers, because they work on very thin margin. And because of the fact that China recently put a restriction on rare earth exports, and that has caused problems in terms of getting some of the sub-assemblies to India. The idea was that, over a period of time, sub-assemblies would come in and therefore that would increase the margin. That makes it a lot more difficult. Now, of course, we have the other elephant in the room, which is the tariffs and the ability to export from India into the US, which by and large remains one of the largest markets even now. 50% tariff clearly means you don't want trade. And therefore, I guess the market is betting on the fact that at some stage that will change, and it is not something which is a perpetual problem. The only challenge at this stage is to figure out how long it will take. And I don't think anybody has a view on it, neither do I. So at this stage, clearly there will be some kind of slowdown. The question is whether it will be 1 quarter, 2 quarters, or will it extend longer. Given where we are in terms of the market valuations, etc., I would think that, perhaps a little early to add, though it remains, as I said, one of the places which has the fastest growth rate thus far. The challenge we are looking at is whether it will continue, and I don't think there is a clear answer. So for now, I think it's best to stay on the sidelines.
Okay, all right. So tread with caution in the space. That's the advice. Anand, hi, good afternoon. Good to have you on here. It's an interesting afternoon for a bunch of new age technology-related stocks. This PB Fintech, that stock's up about 5-6%. And Paytm slowly has been rising. I mean, ever since it reported numbers, it finally looked a little, a little less dire, shall I say. Stock has seen some interesting action. Your thoughts on both of these? Do you like either?
I mean, broadly speaking, the domestic market is where the attention is coming back to. And clearly, PB Fintech is in an area where, at least I am reasonably bullish. The insurance space, to my mind, is still a fairly attractive place to be if you're looking at investments. The question is, how do you want to play it? You could play it through the insurance companies themselves or companies like PB, etc. So from that perspective, I think it remains an interesting company to look at. You can choose what point you want to enter. But it's definitely something that you should have on your list of companies that you're looking for at watching. There is a little better outlook as far as Paytm is concerned. One of the issues was that because of the ownership, it was not suddenly out of regulatory favor. And given what we are seeing right now, it may be the same reason for which it will actually come back in regulatory favor, or at least find it a little less irksome. So from that perspective, as you said, it is not looking as dire. Certainly, at one stage, it was one of his client base. If they can utilize that in the various ways that they propose to, again, this could be something that has a long enough runway, assuming that the regulator doesn't again change its mood.
It's been a phenomenal year for Paytm, by the way. Stocks up 120% in 1 year. The 1 year that's been actually challenging for the rest of the market.
Anand, just a quick word on Tata Motors. The 52-week high was 1100 plus. The stock is at 650, and numbers were okay. There was this tariff impact, but the stock did well. It's up 3%. Do you think the worst is in the price?
Well, again, you're coming back to the same question that I started with, which is what is the view that you take on how the US will behave? And given the fact that that is something that is a toss of a coin and we really don't know how it will pan out, there is a good probability that, tariffs are here to stay. More importantly, maybe not at the level that India is at, but for the global markets. And there is almost inevitable fallout will be that there will be a global slowdown in the economy, at least over the next 12 months. In that kind of situation where there are so many challenges in terms of being able to grow, I don't think Tata Motors is necessarily the best positioned stock. As I said, if you are looking at increasing exposure at this stage, it is better to look at companies which are looking inwards rather than those which are looking outwards at this stage.
Okay, Anand, stay with us. Just going to wrap up things in terms of market closing, and then we'll come to you. We've got it's a pretty good session, just under 200-point gain on the Nifty. I think the Nifty Bank will end up with 0.75% odd move today. Mid-cap index similar, small-cap index a little less as compared to the other three. And of course, I mean, by close 1,600 stocks higher on the NSE, about 1,400 stocks are lower. So that is the advanced decline ratio that you had going on. And of course, Nifty stocks in terms of what went up, Adani Enterprises was up 4%, Tata Motors was up 3%, Eternal was up 2.5%, Grasim, Apollo Hospitals, Trent, Geofinance, SBI, Ultratech Cements, 7-8 names with gains in excess of 2% is what you had today. And nothing, not one name with losses of over 1%. Hero MotoCorp down 0.75% was the big loser that you had today. So that's the overall picture. Broader market, of course, we've been discussing lots and lots of names. It's actually easier to count what was down today as compared to what was up, especially if you add volumes as a criteria. One area down on volumes, of course, is the entire AC space, right? You look at Amber, you look at Voltas, and of course, PG Electroplast, which ends the day down about 13% or so. But big list of volume-led gainers, which we will continue to focus on in just a bit from now. From all of us here on Closing Bell, thank you very much for staying with us. More coming up on the other side on Markets Forward.
The Wall Street starts the truncated week on a healthy note. The Nifty and the Sensex saw nearly 1% each, led higher by PSU banks and defense stocks. The Nifty ends above 24,500. Broader markets rise in line with the blue chips.
In significant relief for oil marketers, the government has agreed to allocate 30,000 crore rupees payable over FY26 and 27 to partly compensate them for their over rupees 40,000 crore in under-recoveries. The stocks woke up on the news.
AC stocks in focus. Voltas's first quarter numbers miss estimates on all fronts as room AC demand remains weak. The stock is lower by 6%. PG Electroplast down another 15% today after the management significantly cut guidance last week. Speaking to CNBC TV18, the management attributed the revision to a lack of recovery in AC sales in July and August.
Well, hello and welcome to Market Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Amakshi Doria, and with me is my colleague Surbhi Upadhyay.
I'm Amakshi. Well, a good Monday after all. Long time waiting for the bulls. So it was a good start, and we will, of course, talk about that over the next 20 minutes. We have you completely covered all the big news flow, the key developments on the street, the corporate voices, and, of course, the events to track ahead. Let's kick it off then by looking at what was a very healthy start to the week for the market. Finally seeing a 1% recovery, about 200 points in the Nifty. And why we call it healthy is because it was a very simple uptrending sort of a day. It didn't have too much of volatility, too much of sharp, jagged edges. And it was fairly well-rounded as well. Mid-caps did well. And the large-cap screen was also up and about. So overall good participation, Amakshi.
Well, absolutely. Finally the grain that the bulls had been looking out for, Surbhi, and a lot of this was actually contributed by the Nifty PSU banks. They were up almost 2.2%. Look at the moves on, Indian Bank. It was up almost 3.5%. And a lot of stocks actually reacting to their numbers on the positive side. From the broader markets, we did see some reactions come in on names like HBL Engineering. Even Siemens saw good recovery after initially dipping in trade, and lots of stocks that were reacting to numbers.
Oh, absolutely. So overall, a healthy session finally, a relief for the bulls. Let's tell you what all we have lined up over the next 20 odd minutes. We'll start off with, of course, as always, the key movers and shakers of the day. Vivek will round up the action for us. Today, we also, of course, decode some very, very strong inflow numbers that have come in from mutual funds for the month of July, and we'll tell you which are the fund categories that are really ticking. After that, we focus on AC stocks. They've been feeling the heat with the entire sector down and out, and stocks like PG Electroplast cracking once again today. Then we put the spotlight on Tata Motors. Market is looking at the prospects of maybe a turnaround, maybe the worst being in the price, because there was recovery on the stock after a weak Q1 performance. Finally, the key events to watch tomorrow. But let's, as always, kick it off with the movers and shakers of the day. We have Vivek joining in with all the action. Vivek.
Well, thank you so much for that. After a while, like you mentioned, a session where you actually saw an uptrending session, a clean move upside is what we saw throughout the trading session. Well, to start off with, after the fact that SBI gave a steady set of numbers and maintained the guidance, especially the credit growth guidance, something that the street was looking forward to, that actually aided the entire up move as far as the PSU banking pack was concerned. That particular sector was amongst the top gainers today. All of the PSU banks, in fact, did quite well in the session today. Another stock, one from the broader end of the market, D Development Engineers. That particular stock gave out its numbers midday today, and after that, we also had the management strong guidance for FY26. That stock ended high by over 13.5%. Dobbs Industries, numbers came out over the weekend. Steady Q1, but the management went and maintained the guidance as far as FY26 is concerned. Almost 10 to 10.5% PAT growth is what they're anticipating. Stock high by over 11.5%. HBL Engineering, something that you alluded to earlier as well. This particular stock from the broad end of the markets, very good set, ended as the top NSE 500 gainer for the day. And Sai Life Sciences, again, this particular stock, very, very strong Q1. And after that, whole host of brokerages went and upgraded, Jefferies being among them. That stock high by over 6.5%. On the other hand, quite a few laggards, some of the usual suspects. PG Electroplast, a 25% downtick on Friday. Today, again, we did have the management, but they did allude to the fact that number one, inventory remains quite high and they see a recovery only post-November. That stock ended low by over 14%. Voltas, this particular stock came out with its numbers post-market as Fridays. post which, it was a weak set, it was a miss throughout, and the bigger worry as far as analysts are concerned is the kind of market share loss that particular company is seeing. Equitas Small Finance Bank, in the broader end of the market, this was a significant laggard. Asset quality is something that was quite weak. NII as well as pre-provisioning operating profit both fell on a year-on-year basis. And lastly, Amber Enterprises, again, the EMS space, the consumer durable space, the entire value chain saw a very weak trading session. And today you saw an Investec downgrade dragging Amber Enterprises lower. Remember, almost 6% lower for this name today.
Well, so those were some of the top movers and shakers for the day. Thank you so much for that, Vivek. Now, in a big relief for oil marketers, the government has agreed to allocate 30,000 crore rupees payable over FY26 and FY27 to partly compensate them for their over 40,000 crore rupees in under recoveries. The stocks were up in the trading session today. We now have Sonal Botra taking us through the highlights for that. Sonal.
Well, thank you for that. It is a big news that has come by, and the street was waiting for this for a long time. That is the 30,000 crore rupee compensation that these companies have received in form of LPG subsidies. Now, do remember they have under recoveries to the tune of 41,300 crore rupees till June 2025. So only a part of it is what they have received. What we don't know whether this is a one-time compensation or whether there will be more tranches of this compensation that will be given to these companies as well. Nevertheless, brokerages, they are quite positive on this one. Jefferies says they estimate an upside of 29 to 42% on EBITDA for FY26. In terms of profits, it will be around 38 to 70%. But this is only when they get the entire compensation in FY26. They will be paid in tranches. We don't know whether all these tranches will take place in FY26 itself. ICICI Securities says that LPG compensation is a material boost to their earnings. It takes away the margin worries for FY26 as well. Morgan Stanley, they prefer HPCL and BPCL. They say subsidy could boost FY25 earnings by 75%, deleverage their balance sheets by 12%, and support a consistent return on capital employed to the tune of 14 to 15%. There could be a downside if fuel prices are cut by 1 to 2 rupees per litre on the marketing side, but that's a limited downside that they talk about. UBS says that the payment that they are receiving right now is equal to 75% of FY25 dues and 62% of the dues which are accumulated till June 2025. So that's around 62%. It is equivalent to 8 to 16% of their book values for all these three stocks for FY25 and is equivalent to 6 to 9% of current market capitalization as well. So yes, it's a relief, but a lot depends on what's happening with crude sourcing as well. Maybe that's the reason the stock are not reacting as positively as it was expected, but nevertheless, it is a positive news that has come by for the entire sector.
Okay, all right, Sonal, and long awaited. So some relief coming through. Thank you very much for that. Let's put the spotlight on some great news that we got in terms of the monthly mutual fund data. The inflows for equity mutual funds have hit a record high, the highest ever level. The net equity inflow in this month of July has been 42,672 crores. That's a huge number, and it has overtaken the previous high, which was last year in Diwali, around October, which was around 41,000 crores. So where has all this money coming from? New fund offerings. Over 30 NFOs, and all put together, they have pulled in over 30,400 crores. That's the might of these NFOs. So you'd wonder, what are these new funds? Well, they're across categories. There are lots of thematic funds that have pulled in the money. In fact, 9,000 crores has come in from thematic funds, the likes of HDFC Innovation Fund, ICICI Prudential Active Momentum Fund, and many others. Then there have been new launches in the mid-cap category, in the multi-cap category. For instance, Bajaj Finance launched their small-cap fund. Franklin India launched their multi-asset fund. And there have been others like the multi-asset allocation, category where Franklin launched a fund. So all of it put together has pulled in huge amounts of money. That's point number one. If you look at the next sort of interesting trend, it's investors' love for mid and small caps. And that really illustrates the point. Look at that, small cap funds drawing in the highest ever inflows of nearly 6,500 crores. That, is huge in comparison to the 2,100 odd crores that large cap funds have garnered. So clearly the market's preference is towards SMIDs, at least the retail investors. Then let's talk about SIPs. Again, a very heartening figure coming through. The SIP trend is rock steady, and this is also a record high. Last month, June, the number was over 27,000 crores. This month, it's almost 28,500 crores. So even as the market has been sluggish, returns have been tough to come by, investors have been keeping the faith. Last but not the least, an interesting sort of perhaps example of how investors are also getting savvier. They're looking at diversification, asset allocation, which is why this category, which is known as the multi-asset category, this is pulling in more and more money almost on a consistent basis. And this time around, if you look at the multi-asset category, then it's garnered almost 6,200 crores, which is a record high for the multi-asset category as well. All put together, a fantastic month, a month of records when it comes to equity inflows coming into mutual funds.
Well, absolutely, Surbhi, and this comes in at a time where, the markets were quite volatile. There was a lot of uncertainty. So given the kind of confidence that our own investors have shown this time around, I think it's good tides for the AMC industry. But, I think it's a good time to bring in our market experts, Anand Tandon, who is the market expert, and as well as Jay Thakkar of ICICI Securities. Good afternoon to you, gentlemen. This is Vamakshi joining in. And, I'd first like to get your take on the markets, Jay. Today, after several days, we've seen an uptick. Where do you think the markets are headed from here on? And we've, of course, crossed above the 24,500 crucial mark.
Vamakshi and Surbhi. Well, definitely, today's recovery is quite meaningful, I would say, because it has not only closed about 24,500, but then, I would say that there has been a very clear shift in the options data as well. I mean, it was quite oversold right at the start of this week. I mean, the PCR was at 0.48. And generally, this kind of PCR you see on Wednesday or Thursday, and you can expect that Nifty to trade with a negative bias. But then on a Friday or a Monday, and that is on a day 1 or 2, or start of the day 2 of the expiry, weekly expiry, when you see this kind of data, which clearly indicates quite an oversold reading, and generally you see a bounce back. And that is what has happened in today's session. And it has now moved to one which is quite a neutral level. By that, I would say that there has been a good amount of put additions at the lower end. Interestingly, Nifty Bank has also managed to close above the levels of 55,200 now. So 55,200 to 55,000 will act as a very crucial support there. I mean, this is also one of the sector which was trading with quite a negative bias, but then post the result of SBI, we have seen a good bounce back coming in the PSU banks, and that has helped Nifty Bank to close above 55,200. So now Nifty 24,500 and on Bank Nifty 55,000. These are the two levels. I think till Nifty manages to hold on to these levels, I think the short covering is still expected, because if we also see the net FI long position has been around 8 to 9%, which has been the lowest since March of this calendar year, and it's been consecutive. It's been trading below the 10% mark for more than 6 to 7 trading sessions, and that's after 2012. So, Vamakshi, generally, when we see these kind of data, short covering cannot be ruled out. And we have already seen 6-week or negative weekly close, which is also one of the rare events, although Nifty has just fallen by 5.25% as compared to the previous falls of around 7 to 8%. But then since we have closed for 6 negative weekly close, so I think one positive weekly close can't be ruled out. So the data is quite oversold. And if the current support levels are held, I think a bounce back until 24,800 to 25,000 on Nifty, and 56,000 to 56,300 on Bank Nifty can't be ruled out.
Well, absolutely, Jay. But moving on, let's also take a look at AC stocks because they've taken it on the chin today. PG, Electroplast, Voltas and Amber have seen cuts of 5 to 15%. What's ailing all of these stocks? We have Riya Bhatia joining us with more details. Riya?
Well, yesterday all of these AC and cooler stocks were beaten down in trade today. So let's take a look at what was hurting these stocks. 3 key reasons. First up, Voltas reported a very weak set of numbers. Even PG Electroplast also reported a very weak set of numbers, and they also cut their guidance for FY26 in a very major way. And there are also high inventory concerns for all of these companies. First, looking at Voltas for Q1 FY26, all of these numbers were below estimates across the board. Revenue was down around 20% on a year-on-year basis, even EBITDA and net profit were each down by 58% compared to the previous year. And EBITDA margins nearly halved to 4.5% versus 8.6% in Q1 of FY25. Now, Nomura on the back of this has a neutral rating on Voltas. They've lowered their FY26 RAC industry growth targets to 5% versus 10% earlier. They've also cut their FY26 and 27 UCP revenue growth targets to 6% and 24% versus their earlier targets of 13% and 21%. Even CLSA has a hold call on the company, and they've said that the high inventory is likely to keep utilizations low and will also continue to weigh on margins going ahead. Jefferies, on the other hand, still continues to maintain its buy rating on Voltas. They've said that from here on, the early festive season possibility of a second summer, as well as the new BEE rating and tactical cost control, could help RAC recovery going ahead. Moving on to PG Electroplast, they've cut their FY26 guidance. The revised revenue growth guidance is at 17 to 19% versus the earlier guidance of 30% of over 30%. They've also revised their net profit guidance to 3 to 7% versus the earlier guidance of over 39%. So big cut coming in on the net profit front as well. And the company has also said that this time around, the lack of rebound in AC sales in July and August was the reason for the revision in guidance. But they've also highlighted that they are expecting a normalized level of inventory by October and November, and that one season doesn't alter the course of the business trajectory for the full year. Just looking at the valuations as well, PG Electro and Voltas are both trading below their 3-year average PEs, and Blue Star and Amber are trading above their respective 3-year average PEs at the moment.
Okay, all right, Ria, got that. Thanks very much. Well, let's move on and put the spotlight on Tata Motors. The stock gained nearly 3% today after the firm came out with the first quarter numbers. The numbers, some could argue, were maybe slightly shy of estimates. The estimates were anyway very, very muted. But the management has held on to its FY26 guidance for JLR. Rima is here to tell us more details on why the street perhaps took it as a positive instead of a negative. Rima.
Thank you. Let's first go through the numbers. Now, Q1 consolidated revenue was down 3%. EBITDA was down 35%, with margins coming in at 9.3%. And that led to a drop of 35% in the profitability. But large part of the impact or the weakness in Q1 was linked to the tariffs. If you strip that out, analysts say numbers were largely in line. The management commentary on JLR then: healthy demand in the US, stable in UK, but EU and China is still subdued. They also quantified the tariff impact, 500 to 600 million pounds this year, and thereafter that 300 to 400 million pounds. What the analysts point out is that despite a weak Q1, the company still holds on to its JLR EBIT margin guidance for FY26 at 5 to 7%. So that is reason number one, for the up move today. Secondly, as you pointed out, the stock has already corrected. It's down 12.5% year to date. From its 52-week high, the stock has fallen 43%. So perhaps a lot of the bad news could be in the price. And thirdly, valuations. Now, Nomura says valuations are currently at 4.6 times forward multiple in terms of EV to EBITDA, which they say is undemanding but fairly, fair considering all the risks. And lastly, the street is looking ahead to what the festive season holds and whether we are going to see an improvement in the domestic sales. Back to you.
Well, thank you so much for that, Rima. But Anand, if you can come in on Tata Motors, year to date the stock has not done too well, down almost 13%. What's your take on this counter?
Well, as I said a while back, I think the problem is that you're looking at a situation which is very fluid in terms of tariffs around the world. If they have held on to the guidance, you have to understand that, you made a guidance, let's say a quarter back where there was no tariff and now there is. The fact that you haven't made a change is a little surprising at the very least. The only thing you can assume is that since they are manufacturing overseas, the impact is a little lower. Overall, I think the issue is that the global markets are going to remain in a bit of a tizzy because of the various tariffs that are being put up. And there is no doubt in my mind, at least, that there will be a slowdown in terms of the overall global economic growth. In that kind of context, companies which are exposed to the international markets are not likely to be able to perform very well, which is something that you can see in the numbers. Whether or not the current valuation is justified is a different call. I think they're still going through a business restructuring, which may actually provide some support. But overall, I would think that at this stage, you're better off looking at companies which are a little more domestically driven.
Okay, so that's Tata Motors. Anand, thanks very much for your perspective on the show today. Really appreciate you joining in. Thanks to both our guests, in fact, on that note. We'll take a quick break, come back on the other side. We'll get you all the top corporate voices along with the key events to watch tomorrow. Welcome back. Let's run through all the key corporate voices that we picked up during the course of the day. Let's start with State Bank of India. The shares were up about 2% after the bank's management has said that the bank would maintain a credit growth guidance of 12% for the full year. It also adds that if things were to improve, then it could even reach 13% growth this year. The firm's deposit guidance is at 10% for the full year. SBI expects a U-shaped recovery in net interest margins with a slight dip in Q1 and Q2 and then a recovery to almost 3% by the time the year ends. The firm also adds that there was no great concern in terms of asset quality.
While Cummins India fell 0.5% despite beating estimates across the board, the firm's stock boss said that growth was broad-based in the domestic market from an exports perspective and hence presents a good growth opportunity. The firm is cautious about exports and is still not seeing a steady trend. The company plans to maintain their margins or even better them.
Up next, JK Tyre is targeting double-digit growth in the current financial year after the domestic industry saw 11% growth. The firm adds that the sentiment remains good in the domestic market. However, with a top line of just 3% in its US market, it is looking to divert to non-American countries. The company expects its Mexican operations will become profitable in the second quarter.
Well, and before we wrap, we bring you some key market events to watch out for. Gaurav is standing by with the key events to focus for tomorrow. Gaurav?
Well, yes. From key events, if we look at the global market, first let's talk about US CPI. Now, this is something that we will be watching out for because remember, US has kept their interest rates unchanged. So this is some interesting data that we will be watching out for. Other than that, US and China, now the trade tariff truce comes to an end tomorrow. Let's see if it is going to get another extension because remember in April they got an extension of 90 days where tariffs were going to be as high as 145% from the USA on China. Currently China is paying just 20% tariff on USA. Other than that, from Indian market we have a couple of stocks which will be in focus on the back of the earnings. So first let's talk about HAL, ONGC, Hindalco Industries, Apollo Hospitals. These key stocks are definitely going to be on our radar tomorrow. But other than that, there are some companies like Cochin Shipyard and BDL, Nivesh companies like Honasa, Nazara Tech, Nykaa, and also some heavy capex companies like Suzlon and VA-Tech Wabag. These companies will also come up with their earnings tomorrow. Remember, Nazara Tech will also be considering bonus issue as well as stock split. So definitely watching out of this stock specifically. And lastly, let's also not forget that tomorrow we will also get India CPI data. We have also kept our interest rates unchanged. So CPI data is something that we will be closely watching out on because this can actually determine the trajectory of rates going ahead.
Okay, all right, Gaurav, absolutely. CPI data always important and we will definitely look out for that. But that's tomorrow. Right now, I think it's time for a goodbye, Vamakshi.
Absolutely, Surbhi. And it's a wrap on this edition of Market Forward. But don't go anywhere. We'll be back with more news and updates on the other side.
Hello, welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a strong start to the week on Dalal Street. The Sensex up over 700 points. The Nifty reclaims 24,500. Midcaps rally in tandem with the blue chips. Inflows into equity mutual funds soar 81% in July, hitting a record high of 42,700 crores. New fund offerings mop up more than 30,000 crores. SIP inflows crossed 28,000 crores. Top government officials to brief the Parliamentary Committee on Foreign Affairs after US-India face a tariff war, the highest rate in the world of 50% being imposed on India. The Indian ambassador to the US attempts an outreach with Republicans as he speaks to Senator Lindsey Graham. All eyes on the Trump-Putin summit scheduled on the 15th of August. US and China yet to announce an extension of their tariff deadline as the fragile truce expires on the 12th of August. Beijing had struck an optimistic note on a potential extension. US officials say the ball is now in President Trump's court. In an unprecedented arrangement, semiconductor makers Nvidia and AMD agreed to pay the US government a portion of their revenues from China in exchange for export licenses. Both companies will pay the US government 15% of revenue from the sale of their artificial intelligence chips in China. RBI Governor Sanjay Mehrotra says the decision lies with banks after ICICI Bank announces higher minimum balance requirement for new savings accounts but allows exemptions. The governor says that minimum balance is not under any regulatory domain and every bank has its own requirements. Sources tell us that less than 10% of the accounts across ICICI Bank's portfolio would be impacted by the move. Block deals continue on Dalal Street. Private equity giant Warburg exits Home First Finance, raking in 1,200 crore rupees. Promoters and PEs have sold shares worth $2 billion in the last 4 months. Onion exporters set to meet Commerce Minister Piyush Goyal after losing global clients following India's export ban, which was lifted in May last year. Exporters say China and Pakistan have increased their global market share while India's onion exports continue to decline. Lawmakers, including Rahul Gandhi, Akhilesh Yadav, detained as opposition parties' leader marched to the Election Commission office to protest against the Bihar voter list revision drive. The police says the opposition did not have permission for a protest of this scale. The BJP calls the opposition's move a well-thought-out strategy to create a state of anarchy. 5 Al Jazeera staff among 7 killed in an Israeli strike on a tent housing journalists in Gaza. This includes 28-year-old journalist Anas al-Sharif, who had been reporting extensively on the war. Tel Aviv claims he worked for Hamas. Al Jazeera calls the killing of its journalists another blatant and premeditated attack on press freedom. The Supreme Court's orders of the rounding up of all stray dogs in the National Capital Region, moving them to shelters, calls the current situation grim and wants Delhi to be stray dog free, warns of contempt action against any individual or organization hindering the rounding up of dogs. Straight to the day's market action. Dalal Street started the week on a positive note, led by PSU banks and defense stocks. The Nifty ended the day above the 24,500 mark. 44 stocks closing in the green today. 220 points higher there on the Nifty. The Sensex added 746 points, 505 higher on the Nifty Bank, and the Nifty Midcap Index higher by almost 1% today. So broad-based buying that we saw in today. But the big story from the markets, investments into equity mutual funds surging by 82% to a record high of over 42,000 crore rupees for the month of July. The new fund offers collected over 30,000 crore rupees in the month. Mutual fund data also showed that investors continue to prefer mid and small caps over large caps. Surbhi standing by with the data. Surbhi, new record there as far as equity inflows are concerned. What's driving this?
The inflows for equity mutual funds have hit a record high, the highest ever level. The net equity inflow in this month of July has been 42,672 crores. That's a huge number, and it has overtaken the previous high, which was last year in Diwali around October, which was around 41,000 crores. So where has all this money coming from? New fund offerings. Over 30 NFOs, and all put together, they have pulled in over 30,400 crores. That's the might of these NFOs. So you'd wonder, what are these new funds? Well, they're across categories. There are lots of thematic funds that have pulled in the money. In fact, 9,000 crores has come in from thematic funds, the likes of HDFC Innovation Fund, ICICI Prudential Active Momentum Fund, and many others. Then there have been new launches in the mid-cap category, in the multi-cap category. For instance, Bajaj Finance launched their small-cap fund. Franklin India launched their multi-asset fund. And there have been Others like the multi-asset allocation, category where Franklin launched a fund. So all of it put together has pulled in huge amounts of money. That's point number one. If you look at the next sort of interesting trend, it's investors' love for mid and small caps. And that really illustrates the point. Look at that. Small cap funds drawing in the highest ever inflows of nearly 6,500 crores. That, is huge in comparison to the 2,100 odd crores that large cap funds have garnered. So clearly the market's preference is towards SMIDs, at least the retail investors. Then let's talk about SIPs. Again, a very heartening figure coming through. The SIP trend is rock steady, and this is also a record high. Last month, June, the number was over 27,000 crores. This month, it's almost 28,500 crores. So even as the market has been sluggish, returns have been tough to come by, investors have been keeping the faith. Last but not the least, an interesting sort of perhaps example of how investors are also getting savvier. They're looking at diversification, asset allocation, which is why this category, which is known as the multi-asset category, this is pulling in more and more money almost on a consistent basis. And this time around, if you look at the multi-asset category, then it's garnered almost 6,200 crores, which is a record high for the multi-asset category as well. All put together, a fantastic month, a month of records when it comes to equity inflows coming into mutual funds.
All right, Surbhi, many thanks for joining us. So a record there for the equity markets. But from equities, let's head to the commodities. Oil prices continue to decline after dropping more than 4% last week. Optimism over a proposed meeting between the US President Trump and Russian President Putin leading to a possible peace deal in the Russia-Ukraine conflict that has driven prices low. There is, of course, no clarity yet on what that meeting will entail. The meeting scheduled between the two presidents has also weighed on gold prices, safe haven demand, also dented as investors wait for the U.S. inflation reading, as well as clarity from the Trump administration as far as tariffs on gold bars, etc. are concerned. Now, top government officials are set to brief the Parliamentary Committee on Foreign Affairs days after the U.S. hit India with 50% tariffs. President Trump has alleged that India was fueling Moscow's, and I quote, war machine by buying Russian oil. The Indian ambassador to the US, Vinay Quatra, has spoken to Republican Senator Lindsey Graham as the government attempts an outreach with lawmakers close to the White House. Parikshit is standing by now to explain where things currently stand. Parikshit, it's important that Vinay Quatra, the Indian ambassador to the US, is speaking to Lindsey Graham because Lindsey Graham has been at the forefront of this business of tariffing countries who were purchasing Russian crude. So take us through where things currently stand.
Well, this is the second time that the Indian ambassador to the US has met Lindsey Graham. The last meeting happened on Friday. Why is it important? You're absolutely right. Lindsey Graham had called for 100% tariffs on countries like India and China, which purchase Russian oil. Now, India has been trying to explain, Lindsey Graham, that we have a strong energy partnership with the United States, which is only growing. While immediate details of the meetings between Ambassador Quatra and Lindsey Graham were not available, sources say this was about giving a perspective on how India-US energy trade is increasing. India now, at multiple levels, has conveyed to US officials that our oil trade, our oil imports from United States have gone up almost 70% between January and June, year on year. They're likely to go up even more. LNG purchases have doubled. So therefore, India's purchase of Russian oil has to be seen in the right spirit. We started buying Russian oil at a time when there were no sanctions. There are long-term contracts. And India will respect the energy partnership with the US, and this partnership is only going to grow further. So this is what we conveyed to the United States. Having said that, back home, there is an outreach happening with parliamentarians. Why is it important? Because the Foreign Secretary and the Commerce Secretary, two individuals which are really in the thick of negotiations with the US, back-channel talks, will be briefing parliamentarians. This is a confidential session on how India-US trade tensions are panning out, how these tariffs are going to impact India. And clearly, there is hope that there will be some breakthrough with negotiations that are happening right now till the 27th of August. It is also important to know the Indian government is pinning a lot of hopes and expectations from the 15th August meeting in Alaska between President Putin and President Trump. We have welcomed the statement openly through a Ministry of External Affairs statement, and we've said that the statement
heralds the possibility and potential of peace in the region, which is everyone's wish. And the Prime Minister Modi, has always said this is not an era of war. So let's see what happens. This is going to be a very crucial week in terms of India-US ties, in terms of a breakthrough in negotiations, and possibly even having some sort of interim trade arrangement.
Yes, let's see what happens. And of course, remember, as per the previous conversations, the US officials were supposed to be in India, or are supposed to be in India, around the 25th of August. As of now, we are given to understand that that plan holds. But of course, our colleague Abhimanyu Sharma is tracking that story. Now, Tesla has opened its second showroom in India, this time in Aerocity in the capital. This has come right after the EV maker opened its first showroom in Mumbai. The Delhi showroom is equipped with 4 supercharging units. The Aerocity site will also function as an experience center where people can experience the product. The 90-day trade truce between the US and China ends tomorrow, and neither country have announced a formal extension yet. China had said that both sides will work towards extending the tariff truce by another 90 days after officials met in Sweden, which was last month. Now, US negotiators have put the ball in President Trump's court. There is no indication from him yet on whether he intends to extend that 90-day period or not. Some reports suggested that it will perhaps be extended, but there is no confirmation yet. Semiconductor makers Nvidia and AMD have agreed to pay the US government a portion of their revenues from China, this in exchange for export licenses. Both companies will pay the US government 15% of revenue from the sale of their artificial intelligence chips that take place to China. The unprecedented arrangement follows Nvidia CEO Jensen Huang's meeting with President Trump. Details of the arrangement and the financial structure still being worked out, is what we understand. Back home, RBI Governor Sanjay Malhotra said that banks can take their own decision on minimum balance for saving accounts. Now, this comes after ICICI Bank announced higher minimum balance requirements for new saving accounts with exemptions for salary accounts and pensioners. The governor said that minimum balance is not under any regulatory domain, and every bank can arrive at one basis their own requirement. Take a look.
ये जो मिनिमम बैलेंस की जो बात है, जो मिनिमम बैलेंस का जो आप बात कर रहे हो, वो उसके अंदर में रिजर्व बैंक ने सभी बैंकों के ऊपर में छोड़ा है कि वो किस प्रकार का मिनिमम बैलेंस वो रखना चाहते हैं। तो अब किसी बैंक ने 10,000 रखा है, किसी ने 2,000, कईयों ने माफ भी किया हुआ है, लेकिन ये रेगुलेटरी domain mein nahi hai.
Well, that is the RBI governor saying banks are free to decide on the minimum balance. Now, sources tell CNBC TV18 that the number of accounts that would have to adhere to these minimum balance norms has been historically below 10% of the total accounts with the bank. So how will this impact ICICI Bank's customers? Ritu's here to explain who is exempt and how other banks compare. Ritu.
Well, this is a clear shift in strategy by ICICI Bank, moving away from mass customers to the relatively more affluent segment by steeply raising the minimum monthly average balance that is required for new savings accounts to the highest that we've seen across any bank in India. We're talking about a 5-fold increase in metro and urban areas to 50,000 rupees. And if this minimum sum is not maintained, there will be a penalty of 6% on the shortfall or 500 rupees, whichever is lower. Now, importantly, this change applies only to new accounts that are opened on or after the 1st of August. So existing customers do not get affected. And also, there are certain accounts which will be exempt from this. So, for instance, all the salary accounts, the pension accounts, basic savings bank deposit accounts, which are no-frill accounts mandated by RBI with a 1 lakh rupee cap on credit, and of course PM Jan Dhan Yojana accounts remain zero balance. Even customers that don't belong to any of these categories, they do have options to avoid keeping 50,000 rupees in their savings bank account. For instance, they could have FDs and RDs with the bank to meet the minimum requirement. Now, while the bank has not officially given any statement explaining the hike, there are various benefits such a move could bring. More stable deposits, improvement in CASA, higher balances at lower savings rates, or more, reduction in cost of funds, more premium cross-selling opportunities, just to name a few. Now, we've heard the RBI governor, ICICI Bank has not broken any rules, but the backlash on social media we've been seeing is understandable because 90% of India makes less than 25,000 rupees a month. And as Chair Kotak points out on X, a 50,000 rupee minimum balance means that 94% of Indians keep all of their monthly income with a bank at all times, or else they face penalties. Now, for perspective, other private banks like HDFC, Axis, Kotak or Yes, they do require around 10,000 rupees minimum balance in urban areas. And then you have public sector banks like SBI, BOB, Canara, etc. that have a zero minimum balance requirement. So as a customer, you do have various options available, but it will be interesting to see if other private banks also follow suit.
Ritu, many thanks for joining us. Now, JSW Cement's 3,600 crore rupee IPO has been fully subscribed on the last day of bids. As of 4 p.m, the total subscription stood at over 7 times. The demand was led by qualified institutional buyers, whose portion was subscribed by nearly 15 times. Retail portion also fully subscribed, while the non-institutional investor portion was subscribed over 10 times. The block deal mania continues on the Lal Street. Private equity giant Warburg has exited Home First Finance, raking in 1,200 crore rupees. Promoters and PE have sold shares worth $2 billion in the last 4 months alone. Nimesh is here with all the numbers. Nimesh, block deals buzzing.
Well, Indian markets have seen clean out trades worth $2 billion since the April of this year. When I mean clean out trades, it's essentially the last blocks either from the promoters or from strategic investors. The first example is Home First Finance. We saw a large block today. Warburg Pincus sold its remaining 10.2% stake in a block deal, and they raised close to 1,250 crores. Again, in August of this year, we saw a big block in Eternal, where Ant Financial sold the remaining 2%, and they raised close to 5,650 crores. Again, in July, we saw a large block in Adani Wilmar, where the Adani Group sold nearly 10.2%. It was a clean-out trade, and they raised close to 3,700 crores. In June, we saw a big block in AB Fashion, where Flipkart sold the remaining 6.2% stake, and they raised close to 600 crores. In May, there was a large block in Paytm, where Ant Financial sold its entire 5.8% stake, and they raised close to 4,000 crores. And last but not the least, there was a large block in RBL Bank in April, and there British International sold its entire 3.2% stake, and they raised close to 430 crores. So cumulatively, as I said, $2 billion of clean-out trades have happened since the April of this year. And if investment bankers are to believe, the pipeline seems to be quite strong in the days and months to come.
Nimesh, many thanks. Block deals buzzing. Members of the Onion Exporters Association are set to meet Commerce Minister Piyush Goyal today. Exporters are seeking the government's intervention. They say they're losing global clients following India's export ban, which was lifted in May last year. Exporters say China and Pakistan have increased their global market share, while India's onion exports continue to decline. Santya is standing by with the details. Santya, take us through what the problem is and what onion exporters are asking for.
So, Shireen, it's been 2 years since the central government first imposed restrictions on onion exports, followed by a ban on exports. But onion exporters are still struggling to cope with the damage it caused. In August 2023, the government imposed a 40% export duty on onion to keep domestic prices in check. Later, in December 2023, a complete ban was imposed on onion exports. This ban was lifted only in May 2024, but the relief came with conditions such as a 40% export duty and a $550 minimum export price on onion. Now, onion exporters say that as the ban was imposed in December 2023, they were unable to renew their overseas contracts, which usually happens in December. They claim that they ended up losing a significant chunk of their global clientele to Pakistan and China, who were quick to fill the gap. As per CRISIL data, before the export restrictions, China's share in the global onion trade was 8% and Pakistan's was only 1%. But once the restrictions were imposed on Indian exporters, China's share in the global onion trade increased to 12 to 13% and Pakistan's share rose to 2 to 3%. As per Indian government data, in 2020-21, despite it being the COVID year, India exported over 15 lakh tons of onion. In 2022-23, it exported over 25 lakh tons. This dropped to slightly over 17 lakh tons in 2023-24 once the export restrictions kicked in. As per CRISIL data, this further dropped to just over 11 lakh tons in 2024-25. According to the Commerce Ministry, overall onion exports, including processed products like dried onion, witnessed a significant drop in the restriction year. Ministry data shows that in 2021-22, India's overall onion and onion product exports were worth $619 million.
In 2022-23, they were worth $734 million. But in 2023-24, once the restrictions kicked in, the value dropped to only $180 million. And in 2024-25, it was $230 million. Exporters say the situation has worsened as Bangladesh has not started importing onion from India this season. They say that exports to Bangladesh usually begin by the first or second week of June, but it's mid-August now and exports haven't started. They say that exports to Sri Lanka are also impacted, attributing this to increased domestic production in these countries. As per CRISIL, Bangladesh's onion cultivation has increased by 10% in FY25, and similarly, Sri Lanka's domestic production of red onion increased by 19% and of big onion by 9% in 2024-25. Both Bangladesh and Sri Lanka are important export destinations for India. According to CRISIL, 41% of India's overall onion exports go to Bangladesh and 14% to Sri Lanka. Indian onion exporters are requesting the government to keep all this in mind and support them. They are urging that the RoDTEP, that is remission of duties and taxes on export products rate on onion exports, be increased from 1.9% to 5%, at least until Bangladesh starts importing from India again. The current situation is affecting onion farmers as well. Exporters are buying less produce, and this, combined with bumper production, has led to a massive price decline. Shireen.
All right, Sandhya, many thanks for joining us. We will take a break, but when we return, the Supreme Court orders the rounding up of all stray dogs in the National Capital Region and says they need to be moved to shelters, calls the current situation grim and wants Delhi to be stray dog free. That and more when we return. The big national story, the leader of the opposition in the Lok Sabha, Rahul Gandhi, and other opposition leaders were detained briefly while protesting against the special intensive revision of electoral rolls in Bihar and the alleged electoral malpractice. The opposition lawmakers were leading a march from Parliament House to the Election Commission's headquarters. The members of Parliament were stopped by police during their march. Some MPs, including TMC's Mahua Moitra and Samajwadi Party's Akhilesh Yadav, were seen climbing the barricades. Others, including Congress President Mallikarjun Kharge, began a sit-in protest at the site. More than 30 MPs, including Congress Party's Priyanka Gandhi Vadra and Shiv Sena UBT leader Sanjay Raut, were detained but released 2 hours later. Police officials say lawmakers were detained as the Election Commission had only given permission to 30 MPs to enter its premises, but the protesters were in larger numbers.
एक्चुअली बात नहीं कर सकते हैं, रियलिटी ये है, क्योंकि सच्चाई देश के सामने है और ये जो लड़ाई है ये राजनीतिक नहीं है, ये कॉन्स्टिट्यूशन की लड़ाई है, कॉन्स्टिट्यूशन को बचाने की लड़ाई है, वन मैन वन वोट की लड़ाई है, इसीलिए हमें साफ प्योर वोटर लिस्ट चाहिए।
कांग्रेस पार्टी और अपोजिशन ने बहुत समय बर्बाद कर दिया है। अब हम देश का समय और पार्लियामेंट का समय को और बर्बाद होने नहीं देंगे। जब वो अपना नेता तय नहीं कर पाते हैं, प्रतिनिधि तय नहीं कर पाते हैं, फिर इलेक्शन कमीशन से टाइम मांगा क्यों है?
Well, the Supreme Court has issued directions to remove all stray dogs in the Delhi National Capital Region to shelters within 8 weeks. The court has ordered civic authorities in Delhi, Noida, Ghaziabad and Gurugram to build dog shelters immediately. It refused to hear any pleas by animal rights activists, saying that there was no room for sentiment. Ashmit is standing by with the details. Ashmit, take us through the court's order, the directions that the court has given. You know, how is this implementable to say that all of Delhi's stray dogs, including in and around the National Capital Region, have to be removed and moved to shelters in 8 weeks? Does Delhi even have dog shelters?
Well, the numbers clearly not making sense at this point. PETA suggests there are over 10 lakh dogs as far as Delhi NCR is concerned. The Supreme Court for the first 6 to 8 weeks suggesting dog shelters for about 5,000 dogs. So those numbers are not stacking up. Is the Supreme Court suggesting that the Delhi government and the municipal authorities need to shelter and provide for over 10 lakh dogs? That appears to be the strategy that the Supreme Court was trying to go for in what was a sweeping order. The Supreme Court, in quite unnatural proceedings, refusing to hear anybody else other than the Delhi Government Council and the amicus, refusing to hear outright, saying that we will not hear any intervention applications. All the applications, intervention applications, will be dismissed. The Supreme Court saying that now is not the time for confusion. Now is not the time for sentiment. This is the time for action, and that it will not be shy of taking action. In fact, at one point also suggesting that the dog should be wound up, and that use of force is also something that has been permitted by the court in terms of rounding up of these dogs. So that's the broad direction that has come from the apex court. All the street dogs need to be rounded up by the municipal authorities. This is applicable for Delhi, Gurugram as well as Noida. Further, the Supreme Court has directed for setting up of shelters. Not much clarity there. The number 5,000 came up by way of a submission that came from the amicus. The amicus said that this will be a progressive effort going forward. We'll need to progressively build more shelters. For now, let's give an initial target of 5,000. So that's what the apex court has given, 6 to 8 weeks, dog shelters for about 5,000 dogs. The Supreme Court also saying that there is no situation in which these dogs that have been rounded up can be released back on the roads, can be released back on the streets, and to that end saying that these dog shelters should have CCTV and that the Delhi government should go back to the court disclosing how many dogs have been rounded up on a daily basis. So again, sweeping directions this. One important caveat that the Supreme Court repeated 3 times as a part of its order, saying that while the municipal authorities have been given unfettered powers while they go about rounding dogs, any individual or organization found interfering with their efforts in terms of rounding up these stray dogs will meet the full force of the law, will be taken action against, will be liable to face contempt of court. That was repeated 3 times. So clearly, the Supreme Court not mincing words, expressing its intent, but the implementation of the order, many say, raises a number of questions.
Yes, Ashmit, appreciate you joining us, and we'll of course be taking this conversation forward right here on CNBC TV18. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned, we're back in a minute with more.
Welcome to Indianomics. Today we put the spotlight on a very important Supreme Court order to the state electricity regulatory commissions to raise tariffs and allow discoms to run on commercial lines. Were it not for the tariff issue, this order would have grabbed the headlines in all newspapers. The Delhi power distribution companies have actually taken the DERC, that is the Delhi electricity regulator, to the Supreme Court asking for the recovery of their past dues amounting to 27,200 crore rupees. These past dues in jargon are called regulatory assets. The Supreme Court, in response last week, gave a broad order to all the state electricity regulators as follows. First, it said that the tariff decided by the SERCs shall reflect the actual cost of power. Second, the accumulated dues or the regulatory assets should ideally not exceed 3% of the annual revenue requirement of the discoms. Third, these regulatory assets or past dues must be liquidated in 3 years, either by raising tariffs or getting the state governments to pay. The current backlog of past dues have to be paid back in 4 years. That's the telling point of the order. It has more. Joining us now are two former power secretaries, Mr. Alok Kumar and Mr. Pradeep Kumar Pujari. Mr. Pujari has also been the Central Electricity Regulator Commission's chairman. I'm also joined by Nikhil Nigania, the Director and Senior Analyst at Bernstein. Gentlemen, thank you very much indeed for your time. Mr. Pradeep Kumar, if I may start with you, sir, since you have, worn both hats as Power Secretary and as Chairman of the CERC, do you think this moves the needle a bit? There have been several national tariff policies which have told the SERCs to do exactly this, liquidate the past dues in 3 years, 7 years, whatever. Nothing has moved them. Will the Supreme Court order move the needle, at least for Delhi?
Thank you. What Supreme Court has said is already there in the various statutes. The 3% limit, liquidation of the regulatory assets, and when regulatory assets are to be created, they are supposed to be created in under exceptional circumstances. Now, the issue is that not only the statute, but also the various I'll not call it direction, but various letters that has been issued from the ministry also had asked the regulator to take necessary steps. Unfortunately, when the regulatory assets are created, at the same time, the regulator should have included a roadmap within the time frame during which these regulatory assets are supposed to be liquidated. So unfortunately, this has not happened. So I'm really happy about this direction that came from the Supreme Court. And I'm sure that the various regulators, state regulators who are having or have to take necessary action will now take action to liquidate these regulatory assets within the time that has been stipulated by the regulator. The rule and the policy says that the old regulatory or the legacy regulatory assets are supposed to be liquidated within 7 years. However, the Supreme Court has now put a new timeline of 4 years. So they need to be regulated. I'm sure that all the regulators will comply with this direction.
Oh, you feel so? Let me get first thoughts from Mr. Alok Kumar. Sir, it is a large number. I mean, DERC itself has to pay 27,000 crores in terms of legacy assets. Their annual amount is much smaller. It's like 20,000 crores or thereabouts. How are they going to clear this backlog? And it is to all SCRCs. So if you go to a state like Tamil Nadu, which is, a huge offender, their accumulated losses or accumulated dues, are 89,000 crores. And in any given year, their annual revenue amount is only 91,000 crores. I mean, this doesn't look even feasible. What's your sense?
Thank you for having me on this show. I will add what Mr. Pujari has said. The Supreme Court has very clearly said it's a regulatory failure. And the regulators are prepared to work under dictation. So that is the sorry state of affairs. But there are some silver lining. If you see the new scheme, the Government of India has floated the RDSS. One of the pre-qualification which participants have to meet every year is the no new regulatory asset has been created and past has been liquidated. If you read the order carefully, they accept Madhya Pradesh, Rajasthan and Tamil Nadu. This is not a very widespread problem in the country. There's some states where the regulatory failure has been very prominent.
Yeah.
But I'm happy to see, if you leave the case of Delhi for a moment, the 4 states which have given their affidavit, they said that we have not created any significant regulatory assets post 2020. So that means this carrot and stick approach by Government of India is working, number one. Number two, DRC also wrote a letter to the Government of Delhi saying that they should take it up, that private sector DISCOM should be able to participate in Government of India schemes. What happens? This has been my view.
Yeah.
Normally, the Government of India has been excluding the private sector DISCOMs from schemes like RDSS and even other. That is not done because the consumers in those companies, they face tariff hike because grant is not given. So there is also a administrative view which needs to be changed, that under the regulatory oversight, the private DISCOMs should also be made fully eligible for participating in Government of India schemes. Third, I'll say there has been a lot of debate why Ministry Power has come and made rules. Now, I'm very happy that most of the rules which are made when I was in the ministry, Now, Supreme Court has welcomed. He says, endorsed them. They said there is nothing can be more clearer than tariff policy.
Yes.
So now the issue is that we need the stick from APTEL and Supreme Court, and we need the carrot from Government of India to see that these things doesn't happen. Past dues are huge, and I personally feel like Tamil Nadu has been giving a lot of support to the DISCOMs from their budget. I think part of it has to come from budget. All of it can't be passed through tariff, and some parts should come from the tariff rise. Most important is that going forward, the DRC has to give up this approach of giving only 8% of DRS for recovery of capital as well as interest, whereas carrying cost is also more than 8%.
Yes.
So if DRC should correct at least the future stance,
so what is this DRS?
Past can be addressed.
What is DRS?
DRS is called the deficit recovery surcharge.
Okay.
Which DRC has been allowing at 8%. It's a laughable. Carrying cost is more than 8%, and you expect to recover everything 8%. That's all I have to say.
Fair point, sir. So let's get a market angle from this. Nikhil, as both the former power secretaries are saying, when the word comes from the Supreme Court, it has a much larger, force of law than a national tariff policy. Policy is a guidance. A Supreme Court judgment is law. So do you think we are going to see, more money flow through? If not all the 2.3 trillion rupees of past dues, will something flow through to the power sector?
Yeah, so absolutely. I think, as Mr. Alok Kumar said, it's a carrot and stick approach, the stick being the Supreme Court and the APTEL, and the carrot being schemes like RDSS by the central government. So definitely a big positive step in the right direction for the broader power sector. In terms of flowing through, if it does, it doesn't impact the P&L of these distribution companies. It impacts the cash flow, which itself is a big benefit. The most immediate beneficiaries would be power distribution companies in Delhi, assuming that's where the case was regarding. And the three there are, one is Tata Power, Delhi Distribution. The other two are owned by Reliance Infrastructure. We don't cover these names, but they are the ones who stand to gain the most. And beyond that, if we expand it to other parts of the country, then CESC is another one, which has regulatory assets, although not all of it might be approved. And so those are the large ones, I would say, were immediate beneficiaries.
Yeah, I agree. Adani Energy also is there in some states. But generally, the DISCOMs are likely to get more power, more money if the law is implemented. I'm going to take a bit of a liberty with all of you. I'm not going to restrict it only to the Supreme Court's order. Since I have three very knowledgeable people on power, I will meander into other questions as well. But Mr. Pujari, just to finish this argument for the moment, do you think it will be more tariffs, or will state governments have to cough up? Like Mr. Alok Kumar said, Tamil Nadu has been coughing up, and they have to, because their losses are really huge, or their dues are really huge. But do you think the state governments will be forced to take this order seriously, or they are, likely to be in contempt of the court?
Yeah, one thing is very clear, that the Supreme Court has rightly recognized that it has to be done in a partnership. Both the state and the regulator have to work out a solution. And as you understand, the structure of the is such that the regulator is supposed to determine the cost reflective tariff. Now, how much of that is to be passed on to the consumer? The state government can always intervene. And if they intervene, the scheme is very clear, saying that the gap, you cover it on the subsidy. So now, suppose the legacy regulatory assets are to be clear, and depending on how much it impacts the consumers, the state government, the specific state government, looking at the local context and the consumer mix, what is the position of the DISCOMs, whether there is an affordability issue. Considering that, the state government has to take a view how much it will allow, or how much should go to the consumers, and how much the state government will cover it through subsidy. So I don't think it is a general rule that a particular sort of approach will be followed. My understanding is that every state government with a state-specific approach they will take, looking at 2 or 3 major things: the financial health of the DISCOMs, the consumer mix, what is the present tariff of the C&I sector vis-a-vis the domestic sectors, and how much, what is the financial position of the state government. So considering that, I think the each state government will take a view on that. That's my take. There will be no one should quit all sort of approach. And this is very clearly Supreme Court has said that both the state government and the regulator have to work it out.
Yeah.
So this is how the probably approach will be.
I'll come to this point in just a minute. Let me, before I take my first break, give our stock market viewers some big gift from the people who are here. Mr. Alok Kumar, very quickly, I mean, I saw your excellent piece in the Mint about how the grid capacity has fallen short because of the waivers given to renewable energy guys. If you can very briefly tell our viewers which part of the power ecosystem today looks most profitable. I mean, where is the demand-supply gap? Is it for transformer makers? Is it for electricity construction companies? Is it, for discoms, for power generators, renewables? Which is the best sector now?
I'll say best sector is transmission because it's a most essential component, natural monopoly, and their dues are mostly paid. You can't live without transmission, so go and invest in transmission first.
Okay, so transformers is the big idea. Thanks for that, Mr. Alok Kumar. Well, we have to take a break, but we have just warmed up. We are going to get a lot more investable ideas and a much richer understanding of the power ecosystem. Back in a minute after break. Welcome back to Indianomics. We have been discussing a landmark Supreme Court order which has ordered all the state regulatory commissions to clear past dues of discoms in 4 years. It will mean 2.3 trillion rupees flowing through the power sector if it is cleared. I've been speaking with two former power secretaries of the Government of India, Alok Kumar and Pradeep Kumar Pujari. I've also been speaking with Nikhil Ligania, Director and Senior Analyst at Bernstein. Gentlemen, thank you very much for your patience. Like I promised, we are only not going to discuss the Supreme Court order. We are going to discuss the power sector in general. Nikhil, before going to the break, Mr. Alok Kumar said that one of the most profitable spaces to be is the transformer sector because it gets paid up front. Irrespective of whether later down in the food chain, discoms collect their dues or not. What are your thoughts? Which is the best part of the cycle?
No, I absolutely agree with Mr. Alok Kumar. So if our pecking order in terms of thematics, number one is transmission, and that too especially the higher voltage segment. If you look at the HVDC segment, for example, that is the highest barrier to entry. Lead times going as high as 10 years in Europe as well for HVDC substations, followed by battery energy storage, followed by thermal, and renewables is lower in our pecking order of preference. Those are the themes we like.
Okay.
So that's our yeah. So transformation, without a doubt, possibly one of the biggest themes globally after AI.
What about all those construction companies? I mean, just to intervene, we had L&T, KEC International, Kalpataru, all of them on the channel in the last 1 or 2 weeks because they announced their numbers. They seem to have orders. I mean, they're bursting with orders. Does that also fall in the category of the beneficiaries of the system?
No, absolutely. So to play transmission, for example, you could either play an equipment supplier and the substation guy like a Hitachi Energy or a GE T&D or a Siemens Energy or even CG Power for that part. These are the high voltage players largely. And on the line and the towers part, the construction usually comes to a player like L&T or a KEC. So within our coverage, among these names, L&T is the one we have and which we like. It's one of our topics.
Okay. Well, to come back to the topic at hand, Mr. Pujari, how do you expect this to, kind of take off the ground? In my experience, people will forget about it because the headlines are grabbed by the tariff issue and by Trump. This will probably come to a head 1 year later when the regulatory assets of many discoms go above the 3%, which the Supreme Court has mandated, and somebody else goes to court. Will everybody start acting only then, or do you think immediately something will take off?
My take is that something will take off immediately because I think the ministry will be pushing for that, and also the Supreme Court has told APTEL saying that you to monitor the thing under 121 section. So I think this issue will be taken up, and also there will be pressure from the discoms. I mean, basically all the discoms who have a large amount of regulatory assets sitting on their books, I think they will be pressurizing for increasing the tariff or getting the subsidy from the state government. So things will move, but that's my thing. And whenever the Supreme Court gives an order, at least in the power sector I've seen, I mean, things don't remain static. It gets implemented. Maybe it will start slowly. Maybe some of the states will take up, but gradually it gets complied with. I don't think there are any orders, that comes to my mind, which is basically issued by the Supreme Court has not been complied with.
Ignored.
So things will move, definitely. That's my take.
Yeah, I guess even if it starts to show some momentum, the Supreme Court will be satisfied that something will happen down the line. But sir, since you have been so close to the entire electricity regulatory commissions, Mr. Pujari, why is this system the Supreme Court has not minced, has used very strong language to say this is regulatory failure. Why would things come to such a sorry pass? Is it that they are appointed by state governments and therefore beholden to the state governments who have been reckless in their promises? Is that the main problem?
I'll not get into the debate when one institution makes a comment on another institution, so I'll not get into it. But point is, it is not so. As Mr. Alok Kumar pointed out, all the states or all the regulators are not have been culprit in creating the regulatory asset. It is a few of the states that has happened. Yes. So based on that, we cannot take a generalistic view saying that there is a general, the regulators are appointed by the state government and that's why they are not in a position to take a strong stand. So it depends on the individual commissions, the individual governance issue, and I think due to various reasons, somehow the state governments are in a position to influence the regulator that certain tariff hikes should not take place during certain areas, like during certain times. For example, when the election is nearby or election is around the corner. I mean, most of the things keep happening like that, except few states where there has been chronic default. But generally, as was pointed out, it is the problem remains limited to few states. And I think we should avoid making a general comment that all the regulators, since they have been appointed by the state government, are not in a position to take a view. Wherever it has happened, I think now there's a time to get the position corrected. Yeah. And in the forum of regulators, again, where the chairperson, CRC, the chairperson of the forum regulator, I think they should take it up. And this should be a regular agenda in the forum of regulators, what has happened. I mean, and there also, the ministry sometimes participates in the forum of regulators for various feedback. And this can be monitored at that level. That's my suggestion.
Yeah, actually, people are just falling back. So many times the APTEL and the Central Power Ministry has to even tell them, SERCs, that you ask for the data in advance, prepare for the, annual revenue requirement in advance. Even that preparation was not there. It comes with a lag. Mr. Alok Kumar, is the rest of the system cleaned up? I mean, time was like before Uday came in, or 10, 15 years ago, when there were chronic AT&C losses, when there were other kinds of leakages. Has that reduced? I didn't last check the data on losses.
I think I'll make only 2 points. What will work is carrot and stick, as has been working, number one. Number two, after the LPSC rules, the payment position of generators have really significantly improved. The major point is that we should look at the power purchase cost. The decisions we make today, some states are ordering the coal-based plants left and right without understanding their long-term implications of fixed charges. In past, they have entered into MOU route projects. Big contracts are very lucrative for many people. But ultimately, lies that unless until you control the power purchase cost prudently, this thing will show up somewhere else, because all of this cost, most of it is creation of the state governments, and regulators have approved these PPAs. So there has to be much more thinking, much more debate, much more noise about how to plan the power purchase agreements properly so that your power purchase cost remains manageable. I think that is one important lesson which, if you read the judgment of Supreme Court, DRC has written that power purchase cost is going up and up. Do something, go to state government, otherwise it is impossible to pass on. This will be all the states, the politicians, the ministers will have to take a call. They should not be very much attracted by large orders for the power plants. It should be done very prudently. That is the main lesson which we have to learn.
Yes, we get carried away by ultra mega power words like that, and do not look at the unit cost, perhaps, in times when the economy seems like growing. Nikhil, I just wanted your thoughts. Renewables have definitely reduced the cost of power compared to the legacy power plants. Though, of course, their availability in terms of time, etc., are an issue. Do you see a secular fall in the cost of this power, at least because of technology, grid batteries? At some point, all this will make it cheaper?
So overall, levelized cost of power, so solar by itself obviously is 2.5 rupees, and new thermal plants is about 5.5 rupees. Nuclear close to that as well, 5.5, 6 rupees. So over time, it's expected that, solar efficiencies will improve as the technology evolves towards HJT or back contact. And similarly, on the battery storage side as well, we have seen a lot of advancements, and the costs have fallen a lot already in the last 2 years. So directionally, it is expected that solar plus battery energy storage cost should continue to come off over time. Definitely, that's the expectation.
Okay. That will hopefully, technology solves what the legal system and the economic system is probably not able to solve. We have still not touched the very important issue of nuclear power, nuclear energy, and what is its future. But we have to postpone that discussion for another day simply because we are out of time. But gentlemen, that's a wealth of ideas and understanding you've given us. Thank you very much for enlightening us on this topic. We have to wrap up on Indianomics. Thanks for watching.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story we are tracking this evening: government officials are set to brief the Parliamentary Committee on Foreign Affairs days after United States hit India with 50% tariffs. President Donald Trump has alleged that India was fueling Moscow's war machine by buying Russian oil. The Indian ambassador to the US, Vinay Quatra, has also spoken to Republican Senator Lindsey Graham as the government attempts an outreach with lawmakers close to the White House. Remember, the senator previously advocated for a 100% tariff on buyers of Russian oil. Graham said on Friday that India should improve ties with the US by helping to end the war in Ukraine. Sources have said that India told US officials that crude oil purchases from US have increased by over 70% in 2025 and assured that crude oil and LNG purchases will only rise. Indian officials also reiterated that India is not the only buyer of Russian crude oil. To take this discussion forward, we're now joined by Ambassador Deepak Bhojwani, former Indian ambassador to Latin America, and Inar Tangent, senior fellow at Tahe Institute. Gentlemen, thank you very much for joining us on the program. Ambassador Bhojwani, what real options does India have at this stage? There is an outreach going on. We're trying to explain the US administration that, listen, we do have a strategic partnership with Russia, but at the same time, we are increasing our oil and gas purchases. Do you think India will be able to clinch some sort of agreement and reprieve from the 25% additional penalty before the 27th of August?
Hard to say. A lot depends upon how Mr. Trump sees the situation. The reports that I'm reading, I have no first-hand news. The reports I'm reading in the media are that our imports from Russia of crude oil have already dipped somewhat in July and may even dip further in August. It's hard to say. The government has not said anything about this except for saying that we will consider our national interest first and foremost. The Ministry of Petroleum and Natural Gas and the oil importing companies, all of our companies import crude oil, a lot of them, most of them from Russia anyway. We also import from other sources, but they haven't said that they have been told or explicitly instructed not to import oil. The private companies, of course, will make their own decisions, mainly Reliance and Nayara, which in any case is owned by Rosneft. But the Indian state oil companies will normally follow the indication given by the government of India for importing Russian crude. I personally think that there may be a bit of a slowdown to sort of test the waters and see whether Mr. Trump will give in eventually and not hike up the tariff to the extent of 25% as he has sort of indicated he will do, because we're purchasing Russian crude. But on the other hand, I think are committing in any way, even informally, that we will never purchase Russian crude till Mr. Trump tells us that we can do so, is not on the cards. On the other hand, there is a summit between Mr. Trump and Mr. Putin. Who knows what will happen there? So it's very difficult to call. As of now, we've indicated that we will do what is in our national interest. By the way, we also have other options. I mean, the crude oil market is very fluid. I understand that the production isn't going down in any significant manner. If anything, it may well be going up after the Saudi decision. So in that case, there will be plenty of oil around to be purchased, and we have traditional sources. The question will be one of price. Do we pay a little bit more, maybe $1 or $2 per barrel, to import from Saudi Arabia or Iraq or wherever else? So let's see what happens in the days and weeks to come.
Right. Let me also go across to Inar Tangent. Inar Tangent, while the US has slapped additional tariffs on India for buying Russian oil, they've not done so on China for now. Lindsey Graham was one of the senators in the US who had been calling on the US administration to take action against countries like China and India. Clearly, the US is making a differentiation, but how is China preparing in case there's any kind of penalty or action by the US?
Well, I think China's in a different position. And as you've heard J.D. Vance say, that he, when he was asked, why are you hitting on India, which is supposed to be your ally, and being so nice to China, he says, well, basically they have more cards that India doesn't. I think this is a slight. I think there's a fundamental misreading. I understand that there's people think that this is just about Russian oil. I disagree. This is about the BRICS. You look at all of the BRICS, all of them are under enhanced tariffs. Brazil, 50%, South Africa, 30%, India, 50%. These are well above everything, and there's been threats against Russia and also China, but those haven't materialized. What you see here is a classic playground bully. And why are they going after, the BRICS? Well, quite frankly, the BRICS scares America. The idea that 40% of the world's GDP, the majority of resources, land, people, markets, and manufacturing would somehow come together, tell the United States to knock it off, or there would be consequences, is something that Donald Trump fears. He's made it very clear. He said, anybody who gets near them, and I'll throw on another 10%. And if they do anything about attacking, substituting the dollar, it's another 100%. Well, I would love to play poker with Donald Trump because he has a lot of tells. Anything he's afraid of, he makes some bombastic statement about. So I think that people in India should really start thinking a little bit more about the larger picture and what it is, because it doesn't make any sense whatsoever. They're not hitting Turkey for this, and they're certainly not hitting the EU, which is the one who's buying the oil from Turkey and also India. So it doesn't make any sense. Trying to make sense of it and not seeing the larger picture, I think, is missing the point.
Right. Going across to you, Ambassador Bhojwani, very important summit between Russia and US coming up in Alaska on 15th. How important will this be for India-US negotiations as well?
I'm not sure if that would come into play, but yeah, it's important for the world as such, because anything that lessens the tensions and gives Mr. Trump an excuse to ease up. I think he's looking for an excuse. He wants a way out. He's painted himself into a corner by saying he'll do this and that to Russia. I think a lot of it is bluster, but he may well go ahead and do something drastic and stupid. He's been known to do that. The point is how much Russia will, how much will Russia give in on the stand it's taken, on Ukraine, not joining NATO, on the territories it has and has incorporated into Russia, and that must be recognized, and so on and so forth, and on the sanctions, because that would be important to us, because if Trump agrees to lift some sanctions, that could be a tremendous relief for us and for the rest of the world. But it's hard to say what will happen. I believe from Trump's body language and from his actual language that there may have been something cooked up already, although it's hard to say. But I think we should try and see if we can be optimistic about this. It's not too far away, a few days away. Let's see what happens. I believe Mr. Trump and his team may have got a sense that they can't push Russia too far. And Trump is looking not for a win here, but for a way out. And Zelensky and Europe, obviously, we've seen from their statements that they're really worried. Zelensky is still claiming absurdly that he's not going to give up any Ukrainian territory. Let's see how far he goes with that.
Right. We've run out of time, but thank you very much, Ambassador Bhojwani and Inar Tangent, for joining us for that important perspective. We're taking a break here on News Center. On the other side, the Supreme Court ordering the rounding up of all stray dogs in the National Capital Region and moving them to shelters within 8 weeks. A special discussion when we're back. Welcome back. You're watching News Center. The Supreme Court has issued directions to move all stray dogs in Delhi NCR to shelters within 8 weeks. While hearing a case suo motu against increasing incidents of infants and senior citizens falling prey to rabies, the court said that there should be no room for sentiments and anyone hindering the rounding up of stray dogs would be subjected to court action. That's not all. The court also refused to entertain any pleas by animal rights activists. It observed that the action should inspire confidence for children to move freely without the fear of being bitten by stray dogs. Delhi Chief Minister Rekha Gupta said that the state government will implement the court's orders, which she believes will benefit the people of Delhi.
इसमें माननीय कोर्ट ने जो आदेश दिया है वो भी हमारे लिए बहुत महत्वपूर्ण है। हमारा एक ही ध्येय है, दिल्ली की जनता को राहत देना। आज ये प्रॉब्लम जिस विकराल रूप धारण करके दिल्ली के सामने खड़ी है, इसमें सरकार की ईमानदारी के साथ में समाधान देना ये बहुत महत्वपूर्ण है, जिसकी हमने पूरी योजना बनाते हुए इस समस्या पे काम हम करेंगे और दिल्ली की जनता को बड़ा लाभ हम लगातार देने वाले हैं।
To take this discussion forward, we are now joined by Divya Puri, co-founder of the Karan Puri Foundation, Ambika Shukla, trustee of the Peoples for Animals, and Khushbu Gupta, director of advocacy projects at PETA India. Thank you very much for joining us. Ambika Shukla, if I can begin with you first. You know, the Supreme Court's direction on asking authorities in Delhi NCR to round up all stray dogs, move them to shelters, build shelters and report about their creation in 8 weeks. Can this even be done? Is this even possible? There is also an issue of this order going against previous orders of the Supreme Court, but I'll come to that after this.
It is actually a completely untenable order, as you've pointed out. It has been passed without any discussion or deliberation and ignoring critical ground realities. There are 0 shelters on ground. Firstly, there is no census. So even the implementing agencies, which have been directed by the court, which are the municipalities, have no idea of the numbers that they are dealing with. If they do not have any ideas of the numbers, how can they make provisions for them? There are no shelters at present run by the municipalities. There is no land allocated for the same. There are no funds that have been sanctioned for the same. The cost of maintaining a single dog in a shelter is an average of 2,500 rupees per dog per month. And this is a recurring cost. If you take an average estimate of 10 lakh dogs in the NCR area, multiply 2,500 by 10 lakhs, that is a cost of rupees 250 crores per month, every month. Can our government allocate this kind of money? Should we be doing this? When, by contrast, the cost of the ABC program is a finite rupees 1,000, a one-time cost of 1,000 rupees per dog forever. So you just look at it, the cost balance exercise, and you will see which is the more effective program. And the ABC program is actually delivering results on ground. We have brought the number of rabies cases down from 20,000 rabies cases a few years ago to just 54. Now, when a program is working well, that is not the time to derail it and implement something that is completely impractical. It is costly.
Right.
It is impractical. It is impossible. You don't have trained staff. You don't have shelters.
Okay.
You don't have numbers. You don't have the money. So I don't see this order as solving any solution. I see it throwing up a number of problems which we will have to deal with.
Ms. Shukla, I'm going to come back to you. Let me also get in Khushbu Gupta. Ms. Gupta, now, when we come to previous orders of the Supreme Court, they had spoken about giving anti-rabies vaccines to dogs wherever they live. And now this order says that you have to relocate dogs to shelters, something that previous orders of the Supreme Court and also certain global norms were against. What is the challenge that this is going to throw up? And could you give us the thinking on this issue of dealing with stray dogs, relocating them, why global bodies and even previous orders of the Supreme Court had advocated against that?
We have seen time and again, and the current law of the country also
we have the animal birth control or the ABC rules 2023, which have replaced the 2001 rules. And according to them, it is illegal to remove or displace dogs from their territory. And now the Delhi government is caught between what the law says and what is directed by the court. The ABC rules have been in place and have been effective in places like Lucknow and Dehradun, which have sterilized up to 70% of their dog population. This is ABC rules is something which is backed, animal birth control is backed by global bodies because it is the only humane and scientific way to control the dog population. In fact, in Delhi also, there used to be a time where we used to euthanize the dogs or then just pick them up or then kill them. But then that hasn't worked. And that was the time when a humane and scientific approach was needed and animal birth control rules were introduced. It is utterly impractical to build dog shelters to house Delhi's dogs. And the idea to jail these dogs is plain cruel. Even if such facilities were built, they would be severely overcrowded and disease would be rife. Shelters are supposed to be just temporary facilities to provide treatment to the dogs and then offer them for adoption. They cannot replace for their homes. The Delhi government must focus on the humane and effective sterilization and vaccination program. And when a dog is caught for sterilization, they are also given anti-rabies shots. And, the government must increase the animal birth control centers and to ensure that enough resources are put to drive. However, it's not just up to the government to work on this solution. We also appeal to the members of public to stop buying dogs from these breeders and pet shops that add to the problem. And the people must also get their own dogs, the ones who live with them, sterilized, and choose to adopt dogs from these shelters. And if the animal birth control program is implemented, then the dogs on the street would be phased out automatically.
The co-founder of the Karan Puri Foundation, the Supreme Court took suo cognizance about incidents of dog bites leading to rabies. The court order also speaks about how children should be able to go out without the threat of being bitten by stray dogs and contracting rabies. How much of this is actually based on facts?
So I think the Supreme Court took suo action on the last case, which was reported where a girl is supposed to have died of rabies, where she actually died of meningitis. Our newspapers and our reporters play a very large role in this wrong reporting which is happening on the ground. We have inflated numbers of dog bites which are being quoted. We have inflated numbers of rabies cases which are being, reported in various media forums. And the most interesting part is that none of the stakeholders were heard today. ABC, the failure was just a blanket statement passed by the judgment. Where is the data backing this statement? Everybody who was there to represent, to show the judge that ABC is working, and it's the only humane way, none of us were heard. It was just a blanket statement that pick up the dogs and put them in the shelter. You cannot do ABC properly. Delhi still has ABC centers. Go to NCR. You don't have a state-funded ABC unit anywhere in Gurgaon, Faridabad, Noida, Ghaziabad. And you are saying ABC is a failure. It's a failure of the government to implement the law. And I'm so surprised that the judge went against the constitutional law, a law which is a valid law, which is not under dispute, to pass such an order. And while I agree that there has to be compassion taught to the children, why is that only a certain section of children are not taught this compassion? And you see so many cruelty cases where children are, killing these dogs, beating these dogs. Why are those cases not reported? I understand the incidents happen, but we have to go and understand the reason behind this incident. Everybody reported the death, but did anybody report that MCD did pick up those dogs who were supposedly biting dogs and found them to be normal dogs and they were released back?
Okay, let me now go back to Ambika Shukla. Ms. Shukla, what's now the solution? Supreme Court has now come up with this order. Municipal corporations, state governments will have to follow it in some way or the other. What's the legal recourse that you're going to take? And also, are animal organizations like yours, are most of them on the same page? What's the way ahead now? Are you going to challenge this legally?
Yes, apart from challenging it legally, I think there has been a huge backlash against the order. There are people congregating outside the Supreme Court. There are people congregating at India Gate. There is a huge and spontaneous coming together against this order because it is completely unviable. And I think the way forward is for the government of Delhi and the government of India to represent to the court that this order is not possible. It is not practical and it is not tenable. So I think it is for the government to represent that along with us. And it was completely unfair of the court to disregard domain expertise. If you have a headache, you go to a doctor. If you have a dog issue, you should be consulting with people who work with dogs. That is surely logical. You do not ignore them. You do not ignore the scientific data. You do not ignore the facts on ground and pass a completely arbitrary and unworkable order. That is not something we expect from the highest court of the land. And I think there will be challenges across the board, legally, physically, and I hope that the media will support this effort because
all right.
It is something for every Indian to consider. When our constitution says compassion, we need to follow it.
That's an important point. And I'm going to ask one question to each of our guests as to how do we now strike a balance when it comes to the welfare of these stray dogs. Ideally, we should be doing this as per global norms and as per set precedents by experts. Number two, how do we address questions relating to safety of children, safety of the public? Let me start with you, Ms. Khushbu Gupta. What is now the best solution forward? What would you recommend?
The communities, they think of their neighborhood dogs as families, and the displacement and jailing is not scientific, and neither it has ever worked. And what now needs to be done is that the government works with the feeders. The feeders are people who can be a bridge between the dog and the government, and for implementing any sort of solution. So far feeders have been seen as somebody who's like, who are just labeled as dog lovers. But having dogs in our community is, it's something that even our constitution encourages us to do, which is the compassion towards all animals. The dogs trust them, and then they're easier to catch for sterilization, and then the dogs are not frightened as much, and then they can be put back into the same community.
Right. Divya Puri, your final thoughts on what solution should we now think of as a society?
Compassion and peaceful coexistence. If Bhutan could achieve it, why can't we do it? We already have, there are so many model colonies within Delhi where you can go and see that dogs are sterilized, vaccinated, peacefully coexisting with the residents. If a handful of the colonies can achieve that, why can't the rest of the Delhi and the rest of India achieve it? Goa is rabies free. If we can do it there, why can't we do it in Delhi? Clearly, there is something lacking on part of our government that they are not able to achieve this in Delhi.
Right. We've run out of time, but thank you very much, Ambika Shukla, Divya Puri and Khushbu Gupta for joining us on this very important program and discussion point. There's not the final word on this. And as Ambika Shukla was pointing out, there are going to be some legal challenges moving forward. That's all we have time for here on News Center. Thank you for watching. Goodbye.
Welcome, you're tuned in to the Climate Clock, and the race to combat climate change is on. Biofuels are a critical part of the solution. On the occasion of World Biofuel Day, we are looking to the future of sustainable energy and focusing on tangible solutions to fight climate change. Today, we are joined by Vijay Murugesh Nirani, who is the founder and managing director at TrueAll Bioenergy, who is spearheading India's transition to a greener energy future. His company's work in converting agricultural waste into clean fuel is not just an innovative business model, it's a powerful tool in a fight to reduce carbon emissions and build a more sustainable world. Mr. Nirani, thank you so much for joining us today. And this is the apt time to talk about biofuels. It's Biofuel Day today, and we are talking about higher blending targets as well. First, before I talk about TrueAll's strategies, the future, let's talk about the industry as such. What have been the biggest tailwinds or bottlenecks for the biofuel industry in the last 2 years, 3 years, since the time we have seen that pick up?
First of all, thank you so much for having us, Sonal. So we're super excited to be here on such an important day. Biofuels is the heart of our whole business ethos. And biofuels is a magic fuel that can actually address multiple problems in one, and this is the one solution. So biofuels ranging from your ethanol, bio-CNG, or your green hydrogen, or methanol, or aviation fuel, all of these are opportunities that have been there in the surroundings since a very long time. It took us and our government more than 30-35 years to understand what Brazil and America have been doing. And the biggest tailwinds that they ended up giving us as a country to boost this sector was back in 2018 when we got the National Biofuel Policy.
Yeah.
And it was such a beautifully scripted policy where we got a program called EBP, ethanol blended with petrol. We got something called as SATAT, Sustainable Alternative Towards Affordable Transportation. Then we got all of these phenomenal programs that understood the potentials that we have as a country, which we largely are an agrarian economy, by converting the excess that we have into meaningful hydrocarbons or into meaningful fuels that could energize our day-to-day lives. So the whole purpose or the whole process of biofuels is converting your carbohydrates into hydrocarbons. That's the whole crux of it. And of course, the biggest tailwinds for us is, one, on the ethanol front, we were successful in achieving our 10-year goal of 2030 by as early as 2025. We are achieving it this year. And that's thanks to the very beautifully laid down policy of the EBP program. We had interest subvention scheme. We had an assured offtake guarantee. The sector was considered a priority sector. And various other nuances. This gave a huge boost for us to scale up and achieve our target by almost half the period that we had our target set on.
Yeah, and that is something that's been an ongoing conversation as well. I'll speak to you about that in greater detail. But let's talk about the commercial viability of a business like this. Do we have enough policies in place when it comes to procurement mechanisms? Is that enough to make biofuel something which is commercially viable as a business?
Let's see. So biofuels, by large, it's a whole universe in itself. Let's say when we speak of renewables, the nuances of a solar is completely different as against a wind and as against a hydro-based energy, because your plant load factor on solar is somewhere about 20-22. Your plant load factor on wind is about 40-42, let's say X, Y, or Z. Similar to the biofuel story, ethanol is only the first blip in the, or rather the first opportunity in this universe. Ethanol, the policies were phenomenal. I don't think the government could have done any better. In fact, they have touched or rather ticked off all the right markers. But since this is a new story for them, and it's just been 3 to 4 years for them to actually scale up this transition, there have been a few back and forths on the whole policy level. But of course, we should give that to the government, because they are also understanding the whole ecosystem of the country on the ethanol bit. So that's just the first bit, where we already scaled up to close to 1,400 crore liters of availability of ethanol in just 5 years. And that's because the policies were phenomenal. And we need to have a right check on the price of raw material as well as the price of finished good. So essentially, we will get to doing that. Now, the second vertical, again, is bio-CNG. That's a big opportunity. Government is giving multiple benefits like capital subsidy. There is assured offtakes. There is a support on the byproduct sale, meaning there's a subsidy there. There is an assurance on the lifting of the gas that we make. Even in terms of the evacuation of the gas in itself, we have got subsidies to lay down pipelines.
Okay. Yeah.
So the tailwinds are phenomenal for people to actually understand this process and scale up.
Got it.
That said, aviation fuel, sustainable aviation fuel is a phenomenal opportunity that we have as a country. Now, just imagine, so what excites me personally is this, that as a country like India, that is a net energy importer. We import close to 80-85% of our gross fuel. In the sustainable aviation fuel, we have the opportunity to be a gross exporter of fuel.
Okay.
We can export to countries like the GCC countries, let's say countries like Singapore, countries like Japan, who have less land mass, even in fact the European Union as well. So sustainable aviation fuel is a humongous opportunity for us to scale up.
Okay.
And again, green hydrogen is another story. All of these are phenomenal opportunities. So biofuels is not just ethanol.
Yes.
So ethanol is the first focus area that we've begun our story on.
Got it.
It's a whole universe in itself.
So ethanol is somewhere we have made a lot of progress. The other places are where we need to do a lot more.
Yes, absolutely.
Okay. So when you talk about us just starting when it comes to biofuels, or at least being there somewhere, how do we differ from markets like the Brazil or the US when it comes to biofuels? Are we ahead somewhere, or do we need to work on certain aspects of the biofuel industry?
I would definitely say that we are only 35 years late into the story. With that said, at least we are getting somewhere. But we have made up for the time lost by preponing our targets, by government giving us these special benefits. That said, see, all the advanced the economies like America, like most of the EU countries, most of Brazil for that matter, a very big factor is your economy by large depends on the price of the moment of crude.
Correct.
You are so vulnerable because you import close to 80% of your fuel. And you shouldn't be vulnerable to that extent. Your whole objective is to try and create an energy independence to the extent possible that you don't really get bothered as to what the price of the crude is at any given time. That said, see, if you have, we all take holidays and we go to places. Whenever we try to fill our cars, because most of the Indians in India, we don't drive our cars, or rather, we don't actually focus on what the dispensing guns offer. But overseas, you'll find 6 guns, 7 guns, the dispensing guns, right? Where you have options, E10, E15, E20, E80, E90. There are vehicles since 2005 onwards in Brazil, in America, called flex fuel vehicles, which can take different blends of ethanol. And these are opportunities that have been there since very long period ago. That said, also in the CBG story, on the CNG story, back in 2000s, you remember your cars had the option to run either on petrol or by switching, you can run it on CNG gas or LPG gas. These were opportunities that I don't know where they vanished. We could have been a energy, a self-sufficient economy early on in the economic life cycle of ours. But so for whatsoever reason, Brazil did it since 1985, America is doing it since 1990s onwards, Europe is doing it since 1990s onwards.
It's our time now.
And we just started in 2020, and I genuinely have to give a big kudos to the policymakers, especially this government, for thinking this through and getting us onto the at par.
So you know, when we are talking about E10, E20 being the options in countries abroad, we are at E20 right now. That means 20% ethanol is blended in the fuel. The big talking point recently has been what happens to the mileage, because that's something which consumers should be aware of. And ultimately, what happens to the parts which are being used? Are the current engines accommodating E20? What's your take on that?
So, to be honest, again, based on the reading materials, because I would not have a lot of understanding on the the structure of the MOC of the engines made currently. But the reading material definitely gives out that there will, and again, if you look at the energy content in petrol or energy content in ethanol, we have a higher burning ratio in ethanol compared to petrol. So if there is a higher burning ratio, the mileage has to drop because you burn cleaner and faster fuel. So the study says there will be a mileage drop of 3 to 4%. However, one, it is cleaner. Two, the cost of ethanol currently is 65 to 70 rupees a litre, reaching your fuel outlet. Whereas you're paying close to 100 rupees a litre for your petrol. Now, there is no harm, if you ask me, and this is my personal opinion, there definitely should be a pass-on of 3 to 4 rupees of margin to the consumer so that your gross mileage drop is compensated on it. And that would be the whole objective of biofuels. Why are we really doing it? We want the consumer to get a cheaper fuel option and a cleaner fuel option for his kids so that their kids can breathe cleaner airs. My take on this is, one, the father, that is the generation that we are now, shouldn't hurt his pockets. It should be cheaper for him as a fueling option. Two, he should be sustainable and caring for his kids next as to what kind of an atmosphere and environment he's leaving behind. So as long as we achieve all, or rather tick all these boxes, it is going to be the talking points. Again, I am very confident that this whole story of us overcoming the price parity and the mileage drop is, we are definitely going to overachieve. I mean, we are going to overcome on this.
That's the big ask from consumers as well. It's a cost-sensitive market. Who wouldn't like to pay lesser when we are blending ethanol as per
Just to add on to that is, see, if you consider when the renewable story came in, the solar and the wind, the government actually purchased power at 15 rupees and 16 rupees a unit. If not long ago, just 15 years ago, let's say 20 years ago. And because we paid that 15 rupees, 16 rupees back 20 years ago, when you had conventional power available at 6 rupees and 7 rupees a unit, you paid almost 3x of the price. Today you have power, wind on solar, the unit price at 2 rupees 80 paise and 3 rupees. And your conventional power has shot up to 6 and 7 rupees a unit. So that is the opportunity that we eventually need to get to in the biofuel story. See, there will be certain premiums in the beginning. There will be a little hiccups. And see, who likes change? We love status quo. And unless there is a little push and we go over that barrier of change or the trouble of change, we are not going to get to a better future.
That's right.
So that's exactly where we are now.
Just too much change happening, so maybe that kind of reaction is what we are getting. It's a very interesting conversation, but we have to get into a quick break. Come back and we'll discuss all about biofuels with Trualt Energy. Welcome back. You're still tuned into Climate Clock. It is Biofuels Day, and no better than Mr. Nirani of True Alt Bioenergy to talk about the industry and the opportunities here thereafter. We spoke about a lot in terms of how different markets are looking, how is the unit economics as well, and what happens when we blend ethanol in our fuel as well. But feedstock, that continues to remain a big challenge for the industry in general. How are you securing reliable raw materials, pricing it well, and ensuring that it scales up to the demand that we're seeing in the market as well?
So that's the one very big important aspect in this whole business. So feedstock becomes the crux of the story because energy demand is almost infinite, I would say, right? Yeah. There is not going to be enough. So there'll never be sort of a period where anybody is going to say, I have enough energy, right? There will be growth coming in. That said, when we speak of biofuels, there are two buckets of biofuels. One is your first generation, which comes from products like food grains or sugarcane juice or molasses, or anywhere there is sucrose content or where we have carbons and hydrogens, and that product has any further use case, right, in rice or maize or any of those products. And the second bucket is called the second generation biofuels. Correct. Here we have opportunities like municipal solid waste, which is absolute waste, agricultural residue, paddy straw, bagasse, or carbon capture from the industries. Right. These are the second bucket of fuels. When we speak of the first bucket, these have a higher cost of raw material, or rather they have a cost on raw material which varies at almost 20% delta on a year-on-year basis, rather in a calendar year basis. Meaning, let's take, for example, cost of maize. It begins at almost 18 rupees a kg to goes at as high as 26 rupees a kg, and the price trend is that large. Now, your objective is to try and procure your raw material at the cheapest available price. And again, even if you keep buying at the cheapest available price, there is a cap to how much you can produce from the first generation sources, which again, this is based on my understanding. We probably might max out at 2,400 to 2,500 crores of ethanol production in the first generation sources.
Got it.
However, your second generation sources, these have lower cost. These are actual waste that is available. In fact, instead of building landfills, or instead of having a illogical use of this feedstock, we convert them into meaningful second generation biofuels. Let's say a ton of agri waste, in our case bagasse, gives us 150 to 160 liters of ethanol. That means a ton of bagasse today costs 3,000 rupees. I'm just giving you brief numbers on a generic basis, and that. And 150 liters of yield at 3,000 rupees gives you a price of 18 to 20 rupees a liter of ethanol. That's the raw material price. Whereas your 1G sources go as high as 45 to 50 rupees a liter. And that is how, one, you keep increasing your availability of biofuels. And if we do the 2G way, Niti Aayog report says that we have close to 3,800 crores of additional potential to make ethanol or biofuels using 2G sources. Here we might do 2,000 to 2,400 or 2,500. Here close to 3,800 to 4,000 crore liters. That's close to 6,500 crore liters. You have a potential to scale up. And the fun part is your petrol consumption is 4,500 crore liters and your diesel consumption is 15,000 crore liters.
Right.
You can bring down the consumption of diesel by almost 1/3.
If you use the 2G way.
The right way. And if you go the 2G way, your cost also, like how Minister Gadkari ji keeps saying that we will see a day where the price will come down, and how we have seen the price of renewables coming down, there will come a time because your cost of raw material is coming down. So that is what we all are working for, and that is what we should put all our top gears to reaching there.
Got it. So raw material pricing, very important. Sourcing raw materials is the other big part of the entire value chain as well. You have a partnership with GAIL as well to set up CBG plants or compressed biogas plants. What is the status of that JV? Are you looking at tying up with more PSUs or private companies for that matter?
In fact, we are sitting on 2 joint ventures currently. One is with GAIL to set up close to 10 CBG plants of 12 tons each. So that's a big opportunity to scale up our CBG vertical. And second is a JV with a company called Sumitomo Corporation. It's a Japanese company, and I think I can share that out because it's public news already. And the Japanese, again, are very diligent in their, the due diligence that they do. And they really love this story. And now they want to increase their the exposure in the biofuel space. And we have got a second JV to do 5 plants of 20 TPD each. So put together, we are sitting on 2 JVs to scale up our bio-CNG space so that we can become one of the larger players in the bio-CNG vertical, along with being already one of the larger players in the ethanol space. And again, there are potentials that we are exploring. We are sitting on multiple MOUs to also set up one of the country's largest sustainable aviation fuel plant. That's a humongous opportunity for us. And that because we have close to 2 million liters of ethanol production capacity, we intend to sacrifice close to 500,000 metric liters of, or rather 500 KLPD of ethanol into making SAF. That gives us one of the largest SAF production plants in the days to come. So these are phenomenal opportunities that we get to partner with global giants, with young and very new companies like us, like TrueAlt.
So no, they definitely like what you're doing, and that's the reason these JVs are happening. So when we talk about you being a company which global corporations are also looking at, you have to make investments to ensure that you reach or meet that standard as well. So what are the kind of investments you're making in technologies to improve the yields of any product that's coming out, to reduce emissions and reduce costs as well?
So one, since these are all very new age businesses, let's say sustainable aviation fuel, and about a few years ago, even the CBG space, we all passed through that learning curve. And we're all perfecting, or rather getting to near perfection of the technology aspects or efficiency aspects. So 1G, we are as efficient as possible. And by diverting the raw byproduct like spent wash or spent lease into the CBG spaces, we are increasing the operating efficiency and increasing the cost, because you're making a byproduct which is a cost to us, converting that into a revenue by making methane out of it. So all these are moving pieces where technology will keep improving, will keep giving better yields, so that we can ensure that this fuel in the days to come, maybe in the next few years, will be much cheaper than your conventional fuel. Today you're paying a higher price because there is a lot of cost on technology build up and all of that. Like similar to your wind and solar.
Right.
A megawatt of solar used to cost you 8 crores, 10 crores, and today it costs you 3 crores. And it is much more efficient than back then. So we genuinely have to do capex in this space. Unless we do this, we are not going to see a better day. So all in all, there are companies doing fantastic work in the space. And if we do not, as a community, as a human species together, do or invest enough, we are not going to get to the levels where we see a better future, one, on your pockets, and two, on your atmosphere.
Oh yes, it is the need of the hour. No two ways about it. So when we are talking about us being self-sufficient, right, that's the need of the hour right now. We are importing around 80 to 85% of our energy needs. Say 5 to 6 years down the line, when we do achieve that self-sufficiency, will TrueAlt also explore some kind of exports? Are we looking at only domestic blending targets right now? And you spoke a lot about the 2G or second generation ethanol as well. Have we reached the targets that we had set internally there, or there's some more to go there?
So we currently don't have a pathway to getting to the 2G businesses just yet. So the government is still addressing the 1G demand crux. Once we get there, then we start focus on the 2G is what I believe they're thinking, right? Otherwise, they should have come out with a policy by now, and I believe they will very soon. That said, India has this phenomenal opportunity to becoming a net exporter of fuels from being an importer. We import close to 80-85% of our fuels, right? And we have this potential to become a gross exporter of energy when it comes to the biofuel space. Let's say to the countries like, for example, countries like Singapore, the GCC countries, Japan, let's say, the Arab countries, all of these places, they require a lot of biofuels so that they offset or they reach their ESG norms, ESG goals, which are very important. So for places like those, India has the potential to become an energy exporter from being an energy importer as on date. So we genuinely have to play our cards right, and energy is going to be a place where we succeed tremendously. And this is what we at TrueAlt and I personally believe.
Okay, so we can become a net exporter, and let's hope that happens sooner than later. But if we talk about more numbers, just to give perspective to our viewers as well, if there's any quantification of, say, carbon savings biofuels have delivered so far, when we talk about on a macro level or on true all bioenergy level as well, or something that you're projecting in terms of savings?
So I would not have a right number to give you, but we do have our BRSR reports that capture them. I don't remember the number correctly, but on a gross levels, right? So what essentially is biofuels? So, or rather, energy in itself is carbons and hydrogens in different forms. So carbons and hydrogens in different compound make petrol, in different form make diesel, in different form make methane, in different form make hydrogen, all of that, right? Now the concern is how you source your carbons. If you do fossil, it comes from ground below. If you do bio, it comes from ground above. So the carbon that is already there in the atmosphere is burnt and it is put back into the atmosphere. So we are a carbon neutral sort of a business. Now when we do 2G, we become a carbon negative sort of a business.
Got it.
Because you're asking the plants to consume more carbon than what we're actually emitting. Right? So that said, the potential that we have to become or rather have a cleaner or have that carbon benefits to the ecosystem by large in biofuels is phenomenally large.
Thank you so much for joining us today. It was such a pleasure understanding from you what biofuels are all about and True Alt Bioenergy's future plans when it comes to that fight against climate change, circular economy and biofuels as well. Thanks a lot for joining in today. But with that, we will take your leave on this edition of the Climate Clock. Do stay tuned for more news and updates.
Hello, welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a strong start to the week on the Lal Street. The Sensex up over 700 points. The Nifty reclaims 24,500. Midcaps rally in tandem with the blue chips. Inflows into equity mutual funds soar 81% in July, hitting a record high of 42,700 crores. New fund offerings mop up more than 30,000 crores. SIP inflows crossed 28,000 crores. Top government officials to brief the Parliamentary Committee on Foreign Affairs after US-India face a tariff war, the highest rate in the world of 50% being imposed on India. The Indian ambassador to the US attempts an outreach with Republicans as he speaks to Senator Lindsey Graham. All eyes on the Trump-Putin summit scheduled on the 15th of August. US and China yet to announce an extension of their tariff deadline as the fragile truce expires on the 12th of August. Beijing had struck an optimistic note on a potential extension. US officials say the ball is now in President Trump's court. In an unprecedented arrangement, semiconductor makers Nvidia and AMD agreed to pay the US government a portion of their revenues from China in exchange for export licenses. Both companies will pay the US government 15% of revenue from the sale of their artificial intelligence chips in China. RBI Governor Sanjay Malhotra says the decision lies with banks after ICICI Bank announces higher minimum balance requirement for new savings accounts but allows exemptions. The governor says that minimum balance is not under any regulatory domain and every bank has its own requirements. Sources tell us that less than 10% of the accounts across ICICI Bank's portfolio would be impacted by the move. Block deals continue on Dalal Street. Private equity giant Warburg exits Home First Finance, raking in 1,200 crore rupees. Promoters and PEs have sold shares worth $2 billion in the last 4 months. Onion exporters set to meet Commerce Minister Piyush Goyal after losing global clients following India's export ban, which was lifted in May last year. Exporters say China and Pakistan have increased their global market share while India's onion exports continue to decline. Lawmakers, including Rahul Gandhi, Akhilesh Yadav, detained as opposition party's leader marched to the Election Commission office to protest against the Bihar voter list revision drive. The police says the opposition did not have permission for a protest of this scale. The BJP calls the opposition's move a well-thought-out strategy to create a state of anarchy. 5 Al Jazeera staff among 7 killed in an Israeli strike on a tent housing journalists in Gaza. This includes 28-year-old journalist Anas al-Sharif, who had been reporting extensively on the war. Tel Aviv claims he worked for Hamas. Al Jazeera calls the killing of its journalists another blatant and premeditated attack on press freedom. The Supreme Court's orders of the rounding up of all stray dogs in the National Capital Region, moving them to shelters, calls the current situation grim and wants Delhi to be stray dog free, warns of contempt action against any individual or organization hindering the rounding up of dogs. Straight to the day's market action. Dalal Street started the week on a positive note led by PSU banks and defense stocks. The Nifty ended the day above the 24,500 mark. 44 stocks closing in the green today. 220 points higher there on the Nifty. The Sensex added 746 points, 505 higher on the Nifty Bank, and the Nifty Midcap index higher by almost 1% today. So broad-based buying that we saw in today. But the big story from the markets, investments into equity mutual funds surging by 82% to a record high of over 42,000 crore rupees for the month of July. The new fund offers collected over 30,000 crore rupees in the month. Mutual fund data also showed that investors continue to prefer mid and small caps over large caps. Surbhi standing by with the data. Surbhi, new record there as far as equity inflows are concerned. What's driving this?
The inflows for equity mutual funds have hit a record high, the highest ever level. The net equity inflow in this month of July has been 42,672 crores. That's a huge number, and it has overtaken the previous high, which was last year in Diwali around October, which was around 41,000 crores. So where has all this money coming from? New fund offerings. Over 30 NFOs, and all put together, they have pulled in over 30,400 crores. That's the might of these NFOs. So you'd wonder, what are these new funds? Well, they're across categories. There are lots of thematic funds that have pulled in the money. In fact, 9,000 crores has come in from thematic funds, the likes of HDFC Innovation Fund, ICICI Prudential Active Momentum Fund, and many others. Then there have been new launches in the mid-cap category, in the multi-cap category. For instance, Bajaj Finance launched their small-cap fund. Franklin India launched their multi-asset fund. And there have been others like the multi-asset allocation, category where Franklin launched a fund. So all of it put together has pulled in huge amounts of money. That's point number one. If you look at the next sort of interesting trend, it's investors' love for mid and small caps. And that really illustrates the point. Look at that. Small cap funds drawing in the highest ever inflows of nearly 6,500 crores. That, is huge in comparison to the 2,100 odd crores that large cap funds have garnered. So clearly the market's preference is towards SMIDs, at least the retail investors. Then let's talk about SIPs. Again, a very heartening figure coming through. The SIP trend is rock steady, and this is also a record high. Last month, June, the number was over 27,000 crores. This month, it's almost 28,500 crores. So even as the market has been sluggish, returns have been tough to come by, investors have been keeping the faith. Last but not the least, an interesting sort of perhaps example of how investors are also getting savvier. They're looking at diversification, asset allocation, which is why this category, which is known as the multi-asset category, this is pulling in more and more money almost on a consistent basis. And this time around, if you look at the multi-asset category, then it's garnered almost 6,200 crores, which is a record high for the multi-asset category as well. All put together, a fantastic month, a month of records when it comes to equity inflows coming into mutual funds.
All right, Surbhi, many thanks for joining us. So a record there for the equity markets. But from equities, let's head to the commodities. Oil prices continue to decline after dropping more than 4% last week. Optimism over a proposed meeting between the US President Trump and Russian President Putin, leading to a possible peace deal in the Russia-Ukraine conflict, that has driven prices low. There is, of course, no clarity yet on what that meeting will entail. The meeting scheduled between the two presidents has also weighed on gold prices. Safe haven demand also dented as investors wait for the U.S. inflation reading, as well as clarity from the Trump administration as far as tariffs on gold bars, etc. are concerned. Now, top government officials are set to brief the Parliamentary Committee on Foreign Affairs days after the U.S. hit India with 50% tariffs. President Trump has alleged that India was fueling Moscow's, and I quote, war machine by buying Russian oil. The Indian ambassador to the U.S., Vinay Quatra, has spoken to Republican Senator Lindsey Graham as the government attempts an outreach with lawmakers close to the White House. Parikshit is standing by now to explain where things currently stand. Parikshit, it's important that Vinay Quatra, the Indian ambassador to the US, is speaking to Lindsey Graham, because Lindsey Graham has been at the forefront of this business of tariffing countries who were purchasing Russian crude. So take us through where things currently stand.
Well, this is the second time that the Indian ambassador to the US has met Lindsey Graham. The last meeting happened on Friday. Why is it important? You're absolutely right. Lindsey Graham had called for 100% tariffs on countries like India and China, which purchase Russian oil. Now, India has been trying to explain, Lindsey Graham, that we have a strong energy partnership with the United States, which is only growing. While immediate details of the meetings between Ambassador Quatra and Lindsey Graham were not available, sources say this was about giving a perspective on how India-US energy trade is increasing. India now, at multiple levels, has conveyed to US officials that our oil trade, our oil imports from United States have gone up almost 70% between January and June, year on year. They're likely to go up even more. LNG purchases have doubled. So therefore, India's purchase of Russian oil has to be seen in the right spirit. We started buying Russian oil at a time when there were no sanctions. There are long-term contracts. And India will respect the energy partnership with the US, and this partnership is only going to grow further. So this is what we conveyed to the United States. Having said that, back home, there is an outreach happening with parliamentarians. Why is it important? Because the Foreign Secretary and the Commerce Secretary, two individuals which are really in the thick of negotiations with the US, back-channel talks, will be briefing parliamentarians. This is a confidential session on how India-US trade tensions are panning out, how these tariffs are going to impact India. And clearly, there is hope that there will be some breakthrough with negotiations that are happening right now till the 27th of August. It is also important to know the Indian government is pinning a lot of hopes and expectations from the 15th August meeting in Alaska between President Putin and President Trump. We have welcomed the statement openly through a Ministry of External Affairs statement, and we've said that the statement heralds the possibility and potential of peace in the region, which is everyone's wish. And the Prime Minister Modi, has always said this is not an era of war. So let's see what happens. This is going to be a very crucial week in terms of India-US ties, in terms of a breakthrough in negotiations, and possibly even having some sort of interim trade arrangement.
Yes, let's see what happens. And of course, remember, as per the previous conversations, the US officials were supposed to be in India, or are supposed to be in India, around the 25th of August. As of now, we are given to understand that that plan holds. But of course, our colleague Abhimanyu Sharma is tracking that story. Now, Tesla has opened its second showroom in India, this time in Aerocity in the capital. This has come right after the EV maker opened its first showroom in Mumbai. The Delhi showroom is equipped with 4 supercharging units. The Aerocity site will also function as an experience center where people can experience the product. The 90-day trade truce between the US and China ends tomorrow, and neither country have announced a formal extension yet. China had said that both sides will work towards extending the tariff truce by another 90 days after officials met in Sweden, which was last month. Now, US negotiators have put the ball in President Trump's court. There is no indication from him yet on whether he intends to extend that 90-day period or not. Some reports suggested that it will perhaps be extended, but there is no confirmation yet. Semiconductor makers Nvidia and AMD have agreed to pay the US government a portion of their revenues from China, this in exchange for export licenses. Both companies will pay the US government 15% of revenue from the sale of their artificial intelligence chips that take place to China. The unprecedented arrangement follows Nvidia CEO Jensen Huang's meeting with President Trump. Details of the arrangement and the financial structure still being worked out, is what we understand. Back home, RBI Governor Sanjay Malhotra said that banks can take their own decision on minimum balance for saving accounts. Now, this comes after ICICI Bank announced higher minimum balance requirements for new saving accounts with exemptions for salary accounts and pensioners. The governor said that minimum balance is not under any regulatory domain and every bank can arrive at one basis their own requirement. Take a look.
ये जो मिनिमम बैलेंस की जो बात है, जो मिनिमम बैलेंस का जो आप बात कर रहे हो, वो उसके अंदर में रिजर्व बैंक ने सभी बैंकों के ऊपर में छोड़ा है कि वो किस प्रकार का मिनिमम बैलेंस वो रखना चाहते हैं। तो अब किसी बैंक ने 10,000 रखा है, किसी ने 2,000, कईयों ने माफ भी किया हुआ है, लेकिन ये रेगुलेटरी domain mein nahi hai.
Well, that is the RBI governor saying banks are free to decide on the minimum balance. Now, sources tell CNBC TV18 that the number of accounts that would have to adhere to these minimum balance norms has been historically below 10% of the total accounts with the bank. So how will this impact ICICI Bank's customers? Ritu's here to explain who is exempt and how other banks compare. Ritu.
Well, this is a clear shift in strategy by ICICI Bank, moving away from mass customers to the relatively more affluent segment by steeply raising the minimum monthly average balance that is required for new savings accounts to the highest that we've seen across any bank in India. We're talking about a 5-fold increase in metro and urban areas to 50,000 rupees. And if this minimum sum is not maintained, there will be a penalty of 6% on the shortfall or 500 rupees, whichever is lower. Now, importantly, this change applies only to new accounts that are opened on or after the 1st of August. So existing customers do not get affected. And also, there are certain accounts which will be exempt from this. So, for instance, all the salary accounts, the pension accounts, basic savings bank deposit accounts, which are no-frill accounts mandated by RBI with a 1 lakh rupee cap on credit, and of course PM Jan Dhan Yojana accounts remain zero balance. Even customers that don't belong to any of these categories, they do have options to avoid keeping 50,000 rupees in their savings bank account. For instance, they could have FDs and RDs with the bank to meet the minimum requirement. Now, while the bank has not officially given any statement explaining the hike, there are various benefits such a move could bring. More stable deposits, improvement in CASA, higher balances at lower savings rates, or more, reduction in cost of funds, more premium cross-selling opportunities, just to name a few. Now, we've heard the RBI governor, ICICI Bank has not broken any rules, but the backlash on social media we've been seeing is understandable because 90% of India makes less than 25,000 rupees a month. And as Chair Kotak points out on X, a 50,000 rupee minimum balance means that 94% of Indians keep all of their monthly income with a bank at all times, or else they face penalties. Now, for perspective, other private banks like HDFC, Axis, Kotak, or Yes, they do require around 10,000 rupees minimum balance in urban areas. And then you have public sector banks like SBI, BOB, Canara, etc. that have a zero minimum balance requirement. So as a customer, you do have various options available, but it will be interesting to see if other private banks also follow suit.
Ritu, many thanks for joining us. Now, JSW Cement's 3,600 crore rupee IPO has been fully subscribed on the last day of bids. As of 4 p.m, the total subscription stood at over 7 times. The demand was led by qualified institutional buyers, whose portion was subscribed by nearly 15 times. Retail portion also fully subscribed, while the non-institutional investor portion was subscribed over 10 times. The block deal mania continues on the Lal Street. Private equity giant Warburg has exited Home First Finance, raking in 1,200 crore rupees. Promoters and PE have sold shares worth $2 billion in the last 4 months alone. Nimesh is here with all the numbers. Nimesh, block deals buzzing.
Well, Indian markets have seen clean-out trades worth $2 billion since the April of this year. When I mean clean-out trades, it's essentially the last blocks either from the promoters or from strategic investors. The first example is Home First Finance. We saw a large block today. Warburg Pincus sold its remaining 10.2% stake in a block deal, and they raised close to 1,250 crores. Again, in August of this year, we saw a big block in Eternal, where Ant Financial sold the remaining 2%, and they raised close to 5,650 crores. Again, in July, we saw a large block in Adani Wilmar, where the Adani Group sold nearly 10.2%. It was a clean-out trade, and they raised close to 3,700 crores. In June, we saw a big block in AB Fashion, where Flipkart sold the remaining 6.2% stake, and they raised close to 600 crores. In May, there was a large block in Paytm, where Ant Financial sold its entire 5.8% stake, and they raised close to 4,000 crores. And last but not the least, there was a large block in RBL Bank in April, and there British International sold its entire 3.2% stake, and they raised close to 430 crores. So cumulatively, as I said, $2 billion of clean-out trades have happened since the April of this year. And if investment bankers are to believe, the pipeline seems to be quite strong in the days and months to come.
Nimesh, many thanks. Block deals buzzing. Members of the Onion Exporters Association are set to meet Commerce Minister Piyush Goyal today. Exporters are seeking the government's intervention. They say they're losing global clients following India's export ban, which was lifted in May last year. Exporters say China and Pakistan have increased their global market share, while India's onion exports continue to decline. Santhya is standing by with the details. Santhya, take us through what the problem is and what onion exporters are asking for.
So, Shireen, it's been 2 years since the central government first imposed restrictions on onion exports, followed by a ban on exports. But onion exporters are still struggling to cope with the damage it caused. In August 2023, the government imposed a 40% export duty on onion to keep domestic prices in check. Later, in December 2023, a complete ban was imposed on onion exports. This ban was lifted only in May 2024, but the relief came with conditions such as a 40% export duty and a $550 minimum export price on onion. Now, onion exporters say that as the ban was imposed in December 2023, they were unable to renew their overseas contracts, which usually happens in December. They claim that they ended up losing a significant chunk of their global clientele to Pakistan and China, who were quick to fill the gap. As per CRISIL data, before the export restrictions, China's share in the global onion trade was 8% and Pakistan's was only 1%. But once the restrictions were imposed on Indian exporters, China's share in the global onion trade increased to 12 to 13% and Pakistan's share rose to 2 to 3%. As per Indian government data, in 2020-21, despite it being the COVID year, India exported over 15 lakh tons of onion. In 2022-23, it exported over 25 lakh tons. This dropped to slightly over 17 lakh tons in 2023-24 once the export restrictions kicked in. As per CRISIL data, this further dropped to just over 11 lakh tons in 2024-25. According to the Commerce Ministry, overall onion exports, including processed products like dried onion, witnessed a significant drop in the restriction year. Ministry data shows that in 2021-22, India's overall onion and onion product exports were worth $619 million. In 2022-23, they were worth $734 million, but in 2023-24, once the restrictions kicked in, the value dropped to only $180 million, and in 2024-25, it was $230 million. Exporters say the situation has worsened as Bangladesh has not started importing onion from India this season. They say that exports to Bangladesh usually began by the first or second week of June, but it's mid-August now and exports haven't started. They say that exports to Sri Lanka are also impacted, attributing this to increased domestic production in these countries. As per CRISIL, Bangladesh's onion cultivation has increased by 10% in FY25, and similarly, Sri Lanka's domestic production of red onion increased by 19% and of big onion by 9% in 2024-25. Both Bangladesh and Sri Lanka are important export destinations for India. According to CRISIL, 41% of India's overall onion exports go to Bangladesh and 14% to Sri Lanka. Indian onion exporters are requesting the government to keep all this in mind and support them. They are urging that the RoDTEP, that is remission of duties and taxes on export products rate on onion exports, be increased from 1.9% to 5%, at least until Bangladesh starts importing from India again. The current situation is affecting onion farmers as well. Exporters are buying less produce, and this, combined with bumper production, has led to a massive price decline. Shireen.
All right, Santya, many thanks for joining us. We will take a break, but when we return, the Supreme Court orders the rounding up of all stray dogs in the National Capital Region and says they need to be moved to shelters, calls the current situation grim and wants Delhi to be stray dog free. That and more when we return. The big national story, the leader of the opposition in the Lok Sabha, Rahul Gandhi, and other opposition leaders were detained briefly while protesting against the special intensive revision of electoral rolls in Bihar and the alleged electoral malpractice. The opposition lawmakers were leading a march from Parliament House to the Election Commission's headquarters. The members of Parliament were stopped by police during their march. Some MPs, including TMC's Mahua Moitra and Samajwadi Party's Akhilesh Yadav, were seen climbing the barricades. Others, including Congress President Mallikarjun Kharge, began a sit-in protest at the site. More than 30 MPs, including Congress Party's Priyanka Gandhi Vadra and Shiv Sena UBT leader Sanjay Raut, were detained but released 2 hours later. Police officials say lawmakers were detained as the Election Commission had only given permission to 30 MPs to enter its premises, but the protesters were in larger numbers.
एक्चुअली बात नहीं कर सकते हैं, रियलिटी ये है, क्योंकि सच्चाई देश के सामने है और ये जो लड़ाई है ये राजनीतिक नहीं है, ये कॉन्स्टिट्यूशन की लड़ाई है, कॉन्स्टिट्यूशन को बचाने की लड़ाई है, वन मैन वन वोट की लड़ाई है, इसीलिए हमें साफ प्योर वोटर लिस्ट चाहिए।
कांग्रेस पार्टी और अपोजिशन ने बहुत समय बर्बाद कर दिया है। अब हम देश का समय और पार्लियामेंट का समय को और बर्बाद होने नहीं देंगे। जब वो अपना नेता तय नहीं कर पाते हैं, प्रतिनिधि तय नहीं कर पाते हैं, फिर इलेक्शन कमीशन से टाइम मांगा क्यों है?
Well, the Supreme Court has issued directions to remove all stray dogs in the Delhi National Capital Region to shelters within 8 weeks. The court has ordered civic authorities in Delhi, Noida, Ghaziabad and Gurugram to build dog shelters immediately. It refused to hear any pleas by animal rights activists, saying that there was no room for sentiment. Ashmit is standing by with the details. Ashmit, take us through the court's order, the directions that the court has given. How is this implementable to say that all of Delhi's stray dogs, including in and around the National Capital Region, have to be removed and moved to shelters in 8 weeks? Does Delhi even have dog shelters?
Well, the numbers clearly not making sense at this point. PETA suggests there are over 10 lakh dogs as far as Delhi NCR is concerned. The Supreme Court for the first 6 to 8 weeks suggesting dog shelters for about 5,000 dogs. So those numbers are not stacking up. Is the Supreme Court suggesting that the Delhi government and the municipal authorities need to shelter and provide for over 10 lakh dogs? That appears to be the strategy that the Supreme Court was trying to go for in what was a sweeping order. The Supreme Court, in quite unnatural proceedings, refusing to hear anybody else other than the Delhi Government Council and the amicus, refusing to hear outright, saying that we will not hear any intervention applications. All the applications, intervention applications, will be dismissed. The Supreme Court saying that now is not the time for confusion. Now is not the time for sentiment. This is the time for action, and that it will not be shy of taking action. In fact, at one point also suggesting that the dog should be wound up, and that use of force is also something that has been permitted by the court in terms of rounding up of these dogs. So that's the broad direction that has come from the apex court. All the street dogs need to be rounded up by the municipal authorities. This is applicable for Delhi, Gurugram, as well as Noida. Further, the Supreme Court has directed for setting up of shelters. Not much clarity there. The number 5,000 came up by way of a submission that came from the amicus. The amicus said that this will be a progressive effort going forward. We'll need to progressively build more shelters. For now, let's give an initial target of 5,000. So that's what the apex court has given, 6 to 8 weeks, dog shelters for about 5,000 dogs. The Supreme Court also saying that there is no situation in which these dogs that have been rounded up can be released back on the roads, can be released back on the streets, and to that end saying that these dog shelters should have CCTV and that the Delhi government should go back to the court disclosing how many dogs have been rounded up on a daily basis. So again, sweeping directions this. One important caveat that the Supreme Court repeated 3 times as a part of its order, saying that while the municipal authorities have been given unfettered powers while they go about rounding dogs, any individual or organization found interfering with their efforts in terms of rounding up these stray dogs will meet the full force of the law, will be taken action against, will be liable to face contempt of court. That was repeated 3 times. So clearly, the Supreme Court not mincing words, expressing its intent, but the implementation of the order, many say, raises a number of questions.
Yes, Ashmit, appreciate you joining us, and we'll, of course, be taking this conversation forward right here on CNBC TV18. But with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Bollywood actor and wellness enthusiast Zareen Khan introduces Happy Hippie, a clean, conscious and easy-to-use skincare and hair care line created for those who seek simplicity without compromising on results. The products are gender-neutral, cruelty-free and made without harmful chemicals. Ranveer Singh bags Super U goes pro. At the heart of Super U Pro is biofermentation tech, now available in India. This technology makes the protein powders 100% vegan, gut-friendly and engineered for smoother absorption and superior digestibility. BizDataUp acquires 7.14% equity stake in RBH Solutions, a Tier 2-based industrial automation and smart grid innovator. Funds will be used to expand RBH's SaaS product suite, complete its distribution management system and build a global partner network. AI healthcare content creation platform Hameta expands services to UAE and US. To fund this global expansion, the company is also raising $2 million in its pre-seed funding round. Grass.ai bags $9 million in a pre-Series B round for agentic growth. The round was led by Tinman Capital with participation from Incred Wealth, Orzon and existing investors. Funds will support the launch of Agent Foundry to help e-commerce brands automate everyday tasks via agents. Well, those were the headlines we've been tracking for you this evening. On What's Brewing today, Pune-based Super Gaming has raised $15 million in Series B funding, taking its valuation to $100 million. Backed by global gaming giants like Bandai Namco, top VCs including Steadview Capital, and Web3 leaders such as Polygon Ventures, the studio is best known for its hit Indo-futuristic title, Indus Battle Royale. With over 200 billion installs across its portfolio and a powerful in-house tech stack, Super Gaming is now eyeing global markets and a bigger play in Web3. Joining us now to talk about the future roadmap at Super Gaming is its founder and CEO, Robbie John. Robbie, welcome to Startup Street. $100 million valuation and $15 million in fresh capital, with backing from gaming giants, Web3 players and returning investors. Robbie, first tell us, how will you deploy this capital? I understand global expansion, scaling development capabilities and hiring top-tier talent are key priorities. If you could elaborate.
Sure. Shruti, thanks for having us. Our round is about scale. A Series B is about scale. We've kind of built our games. We are now kind of taking them global, first to Latin America, where we see a large similar market to India, but growing and very, very passionate about video games. Then kind of taking our growth to the Middle East, which is probably the worst represented from a video games perspective. That's really a large market that we are serving. But more importantly, what this large round is going to allow us to do is to scale our development capabilities. We're already 150 people, but going to support taking our game global is really one large investment. And finally, talent, game design, engineering, scale, publishing, building this hyper-local publishing piece for our company is really what we're kind of focusing on.
All right. Robbie, with titles like Indus Battle Royale, you've got Mask Gun, Silly Royale and Battle Stars under your belt. Tell us, what's your strategy for balancing global appeal with hyper-local content? And if you could give us a sense of your current growth numbers, what kind of revenues are you clocking?
Sure. Our approach is global, but hyper-local always. We think that people who play on mobile devices really value that localization, bringing in that local flavor. That's kind of something that we brought in across all of our games. That's really the reason for our organic growth in these markets. $200 million without any kind of marketing, 200 million users without any kind of marketing spend is really something that we feel very good about. What our games have done is to really kind of tap into what we call the Indo-futuristic vibe that we've done with India, very inspired by what the movie Black Panther did with Afrofuturism. We're doing the same now with Latino futurism, Arab futurism, and that's really something that we kind of see as scale. From a numbers perspective, we obviously crossed 200 million users across our other titles. Indus is close to 10 million users. We're at a $5-7 million run rate, but we're seeing a 50% year-on-year growth across our games.
Okay, now all the games that you and I mentioned are built on your in-house super platform. You call it your most strategic asset. Tell us, how is it a game changer for developers in emerging markets, and how AI-assisted tools, monetization systems and social features built into super platform give you an edge over other back-end game tech providers?
So essentially, what we've kind of realized is that you need a competitive advantage over other people. Super Platform is that advantage. It's built over 10 years. It's an engine which kind of captures all of our understanding. It's built in partnership with Google Cloud. It's something that powers some of the biggest games in the world, including Bandai Namco's Pac-Man. Today, with AI-assisted tools, what we're kind of doing is, whether it's game balance, monetization, live ops, analytics, all powered by our AI engine, kind of helping us scale monetization, social features. What's the most important thing in emerging markets is really how do you optimize the game, both from a graphics and from a network perspective. Our AI engineering now is kind of allowing us to optimize this at a much larger scale, seeing what the device is and optimizing it on the fly so that we can run global quality games, but on local hardware. That's something we kind of see as the biggest advantage of Super Platform.
All right, and that's going to help you grow globally as well. You've been early movers in Web3 gaming, experimenting with titles like Tower Conquest, Metaverse Edition, and now integrating B3 Game Chain. What's the larger vision here, and how do you see Web3 fitting into mainstream gaming?
Sure. What we're seeing is this large explosion in Web3, not being called Web3, not being called crypto, not being called blockchain, but essentially being called on-chain. Similar to what you kind of see as the 90s, where we went online. That's really something where on-chain is hidden from everybody from a perspective, where true digital ownership can be provided to users without them even kind of having to go through all those loops. With all of Web3 kind of getting regulatory clearance, we kind of see this as a large opportunity in the coming year. Think of it as every good gaming company is 3 layers: the engine, the content, which is really your games, and finally the marketplace. Today, we see Web3 really powering that marketplace. In Pune, or if you're in from Maharashtra, we'll say it's the Satbara of our universe, like an RTO of our universe, which kind of tells you who owns what and can be anytime, anywhere.
All right, you've said India is moving from being just a gaming consumer to a driver of innovation. So tell us, what will it take for an Indian studio to truly become a global leader? Also, before we wrap up, tell us what's the next big leap for super gaming?
I think, everybody is kind of looking forward to what is called in China the Black Myth Wukong moment, the RRR moment. We saw Indian cinema kind of take its forefront worldwide. We want to see that in games as well. At Super Gaming, we're putting our head down to kind of focus on this opportunity. We're at David taking on Goliaths. Most of the great games that you kind of hear about are made in China. We want to kind of build that created in India brand and take it to all parts of the world and realize that AAA quality that people are looking for. It's a long journey, but it's something that we've kind of committed and kept our heads down on. Building that identity for all of our players where people can feel proud of a made in India game that they're playing is really something that we kind of truly care about. That we've kind of changed our economy from being a consumer economy to a creator economy.
Okay, well, on that note, it's time for me to wrap up our conversation. Many thanks, Robbie, for joining us on Startup Street, and wish you the very best for all your aggressive growth plans.
Thank you, Shruti. Thank you so much.
Moving on to our Investor Eye segment, Kettlebro VC is ramping up its bet on India's next wave of founder-led businesses. It has launched its second fund with a target corpus of 80 crore rupees, already locking in 35 crore rupees at first close. Fund 2 will deploy early-stage checks of $300,000 to $500,000 in about 10 high-conviction bets with extra capital reserved for follow-ons. Known for its last-straw founder strategy, backing entrepreneurs with over a decade of domain expertise, Kettlebro has already seen Fund 1 nearly double in just 3 years. The firm says it will continue to focus on capital-efficient, execution-first businesses across financial services, full-stack commerce and SaaS. Joining me now is Nisarg Shah, the founder of Kettlebro VC. Nisarg, welcome to Startup Street. The Fund 2 follows your last-straw founder thesis. First, tell us what this means, and then what's driving your conviction that this concentrated founder market fit approach works in India's current startup climate.
Thanks, Shruti, firstly, for having me. Adding up on what you mentioned about Lastro philosophy, we believe that India is a very unique and a different market from what China is or what US is or Europe is. And the playbook for India needs to be very much India-driven. We believe in business first, a revenue model first strategy. What it means is that we want to build businesses which are going to be existent a decade down the line. And we believe that for building this kind of businesses which are not going to have existential crises at any point of time, they need to be built by people who have seen businesses, who have seen cycles of businesses. For good long amount of time, near at least a decade, preferably 2 decades or
Sure.
more. So that's what it means, that think of a founding team, think of a entrepreneur who has spent a good 10, 15, 20 years in a particular domain, building up on its expertise and refining on that. And now they are just accumulating all of that experience into the last gig of their professional career. That's what we call as last straw moment, wherein they want to build it for legacies. For
All
business.
right.
Yeah.
Okay, now, like I mentioned earlier, you've hit 35 crore rupees in the first close. What's the timeline for getting to the 80 crore rupee target? And are you seeing more interest from domestic LPs or overseas backers? Also, you plan to invest in just about 10 companies from Fund 2. What gives you the confidence to keep the portfolio so concentrated in a market where most VCs spread their bets wider?
So, as you rightly mentioned, it's a very, very concentrated portfolio. And that comes from the fact that it's a very, very high conviction strategy and bets that we make. And consequently, we are able to do that because we exactly know the kind of plays that we are about to make. We are not an investor who is praying and praying and, investing in some things which may not work. This is a very, very thought through, strategy driven, play that we do, which allows us to take very, very high conviction bet. Our margin of error, we don't really need that a lot. Our companies don't really die a lot. While we are a seed stage investor, our mindset is very much like how a private equity guy would think about. We want to make money out of every money. So that's on the strategy and concentrated part. Regarding the closing, we anticipate closing on the full fundraise by the end of this year. We are having good momentum on it. We have added some more capital beyond the first close, and I think we will reach our target by in the next couple of months. That's regarding the investor base that you mentioned. This is majorly individuals, HNIs, family offices, some from India, some from Western geographies as well.
All right, picking up from what you just said, you're sector agnostic, but have a tilt towards Dhanda first businesses. Which sectors do you think will dominate your deal flow over the next 18 months?
We have realized retrospectively, looking at what we have done and what we like, there are majorly 3 bucketings where things fall into. Financial services, we are very, very strong in that. So think of NBFC companies, insurance companies, fintech infrastructure companies. That's a strong area for us. Second is full stack commerce, wherein we like to include consumer brands or retail plays necessarily. The point being wherein you have the full ownership on the customer as well as the vendor, and it's all delivered by yourself. And then lastly, the software plays, wherein we are seeing a lot of verticalized solutions, platform plays, agentic AI, which has been very, very active over the last couple of quarters because of the advent in the technologies. Majorly, these are the 3 sectors, 3 categories where we think majority of our money will go into.
All right, one final question. You expect the first set of exits soon. Given today's market, are you looking more at strategic M&A, secondary sales, or waiting for IPO windows to open?
Sure. So I think it's more driven on how the internal financial engineering works, in the sense of how much money per company we have. When the target is to go really, really long, we wait upon for near IPO, pre-IPO stages, wherein it is secondary sales, institutional sales. And whenever it is more about churning on the capital, again, it's a little bit of earlier exit, but we have realized that it's a mix of either M&A full exits or it's majorly sales to secondary new institutional investors.
All right, on that note, it's time for me to wrap up this conversation. Many thanks, Nisarg, for joining us on Startup Street, and wish you the very best with your fund too.
Thank you so much. Thank you.
On that note, it's time for us to head into a short break. But coming up, Make My Trip is betting on Gen AI to change the way you plan and book your holidays. A special conversation on the other side. Stay tuned. Welcome back to Startup Street. Make My Trip is betting on Gen AI to change the way you plan and book your holidays. The online travel company has rolled out a new multilingual voice-enabled trip planning assistant, promising to take you from one destination ideas to confirm bookings in a single conversation. The move comes alongside a big global push and a multi-billion-dollar share buyback. Aishwarya Anand brings you this special report from the launch. Take a look.
What if planning your next vacation was as simple as chatting with a friend? And what if that friend understood multiple languages, could tell you real-time prices in Indian rupees, and could take you from where should I go to booking confirmed, all without ever leaving the conversation? Well, that's exactly what Make My Trip is promising with its brand new avatar of Gen AI-powered trip assistant, Myra. It's voice-enabled, multilingual, and is supported by a complex web of AI agents who are working in the background to simplify the travel journey, from inspiration, itinerary to in-trip support.
One of the problems that we were trying to solve, which was not solved with the, let's say, erstwhile interface that we had, was to have a fully integrated trip planning. Right now we are doing it in Hindi and English. We want to bring in more regional languages as well. I believe that this will be able to penetrate into Deep Bharat.
Launched in beta, Myra has already been used by over 10,000 people. The company is gathering feedback to make conversations more relevant and personalized.
I think we've seen users of all types right now. We've seen some new users, we've seen some repeat users coming in and giving us very, very valuable feedback. Whether it is, sometimes it could be, I've given a particular context and I didn't hear the same kind of response because I was changing the context multiple times, and that is all about sort of collecting all the insights to meet the expectation eventually.
It's also built on multi-agent framework. Yeah. So help me understand how much of the tech was built in-house and, what kind of investment has gone into it?
Yeah, sure. All the e-commerce companies in India would be leveraging, the foundational models that have already been built. So the LLMs and and what we end up doing is customizing because we also have a lot of content. So we will do the customization bit in-house, and rest of all the development, whether it is the user interface, the design part of it, or making sure that we stitch together the integration part of it. And that is where agentic framework was very, very helpful.
Make My Trip has also launched a global tours and attractions platform with over 2 lakh activities in 1,100 cities across 130 countries, all priced in Indian rupees. Soon, Myra will be able to generate itineraries, show content, and let users book flights, hotels, and tours directly in one conversation. In the first quarter of FY26, you've shown a solid 22.6% year-on-year rise in your net profit, despite travel disruptions that we have seen. So what's driving this kind of resilience? What segments are driving this kind of growth for you?
It was a tough quarter because it was disruption, because, the many events happened back to back, unfortunately. Over the last several quarters and years, we've been declaring and delivering consistent performance. Not necessarily on top line, but also the bottom line, right? You're able to have tighter grip on the P&L, because even during the tough quarter, if you will, right? So it's all about operating rhythm, and that's what played out.
The company has also raised over $2.6 billion through equity and convertible notes to repurchase a stake from Trip.com Group.
It was a pure sort of financial restructuring transaction for us. And there was a market opportunity, there was liquidity in the market, and we just encashed that opportunity. And that's about it, right? So, hopefully it just be very good for the organization going forward.
From AI-led trip planning in Hindi to booking Tokyo attractions in rupees, and from global expansion to strategic financial moves, Make My Trip is betting on technology and scale to shape the future of Indian travel. For now, AI's biggest impact is on productivity gains, especially in customer service. With camera person Lakshman Singh, Aishwarya Anand in New Delhi.
Also on our checking in segment, SAP Labs bets big on India with a €194 million innovation campus in Bengaluru, even as much of the tech industry turns cautious. Sindhu Gangadharan, Managing Director of SAP Labs India, told CNBC TV18 the move aims to underscore India's role as a core driver of SAP's global product strategy. She said the future workforce must combine strong problem-solving abilities with adaptability as technologies evolve at breakneck speed. Beyond core technical know-how, learnability and design thinking will be key to staying relevant in an AI-driven economy. Take a look.
First of all, great to be talking to CNBC today, and especially on this milestone of a day for us. Inauguration of our brand new SAP Labs India Innovation Park here. And I think this is an absolute testimony to our belief in what India represents, be it talent, be it the kind of transformation, be it the belief in terms of how we have evolved over the last 27 years of our presence here in India, right? And today for us, India is not just one of our fastest growing market regions, it's also the country where you have the full breadth of our product portfolio in one location. And if you ask me, Meghna, this becomes a very unique combination also in the way we build our innovations, but also in the way we take these innovations to our customers, co-create solutions for them. So this innovation campus that you're seeing here is, again, that belief system that we have had in India and continues to have in India. So this is a, €194 million investment that you see here, and which is an absolute clarity in terms of our strategy of the fact that we want to continue to see this location and benefit and also give back to this location.
At a time when tech firms are turning cautious, what's the strategic thinking behind SAP's new 15,000 campus in Bangalore?
Yeah, I think as a product company, Meghna, and if I just put some numbers out there, today 87% of the world's business transactions touches an SAP system, right? 99 out of the top 100 companies in the world are SAP's customers, right? 97 of the top 100 green companies in the world run on SAP. Or if I take the India context, 8 out of 10 cars on Indian roads are manufactured by SAP's customers. So what I'm trying to tell you is, when you're talking about core business processes, right? When you look at any process, be it in your core financials, core supply chain, core manufacturing, core of sourcing, procurement, these are core business processes that in today's world where things are changing at this pace with all the geopolitical aspects that's going on around us, every business needs to be on top of. And this is where SAP helps them give that visibility, give that transparency, get that intelligence into their business, take those actions at the right time, make those pivots at the right time. Because every customer needs that visibility in order for them to stay successful. And this is where SAP helps them, right?
How many roles is SAP planning to add in India over the next 2 to 3 years? And what are the skill sets that you will prioritize?
I think, skill sets, when we talk about skill sets, especially in these times, right? Technologies are changing at such a pace. So at the core of it, I think learnability is a very important skill, right? And also thinking of aspects like problem solving. How do you approach a problem, right? Aspects like design thinking. These are aspects which for us, we play a huge emphasis on. Of course, we have various programs where we collaborate with some of the leading universities here in India, but also across the world, to really make sure that our talent is always on top of the latest and greatest. Because and when you're talking about talent being on the latest and greatest, is also about not just about learning about technologies, but also how you apply those technologies to real-life business problems, right?
The big news in the Indian IT is about the massive layoffs announced by TCS, which it said was due to skills mismatch and also large-scale deployment of AI and so on. Even NASSCOM in its statement has said that in the near term, we could see some workforce rationalization as the traditional skill sets are re-evaluated. To what extent could jobs be impacted as this shift takes place?
I think what is important to understand is really going back to the core of, as you come out of universities, how do you make sure that what you have learned can be applied in real life, right? So this is why, as NASSCOM, we're putting a very strong emphasis on this deeper and much more strategic collaboration between the academia and the corporates and the government. Because very early on interventions on understanding deep domains, on where technologies like AI or in the future quantum can be applied, is more relevant than just coming out with core technology skills. And this is going back to the point on realignment, repurposing roles, and it goes down to also making sure that people have the right kind of attitude plus skills before they get into problem solving, right?
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening: Indian and Brazilian officials confirmed yesterday that Brazilian President Lula da Silva called Prime Minister Modi yesterday. The Indian government said that the two leaders exchanged views on regional and global issues of mutual interest. However, President Lula said in a social media post that the hour-long phone call focused on the imposition of unilateral tariffs. Lula also said that the leaders reaffirmed the importance of defending multilateralism and the need to address the challenges of the current situation. This comes after Brazilian President Lula da Silva said that he saw no room for direct talks with Trump as US tariffs and 50% on Brazilian exports took effect. In an interview from his presidential residence in Brasilia, he said, and I quote, "My intuition says that Trump does not want to talk and I'm not going to humiliate myself." The leader also said that Brazil is not about to announce reciprocal tariffs. US President Donald Trump has hit Brazil and India with the highest tariff levies among the BRICS nations at 50% each. Furthermore, President Donald Trump has said that there will be no trade negotiations with India until the dispute over tariffs is resolved. His remarks come days after Washington escalated the rhetoric against India, imposing 25% additional tariffs over the already prevalent 25% for buying Russian oil. We're told Shashi Tharoor, Congress MP and chairperson of the Parliamentary Committee on Foreign Affairs, is with us right now. Mr. Tharoor, thank you so much for joining us on the program. Let me begin by asking you, 50% tariffs seems imminent imminent right now. Do you think India will be able to come up with some sort of negotiated solution in the next 20 days?
Well, that's precisely what we have to trust our negotiators to do, Parikshit, because the truth of the matter is that's going to be an impossible position to find ourselves in. But there's something terribly unjust and unfair about this entire proceeding at the moment, because, as you know, on the 27th of August, if we have 50% on our goods, the Chinese, who are buying far more Russian oil and gas than we are, and trading on a larger number of other items besides, will only have 30%. So what happened to the great strategic partnership with India? What happened to their alleged competition with China? It seems very, very bizarre that the Americans are in the process of jettisoning a relationship they've spent a quarter of a century cultivating and building up for apparently some very petty short-term gains. I don't understand it. But our negotiators should definitely go in a spirit of saying where we can make reasonable concessions, we will, but we will not be dictated to. There has to be give and take on both sides. And certainly we're not going to accept a situation where it's, you take it or leave it, it's my way or the highway kind of thing coming from Washington. If that happens, I think we'll take the highway. And we should.
Right. You know, when it comes to having some sort of options in the diplomatic toolkit, now this is a very old relationship that we've invested in over the past 2 decades, Mr. Tharoor. Is it really possible for India to let this relationship go down as a result of a trade deal going sour?
But listen,
Parikshit, it's not us who've done this, right? I mean, the entire sourness in the relationship has come from the extremely insulting language of a highly transactional negotiator. Now, if this had been conducted differently, it might have been a different story. But the way in which this thing has been done, the way in which the gentleman has spoken of us, a sovereign, self-respecting country, becomes very difficult for any Indian political leadership to swallow, number one. Number two, you can't have a relationship which one side values more than the other does. If America values us so little that they're prepared to throw us overboard so quickly over relatively trivial amounts for an economy the size of America's, then I'm afraid we may have been wrong in assuming our relationship was that important to them. Whereas previous American presidents have made it very clear that they valued India in India's own right as a significant presence in this part of the world, as an alternative pole to the Chinese, as a democratic ally with shared interests, no particular strategic lack of convergence, a population, I think almost 4 million Americans are of Indian descent. We had so much in common, and of course the shared values rhetoric as well. All of that kept us going as partners. Now, if all of this can be tossed aside with this kind of somewhat demeaning and belittling language by the American president, then we do also have to ask ourselves, what was all this worth? I'm still hoping that it's purely just a negotiating tactic and that the real work that's happening between the actual professionals, the negotiators from our Commerce Ministry, the negotiators from the American Trade Negotiators Office, that they are talking in a much more practical and constructive way, and they're getting things moving. And Mr. Trump's rhetoric was just sort of the accompanying soundtrack in order to put some pressure on the negotiation. That could well be it. Mr. Trump is fairly famous for having a very idiosyncratic negotiating style. And I think it may just be that. Let's not overreact. I'm always in favor of keeping a fairly cool head on these matters. But come 27th of August, if we are at 50%, let me be very clear, the bottom is going to drop out of a lot of our exports in the American market. No one is going to buy items from us at 50% tariff when even China is 30%. Our competitors like Vietnam, Indonesia, Pakistan and Bangladesh even are between 19 and 15%. Why would anyone buy anything from us at 50% premium? It's simply not. Even 25, the original tariff imposed upon us, puts the onus on us to somehow make up that 6 to 10% differential with our competitors. With 50%, we're out of the game. We're not even in the race. So we have to understand that in those circumstances, we have no choice but to look for other markets, to look for other outlets. And there will be creative things happening. I mean, I wouldn't be at all surprised if there aren't some smart Indians in the UK where we now have an arrangement with the FTA where 99% of our goods are going without any tariffs to the UK, who will figure out a way of importing all the things from India that America used to buy, repackaging them as made in UK and reshipping them to America for a tidy profit. Anything like that could happen, who knows? But I mean, that's unfortunate for both Americans and Indians, but that seems to be where we might be heading if we don't manage to pull off a decent negotiation in the next 3 weeks.
Right. Mr. Tharoor, you spent a lot of time in the United States, in Washington, D.C., meeting think tanks, meeting members of the diaspora and the U.S. government. What do you think has gone wrong in the India-U.S. relationship? It's clearly not just about Russian oil.
Well, when I was there was no inkling of any such negativism. On the contrary, we found tremendous receptivity, tremendous support. I met, God knows, 50, 60 people, top influential people in Washington, not just think tanks and media, but also, frankly, a large number of senators and congressmen from both political parties, the Deputy Secretary of State and the entire establishment in the State Department, the kind of reception we got, and then Mr. Vice President Vance himself, totally positive, totally supportive, very keen on strengthening relations with India across the board, very keen on the success of the trade talks, very keen on cooperation in technology and artificial intelligence. I came back thinking this relationship was in great shape. So I am utterly stunned that the president seems so out of sync with what everybody else we met was conveying to us. It's true that I wasn't there to do trade negotiations. I was there to talk about Operation Sindoor and our political relationship. But the number of conversations I had, they couldn't all have been in the direction of positive relationship with India when the president apparently is alone on a completely different track. I don't get it.
Right. What do you think can be done now? If I ask you to put on the hat of a diplomat and someone who is a seasoned politician over decades, what can be done right now? Here you have a president who is trying to put pressure on Russia and wants India to stop purchase of Russian oil because he thinks that will hurt the Russian economy. What can India really do? How do we balance out trade relations and also a strategic partnership with Russia? Can we afford to cut off oil purchases from Russia altogether?
Look, that depends on market conditions. And if the differential is significant, we won't cut it off. I mean, we have every reason to look after the interests of Indians who need energy. I mean, it's as simple as that. We have said we'll always act in our national interest. If there is a continuing differential between the world market price that anybody else will sell oil to us and the price at which the Russians are selling to us, why shouldn't we buy Russian oil? I'm sorry to say, until and unless there are sort of United Nations approved global sanctions, we are not obliged to accept any country unilaterally dictating to us who we can and cannot buy from. The same, by the way, applies to the others. The Chinese are buying far more than us. If the Americans don't have the guts to sanction the Chinese but will sanction us, then I think we have to draw our conclusions from that. Look, our self-respect matters, Parikshit. After 200 years of colonialism, we are not a country that can be talked to this way, taken for granted or pushed around. We will stand up because we have convictions, and what is more, any Indian government would have stood up to this kind of pushing around. So I will say to you, I hope our negotiators go with courage and clarity, with a good sense of where we can make concessions. Remember, we made very sensible concessions in the first Trump term when he made this big fuss about Harley-Davidson motorbikes. It didn't hurt us at all. Instead of selling 83 Harley-Davidsons a year to India, they now sell about 280 or whatever. It didn't affect anything because the reduction of